to the stratospheric heights of just over $800. Well, by current gold standards, that's not stratospheric at all. But certainly in relation to what it had been, it was. And they were very, very volatile times. Now, back then, of course, I knew very little about trading, but the die was cast, and I over the years managed to lose all of my gold gains, as you do, and therein started an education in how to trade successfully. And I mean, certainly over the years there have been quite a few knocks along the way. There have been some very, very good years, and it's really once I'd managed to get out of my system the need to sit at screens all day and feel that I had to trade. You know, if I call myself a full-time trader, there's a tendency that one feels that one should be trading all the time, as you would do just in a conventional job. You know, conventional job, you've got to work harder, you've got to work longer hours, you've got to be, you know, clever at doing stuff. But it's you're always trading hours. You're always trading hours for your dollars or your pounds or whatever your wage is. It was only really when I sort of looked back on trading accounts and took a long, hard look at what I was doing that I then sort of shifted my focus from frenetic intraday trading to calming right down, and that brought about my breakfast trading, which I still do, and that's my intraday trading these days. When I don't trade every single day, but when I do, I trade at the most volatile time of day, which is the morning. And you know, I recommend anyone who is wanting to intraday trade and can intraday trade, quite often you want to just forget about the middle of the day and just trade the ends of the day. The mornings and the evenings can be quite lucrative, and it will also keep you sane. Because I've known people burn out. In fact, there was a guy I distinctly remember when way back when I had a proper job, and he was a currency trader, and this guy, he was 32. He was 32. We actually took him on. We employed the guy in the education world at the time. He was 32, and this guy, he looked 62, and he'd just burned out effectively. He had been an extremely successful prop trader for a bank, household name bank, but it just proved far too much for him. And I've known a good many people that have come to me for coaching, and I've had sort of similar degrees of burnout, where people have just, you know, they've just worked at it so hard, trying to trade every little twist and turn in the market, and their accounts have shown that they're just losing money. And the majority do lose money in the business, and that's one of those regrettable facts that I think so many of us, certainly in the early stages, get sucked into the idea that you're going to be on easy street by just putting a bunch of trades on, and all of a sudden you're going to be trading from a sandy beach somewhere in the Seychelles, and everything will be wonderful. The reality is, though, that trading, to get into trading, to get started and to get a real foothold, which means that the foothold is that you're becoming profitable, it's like any profession that you might want to break into that you haven't been in before. So if I wanted to become a veterinary surgeon, for instance, and veterinary surgeons do make good money, very good money, but they're going to be training for a minimum, an absolute minimum of 6 to 8 years before they're going to be qualified. If I decided I was going to become a barrister, as indeed a friend of mine did some years ago, she decided that the time was right, kids were off her hands, wanted to become a barrister. She has become a barrister, but my goodness me, it has taken her so long. So eventually she got there. And it's the same with trading. The successful traders I speak to have had to put in the hours. And there was a very interesting book some years ago that talked about the amount of time that has to be put in to become really extra competent, super competent at whatever it is that you're doing. And they came up with this figure of 10,000 hours. And certainly in my experience, that is absolutely right. You've just got to put in the time to learn your craft. So yeah, you know, that's where the hard work comes in. But then once you've understood everything that you possibly can about the markets and how they actually work, then you drop into competent trader mode. And competent traders will trade possibly a relatively narrow way in which they do it. They find something that works for them. We're all different. We've all got a personality. Some of us, you know, might be slow and steady. Others of us will be exactly the reverse. We need action. We need to be doing stuff all the time. In fact, I tend to be one of those people. And we then will find something that works for us, and they just stick at it and do the same thing over and over and over again. So my message to you is that when you get to the point when you can do the same thing over and over again, and it becomes almost boring, then you've probably cracked it. And the other thing which will tell you when you've cracked it is your trading account. It's dead simple. It's dead simple. If you're going from sort of loss to loss, having to put money into a trading account again and again and again every few months or so, you clearly haven't got there yet. But once you've got to the point where you can get a string of months, and I say to people, you want to have 3 to 4 months, when you can have 3 to 4 consecutive months where overall you've done a whole bunch of trades, but you've actually made money in at least 3 of those 4 months, then you're pretty close. You're pretty damn close to being able to make a good living out of this business. Anyway, there we are. That's that's my preamble. Now, guys, we're going to be looking at charts. Well, I'm not going to show you a whole bunch of slides. We're going to be looking at some real charts, and what I'm going to be talking about, as you can imagine, is most definitely not intraday trading, because intraday trading, yeah, you know, it can be profitable, and as I just said, I do my sort of morning breakfast trading, and that's absolutely great. But what really brings home the bacon for me is longer term swing trading. And by longer term, I'm meaning trades that will last for sometimes just, say, a few days, but sometimes they will last for months. And that's where the big money is made. And because it lasts for a series of days or a series of months, I don't have to watch the screens all day at all. In fact, these days I just look at the screens in the morning and I look again in the evening. During the day, what do? I go and do something completely and utterly different. So let's get to it. Now, as we go through, do please make some notes. Don't hesitate to ask me questions as we go through, and you know, do challenge me on matters. You're going to see a series of charts that I've got set up in what I've now come round to decide is probably the best little trading and charting platform out there, and that's MetaTrader MT4. Widely available from certainly most Forex brokers use it, and some stock traders, some stock brokers do also offer the same. So here we are. This is a very straightforward set of charts, and as you can see, we've got some stock charts, some stock index charts over here on the right, over here on the left, I've got the odd commodity, got the dollar index, got silver, got gold. And we're going to be looking at a whole lot of currency charts, because this is where I find that most of the liquidity is right now. I'm very, very wary of individual stocks at the moment. You know, they will have their time again. But as we can see with the S&P, it's just been going up and up and up. And, you know, I think we all know the reasons for it. It's the massive amounts of liquidity that the ongoing saga of QE has pushed into the market. And I think we're getting closer now, not quite at the end, but we are getting closer to the end game. And the end game is going to be a big ruction in the bond market, and consequently we are going to find that stock markets are going to have a really difficult time. We're not quite there yet. But the signs are pointing in that direction. So let's just look at, first of all, we're going to take a little look at the dollar index. Now, the dollar index, these are daily candles. We've seen this move on up, and in fact, if I run right the way out to the weekly and then the monthly chart, what we can see is that we've had a very, very strong dollar. But over now, we're getting on for 18 months, the dollar has really gone nowhere. It's just been popping up, popping down, popping up, popping down. And if ever there was a trading range, this is it. And those who look at classical chart patterns will just see that this is a head and shoulders, and it's possibly waiting to collapse. We just do not know at the moment. But without a doubt, the dollar is the only Western currency where there have been interest rates that seem to be perhaps about to rise. Exactly the opposite. It's just happened in the UK with Carney reducing rates. We're finding it's happening in Australia, New Zealand, and of course Europe. They've got no intention at all of raising rates. So there's no sort of wonder why there shouldn't be a degree of strength in this dollar index, but it's not that strong, as you can see. But we're at another important level. Got a red line here. That's my line in the sand. If it breaks down below this 94 level, then it's highly, highly likely we are going to see much deeper tumbles. And the big but is that we are in a US election year, as we all know. You know, is it going to be Trump? Is it going to be Hillary going to be getting in? But what is a feature of pretty well every, statistically, it tells us that in an election year, stock markets are not going to crash. The dollar is not going to crash either. So it will be massaged to make sure it does not collapse on down. So what are we going to trade? Well, let's just look first of all at crude oil. We've got WTI crude, which is the American contract, light sweet crude they call it, and this one trends like crazy. And of course we've seen the big tumble that we had, but since then, that's on the monthly chart, so we come right the way back down to the daily, we've had some tremendous runs, very clearly signaled by the software that we use, which is just a combination of, we've got a broad definition of trend, which is this activity index that we use. It's volume based. So when the histogram is below the red zero line, then we're in a downtrend. This is one of the simplest definitions of trend that I've seen. It's something that we've developed. I've developed it with the programmers, and it's so simple that anyone can see at a glance what the trend is doing. Previously we had an uptrend because it's above the line, then it drops predominantly below the line, it's in a downtrend, and then it pops up again. Simple as that. And we link that to another neat little momentum line, if you like. We call it the swing trend. And the momentum line gives us what is going on with day-to-day momentum. So what we do is that where we get a rally, as we did from this low, we get a little bit of a pullback, as inevitably we always do, and price then took off. And this little rally, you can see where we entered, you can see where we closed, just based on what is going on with these indicators. The activity index is up. It's an uptrend. And the swing trend is moving in the right direction. Price action just confirms it. And it runs for almost 400 pips until this little rally, for the moment, has come to an end. Where's it going to go from here? I haven't a clue. And that brings me to another thing that I find, that when I'm over the years, I've coached dozens of people, well, hundreds, and again, people feel when they're starting out in trading, they feel that they have to know what is going on with any market at any one time, and if they don't, they're really, really, really uncomfortable. Well, there are so many times I just look at a market, I haven't got a clue. And when I'm big enough to say that to myself, if I haven't got a clue, I'm not going to trade it. I'm not going to go anywhere near it. It has to show the signs to me that it is ready to move, and it is moving. Simple as that. And WTI, the oil market, is one of those that showed itself very, very clearly. A little bit of price action there. Those of you who know your candles will know what this little candle is, and I'll leave that to you guys, see if you can answer that question. Right at the top there, we had this candle this day. It opened higher, it went higher, it went lower also, but it closed higher. It's actually, if you take that in pure isolation, it is a hammer. But if we put it in relation to the preceding candle, where there is a gap, it gapped up, and then we get price deciding that it's going to run on down, that is a classic candle pattern. So I'm going to leave that question with you guys. If you can wallop that one back to me. We'll got no prizes in this one, but see if you can let me know what that one is. Right. So let's go and look now at some currencies.
George.
Yeah.
We have a very high level of trading on the line today. Evening stars, shooting stars, spinning tops. These are all the answers that are coming in.
Excellent, excellent. All you guys go to the top of class. Yeah, it's an evening star. It's an evening star, and where you get that little candle, it's like an exhaustion sort of gap. It's the last gasp of a trend. So very, very, very often. So yeah. Full marks to everybody. That's really good. That's really good.
Well done, Ripple. You were the first there.
Excellent, excellent. Now I'll just apologise. You might hear a little bit of noise in the background. I think this happened actually last time we were on, or the time before, when I had some work done here at the house, and we're having sort of the driveway sorted and this, that, and the other, and they've decided to come in with a vibro roller this morning. So the house is shaking ever so slightly every now and again. Right.
It's not coming through at this end, so it's absolutely fine. Thank you.
Okay. Let's just look at two quite important charts to people in the UK. First of all, the British pound, cable, pound against the dollar. And we know what this is all about. We know what that big move on down is, and I don't think anybody out there will be at all puzzled as to why we got this move down. So we got this move down. We then had another move down towards the low, and all of this coincided with our wonderful central banker, and I might add our wonderful Canadian central banker, who flew in to take charge of the UK economy a couple of years ago, and he decided in his wisdom that because of Brexit and so on, he just had to reduce interest rates somewhat lower than they were already. And what did the market do? Well, sort of in anticipation, it made a nice little sell-off, but then we start to get some really positive news coming out about the UK economy, some of it post-Brexit, and consequently we get a rally. And this little pattern is something that we look at from time to time. It's called a bat pattern, and essentially we just have a low, and then we have a higher low. And it's as simple as that. It's part and parcel of a multi-point reversal without just getting more complicated. But the simple fact is it's a higher low, and that told us that there was going to be a rally, and we've had a real good rally so far. Now, how much further it's going to go, I really don't know. But notice my two indicators here. I've got the histogram on the activity index. It turns blue, and that's telling us that price is now starting to perk up. It then went above the 0 line, and our swing trend is pointing up, and that has been worth well, quite a few hundred pips so far. And it's dead simple, and we do not need to do any screen watching to see it all going on. Let's go and look at the euro. Now the euro, this is a daily chart. I'm going to run this out to the monthly first of all. Look at this, the euro. We've got this move down, move up, move down. It's an ABC pattern. It's an ABC pattern where we get a move down is the A, then we get the B, and then we get the C, which is very often the same length as A. And these C legs can be, C legs, forgive the pun, can be some amazing moves to actually get on. And it just was producing the pips over and over again. We're now into a trading range. The weekly chart is actually showing this fairly wide trading range, plenty of pips in the range, and the daily chart is actually giving us the opportunities. And again, using the software, look at this. We've got price moving down, activity index is below the red line, so it's a downtrend. It then perks up, goes above the 0 line, so we're now into an up move. And then our little momentum indicator is getting us in at the right places. Price action is confirming it. We've got a classic engulfing day there, an engulfing candle. What an amazing candle that is. And we get a nice little run of 129 pips. Now this took place over a few days, and once we've got this thing running, we set our stops. We set our stops so that we're going to lose just a minimal amount if it comes back on the day, but then once it takes off, our stops come up to break even, so we cannot lose. And away it went for a nice little 129 pips. Now we can see that it was in an uptrend, so we didn't want to go and sell it. We wanted to wait for the next opportunity, and sure enough, it came. This is another one of these engulfing candle days, and away we went with a nice little entry that ran us on up, and then price decided that it was not going to go any higher for the moment. It then ducked on back down, and we said, well, thank you very much. So that gave us recently two very nice little profits. I'm now going to put those two charts, the euro and the British pound, together, and what do we get? We get the euro GBP. Now the euro GBP is a real interesting one, in that on this most recent run up, you can see that we've got a very, very clear move on the upside. We've got the activity index above the 0 line, so uptrending. The green line is green, and price action is confirming day after day, higher, higher, higher. So we just run the trend. And all we've got to do is to look at this once a day, once a day. And it's a very happy feeling to be able to look at this once a day and say, oh, right, price has gone up. I will move my stop profit level to give me more guaranteed profit. And you do it once a day. Eventually, of course, it turns the corner and we say, right, okay, enough's enough. We'll take all of our profits now. And what are we going to do next? Well, we're looking at this and thinking, yeah, there's all sorts of reasons why we might want to have a top at this level. And we find that that's exactly what we do have. So what we've actually done is that this week, price action told us that it was time to sell. So on Monday, we sold. And on Tuesday, we brought our stops to break even. On Wednesday, yesterday, it ran on down to a level that said to us, right, now is the time to take half profits on this trade. So that's exactly what we did. We've taken half profits on the trade. And what about the remaining part of the trade? We're leaving it on. The stop is at break even. We really don't mind if that stop gets hit or not because we cannot lose money. But it just might want to run right the way on down to where this red line is. And that's a level at which price just might want to get to. So it didn't take any great effort. All we had to do was relax, sit back, wait for the market to show us what it was doing, using these two indicators, and that's what we did. Took our half profits, and then we just stand to one side. We've still got a piece of the trade on. It cannot lose, and so we can now just go and look elsewhere and just leave that one to go wherever it's going to go.
George?
Yeah.
Sorry, just while we're on that chart, one or two questions have been coming in. So could we go back to that chart just for a second? Paul's
Sure.
asking, he said, why did you not sell after the 129 pips? There was a sell signal on your indicator.
Oh, right, okay. Well, what we wait for is three things. We want to see what the activity index is doing. We also want to see what the momentum indicator is doing, but the final arbiter is what is actually happening with price action. So it's those three things. And price action is largely to do with what the various candles are deciding that they're going to do. And the evening star that we looked at, that was a classic candle. Engulfing candles are classic candles. Shooting stars are classic candles. And the combination of those three things seemed to be the optimum way of picking out some of these best places to actually put our trades on. There are times when the three things don't really quite come together, and when they don't, then we just pass on it, and we'll just maybe avoid that trade. Or if we're in a trade and we're in some doubt as to where it might go next, and if there's a possibility that the profits that we're sitting on are could well be taken away from us, then we will just take those profits. We will just take those profits.
Okay, thank you. In terms of, it's also asking, the two indicators that you mainly use on daily charts, would they work on shorter time frames as well?
Yes, they do. Yes, they do. And when I'm breakfast trading, that's what I use. Plus one or two other things. There are when I'm breakfast trading and intraday trading, then there are quite a number of other little things that come into play that we actually use that make it just a tad more complicated, if you like, than what we're seeing. But they are the core of what I use for all trading.
Fantastic, thank you. Just one last question. James is saying, how do I get access to these charts?
Right. Okay. Now, the charts and the indicators are two different things. Right. Now, the charts, first of all, come from more or less any MT4 broker. Now, you will find that the biggest name in the business, in the spread betting business, IG Index, offer MT4, as do the majority of other brokers. And you can usually get MT4 on an entirely free basis. You're not going to be paying anything for it, which is one of the great benefits of it. Once you've got MT4, and if you wanted to get hold of the activity index and the swing trend and everything that we're actually I'm talk a little more about just in a few minutes, then I've got a course. The course is the 20-minute Extreme Swing Trader, and the course comes with these indicators to put into your MT4. And of course we can sort of help you with setting it all up, which we can do remotely from here. Or indeed, you can come along and spend a day with me when we can get into nitty-gritty detail on things. So I hope that helps.
Thank you very much.
Fine, fine. Now, I've got umpteen other examples, and what I will just mention is the US dollar against the Canadian dollar. If we go out to here, we can see that this chart of the US dollar against the Canadian dollar was just going up and up and up and up. And this was at a time when we found that the oil price was coming down and down and down and down and down. So the two are very, very closely correlated. And Canada, of course, their economy to a very great extent is reliant upon a good oil price. And if we find that there's a movement in the oil price, we're almost certainly going to get a movement in the US dollar Canadian. And that's given us some really good moves, some tremendous moves. And this is the weekly chart. This is going in the last year. We had this run that just ran and ran and ran and ran. All the time, more or less all the time, the activity index was positive. We had several trades in and several trades out, and as you can see, well, the first part we had a trade, and then it looked a little uncertain for a while, but then the trend resumed, and on up it went. And of course, this was all the time that there was a problem there with the oil price. The oil price eventually bottomed, and it started to rally. So that was going to be good for the Canadian dollar and not good for the US dollar. And so we sold it, and on down it came. The trend actually started with the activity index histogram just going red, and as you can see, it just kept going down. Then it went below the zero line, and it just kept on going. And then when we got a blue, which coincided with price action and coincided with the red line of the swing trend becoming green, all three things together, then it said, well, look, you know, we've got all of this profit, we've just got to take it. And then most of this year, or at least certainly the second quarter on, the Canadian dollar's been going sideways, and consequently we're getting this sort of jumping up and down, but we're still getting signals, and we had one recently, and we picked up 218 pips for you know, just about a fortnight's work. What was the work? Well, not a great deal. In fact, the hardest work was just clicking the mouse with the index finger. But really just waiting for things to come together, and that's what I really want to emphasize: waiting and relaxing while you're waiting. Not on tenterhooks, not sort of looking for every little sort of twist and turn that might want to get us into a trade, but going off and doing other things. For me, it's sailing. Mate of mine, he goes off on golf weekends and midweek golf trips. He comes back and trades, and the guy has got a wonderfully relaxed life, and he just swing trades using much the same techniques that I'm sort of showing you today. So it doesn't have to be fast. It doesn't have to be frenetic. You don't have to be looking at the markets and the charts all day long. It was really only when I realized that let's just wind back from all of this, what was becoming work. Let's just wind right back and make it fun, make it enjoyable, and enjoy the fruits of trading, which is to just take time off. There's an old expression called "fake it till you make it." Much misunderstood. It's used by salespeople and so on. You know, well, think they're going to be a hotshot salesperson, so they immediately go out and buy the best Jaguar that they can possibly get on credit to make it look as if they are the super successful salesman. When, of course, you know, it doesn't quite work out for them, it's got to go back to the finance company and so on. But what I mean here on fake it till you make it, relax until you make it. So you might sort of be in the position where spread betting accounts, so often they last about 3 to 6 months. People then have to top them up with more money, and it's a cycle that a lot of beginning traders go through. And consequently, you're going to be in a bad place if you are in that cycle, and you're going to be getting uptight about it. Well, getting uptight in the markets, well, doesn't really breed success. You've just got to wind back. You've got to cool down. You've got to be calm. You might possibly not need counseling, but you need to maybe do, at the very least, some of those breathing exercises and stuff, which just will lower the heart rate, will just cool everything down, and just take time out. Take time out from the markets. And that's what I mean by fake it till you make it. Tell yourself that you are calming down, that it's all going to be all right, that you will get there. Even though in the back of your mind, you know, you're thinking, oh, no, will I ever make it? But you've got to force yourself to do it and step back from the markets and let the markets show you what is going on. We so often do exactly the opposite. We try to find out what the markets are doing. Wait for the markets to show you. And that is one of the strong keys to success. Right. Okay. Well, the sermon has been going on a little while there. We're going to just mention now the US dollar against the Japanese yen. This, over the years, has been not my individual biggest earner, but it's certainly been my biggest earner in terms of long runs over a period of time. Here we are, US dollar, Japanese yen. We all know the Japanese story of where they decided that they were going to use financial engineering to boost their economy. And of course, it doesn't work. QE will not work to, anyway, I better just jump off that hobby horse for a moment. But we ended up with this amazing trend that just ran on up, and we just had to trade it. And these moves went on and on and on. And we had a whole series of moves that just kept on bringing home the bacon. And although these little numbers have not quite gone into the right places yet, there we go. We've had these moves, and it's just following all of those rules that I've just mentioned, where we just get a trend and we jump on the trend and we run it. We never want to lose money. Well, yeah, we do every now and again. Of course we do. But what we do absolutely everything possible to make sure that we are not going to take a loss. And we're not going to break the cardinal sin of all trades, and that is, if we've got a profitable trade, we never ever want it to turn into a loss. We never ever want it to turn into a loss. And that's why once we've got a trade that is going in our direction, we will get our stop to break even. We will get our stop to break even. We will get full protection so that we can then only make money. And we take half profits or 2/3, and we take that along the way, and we will leave a piece of the action on just to run and run and run until we get a clear reversal. And that's how, on these swings, on the US dollar, Japanese yen, we managed to pick up those pips. It is not rocket science. It doesn't need to be. If it's complicated, if it looks complicated, and you find that in practice it is complicated, forget it. It's not going to work because you won't get your head around it. Whoever designed that system that became complicated probably doesn't really fully understand it anyway. So the KISS syndrome, K-I-S-S. Well, let's leave off the final S, but keep it simple. Keep it simple. And it doesn't get simpler than this. This is the pound against the Australian dollar, and look at this. Tremendous runs. We actually had some real good runs on the way up and on the way down. Look at these. Look at these number of pips. Massive moves. We've just actually we've just closed part of this one on the way up. Still got a piece of it running, but we've taken 412 pips. Oh yeah, we also did this one, which is the pound against the Swiss. Nice little run up there. Not massive pips on this one so far. It may well come back. It doesn't really matter because we've actually taken a partial profits on it so far. So there we are. Dead simple system. Dead simple system. And what I just want to point out to you guys is that if you are serious about getting stuck into this, head on over to Click Events and just take a look at the website. The main program I'm talking about here is the 20-minute swing trader, extreme swing trader, and here it is. Comes out to you as that little package, as a bunch of CDs. The charts, well, it's dead simple. There we are. And one of the most important features of this is that as we present this to you, and as you work through the CDs, it doesn't end there. I run Traders Class, and what Traders Class does, it's an online coaching process that people who buy any of my programs, and this one in particular, will receive from me coaching videos a couple of times a week, and they've got access to me by email and so on. Umpteen testimonials of people who really like it. Got another one in yesterday from Les, Australian-based Les, who absolutely loves it. He's doing extremely well, trading actually Australian stocks with it, which I haven't shown him how to do. I showed him how to do it with what we've just looked at, with currencies and commodities and gold and silver and so on. But he's using it on Australian stocks. So we've got a number of these, as you see the examples. So what does Traders Class give you? Give you on this particular deal, it gives you not just the usual 30 days, but on this particular deal for Simon's people, it gives you 3 months full membership of Traders Class. Okay, usually £97 quarterly, which people do pay, and it gives you mentoring videos of the trades that I'm looking at, that I'm in, and what I'm doing, and why I'm doing it, because I want you to make a success of this. And 3 months, well, that's what you get. I want to see that you get full support and can put this into practice and make some money. Not only that, the regular price, which we have dropped from $379, is $279. There's even a payment plan, $139.50 now. Have it for 30 days. Don't like it, send it back. No problem, instant refund. But you might just want to stick around, and not many of these come back, I have to say. And then you just pay the balance, $69.75, 33 days after that, and another 33 days after that, the final amount comes up to $279. Of course, if you're an existing Traders Class member, get it for £179. So there we go. That's the deal. That's the deal that is alive and here for you right now. And do grab hold of it. No problem at all. If you find that it's not for you, you just return it and nothing's lost. But you just might gain a whole lot from it. Well, guys, been great just talking to you, and many thanks for your questions, and particularly your brilliant answer and very quick answer to the little trading question I posed to you earlier.
That was wonderful. George, we've got another few questions that have just been waiting for a few minutes. If we can address these. Going all the way back to Christopher asks, do you provide the indicators for NinjaTrader?
No, we don't. No, we did look into programming it for other platforms. TradeStation was going to be one of them. Regrettably, TradeStation, the way in which they show volume, it just wouldn't work with this indicator. And I think that possibly Ninja might be the same. So MT4, it's a free program. In actual fact, we've got several people who use the indicators on MT4. But they use different charts, and they've got a sort of totally different broker to actually put their trades on. So for analysis, MT4 is the way to go.
Okay. James is asking a question on getting out of trades. He says he gets that watching charts all the time is crazy, but how do I avoid missing the right time to get out of a trade? Do you put in limits as well as stops?
No, quite simply. What we do is that well, let me just say the problem with limit orders is it has the effect of potentially limiting the amount of profit that you're going to make. What we've found is that if somebody said that, right, I want a 3-to-1 profit ratio, which is very often what people state, that we find that we get profit ratios of going sort of 5, 8, 9, 10, even more to 1. Limit orders will limit that. So what we wait for those three things. We wait for price action, we wait for the activity index, we wait for the swing trend to effectively tell us when to get out. So if I took just one of those, it would be the swing trend. When the swing trend, if it changes, if we're in a long trade, it's green and it goes to red, we're out. Simple as that. And we always want to preserve the profits that we've got. We never like to give back a big chunk of profits. Money management is probably the second most important part of the whole trading dimension, and we show people exactly how to use the MT4 platform to put in the various orders. But we usually go in with a buy stop or a sell stop order, and we usually come out with, again, a sell stop, which will be a stop profit order, which is just put into the system automatically. We show exactly how that's done, and also how we go about taking partial profits and the amount of partial profits that we take and when. Hope that helps.
Yeah, well, James has just come back actually. He says, so you do have to watch the charts most of the time then?
No. I mean, if you want to watch the charts, you can, of course. But we just do this on a sort of a once or maybe a twice a day basis. Okay. And that's it. You know, the screen watching is counterproductive. It's counterproductive in that intraday you get all sorts of little twists and turns, and it can play havoc with whatever your longer term trend is actually telling you. And intraday screen watching is so often counterproductive. So we really don't suggest you do it.
Okay, George, we've still got quite a lot of questions. So if we can go through these,
I'll be quick.
Quite quickly, that would be great. We've got about 6-7 minutes. But moving on to Alexander. Hi, are all those lines, etc., self-drawn, or do they come with the indicators?
No, they're we just click them into place when we want to put a line in. For instance, these red lines we just we'll sort of move them around every now and again. You know, there was a time when you'd print out charts and you'd draw them by hand, and there are just lines that sort of just help show us where we've got key levels. For instance, I will use this red line in exactly this position. You see this downtrend that we've got? Right. We've got a little mini uptrend in the context of what is still a downtrend. Once price goes above where I put that red line, then it's pretty damn serious that we've got a new uptrend. Why do I say that? Because a definition of a trend, when we just look at price action, are a whole series of lower highs. We've got a whole load of lower highs. This, in this downtrend, is the last lower high, the last big, significant lower high. If price manages to get itself back above there, it's going to be a new trend. So, yeah, we just sort of plonk a line in and just leave it there, until such time as we will move it.
Okay, what about the blue lines? Are they Fibonacci levels?
Yeah, they are. You know, we do also. I do throw into the education aspect how I use Fibonacci, but it's not essential for this this process, this system of 20-minute extreme swing trading. I also do. I've studied a lot of Elliott Wave over the years. Some people think it's complete and utter mumbo jumbo, but it's quite uncanny how it seems to work every now and again. And I throw in some education on that. Again, it's not essential. You know, it's just one of those things that I just sort of throw in as added value, if you like. And I try to make sense of what can be to some mumbo jumbo.
Indeed. Well, if you're interested in Fibonacci, we have another speaker, Steve Ruffley, is going to be talking about Fibonacci trading at 11 o'clock. Ian asks you, what time of day do you place trades and alter stops?
Either in the evening. The currency markets switch over to the new day at 10 o'clock on a UK evening, 5 o'clock New York, and I either put a trade on, usually fairly sort of late in the evening, or indeed first thing in the morning. That's my there are my usual times.
Thank you very much. We are getting lots and lots of questions. We're going to try and get through them all if we can. It appears, asks Paul, you don't trade the reversals. Do you just do directional trading?
We are looking at a reversal right now. Yes, I most definitely trade reversals. We do both. We trade, once we've got an established trend, we will trade the devil out of it. But we're always looking for reversals. In fact, on this chart, we've got one right the way over here on the top left. That is a reversal from an uptrend to a downtrend. We've got reversals. We're trading reversals. And you know, we'd like to get in on trends as early as we can possibly get in on them. And if we come over to this one, for instance, this now is a potential long-term reversal. We've had a big downtrend, and it's got the potential to be a reversal. It's got the signs in. We've got two sets of bottoming candles, if you like, a potential double bottom. Now, we don't know if this is going to be a full reversal or not, but we'll certainly get in very early, okay, as we have done. So we got in on this one on Monday. We've taken the half profits. We're going to just keep this trade on until either our stop gets taken out or price just keeps running on up. Now, if it gets above that red line level, then that's going to sort of tell us that, yeah, the reversal has taken place, but we're getting in really early. Okay, hope that helps.
Yeah, that's great. Mike is asking, why do we have lines on certain entries and not on others?
Oh, right, just because I've just given you a snapshot of trades. I don't take absolutely every single trade that is signaled for several reasons, because on currency pairs, a lot of them are correlated. For instance, I don't want to have too much exposure on the fact that the pound is rallying, but there were signals on the pound against the AUD, the pound against the Swiss, the pound against the Japanese yen, etc. I'm not going to take all of those because I have far, far, far too much exposure in relation to my overall account. So I'm only going to pick, well, in this case, I actually picked three. We have the pound against the Swiss, pound against the Australian, and the euro against the pound. So sorry, the pound against the euro. So I will always make sure that my overall account is never ever more than about 1.5 to 2% exposed to any one currency trade. So on each individual one, it's around about 0.5% that I will put on. I'm not going to take every single trade out there. There are so many opportunities.
Okay, thank you. He's doing your day job.
Sorry, I didn't quite catch that.
Sorry, Sanj. He says, can you do this while doing your day job, not your George Halmy job, but
No, you most definitely can. You most
yes.
definitely can. And by as long as you can look at the chart, say first thing in the morning, last thing at night, absolutely fine.
Okay, fantastic. Paul's on the education package, the swing trading package. Paul, is this a once and for all payment, or are there additional recurring costs thereafter?
Right, it is once and for all, but after the 3 months, if you want to remain a traders class member, as several do, some would just go off and do their own thing, but after that, the figure is £97 quarterly. But it's not essential, not essential.
There we are. Andy asks, where does the volume figure come from? Many broker volume figures aren't that accurate.
Yeah. Well, that's very, very true. It does vary from to some degree because there's no central clearinghouse for Forex, and so all of the bank feeds are different. So yeah, that is something we have to live with. So what it's actually using is not the actual amount of currency which is bought, sold, but it's the amount of tick activity that goes on. So where there's a lot of tick activity on an up candle, okay, that's recorded as an up, and consequently it contributes to maybe a blue histogram, where tick activity is more selling tick activity, then it contributes to a red candle. So it's the tick activity as a proxy for volume. I could go into a whole day explanation on that one, but I'm certainly not going to. But it's a pretty damn good measure of volume.
So there we are. We'll take one more question, if that's all right, just in the last 60 seconds. The rest of you, I apologize, but we'll put you directly in touch with George. But if we just take one last from Ripple, he asks, do you also look at break of trend lines as an entry signal with the activity index?
Yeah, I do, but they're not reliable enough. What is reliable are the horizontal lines. They're more reliable than the sloping lines. So we do use both. We do use both, and we do use channels as well, which can give you a broad definition. But they're not really quite accurate enough in order to risk money on entries and exits. Now, I've just put my email address out there, Simon, if you could send it out, and
yes.
Further questions, don't hesitate.
We've just done that, and copying the website as well, where people can go for the offer there. I'm sorry we haven't had time to get through all the questions. That's us at 10 o'clock already, incredibly.
Well.
Enthusiastic. Thank you for all the questions, and thanks for all the interaction. And George, thank you very much for starting us off today, our August Round the Clock Trader. It's been a pleasure, as always, to have you on, and you go through things in a very clear, methodical way, which we all appreciate. So thank you very much indeed for that. I'm going to take the presenter role back from you now.
Thank you, Simon. Bye now.
There we are. So that was George Halmy from Click Events starting us off today. So we enjoyed that first presentation, and we are just on 10 o'clock, so we're going to move straight along. Welcome to everybody that has just joined us in the last hour. I can see a super number of people joining us, which is surprising me. I wondered if August was a month that we should be doing an event, but the support has certainly proved me wrong or right that we've done the event because so many of you are here, which is during the day. This is Round the Clock Trader. My name's Simon Campbell from London Investment Week, and we've just over to our second speaker of the day, aka bring Rob into the room now and see if he can hear me. Good morning, Rob.
Good morning, Simon. How are you doing?
Oh, I'm very well, thank you. And you sound crystal clear.
Oh, brilliant. This is a whole new internet thing. We've upgraded finally after years of suffering.
I know you had concerns about the Wi-Fi where you are now, but it's strong, which is great.
Well, touch wood, yes, it will work out for all of us. So, yeah.
Well, we've got a busy day. We've taken up the full hour. We're just into 10 o'clock, so I think we'll go straight over to make you the presenter now, so that we don't lose too much more time. If you're ready to confirm the presenter button.
Yeah. Confirmed.
Excellent. I'm looking now at the browser. How to trade from 10 minutes a day. Is that the right window we should be seeing?
That is the right window. Don't worry, I'm presenting from my laptop today, so I won't be able to see the questions, unfortunately, as they come up. So feel free to interrupt me if there are any, and I'll happily answer.
I'm sure that we're very enthusiastic audience today, which is great. So, Rob, you are the Lazy Trader, for want of a better. That is your company. You offer education on top of doing your own trading every day. You have a private trading community and trading room. I understand. I'll let you expand more on that. But today you've come back to us, which is great, to tell us how to blend trading with having a life, essentially, I think is your message. So we'll look forward to that. So what I'll do, I'll hand over to you now, and we'll take questions as we go through it, and I'll interrupt at the opportune times, if I may.
Great. Thank you very much, Simon, and thank you for inviting us. It's always a pleasure to take part in the Round the Clock Trader events, and great presentation by George as well. It's very nice to hear people who are involved in a similar vein of trading as ourselves. You know, they do it. They're reaping the benefits of just setting and forgetting, really, and not being in front of the screen all day, because life's short enough, right? And life is definitely complicated enough. But as Simon said, this webinar is how to trade from as little as 10 minutes a day. And I'm not so much going to teach you strategies. I'm going to talk to you about a concept of trading with a strategy, one of our key strategies bolted onto it. It's a reversal strategy as well. So like George, I am known to trade reversals also. So let's go straight into the PIF. I just want to talk to you about the disclaimer. Just have a quick look at that. And then there we go. It's nothing untoward, it's just the usual stuff you've probably seen before. Okay, so for those of you who don't already know me, my name is Robert Colville. I'm founder of thelazytrader.com and TradeVest. We've been accredited by the Society of Technical Analysts. I've been trading for about 8 years now. It's all started off in 2007 when I realized that journalism wasn't going to pay the bills, despite writing for a myriad of publications like The Guardian, The Big Issue, did a bit of freelance work for The Telegraph. But unfortunately, being freelance and being a journalist was never going to pay the bills. So I fell into financial markets trading, made every single mistake I possibly could. In fact, I was an absolutely horrible trader to begin with. But I decided to stay true to my conviction that I wanted to make this work. And the only thing that really separated me between the 92% of people who actually fell in the markets and myself is that I had the tenacity to continue. I was in deep, and I discovered a style of trading which enables me to really set my orders up and walk away and really just leverage all the benefits of trading, i.e. making money from the markets without really having an intellectual fascination or interest in the markets. When people ask me what I think of various statutes, decisions, currencies, most of the time I simply tell them, I really don't care, to be honest with you. I'm just interested in what the market is doing at the moment and to see how we can make money off it. Okay, so since becoming consistent and building up a good track record, since taught thousands of people around the world how to trade, and through this set and forget style of trading, which anyone can do, by the way, I'm nothing special, it allows you to free up a lot of time in your day so that you can concentrate on other income streams, whatever that might be, whether it's your day job, network marketing, or indeed just entertaining hobbies, or indeed spending time with the family. Anyway, I could talk about myself all day, but I'm pretty sure you didn't take time out of your work schedule or your existing schedule to hear me prattling on. So let's go straight into the PIF. One thing I'm going to tell you is that I'm going to be offering bonuses throughout the presentation. So do look out for these commands, these giveaways, the video courses, ebooks, one-to-one mentoring, and VIP access to flagship events. So when prompted, please do well, go to the website and follow the prompts if you want to actually take advantage. Okay, so trading from as little as 10 minutes a day, we're able to achieve this through trading the higher time frames, the daily and or the weekly chart. If you trade the daily chart, you check your trades or look for opportunities once a day. If you want to trade the weekly chart, and you can be an end of week trader, then you can simply look at the chart for opportunities or manage your trades once a week. It's entirely up to you, but just because you're trading a higher time frame, it doesn't mean that you're any less exposed to opportunity or profit than if you're an intraday trader. That is a huge misconception that a lot of people, certainly new to the markets, make. So we trade the higher order time frames, the daily and the weekly, purely and simply because they're more reliable. The setups, signals, patterns, levels are far more crystal clear in the market. They're far more easier to identify. When you see things which are more easy to identify, generally they're a lot more self-fulfilling, the moves that happen thereafter. Lower maintenance of trading, that's a big one. You don't have to be champing at the bit to manage your trade, moving your stop loss every 5 minutes. You can just simply manage your stop loss at the end of the day or at the end of the week if you are a real lazy trader like myself. I actually really do enjoy the weekly time frame more than anything else. The higher order time frames as well, i.e. the daily and the weekly, can enable you to obtain or win a higher reward. And of course, it's less emotional to trade because a lot of people say that, hey, okay, opportunities on the daily or the weekly are few and far between. I'm never trading all the time. I'm not trading all the time. Well, that's absolutely fine because it's the trades that you don't take are often the ones that make you the money. And when you are in a position, like we're in currently 3 positions at the moment, which we'll discuss a little bit later. We're currently in Singapore dollar versus the yen short. We're in oil long and New Zealand CAD short on the weekly time frames, and they're triplet trades which have done very well over August and July, and these setups have only taken a couple of minutes to identify and place, and we've been benefiting from market movements and the trend. Okay, so like the old adage goes, the higher the time frame, the stronger the trend, and essentially they are the time frames which the big dogs in the market are looking at. They give us more clarity and a broader perspective as to what is really going on in the market. I know we've all been a little bit guilty of looking at the 5-minute chart and trying to, squeeze these kind of opportunities out of these tiny time frames. But, I'm pretty sure those of us who have tried, i.e. myself, we've become victim to inexplicable spikes, noise, news announcements that we didn't know about, because we just forgot to check. And quite frankly, on the daily, you are immune to news announcements most of the time. And yes, trends are far more easy to identify, and they are more resistant to noise and strange spikes and random moves, which no one can really explain. Okay, low maintenance, like I mentioned, we can be in the flow of opportunity by simply checking our charts on the daily once a day, or we trade the weekly, like I do as well, once a week. That is the ultimate sweet spot of trading. It means that you can make the most you can potentially from the market, and you can essentially dedicate less time to it. That is a sweet spot. Like I mentioned to you on the first slide, I have no real intellectual fascination for the inner workings of financial markets, but I've got every interest in what it can do for me and my clients. That's the difference. Okay, some people don't want to learn to trade how to make money. Some people want to learn or have a desire to learn to trade because they like to sound impressive in front of their friends. They like to swing the bat. And a lot of people who I've mentored do sometimes fall into that trap where they lose sight of the actual end goal to make money. The mission is to make money, but actually they fall into the trap of falling into the trap of analysis paralysis and trying to sound all very impressive and analytical, paralytical, should I say, but they lose sight of the vision to make money. But of course, before we make money, we want to break even first. Okay, so the ideal perfect storm for us is making as much as we can from the markets, dedicating as little time as possible to it, and trading the daily and the weekly time frames are the perfect format for that. And there is a completely disproportionate relationship to time and dedicated to trading and money made. Unlike our day jobs, this is a concept that a lot of people struggle to get, like myself when I was new to financial markets trading. It's completely disproportionate, wins are random. And I'm going to talk to you about this working example here. Intraday traders, certainly newbie intraday traders, you might want to pay attention to this particular example. We've got Jack and John, both make 8% gain on their trading account. Jack is the end of day trader. He spends 11 hours trading or looking for opportunities as a result of his half hour every night scanning the markets. And we've got John, who spends 88 hours every month to make his intraday money or return, and he makes 8%. But who do you think's got the better time return advantage? Who do you think's better off? I would say Jack is, because he's making more return for the money, more return for the hours spent trading. Whereas John, okay, he might be spent or taking more time trading, but actually he's far worse off. And if you've got a tiny trading account, then what's the point? Because you are sacrificing other more lucrative activities, like even getting paid per hour or other opportunities, whether they're web-based or not. Okay, so the hard time frames as well obviously give us jaw-dropping profit potential as well, and I'll show you some of these examples a little bit later, like our Brexit hedge trade, which we took pound Swiss, which you might have heard us talk about last time. Staggering profit potential. Some of our clients doubled their accounts on that, risking 2% on the trade, okay? And this was trading the reversal, and this was trading one of the very strategies which we're going to talk to you about in just a second. Okay, so because the daily and the weekly time frame are so boring to trade, by the way, boring is good in trading, like George mentioned earlier in the presentation before this, quite rightly so. It means that we can just go about and not meddle with our trades. The worst thing you can do as a trader is fiddle and molest our trades when they're in motion. And a lot of people just can't wait to do that. I don't know why. It's because they want a sense of purpose. Maybe if they're trading the 5-minute chart, they're just in the market. They want the excitement of still being attached to the action. Whereas us end-of-day traders, end-of-week traders, we simply relish the fact that we have set our trades up and we walk away and we don't do anything. And of course, these quick outcomes as well, which don't happen in the higher order time frame trading. They remove the temptation to place trades out of boredom, anger, and frustration, which is a really vicious circle. Those of you who've, like myself back in the day, have made mistakes in trading, that is a real bad, vicious circle to fall into, where you place a trade out of boredom because, hey, there's no intraday action, it loses money. Then you place a trade out of frustration, you lose money. Then you think, hey, I'm really angry now, so I'm going to place a trade out of anger, you lose money. And that's even that's a worse kind of like cycle, vicious cycle you could fall into. Okay, so that's why we trade the higher order time frames. I hope that's hope we've managed to inspire a few people who are on the fence or intraday traders. I would say end of day trading all the way for me. It's what I'm known for. I actually haven't got the personality profiling to pull off intraday trading, so I go for my strengths really. I mean, it doesn't mean I'm any less a good trader. It means that I found my edge, and all the best traders out there, they're specialized. They have a very specific strategy on a very specific time frame, and they'll just do that day in, day out, even if it's the most boring thing on the planet. I mean, I'm bored senseless with my strategy, but it doesn't mean my strategy is losing me money. My strategy is doing very well, especially this year with the Brexit hedge, but I'm still bored of it. But boring equals good, and trading has to be boring in order for it to succeed. When you've got no emotional excitement or impulsive emotions that might perpetuate an emotional trade, then that's very good. Okay, so just the advantages in a nutshell about 7-Baguette trading is it frees up time, removes emotion. It means that your money is working hard for you and on your behalf. You can benefit from the stability of the higher time frames. You're more immune to news. You can capture bigger news. You can follow the big dogs in the market. And we can just do this by trading the daily and the weekly time frame. Having a strategy, which I'm going to teach you in a minute, and there are many more, by the way, and keeping the risk low. And have something else to do. I mean, have a life. I mean, just don't. The worst thing you can do if you're new to trading is characterize yourself and take on the persona as a trader, because that's when, I far rather, if you're trading the end of the day, just say trading something you happen to do on the side, okay? And that's absolutely fine. It's when you start taking on the persona of a trader, like buying 4 different screens, for what? I mean, what's the point? If you're trading end of day, there's no big moves or sudden information flow you need to suddenly be jumping into. Okay, so end of day trading, end of week trading is the difference between working for you and having your money working for you. So you working for your money or your money working for you. That's the key difference, and that is the sweet spot. Okay, and this is what I'm very passionate about, the key difference here. Okay, so this strategy, which I'm going to share with you, is a reversal strategy. It's got a higher risk profiling than a trend-based strategy, which we also teach, by the way, to our clients. But the reward is far higher, the profit potential. There's usually a correlation in trading between risk and reward. The higher risk you're willing to give, the higher the reward ultimately is. But you ultimately have to sustain a few loses before you get to that reward. And that's the point where a lot of people get shy and they retreat back into themselves and think, is this really a good idea? Okay, so I like to trade trend. I also like to trade reversal. I'm very specific with my reversal strategy. I'm very specific about the rules, and I'm obviously going to share them with you today, hence the purpose of the webinar. So the pros behind this supply and demand strategy is the fact that we can get into big moves right at the beginning. These reversal trades. I know George trades reversals like I do, but sometimes people like a bit of extra confirmation, like a free-step confirmation before getting into a reversal trade. This one, we've got a few boxes to tick, but it means that this style of getting into a reversal means that we can get it at the very beginning, with the lightning in the storm that flashes before the thunder sounds, if that makes sense. Silly analogy, but it's kind of true. We can benefit from a free trade earlier. It means we can move our stop loss to break even and have a no loss outcome quickly. We can benefit from big levels that big institutions and funds will typically have their orders. There are a few barriers or rules to entry so that we can take advantage very quickly. And it's really epitomizes 7-Baguette to its highest degree. I mean, you can go through the charts on the weekly time frame, place your orders on the weekly and go traveling for up to a year and just say, well, hey, I've already automated this. Okay, you can set this up to all asset classes. So I know my focus is on foreign exchange and the 26 pairs which I trade, but actually you can apply this to stocks, precious metals, commodities, anything else. Okay, so it's very objective. The cons are, of course, there's no strategy is perfect, and there's always going to be a downside to any strategy. But it's not a bad set of problems to have when we look at the fact that with this strategy, there are just fewer opportunities to trade. If you're not seeing that many in Forex, well, what do? You can just move over to stocks instead. Boo-hoo, no big deal really. Okay, so few barriers to entry as well could create a fear-based disposition. People who don't like getting the word oncoming train, then you might not want to take note. But there are people who are listening right now who will take this on board, and others who will think, well, this is too risky for my blood. It's up to you. But we've got strategies for all different personalities because we appreciate that everyone's different, and this is just one of them. And we wanted to obviously just give you one of them, just give you a sample. So no price action based confirmation. But before we get into the actual strategy rules for entry, management, and exit, I'm just going to talk to you about bulldozing some jargon, because I appreciate supply and demand to some people might sound double Dutch. It did to me when I first came across this phenomenon. So what is a level of supply? Well, a level of supply is a sell level known also as a ceiling or a level of resistance. It's typically where people who are long will want to unwind. This can happen at multi-year highs or all-time high or big round numbers. Essentially is the balance tilting where more people are starting to want to sell than buy. And like the FTSE, for example, which has just reached its penultimate all-time high, I believe, last time I looked at it. And you can reasonably expect quite a few sellers thinking, hang on a minute, let's this is an all-time high, almost approaching. But the FTSE is a bit of an anomaly at the moment because, of course, the pound's devalued so much against pretty much every other currency out there that people probably flood. You know, the pound's cheaper, so people are buying British stocks because they are a lot cheaper at the moment. But that's besides the point. Okay, the level of demand on the flip side of the coin is typically where people are looking to buy. It is typically correspond with levels of support or floors. Whatever you call it, they're typically levels that occur at multi-year lows, all-time lows, or big round numbers. Okay, so typically where more buyers are coming into the market seeking value, and you know, there's always, so it's called the market because there's always going to be a perception of value at no matter what side of the trade you are. Okay, so this is why it's called the market for a reason, because whoever you're selling to thinks it's a good price to buy at, and vice versa. Okay, you can be rest assured that there's going to be millions of people out there trading all different strategies, taking the other side of your trade for who knows whatever reason, but because it conforms to their strategy. The fact of the matter is you're trading yours, and that's all you should be worried about. Okay, so just developing a little bit more on the bulldozing of the jargon. I'm going to talk to you a little bit more about hard levels and support and resistance, or supply and demand, as we now term them. A hard level is basically a level which has not been breached in at least 10 months. So a level of supply is a level of resistance that has not been broken and had price closed above it for more than 10 months. It's essentially held for 10 months plus. And it's the same thing for a level of demand, one which is held for 10 months, i.e. a level of support that's held for 10 months. Okay, so the hard time frames give us a sounder market perspective. The opportunities are far easier to establish, and the moves are generally more self-fulfilling. Okay, so here we go. I'm going to give you a few very straightforward examples, okay, just to really kind of give you the rules, and then we'll show you some actual trades that happened, and I'll talk to you about what trades we've recently taken. So there we have it. So what we're looking for are two tests in order to qualify a potential opportunity on a level of resistance and support. So level of supply is the top level here. So all we need is two tests where the market has respected it, and then we have our sell opportunity for the third touch. And it's the same with the level of demand. Okay, so range-bound markets are absolutely perfect for this. Absolutely love range-bound markets. So we're looking for two previous tests, and then we have the buy opportunity on the third, or even the fourth, or even the fifth. Okay, so it's simply buying and selling on levels. Okay, so just to recap, we're looking at a buy setup on a level of support, or indeed a level of demand, which is held for at least 10 months, which has had two previous tests and no close, I repeat, no close below that horizontal level. Okay, a sell trade is pretty much the opposite. We're looking for a level of supply, also known as a level of resistance, which is held for at least 10 months and has had two previous tests at points of rejection and no close above that horizontal level. Okay, so that's that. So here we go. This is one example. This is the British pound versus the Canadian dollar, and you know, throughout the past 5 years, this really has been a favourite. Really, it's been range bound for a very long time. I know this is a historical chart, but we'll show you live charts in just a second. This is just a good example where we had clarity. So we had two tests here: test one, test two. We had sell opportunity here, sell opportunity here, sell opportunity here. 3 sells. And we saw that the profit potential was pretty staggering. When you look at the depth of this range here, the height of this range is phenomenal. If you have like a stop, say 150 pips away, we'll talk to you a little bit more about the stops. And as on the bottom side, the level of demand on this range, we had test 1, test 2, then that qualifies our decision to buy on test 3. Simple as that. It's the same with the Aussie dollar versus the Swiss franc. We had our 2 tests here. Obviously, I'd rather that the tests were a little bit further apart, but the third test we had it here for a sell, and then we had our 2 tests on the level of demand, where essentially buyers are anticipated to come into the markets, and then on the third test we had the buy opportunity. So just to recap, hard levels, they typically occur at round numbers, hundreds or 50s, multi-year highs or lows every 10, 5, 15. 20 years, if you look on the weekly, you'll get a good perspective as to how cross-currency pairs have fended over the past 20 years, and a lot of them haven't really gone anywhere. They've just oscillated for a very, very, very long time, and that's absolutely fine because it just gives us opportunities to take advantage of. And of course, we've got the levels defended by central banks. That's quite an important one. For example, central banks, yeah, you don't really want to go in the opposite direction of a central bank, but this is a whole different conversation for a whole different day, I think, about central banks. Okay, so cherry picking, absolutely fine to pick the best and leave the rest, as they say, that old adage. So I prefer, when we're looking at range-bound markets like we've been discussing, I like the tests to be random, and they have to be clean and whipsaw kind of tests like these. I don't like it when prices been ranging in and out of the levels of supply and demand. Okay, so they need to be isolated, the tests, and need to have quick kind of whiplashes of rejections off them. Okay, so it's the same as well on the FTSE 100. This 2014 was an absolute dream. We're simply selling the penultimate all-time high, and the FTSE just would not break this level, and we had test 1, test 2, test 3. So on the third test we would sell, on the fourth, fifth, sixth and seventh test we would sell, and we did, and it was an extremely lucrative instrument to trade until it finally broke last year, April 2015, to reach an all-time high, and that's the one time it lost money. But hey, it doesn't matter, we've had so many winning outcomes with the FTSE, it almost made winning boring. Okay, so another example of a setup is the US dollar versus the Polish zloty. It doesn't matter what the currency pair is, we just trade it depending on what it looks like on the chart. Okay, we don't discriminate. That's very simple when it comes to Forex trading. Okay, so the first test, second test, third test, buy opportunity, and we bought, and then we had on the FTSE, like I mentioned, the first test here, second test to sell, and the third test, well, we had our level already, sorry, our order already on the level to sell, and reached the level, and then it went down. Okay, so the higher the time frame, the better. I've just talked about this. So management, well, we have our entry, of course, on the level. A stop loss essential, and a target will be a limit order. We trail our stops for this. Okay, so what we do is we have our entry just above the level if we're going long, and our stop loss just below if we're going short. Sorry, just below the level. I'd say 100 to 150 pips, and below the point where it's below price, which might have had a false breakout before. We want our entry just to be above the level, just in case. Our stop loss just below price, and that might have had the false breakout. So what we do is we measure the midpoint as target 1, typically for high probability, low reward outcome, and target 2 is the lower probability, higher profit outcome. Okay, if we're going short, it's pretty much the same thing, but in reverse. We have our order to sell just below the level of resistance, stop loss just above, and we have our target at the midpoint here, and then that's our high probability, low reward outcome, and our second target is at the bottom of the range, which is our lower probability, higher reward outcome. Okay, so it's more aggressive. Okay, so in terms of managing the trade, we have to have our first target to preserve capital. So our first opportunity is to preserve capital, and that's what a lot of traders forget. They want to preserve capital, but they don't. They're too focused on making money. So objective 1 is to preserve capital, move stop loss at break even. Second objective is to make profit and lock it in. Okay, so with this strategy, worst case scenario is when we have a close below the level and it takes out our stop loss in one hit. That's the worst possible outcome. Same if we're selling. We have our orders on the level of resistance and price just carries on going up and hits our stop loss, then unfortunately that's it's just a full hit. And that happens sometimes. But sometimes there are ways when we can prevent a full hit and we can manage the trade accordingly to prevent these worst case scenario outcomes. And because it's one thing taking a full hit and it's another thing taking a marginal loss. Okay, so that's better. So how do we look out for the early warning signs? Well, there are several ways in which we can do this. If we're going long and we're looking to buy on the level, then what we do is we wait for price. If price charges through the level of demand, we get a close below it, and the next bar takes up the low, then that's a huge warning sign. That means, uh-oh, our trade is in trouble. But what we can do is we can take an early exit if the candle which closes below the level's low is breached. So we can exit at that point there. Okay, so that's the important, crucial thing to do. So that prevents a full hit. Okay, it's the same if we're going short of a level of supply. If we've got a close above the level which we're selling, then that's a warning sign. But if the next bar takes out the high of the bar which closed above the level, then that is danger territory. So we can get out for an early exit and a small loss and take it that way. Okay, so that is essentially how I manage it. And it's in terms of locking in our profit, because it's one thing to make money, it's another thing to lock it in. And we need to do that as traders. Okay, so what we do use for that is something known as the ratchet stop loss, where we trail our stop loss depending on how many pips difference between our entry and our stop loss there is. Okay, so we've got a 100 pip difference between our entry and our stop loss. We trail it 100 pips behind price. Okay, so if we're in the trade and, for example, it goes in our favor, so we bought here, and it goes 100 pips in our favor, then we move our stop loss to break even, because there is 100 pips difference between our entry and our stop loss. If price continues to go up in our favor, it makes 200 pips profit, then we move our stop loss to lock in 100 pips profit. So it's always 100 pips. The stop loss is always 100 pips behind price, and we only move it when it's hit a new 100 pip threshold. Okay, so that's how we objectively lock in profit in a very mechanical way, because on one hand we want to be objective, and we want to of course lock in profit, but we don't want to do this too aggressively, because sometimes the market will come back, take us out, only to go in our direction. And when that happens, that sucks. That basically sucks. It's horrible when that happens. And we've all been there, when we've been too aggressive with managing our stop and mollycoddling our trade. And okay, it pings us out for a small profit, and it goes completely in our favor, plus extra, plus more. And that it's very soul destroying when that happens. So sometimes you've got to take a view on it and rationalize in your head, well, what is the worst possible thing that can happen if I take this trade? Okay, well, I'm going to lose 2% if it goes belly up. And what's the worst possible thing that can happen if I don't take this trade? Well, if I don't take this trade and give it slack, then I could miss out on a 20-to-1 profit potential trade. And, you know, in the earlier days, I found myself doing this all the time. So another example of managing our ratchet stop loss is simply, in this sell example, is simply having our entry just below the level to sell, 75 pip difference between entry and stop loss, but trailing your stop loss every threshold, every 75 pip threshold, the market goes in favor. So if the market goes, say, 75 pips, then you move your stop loss to break even, and so forth. It always is 75 pips behind the live market. Okay, so let's show an example here. This is Euro NOK, and this is one which I believe we traded, where we had test 1, test 2. They're very uniform, these two rejections of the level of resistance, also known as the level of supply. Typically, people have been wanting to unwind at this point and take profit however long. So you can reasonably expect the market to turn around just above 8.500, stop loss above the point where price might have faked out before, where there might have been a false breakout, where market might have been, but there hasn't been a close above, and wait for the market. Okay, we had a huge spike there, great. We had filled in the trade, pretty much instant profit. Look at how quick that was. This is the daily. So what we did then is we just trailed our stop loss, had our original stop loss, and we just trailed it for every, well, I tried it 3 times immediately because it all happened in one day, this big move, but we trailed it for every equivalent distance. Our trade was between entry and stop loss. As soon as it moved in profit, we trailed it that distance. Okay, so we risked 2% to make 8% gain on this one. We've got also the US dollar versus the Polish zloty. I think you might recognize this one from earlier. And we had, okay, test 1, test 2, and we had our entry just above 3, and our stop loss is below. And okay, so we filled into the trade, and okay, we had the opportunity to trail this several times because the market just did not come back. So we had the distance between our entry and our stop loss, and that gave us the number of pips we'll be trailing our stop loss by. Okay, so we tried it 1, 2, 3 times, hit our target, and that was that. So that was a happy ending. Okay, so I'm just going to talk to you about some of the trades which we're currently in. I mean, we're in quite a bit at the moment. So let's go to the charts. Please bear with me. I'm on an Apple Mac at the moment. I've made the reluctant decision to go to Apple after years of dithering and delaying and yeah, procrastination. So anyway, I've got parallels and I managed to get my lovely e-signal on it, and hopefully you can see this chart right now before your very eyes. It is New Zealand CAD. This is where it is. We've got this level of resistance here, and you can see here, this is on the weekly time frame, by the way, so this is a very strong level. We had 1, 2 examples, and we had the third already, which makes it a legitimate example. So on the fourth example, which came to our attention a few weeks ago, we had this wonderful opportunity to place our order sell here, and we had our stop loss above this point here, because you can see that price faked out here. Okay, so we wanted our stop loss above this point. You can see the reward to risk is actually pretty good because, okay, let's say our stop loss is here, and our first target is this point here. You can see that actually, let's get the arrow out. Price ruler, well, you know, either as good as each other. Okay, so say 156 pips to make this much. You know, this is good reward to risk if you think about it. And it means that, okay, reversals do fail. 80% of reversals do fail. But the ones that do make it, then they really do make the money. You look at how many times this fits into, this distance between our entry and our stop loss fits into our profit potential. Numerous times, like 1, 2, 3, 4 times, and if you're risking 2%, that's an 8% potential gain. And the thing about reversals, like I said, 80% of the time they do fail. But if you're at the very beginning, at the very level where price whiplashes and turns around, of course reversals don't happen all the time. Sometimes, or immediately, sometimes price just takes a while to turn, and that's absolutely no problem. It's a tilting seesaw. But what we do is we're in at the very beginning of the move, so we can take advantage of a free trade. We're almost at that point with the New Zealand CAD. Remember, it's on the weekly, but this was on the daily. It's the same logic applies and the same rules apply on the daily as if it was the weekly. We can do just that. Okay, so we're almost at the point where we can move our trade to break even. We've got a lot of downsides to take advantage of, and that's why the trades we're currently in. For those people who wanted the safer entry and indeed took it, well, there's a slightly different technique. There's entering at the halfway stage up the bar. We've got a bearish pin bar reversal rejecting this horizontal level, which is a good tell, actually. So what you can do is simply, for an aggressive entry, just simply anticipate price retracing at the halfway point, stop loss above the level of rejection, bearing in mind that it's very likely that price is going to take up the high of a bearish pin bar reversal, given that the bears came in very voraciously when price last dared to come up this level. And yeah, we just took it short. And we're just waiting. It's a waiting game now. Okay, so in other trades, we're currently short on Singapore dollar versus the yen. You're probably thinking, what the hell are you talking about? But actually, you know, the yen-based pairs, if you get an opportunity on one yen-based pair, you generally got an opportunity on them all. And we had this for trend-based traders. I know this is a little bit different from the strategy we talked about, but it doesn't matter. It's a trade we're in, and it's important that you see real-time opportunities and that are currently live for your wider education. We had this, what we call a ring high sell, and this was about 5 weeks ago. We had this opportunity to simply sell the bottom of this bearish pin bar reversal. It's to sell the rally in a downward trend. We placed our entry just below, stop loss above the high, and we had a good 1, 2, 3, 4, currently up about 6%, risking 2% of this trade. And we've got more downside. We're targeting the previous swing low, and we're anticipating eventually, a new low is going to be made. And that is that, really. We've still got some downside to be taking advantage of, and yeah, it's the power of trend-based trading. If we're simply selling the rally in a downward trend on the weekly time frame, we can be making 6% on our trading account over the course of a few weeks. This could be our nice summer break. I mean, we could just set this up and bugger off to Barcelona like I did last weekend without really caring what the market's going to do. Rationalizing in your head, okay, worst case scenario, I could lose 2% if I'm wrong, but if I'm right, I could make at least 6%. Okay, so that's the great thing about Sell and Forget trading, as George opened up this morning with his presentation. And it's a beautiful style of trading. A lot of people don't discover this style of trading until it's too late, until they've been jaded and they've lost trading accounts and they've chipped away at the golden nest egg trying to make intraday trading work. Ultimately, unless you're trading big money, I really don't think intraday trading is worthwhile, because you really are sacrificing a lot of time for very little relative return. So they're the trades we're in. I'll talk to you about oil very quickly, which is a slightly different strategy, but I want to talk to you about what we're in because, you know, it gives you an example. Currently in oil, on this bullish pin bar reversal here, 3 weeks ago. There we go. Let me just go back in time a little bit to simulate this, if I can. There we go. So what we saw with this was oil has reversed. We've been long on oil ever since February, ever since this formation of this bullish pin bar reversal, the high low. Seasonally, we've been quite bullish for oil back in February, so we took a long entry above the high, stop loss below the low, and we took our orders off. We tried our stop loss until this point here. Brexit, around that time, in advance of Brexit, sorry, we killed our order and we got stopped out, but we had at a profit. Okay, I think we got about 5.5% gain on this one over the course of a few weeks, or a few months even, sorry. But now what's interesting with oil is you've seen a reversal, bullish reversal to the upside. And this bullish pin bar reversal, as of the 1st of August, what it gave us was the acceleration point of what we anticipated to be an inverse head and shoulders. And that's what we're gunning for. Because if this indeed is an inverse head and shoulders forming part of a reversal, then we are in oil at a very efficient price, very efficient price. So this point here also marks the 50% retracement, just shy of the 50% retracement. That's good enough. Psychologically, anything that retraces 50% of an initial move, if there's confidence in the prevailing direction, then generally price will move in that direction. We also had symmetry with the right-hand shoulder here, what we anticipated to be the right-hand shoulder of an inverse head and shoulders and the left. So we thought, well, great. We've got the level, we've got the retracement, we've got the fact that the previous 1, 2, 3, 4, 5, 6 weeks highs had not been breached. So we said, well, hey, if this week's high is breached, then that's a significant event in the scheme of things. So we placed our orders just above the high, stop loss just below the low, and that is what we did to do it. And we're currently in oil long, and it's been surging in our direction. We've had a bit of retracement this week, but we've been very fortunate. If it breaks this neckline here, of course we're expecting a bit of resistance there as people are looking to unwind in this zone of supply, dare I say. But if it explodes past this point, you can expect it to reasonably go up to $60 a barrel up here, and that's good. That's good profit potential. You know, if you consider your entries here, your stop loss is here. That's what would you risk? You risked about $3 to make 52, about $18. 18 divided by 3. You know, that's good profit potential. So this is just to give you an example of kind of trades we're in and what we look for and how we identify opportunities. Okay, so I've talked to you about the currently trades over August, and yeah, I hope you can see that very minimal effort really went into identifying the opportunity. Once the trade goes in our direction, it's a very straightforward process of just waiting for it, waiting for the market to come to you rather than chasing the market. The last thing you want to do is chase the market. Okay, so you know that's a big point of trading. So just going back to this, I know we're kind of drawing to an end, and so one thing I'm going to do is talk to you about something which Simon and we are offering, London Investment Week exclusively for today only, is that we've got our Ultimate online trading program, which is valued at £1,997 or dollars. Sorry, should I say? I'll get that right. Duh. And I'll just give you a preview of it. I mean, we've got an online private trading community. It's an app-driven membership site where you've got access to trade ideas, what's in progress, orders placed, watch list, past trades. You get an idea as to what we've placed historically. You've got all webinars weekly as to what we're trading. You've got our trading team, access to like 40 years plus of expertise. Kaylee, Julian McCree, you know, these guys, they're top of their game. And we've got numerous video tutorials and flipbooks, over 15 hours plus, or 20 hours, should I say, on the psychology, which is the new section, which you've got. And, you know, we've got how to remove your emotions from trading, how to really kind of get you in a game, as well as the strategies, the all-important strategies, which I know a lot of people are big on, trading strategies. We've got all of them listed. We share with you every every kind of trade which we take. You know, we don't hold anything back essentially. We've got a forum, the membership community, which is pretty active at the moment. We've got our expert Chris Rivaldi in there, who is a very good trader, seasoned trader himself. We through him through the process. So that is essentially our flagship online community. We've got everything there you could possibly need to make a success out of end of day set and forget trading, so you can trade from as little as 10 minutes a day and feel supported in that. Okay, so we have our online price, which is $252, but all I'm going to give you is a 1 month test drive for $30 only. So you make a huge, huge, huge saving. And you know, if you're not happy, you can get a full refund. It's no big deal. But just to reiterate, you get access to 10 hours plus, 15 hours plus of video tutorials, strategies, our trade ideas. We've got bespoke programs like our Trader Hypnosis audio course as one of our bonuses. We've got pattern recognition software, and all dedicated to helping you become a profitable and successful trader from as little as 10 minutes a day. If this is of interest to you, then just simply go to www.thelazytrader.com/training, or the link that Simon puts in the window. Read the terms and conditions, buy the ultimate program, type in the promo code round the clock to get your discount, and we look forward to seeing you on the other side. Okay, but like I said, there's absolutely no risk. Full refund if you're not 100% happy, and I will say, nobody's actually asked us for a refund as a result of one of our offers before. So there's always a first, I know, but essentially you've got nothing to lose from this. So, you know, no love lost if you decide it's not for you. That's fine. But otherwise, we look forward to seeing you on the other side and working with you. And we'll open up the floor to questions if you have any.
Rob, thank you very much. Yes, lots of questions coming in. Very enthusiastic audience we have this morning. George, we ran out of time for George's questions, and I fear the same might be true. But if we can try to go through them relatively quickly, we'll try and address as many as we possibly can. First question from James. Do we need to be watching for a period after placing a trade, and how long in general?
Oh no, don't worry about that. So you place your trade up and then you can walk away and don't do anything. Don't need to. If you're trading on the daily or the weekly, you trade literally on that time frame. Once you place the order, there's no reason for you to come back to that trade until for at least another 24 hours if you're trading the daily, or for another week if you're trading the weekly. So it's very, very low maintenance. A lot of people struggle with this whole concept of less is more.
Mm-hmm. Paul's asking again on this timeframes, is the strategy suitable for only daily and weekly timeframes, or does it work also on the 4-hour timeframe?
Yeah, absolutely. You can trade it on the 4-hour time frame, but you need to have more of a cursory glance at news announcements throughout the day, throughout the week. So I can't bother with all that nonsense. So I tend to keep it exclusively for the daily and the weekly time frames.
Okay, thank you. Ray, he's commenting on the momentum on the New Zealand dollar and the Canadian dollar, saying the momentum's up. Could this break through and continue?
Is this to do with the example which we showed? Was this New Zealand CAD or New Zealand?
Yeah, New Zealand CAD.
New Zealand CAD. Well, that's the thing. I mean, there have been examples where the momentum coming into the level has been high, but we've seen a decent reversal, or at least as much a reversal to lock in profit before we either get stopped out for a decent profit or it continues to go in that direction. So it's very difficult to gauge that. So I just have a rule just to simplify everything and not bother to look at momentum. I know it seems quite counterintuitive, and as I said, a lot of people don't like this strategy because it does feel like coming in the way of an oncoming train. But for those people who have the forgive the expression, the testicular fortitude to do it, and are happy with the set and forget nature of it, then it's for you. There are other ways of trading reversals, which I'll do another time. There's a 3-step process, which I use if you want a bit more safety. Some people wait for a price action-based reversal. We had that for New Zealand CAD with the bearish pin bar reversal. Those who want a safer entry, I discussed a safer entry at the midpoint of the bearish pin bar reversal, which closed a few weeks ago. for those other people who want an even safer entry, then they might want to go for a lower high on the weekly or indeed the daily. But we had that on the daily.
Okay. Gene says, sorry, he came in late to the webinar, so he may have missed this, but can you just reiterate how you use moving averages?
Oh, not for this strategy. We don't really mind about moving averages for this strategy at all. It's one of the strategies where moving averages are obsolete. We use them for trending strategies, like TrendRider Pro, which is one of ours. We use moving averages, the order angular separation of the 20, the 50, and the 200. And we're very specific with that, but for this reversal strategy, we don't really care about moving averages at all.
Okay, thank you. Manhar says, how do you find the trades that are trending between support and resistance?
How do I find, sorry, between support and resistance?
How do you find the trades that are trending between support and resistance?
Okay, well, what I like to do is simply go to the weekly time frame. The higher the time frame, the easier they are to spot. So what we can do is just say, let's pick the FTSE, for example. And if I don't see it, say on the daily, say if I don't see the decent levels on the daily time frame, then what I do is I simply just go, well, hang on a minute. There are big levels here, but we'll get more clarity on the higher time frame. So we go up to the weekly, and we can see on the weekly that, okay, this level here at 68.80 is a decent level to sell at, or it was back in 2014-15 before we broke to all-time highs. But since we've broken to all-time highs in 2015 and that level since breached, we want new evidence to suggest that this is a level that's been respected. So I want at least 2 tests of this level in isolation before I can put my order on the third test. Let's talk about another example as well, just very quickly. New Zealand CAD. I'll just go back to that one as this is one which just revisiting. But okay. So you might, on the daily, you might think that this, okay, it's quite straightforward to see on the daily, okay. But if you, say for example, you don't see it very easily on the daily, the levels, what's trending between the levels of support and resistance, then I'll just encourage you to go up to the higher order time frame at the weekly, okay. You can see how much easier that is to see down on the daily, okay. I hope that answers your question, whoever asked it.
Yep, that was Manhar.
Manhar, thank you, Manhar.
Okay, Hezbon asking a question about leverage in context of spread betting, I suppose. What is the least amount of leverage you can advise someone?
Well, I've never really, to be honest with you, I always enjoy 100 to 1 because as soon as I put my trades at break even, I consider it as a no loss outcome, for example. So as far as I'm concerned, it's a clean slate. So I know some brokerage accounts won't let you, they'll require you a maximum of like 5 trades, depending on how much you risked. I would say 100 to 1 is absolutely fine for me. Any less, I would not be too happy.
Okay, and I think you've just done this as well, also saying please give us an example of how you draw your support and resistance zones.
Okay, well, what I'll do is I'll simply just go to the chart and do this for you, and I'll just try and align up as many tests as possible to get that fair kind of. Let's just remove this, and I'll show you exactly how to do it. So let's go back to the drawing tool. So what I'll do is I'll just simply try and line up as many tests as possible, so I can see that okay, we've got 3 tests on the right-hand side, but there's one that's broken through. But this level, the net sum of all 1, 2, 3, 4, that's the best possible fit. Okay, so I'll always look for the best possible fit. And of course, you're going to always typically see like points where you've seen a breach of the level, but as long as you haven't had the close above or below it, then it's a valid level.
Okay.
Is that okay? Does that answer the question?
Yeah, thank you very much. Sanj is saying, can we use this strategy on MT4, or is it only on eSignal where there is a cost?
You can use it on any kind of charting software provider, whether it's MT4, whether it's e-signal, it doesn't matter at all. What matters is the information it's giving you and whether it's actually correct.
Okay. Now this one doesn't have a name, but it's do you use divergence on your trading, i.e. the MACD on a daily time frame?
I do for other strategies. If, for example, I'm looking at trending strategies, I look for reversal divergence after a pullback, very short term. If I'm looking for a safer entry into reversal, if I'm scaling into a position, then I'll use reversal divergence as an additional tick in the box. Yes, so yeah, that's correct.
James, just come back. You answered his question earlier on. This is a follow-up. He says, but what about managing the first stop? Just to give you, James was asked if he needs to be watching for how long after placing a trade should you be watching a trade. So he's come back and just as a follow-up to say, what about managing the first stop?
Okay, so what I'll do is, watching the trade. I mean, I would simply say you're trading the daily. Go back once a day to just see how it's doing in terms of management. If you're on the weekly time frame, look at the trade once a week. So trading can be very low maintenance, very, very low maintenance. But what people struggle to do, and this is something which I always encourage you to do, is to rationalize and just say, well, hey, what is the best possible thing that can happen if I take this trade versus what is the worst possible thing that can happen if I don't take this trade?
Okay.
But these are all very good questions. Very good questions.
These are great questions. If you trade the daily chart, you don't look for example to the weekly chart, Marcello. So if you're trading the chart, yeah.
Sorry, the weekly chart's always going to have higher significance than the daily chart because the levels are typically stronger if visible on the daily. If visible on the weekly and the daily, the levels are a lot stronger on the weekly. But I would always prefer a level off the weekly for those advantages.
Okay. Question from Zahir Anwari, who is another one of our speakers around the clock. Okay, Zahir is saying if 80% of reversals fail and that results in 160% in losses, how many trades does one need to make money?
Very good question. I would say, I mean, that statistic, 80% of reversals fail, has admittedly been lifted. I have from a book which I read, I believe it was Trading the Zone. What I would do for reversals, trading them myself, is scaling into them, and I would have a third of position onto the horizontal level. I would have the third of position onto the price action based setup, and then the third of position on the lower high if I'm going short or the higher low if I'm going long. That's a great question. I mean, I say 80% of reversals fail to scare people into it because a lot of people, I started with reversal trading and admittedly, I kind of wish I hadn't. But through accepting that they're a lot less likely to succeed than trend-based setups, I was happy to sustain the losses in order to ultimately get the wins. Let's take a look at pound Swiss, for example. Let's go here. Let's try and get to this one. Okay, so pound Swiss, around about Christmas time. No, it's 1st of December. I'm just going to try and go back in time here. There we go. Forgive me, I'm on my laptop and it is a pretty...
Just got the last 30 seconds if we can.
Okay, well basically we saw on the pound Swiss that this kind of setup here on the weekly was a solid level, one spot 5,500. And okay, it hasn't broken in years, like 2011. These are the typical kind of reversals I look for, multi-year highs. So we placed the order on the level here, 150 pips stop. It came up to that level, and then it reversed. I believe on the daily we had an opportunity to add to the position. We did. This bearish pin bar reversal here, lower high, gave us another opportunity. Not only were we breaking our stop loss to break even on the first entry on the level, but we were able to once add to the position by placing another trade on that lower high in that reversal, and it went all the way down. So you can see we essentially doubled up to the position without risking more. Okay, so those kind of outcomes are the ones which really make good the reversals which fail, ultimately. Okay? But the 80-20 rule, I just like to say 80% of reversals fail. With the 80-20 rule, your 20% of wins will generally look after most of your losses.
Okay, listen, thank you very much, and thank you, Zahir Anwari. Those of you that know Zahir, of course, from other round-the-clock events will know that he's a proponent of the longer-term trend trading, so thanks for that input. Rob, we'll need to cut it short. I'm afraid we've just run over the hour yet again. Thank you to everybody for such fabulous questions. It is great to have such interaction this morning. So I've put if you want to follow up with Rob, the link is in the chat box, thelazytrader.com/forex-training, using that promotional code round the clock for the $30 offer. So Rob Colville from The Lazy Trader, thank you very much indeed again for joining us this morning, and we'll hope to hear from you again. But in the meantime, I'll take the presenter role back from you. Many thanks indeed.
All right, thank you, Simon. Thank you very much indeed.
So there we are. Thank you very much again to Rob, and we are going rapidly through the morning. It's already just gone 11 o'clock, and I'm pleased to say that our next speaker, Steve Ruffley, is here waiting in the room. I'm especially grateful to Steve, having done a last-minute change of time slot, due to be speaking later on at 6 o'clock. He kindly brought that forward at 11 a.m. To accommodate Alex Spiriglou, who had a time conflict. Alex Spiriglou from Trader Training will now be speaking at 6 o'clock. So all good for us who are here in the morning sessions to welcome Steve Ruffley, Chief Market Strategy at intertrader.com. Steve, good morning. You should be able to hear me now.
Yep, morning Simon, I can hear you.
Oh, great. How are you doing? How are things?
Yes, well, had to get out of bed especially early for you, as you said, so you do owe me a pint for that, but no. No, all seriousness, here in Jersey, it's another beautiful day. I'm just looking over the sea. It's really nice. A nice day for trading as well. It's
Wonderful.
been a great morning.
Wonderful. Well, we are pleasantly surprised with the turnout for today's event, and also the quality of all the questions. We've got a very engaged audience, which is fantastic news. And we've spent the last couple of hours looking at various sort of lazy trading, set and forget strategies. And Fibonacci popped up, and I said to people that you were going to be focusing a little bit more on the Fibonacci, which is, of course, your chosen levels, the chosen indicator for your trading. So hopefully you can shine some light on that, and also give us a bit of a market update in your way that you do, which we appreciate. So what I'll do is hand over the controls to you, make you the presenter now.
Okay, can you see my charts?
Wonderful. Yes, I can see the 8 windows that you've got. If we could just ask everybody at home to quickly confirm also that they can see Steve's screen. That's great. So we are all systems go. Stephen Ruffley, Chief Market Strategy at Intertrader, I'll hand over to you. Thank you very much.
Okay, good morning guys. Well, here we go again. The market's been fairly interesting over the last few days. I think my basic rule, the kind of 80-20 rule that I've talked about for many, many years now, this idea that markets move 80% of the time in a technical manner and 20% of the time in a fundamental manner, maybe shifting a little bit. It's interesting. I never listened to any other presenters, but I was listening to the previous speaker, and he was talking about, set and go strategies where you put them in and you walk away. And he's not interested in news. No, he's not interested in that stuff. My biggest trades have been made by that stuff. My 10, 15, 20, 30, 40, 50,000 pound days have been made from news, from events. So I don't think you can ever, in modern markets, discount the power of this underlying drive of the fundamental data. So again, key interest rates decisions. If you think Janet Yellen, she's really sitting on the fence and being data dependent. So every non-farm payroll counts, every GDP figure counts. It's all counting to what's going to happen. If you're trading the currencies, again, these are big shifts. So even 0.25% in modern times of rate hikes for the US is absolutely massive. It's massive for every currency that's traded against it. So it's always interesting, when you kind of go back into the other sphere of other people, selling their ideas and selling their strategies, etc., etc. For me, I've never sold any strategies because my strategies make me money. So why would I sell you my strategy if I can make money out of it? It doesn't make any sense. So what I try to do is help people understand the relationship between what you can see now, what's happening in the markets right now, these 8 markets, okay, and what's happening with the effect of the fundamental shift and push on supply, on demand, on people's long-term, short-term, kind of medium-term views on the market. So, for instance, the DAX was a great one this morning. If we're going to talk about Fibonacci, that's purely in the 80% of technical. Now, Fibonacci I use in my strategies. My book has, a big section dedicated to it. I have algorithms using Fibonacci because it just works. There's 2 ways that I've always talked about Fibonacci, and that's a strong directional move or some sort of breakout spike type scenario. So if you're looking at the DAX, for instance, we made 7 grand this morning on the DAX. Real money, not really particularly difficult to make that amount of money when you're trading large size. But again, I've helped other clients that I mentor use these kind of simple strategies. And you look at the DAX this morning, okay, so if you're talking for a longer term trend, you're talking from maybe the highs to the lows, this big sell-off here, you can do Fibonacci and whatever you want. A lot of people get confused about Fibonacci. But really what we're looking for is using the past to help us predict the future. So what we see on this hourly chart here is the market opens up, we look pretty negative, and then we have a fairly decent sell-off. Now, when you're using any kind of strategy, you have to kind of back up your technical view with something else. So all these lines here are Fibonacci. So the red lines are expansions, the green lines are retracements, and the 50% is the pivot. So what this is telling me is all my lines on my charts are automatically updated and automatically, generated by iView charts, the system that I use to run my hedge funds. So what we find is the market here is always finding a pivot point around that 50%. So if you wanted to sell around that 50%, you are making good money. I mean, if you hold on for a couple of hours, 250 ticks. From this, again, if you sold on and held that over a couple of days, again, 188 ticks. So these red and green lines will change, with the different market conditions. But what they do show you is that Fibonacci is always looking at what happened in the past to help you predict the future. So if we're looking at it right now, then essentially we see 3 selling red candles. So high to the low, we hit these 2 daily levels here, break them, briefly, but then we don't close outside them. And then the next hourly candle opens up. Well, where's it going to get to? You start buying above this daily level, you get back to 38.2, you get back to 50%, bang, you get back to 61.8. And that 50% again, tell me that isn't working as a point of interest. Now, again, if you're thinking that the down move is going to continue, you can sell back at the 50% and you've got the 23.6, break the new lows, support to aim for. Now, that's kind of like a shotgun approach to Fibonacci. But realistically, you can put that onto any market, onto any scenario. All you have to find out is what is set in stone. What is an absolute I can go to with my Fibonacci in order to use the Fibonacci levels as an indication of what will happen in the future. And again, referring back to the previous speaker who was saying about an 80% strategy, etc., etc. That's when I look at Fibonacci, this 50%. 50% of the time, if I'm buying or selling Fibonacci, if I've got it right and based it on a strong directional move or an overextended candle, then 80% of the time doing that, I make money. So it doesn't mean that you have to hold trades for days, weeks, or months. You can hold trades for 5 minutes, 15 minutes. You can trade 10 times in an hourly period. All I'm looking for is something that is set in stone that I understand. So I understand the DAX has opened, it has gone down, okay, it has hit a couple of daily levels and closed inside that. The next hourly candle has opened inside the lows and the daily levels. So I'm thinking, well, if I'm a DAX trader, probably the best idea after all that selling action is I start to buy as people get out. The market will go up, profit taking. And also, if we look on the higher time frame charts, which I'll show you in a minute, every time we've hit new lows, the DAX in recent times has bought back up. Now, again, when you look at that technically, that's 80%. But why are stocks buying back up? Why are stocks so high? Why do stocks keep falling and then getting bought back up? Well, again, it goes back to the fundamental side, people's thinking. Okay, interest rates have been cut in the UK. They're going to get cut again to 0.1, so it seems. So you get no return for your money in your bank. If you're a top 1%er or you're averagely rich and have 100,000 quid in the bank, then you're getting nothing back from it. Literally nothing back. So people have turned their back on safe investments, on the establishment, and are buying stocks which are still a risky investment to get some sort of return. You get the 6-7% average percent. The market's been going up a year, and you get your dividends. So it's kind of a win-win. And while the stock market is in this nowhere else to turn to mode, then it just seems a no-brainer to buy stocks. This is the great thing about having all your charts set up. I was going through this exact scenario with one of my clients this morning, and he was saying that, yeah, I was selling into the weakness, but I really wish that I bought the bottom of the DAX and let it spike back up. Well, that's what I said. You go back to all time frames. Okay, we might be looking in the short term on the 5-minute charts, the 15-minute charts, the hourly chart. But look what's happened in the past. Use it to predict the future. So this with the dailies. Every time we see a significant pullback on the stocks, we then see green. And this is a trend you'll see on the weeklies here. All the time we hit these lows and leave these tails, these wicks to the low side. Yeah, the market goes back up. Monthlies, the same. Look at these big trend lines working. Big trend lines. Rejection, higher. Rejection, higher. Rejection, bounce, higher. Rejection, bounce, higher. Because nobody has anywhere else to put the money. Okay, so people are putting it in stocks, and everything is value. Everything is value when you get no return from a standard bank on your deposits. So that's why the market is going to continue to go up, because it seems that only the US is trying to stick to its plan of normalizing rates. Everybody else is cutting them and getting themselves in all sorts of trouble. So when the stock market corrects, it will correct massively. But for now, we're buying dips. That's all we're doing. So you start off in your dailies, and again, you look for your trend lines carrying through. So when we break through this trend line briefly, okay, you have to take some pain if you're long the stock market's here. But once we close above that trend, it's inevitable, isn't it, that stocks are going to carry on to make new highs, because every time, again, we see any kind of rejection to the low side, we get bought back up. So a couple of days back, we see a rejection, market closed back up, and it goes green. So again, market slams down this morning, no news out, no real sentiment change. So what do? You buy low. So that, again, is the perfect opportunity when you're looking through your different time frames to look for some good indicators. So here we have my bias. My bias is green. Okay, so it's a buy here on your 15 minutes. You get a double confirmation, which you very rarely see on these two indicators, and that's a massive buy. So if you look at your 15-minute charts, you're thinking, wow, this market is aggressively selling off, but wow, we've got two daily levels here. We're outside the Bollinger Bands. Both these indicators are saying buy. What am I going to do? Well, I'm going to buy. And where'd you buy to? The 50%. So just drag your old friend Fibonacci, yeah, from the high to the low. Where's that 50%? Bang. So I mean, it almost writes itself. You buy, the rejection of the daily levels that we see here, back to the 50%. You made yourself 65 ticks, and if you'd been brave, you could have held on to the 61.8. But even then, you've got time to get out, down to the 38.2. So no matter how you look at it, I do big averaging strategies. So I'll be buying all the way in this candle up to 23.6. You got yourself 30 ticks in order to get yourself a nice big fat average. I generally do about £500-600 in total, so maybe 6 £100 a point clips. So you get to here, then you wait for that 50%. You've averaged in 30 ticks. You make yourself another, 40 ticks on top of that on big size. That's your £7,000. Happy days. Yeah? And if you want, you can sell the spike. And this is the whole point about Fibonacci. It just gives you a framework. So what I'll be looking for now on the way forward for today is, what's the market going to do? Is the market now going to reject this 50%? So I'm selling a break of the 38.2, buying back at the 23.6. Or am I aggressively thinking that maybe some data this afternoon or the sentiment's changed and we're suddenly going to move into a selling market Well, I don't know. Anything can happen. I'm not really interested in the long-term view. I'm not really interested in, what's going to happen next week. I'm not interested in clicking, a buy or sell trade, walking away and then coming back to it. I'm in the business of making money. Trading's not about being right. It's about being right at the right time. And that's what Fibonacci gives you. The ability to look at that 50% on a move that you know will filter through for the next hour, 2 hour, 3 hour, 4 hour, and trade it all day long. So when people are saying that, yeah, I held on to a trade for a week and made, 600 ticks out of an up or down move, well done, great. What have you done in that mid-time? What, you just sat there, twiddled your thumbs, go walk the dog? I'm not interested in that. I can make 600 ticks in 15 minutes. I can, can trade 10, 15, 20 times a day and make 10 times that amount by, not really having that opinion if a market will go up, if a market will go down. I don't care. As long as it moves and I understand the parameters in which it can move, then we're set, and this is it. So today we can see maybe the Fibonacci, we hover around the 50%, and we break back down, and we get down to 1050, maybe break these lows and see where the market can go. Well, they've got another big daily level here at 103.72, or more likely we're going to find support above the 23.6, the 38.2, use the 50% once again as a pivot point, and then go on to make new highs. So from when the market opened and sold off, then you've got your targets, 106.13 spot 2, then if it breaks previous highs, 106.5 spot 2, and then again your Fibonacci expansions. So I'm not saying that the market, is going to sell off 145 ticks in this period and then reverse and go up, another 90 ticks. But, stranger things have happened. At the end of the day, I've shown you with the kind of daily trend, weekly trend, monthly trend, that markets that reject that sell-off, these stock markets, and, put them all in the same class, the FTSE, the DAX, the SMI, the S&P, okay, all of them have the same charting patterns on the higher time frames. They've all rejected those closes towards the low and the higher time frames. So that means in the short term, medium term, there are buyers. Buyers are plenty at even these high levels that we're at now. So that's just an example of using Fibonacci. You pick a strong directional move, and that is a strong directional move. Yeah, 1, 2 green candles, well, 3 green candles in these big selling periods. That's a strong directional move. You don't make a new high, you don't make a new low. So this is set in stone. The 50% is your pivot until we make a new high, until we make a new low. Okay, so until that point, you can either say market's going to make a new low, carry on the trend, or we're going to hold above the 50% and carry on the longer term trend and head higher. Now, this is again where you have to use your other indicators. So if we're still green, we're undecided in the markets now on the smaller time frames, but we've had the green, we've had the bounce. So are we going to go from green now to red? And that signifies that we're going to then sell. I mean, these indicators are indicators that I've designed over the years, and they're a combination of many things people talk about, MACD, RSI, stochastics, etc., etc. Now, for a long time when I was a very young trader, we're going back 15 years, what's the word? I was cocky. All right, I was very cocky, I was arrogant, I was aggressive, and I thought I knew more than anybody else. So I was a real counter-trend trader, and I wasn't interested in what other people were looking at. I was going to reinvent trading. I was going to change the world. I was going to look at charts in a way that nobody else would ever look at them, and I was going to absolutely take the world by storm. And it took me, I was very successful for a short period of time, and then markets kind of tightened up and it got very hard. So I went into this mode of almost like self-evaluation. I was like, well, why is this happening? Why is this happening? And then I kind of got the idea that it shouldn't be about having the only strategy nobody else knows. It's being smart. It's understanding a strategy that everybody else is looking at. Okay, and when they're right, go with them. When they're wrong, go against them. So I took all the indicators that I know, Fibonacci, stochastics, MACD, RSI, moving averages, and I put them into a complete kind of overview of the markets. So I knew at any one time, on any time frame, on any product, if people were buying, if people were selling, okay, down to those indicators, and if they were they right or wrong? If RSI is at 88 and a market is still spiking and making new highs, well, I know that people are getting caught short. They're getting squeezed out. The market will be going up aggressively, pushing people out because people are selling this indicator. So what do? Well, I can either do one of two things. I can buy into that spike, or I can wait for the spike to overextend and exhaust itself and then sell. So when people are getting killed at RSI 88. I might let it get to 90, 91, you know, huge levels, and then sell it high. So this is the whole point of iView charts and having this view, that no matter what you do, no matter what the product is, whatever the time frame is, you're still looking at it with fresh eyes. So all these levels, as I say, that's Fibonacci on the 5 minutes. All these levels are Fibonacci on the 15, all these levels are Fibonacci on the hourly. But then all the big lines, the dotted lines, are daily, weekly support, daily, you know, resistance, points of interest that have been proven to have held and to kind of been set in stone back in the charts. And then you look. So I mean, again, even though we see on the DAX here lots of daily, you know, selling opportunities based on the bias, the real opportunities in the short term, I think, on the smaller time frame charts, to buy back. So you see 3 hours of selling, but it only takes 1 hourly candle to get back to the 50%, well, even higher, the 61.8. So even though you have to wait 3 hours to get the most out of the down move, in reality, you only have to wait, you know, probably 45 minutes on the 15-minute charts that we see here for the bounce to happen and to make your money. So as I'm saying, you can wait in charts and positions and trades for hours, days, weeks, or months, or you can just pick off these big, fat reversal candles. Now, that's the stocks, okay? So when we go back to our overview, that's just looking at the stocks. I mean, the markets are much more complicated and complex than just looking at stocks. So I'm always looking for correlations. Well, if stocks are bouncing high, then you want to be selling gold, and gold's coming down. Okay, so again, you can do the same with gold. Yeah, I'll show you a big kind of Fibonacci on gold, you know, just to kind of get your head around this. But I mean, if you're looking at this particular move here, then what I do is a little trick. I do Fibonacci. I class this really as a strong directional down move. So I draw it in the opposite direction. I draw it from the low to the high, because if I think the market's going to go down, I want to see where the expansion points are. So the 50%, you know, has acted as a, you know, real strong indicator that the market didn't want to bounce back up from these low levels. So we've ground down. So eventually, if we're going to break and continue this down move here, then, you know, we're looking for the 50% has already acted now. So we're below the 50%. So we know that is set in stone. That if we do make a new low, that theoretically, if Fibonacci is going to work out in our favor, then it's going to go to these expansion points. Okay. So expansion points are 161.8, 261.8. So the market has moved in this down move 160 ticks. So if it goes down from this point, it can go 99 ticks, or it can go 255 ticks back to the expansion points. So that's another tip with Fibonacci. You know, make it work for you. If you want to see a down move, then, you know, draw the market draw the Fibonacci in the opposite direction from the low to the high. Because generally what you'll do is draw the Fibonacci from the high to the low, and then you get expansion points on the high side. So if the 50% was acting here, well, if we have made a new low, but if we start to bounce through, and that seems like a bit of a fake out, we get back to the 50% here, then you look in the opposite way, get to the 61%, get to 100% here, and then break above 1340, and then you'd see 1349 and around about 1364 would be the natural point for gold to go back up. So again, I mean, that's longer term views, isn't it? You know, again, I'll show you the gold chart on the monthlies. Now, it's far too messy. This is the problem with charts. You can make them look too messy, but if you want to just get a gold chart up from blank, I'll show you where we are with okay, hunt for gold. The only problem with MT4 is it just never has the right search facility for me. So simply put it on monthly template, monthly view. So this is gold. So if you want to know what gold's going to do, as again, you look from the past to predict the future. So absolute lows to absolute highs, where's that 50%? It's here. So I was pretty convinced, to be honest, at this point here, previously in gold, that we were going to hit back to that really important key $1,000 a level mark. But we just couldn't get there, could we? And obviously, this is the point. Now, technically speaking, we have gone through the 23.6, 38.2, and the 50% has acted as a significant point of interest. Okay, around that 1301.6 level, significant interest in the past. Yeah, Fibonacci tells us that if it goes on to do this, then it should go on to make a new low. So again, we're looking for the 61.8 again, the rejection here, and I thought definitely at this point, when we've got as low as 1065, that the market's going to try and test that $1,000 a level. But then with China slowdown, interest rates, Brexit, blah, 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 fear, Zika, whatever else you want to kind of throw into the mix, then the world's changed its tune, hasn't it? All of a sudden, no, the world's falling apart. Where do I put my money if I'm a 1%er or wherever I'm a big central bank? Let's get back into gold. So technically, when you've watched and exhibited a trend for this long, you would expect that just by sheer odds, gold would at least test $1,000 before it bounced. But going from the fundamental side, a lot of this fundamental or this moving gold is due to fear, the fear and greed. So other people saying that, I just fade out the news, I fade out Brexit. You can't fade out things that are this big because they fundamentally change the actual desire for products. And that's why they're called fundamentals. They actually change the way people think. So you could be as technical as you want and fade out as much, short-term news as you can. But when you get key big events like a Brexit, and with something with Brexit is there is no president. You don't really know what's going to happen. Doesn't matter if you're Mark Carney, Janet Yellen, Steve Ruffley. Nobody knows what's going to happen after Brexit. Nobody. So what do? People are sheep. People go back to tried and tested measures. If I'm fearful of my assets, I diversify, put it in something solid that's been around, something that's physical and tangible, bang. That creates tremendous amounts of demand for gold. Gold goes back up. So in this scenario, what we're looking for really on the higher time frames is what gold does around 1300. So going back to the fundamentals, the world hasn't ended. Brexit, in all effect, could actually be good. It could actually be good to sort out property price in London. It could be good because anyway, we're a service industry, not manufacturing, so there'll be a lot of services associated with the Brexit. And really, the world's pretty good, and the UK especially is pretty good at just getting on with things. So are we going to crumble and collapse if we're outside the European Union? Of course not. It's just nonsense. So that could then change this desire to hold gold. We haven't hit the big kind of 38.2 and 23.6, and there are still a lot of long-term people short gold. So we start to aggressively get rid of this news-based spike. Then again, the trend continues, hold below the 50%, break the 61.8, get to $1,000, and maybe in a couple of years' time we're back down to the 100% and normal levels in gold, or normal-ish, at 695. Again, that's trying to combine that fundamental and technical view. But as I say, these are long-term views. Again, weekly, still long-term for me. Daily, again, you want to see what the dailies are doing? Well, this is an unusual spike, isn't it? So what you want to kind of do is, it doesn't really work in this instance, I guess, because we've made these new highs. But if we were just trading back upon this this weekly candle alone, then again, you look for that 50%. Well, if the market spikes up, it gets back to that 50% within 2 weeks, or 2 days, sorry. And, again, it's an 80% strategy. So 80% of the time, a strong directional move or over an extended candle, which this is. It's much bigger than the rest of the candles. It's something out of the ordinary has happened. 80% of the time, it will get back to that 50%. So bang, you can sell the next day, and then the next day it opens, goes lower, gets to the 50%, but the overall trend then continues, and the market continues because it's held above the 50%, 38.2, 23.6, and gone on to make a new high. So, again, you can use, it's dead easy in hindsight, isn't it? Because you can use Fibonacci and say, well, of course that was going to happen, Steve. Of course. Well, you just put that Fibonacci on, and of course it's magically just touched the 50%. Well, if you're doing the charts in real time, like I said, it's great. You can prove anything with, monthly charts, weekly charts, daily charts, because they're closed. They're set in stone. What we're trying to do is, use the open charts to make our money. Okay, and that's what we're doing now. So this morning we made $7,000 buying a bounce on gold on the DAX. Sorry, getting back to the 50%. Now it's not the only thing I only use. I don't just only ever use Fibonacci. You have to back it up with other things. But what we're looking at now is to maybe use Fibonacci on what's happening in the charts right now on the movement to figure out what could happen. So again, the UK, bang, we've bounced back up, but haven't really kind of retraced too much yet. So if I'm thinking the FTSE is where I want to be today, well, where are we trading in the grander scheme of things? Well, we've caught the bottom of the 423 spot 6 retracement level of where the market could potentially get to. We've hit a good daily level. So for me, I'd be thinking, well, not all doom and gloom. data's been pretty good, things have been pretty positive, so I'd be looking to probably buy the FTSE once it closes above the moving average and gets to a resistance point here, top of the Bollinger Band resistance point here, and maybe as high as the 50% that's worked in the past. So again, I wouldn't be buying and holding till 6.8, 6.2, but what I would be looking to do is to see small bounces on these levels and maybe trying to get 10, 15, 20 ticks every time they shoot up. Again, it's another strategy. I mean, you're either looking for a strong directional move that kind of is going to show you a pivot point in that 50%. You've either made your money from it, or you're waiting for the US Open at 2:30 to then let the market do what it needs to do. So if you've seen this downward move, you've done your Fibonacci on it, and we don't hold above the 50%, you're going to see that when the US traders open up and the cash market is open in the US, they're probably going to say, yeah, the same thing. We've sold off, go back to the 50%. Well, there must be a reason for this, so we'll carry on selling down and see if we can trigger some more stops before people buy it back up. Or they come back in and they say, right, bit of a sell-off, completely rejected very quickly, holding above the 50%. Well, the longer-term trend, daily, weekly, and monthly, has been buy dips in the stocks. Let's send the S&P higher, above 2,200. Everyone will jump back in, buy the Facebook shares, buy the Apple shares, DAX, FTSE will follow suit. Okay? I mean, has anybody got any questions about Fibonacci? I mean, as I say, you're looking for that strong directional move that shows you that pivot around the 50% that can send you higher or lower throughout a period of time. Now, generally, I'm only looking for the intraday Fibonacci's for that purpose. So if I look at a good hourly Fibonacci scenario, then I'm just trading around that 50%, maybe on the 15-minute charts or the 5-minute charts. Now, if I'm looking for a longer-term trend, then that's just to back up a trade I'm in, because I'm not going to hold a trade for a day, a week, or a month. I mean, if you look at the stats, nearly $5 trillion is traded on the FX markets alone every day. Now, you don't need a large percentage of that. If anything, you need 0.000000001 to make yourself a very handsome living. So I'm not interested in holding and being right. I'm interested in being in the markets at the right point where my technical analysis ties up with some fundamental views, ties up with my longer term views. And then I'm in for 15, 20, 30 ticks. If I get 50 ticks out of a move, happy days. When you're trading hundreds and hundreds of pounds a point, that makes it worthwhile. And that's the mentality hedge funds have. That's the mentality banks have. They're trying to make that big swing or that big kind of hit in the markets and make some good money while they can. And then also what they're doing is the opposite, is when the markets have these big swings and moves, they're creating this volatility by putting huge amounts of orders, because banks can also hold things for days, weeks and months. So banks have it both ways. They can make money in the short term by getting into positions, yeah, by moving the markets and using that short-term volatility. But they can also use that to put huge volumes of orders into the market to then get positions to hold them for long terms. So it's all about understanding where you are in the market, who you are, yeah, understanding your enemy or understanding the competition. Yeah, everybody in the markets is there for the same reason, to make money. Doesn't matter how you do it, you just have to understand who you are and how you best perform in these current market conditions.
Okay, Steve, quite a few questions coming in.
Okay.
Let's go through Wayne and Jean. Similar questions on timeframes. What timeframes would you use most? And says Wayne, and Jean says, given the multi-chart analysis, which timeframe would you find most effective for entries?
Okay,
So,
I mean,
similar questions, yeah.
Yeah, absolutely. I mean, this is a question I get asked time and time again. I mean, if you read The Rough Guide to Trading, my book, I start with FAQs. I kind of turn it on its head. I've been asked, after 15 years of doing this, 15 years is a long time, I get asked the same question a lot. And I kind of got not tired of it, because I'm never tired of talking to traders and people who are interested, but there's only so much you can say. So I designed iView charts, this system that you see right in front of you, to explain my thinking. Okay, I look at the daily chart because that is set in stone. Okay, when you talk about monthly, weekly, dailies, they have a close that cannot be changed. So if I want to do a Fibonacci from the low in the DAX here at 10082 to the high here at 1080, then I know that's set in stone. It won't change. But an hourly can change. An hourly can move 200 ticks if it wants, and then can close with only one tick. So this is the whole point. If you look at the things that close to give yourself that framework that cannot be altered, then you bring that into the smaller time frames. I start to build a picture from the hourlies. So I build a picture from the hourlies because they are strong. Hourlies are 4 15-minute closes, so it gives you 4 potential signals in 1 hour. In 1 hour, a lot can happen. In 1 hour, not much can happen. But an hour, for me, and the open time frame scenario when you're intraday trading is the most consistent. So again, I'll just do the Fibonacci example. So I know that's been an absolute low, absolute high of the day. I know that. That won't change from where this Fibonacci scenario is trading right now. I know the 50% is at 1054.8. So that's great. I know that the market can easily go up and make new highs. It can easily go down and make new lows, and it can do that in an hour. It can do that in 2 hours, whatever. But we're going to need some movement, some emphasis for that to happen. So really, you look for the 12:30. You get 12:30, you get some US data, some kind of key data. That might do it. Or you wait for 2:30. Okay, market opens, the cash market in the US opens. Yeah, and that might move the markets. So really, if you haven't made your money by now, then you're probably a wait and see strategy. So what I'd be looking for now is to what's going to happen in the future. And I generally then, this is the 50%, pivot point here we've got in the hourlies. So I'll go back to the 15-minute charts. That's what I'll now be looking at, because if there isn't, that big emphasis to push the markets and any excuse for traders to kind of get in and put the banks to put this volume through, then we're probably not going to see as big a movement as we saw on the open. So really, all I'd be looking for is on the 15-minute chart, or maybe 5-minute chart, around that 50%. So what I'd be looking for, if we break the 50%, I would try and get it back to the 61.8, so try and make 17 ticks out of it. If it breaks the lows at 38.2, hit these lows here, I'd be buying back at the 23.6, and I'm making 21 ticks out of it. Not particularly exciting, not particularly interesting, but that is trading. Sometimes it just isn't that interesting. You've got this 50% window here below the 38.2, and above you've got the 61.8. So really that's where we're trading right now. That's our only options. So I'm using the Fibonacci that I've drawn on the hourly, okay, but I'll be trading off the 15-minute, and it's just basically scalping. So if we break the 38.2, then we're trying to buy back at the 23.6. How quickly that could happen? Who knows? But that's the trade. That's what we're trying to do. So with the lack of any other information, with the lack of any other kind of technical screaming out at me, that'd just be the trade. But if I don't like it, I don't have to do it. As I say, I've let the DAX sell off all it wants. I've bought above the daily levels, and I've bought it, back to the 50% and made 66 ticks. Happy days. We're good. We're good for the day. We've made a great deal of money in a very short period of time. But that's because we're prepared. That's because we've waited for it and we know what's going to happen. So again, a lot of people could have made the money selling it. But really for me, the smart money was buying the bounce based upon all the analysis I showed you on the dailies, weeklies and monthlies. So again, when you're prepared and you have your levels in play, the Fibonacci's kind of speak for themselves. So, you get the high, the low, your Fibonacci's, you've got your pivot point, you've got the bounce off the 2 daily levels here, you've got your indicators saying that we're at a low point, a potential buy on the bias indicators. On your 15 minutes, you've got a potential buy, and screaming here, you've got a buy, which you very rarely see these two green combined. So you buy the low, run the dailies, wait for the 50%, you make your $7 grand, go and buy yourself a Rolex, and then go out for tea and have a nice bottle of Dom Perignon. That's how trading's done. But you see, if you don't have these things in place, and you don't have these levels in play, and you don't have these overall view and picture in place, just to put that Fibonacci on now, on a blank chart, probably wouldn't give you the confidence. So, I could just show you. I can show you absolutely perfectly. If we just bring up a normal MetaTrader chart, here it is on the hourlies. So what's that telling you? Not a great deal. We can zoom in. So you think, right, okay, well, I don't really know. Maybe do a Fibonacci from the low to the high here. So market selling off, what do I do? Do I buy back here? Nonsense. That doesn't tell you anything. That's why MetaTrader is so one-dimensional. Until you do something with it, Fibonacci's don't mean anything, do they? Do a Fibonacci from here to here? Okay, well, go back to the 50% here, but now what do we do? Do we sell it back down? Is it going to continue lower, higher? Then bang, you want iView charts, stick on your hourly template, all of a sudden it's screaming, red, danger, sell it, pivot point, yeah, close below it, buy it back here, buy it back here, buy it back here, buy it back here, bang, make your money back. This is the whole point of why I've developed this thing over the last 8 years, is to to make things scream out. That you don't have to do the work. And this, you know, again, what you do is you want to trade gold. Well, there we are, gold, 50% pivot, bang, buy it back here, buy it back here, buy it back here. You know, it works on everything. The SMI, 50% pivot, bang, buy it back here. You know, it's kind of, it works on everything because it takes all the information we've used in the past and it puts it into every time frame you can use, like in this view. And, you know, you just trade any product from it. So, you know, if you're looking for the euro dollar, for instance. So euro dollar, again, big red selling kind of indicators here. We sell from the top, but really the market's bouncing. Okay, so for whatever reason, doesn't matter. Wait for your greens, wait for your big levels, double bottom here. And then, you know, the market's finding support on these levels, gets back to the 50%. Yeah, we hit the 50% here. So we're either going to go on a massive buying spree in the euro, or it's going to completely implode on itself and come back down. But at least you're ready for any outcome. This is the whole point I'm trying to make. When you listen to other styles of traders that have these very high probability win rates, they might only do one trade a month. I mean, A, that's boring, and B, the amount of size and risk you'd have to take to make your money holding the trade for that long doesn't make any sense to me. The whole point of being a spread better, the whole point of being an intraday trader is to be quick and be nimble. Use your margin, use your leverage, use your account size, use the ability to trade any products and go and find value. So it doesn't matter if it's the euro dollar, you know, the Canadian dollar, if it's gold, if it's silver, if it's oil, it doesn't matter. As long as you understand when you put it into this framework that what's happened in the past will more than likely repeat itself in the future, then you've got your framework. You then just go and hunting for value. So trade a bit of oil, trade a bit of gold, trade a bit of DAX, try and nick 20, 30 pips out of a market a day, and you do that with any kind of real decent size, and you can do 5, 10 trades a day, you're always going to outpace any, you know, big trader. And for every trader that holds these trades for a long period of time, they always tell you about the winners, but they never tell you about the losers, do they? You know, you might have 2 or 3 losers with your 150 pip stop, and you know, you have 3 of them, and you might wipe out your account. This is the thing for me. It's all about understanding what's happened in the past. Everything is there available for you. That's what I love about trading. People love to make excuses for them losing money in trading. Oh, well, I got stopped out, or there was a pin bar, or there was a stop grabber, or a short squeeze, or well, definitely paper came in and got me out of that level, right? They all know the levels you know. I know the levels they know. So you understand that this is the way the markets function. So understanding your place in the market, and you can't change this. And you can't get upset about it, and you can't get angry. You can't lose your focus. You can only control what you can control. And that's when you press the button to buy, to sell, or to get out. But being organized, being able to look at any product at a glance and understand what the markets are trying to tell you, that's the edge. Yeah, there are no shortcuts. There are no easy ways to make money. There are no guaranteed ways to make money. There is an easy shortcut, though, to being prepared. If you wanted to set up these charts like this every single day for the movement, you'd kill yourself. It's just, you know, it's too boring. It's too hard. But if you have them set up already, then you can have them however you want. If you want to be a short-term trader, look at all the markets in the 5 minutes. The Fibonacci's are still the Fibonacci's. You know, the indicators are still the indicators. Look at gold. So you've just sat here bored. You could have bought gold here at the low, spike back up. You made yourself 17 ticks. All you got to do is look at the buy, which doesn't happen that often, and a low point in the chart. So it doesn't matter. You don't have to be a gold trader to make 17 ticks. You can be any kind of value trader you want. So again, just go through the markets, see what's happening. Well, pound against the dollar, hit the 50% of the 5 minutes, hit the low of the 423.6. So maybe there's a little bit of a bounce due, you know, in the pound. Maybe we get back up here. You know, we're outside the Bollinger Bands. So if you want to just be a short-term 10, 15 tick scalper, you know, you can still use it, but then you're prepared. You know what the markets are looking for. Any of the questions are coming through, Simon? Did people...
Yeah, thank you, Steve. No question, but I was right, Paul V. It's not not a question. It's no question, but I use iView charts. Okay, which is your service. Kudos to you, Steve. On news events, I've been very successful with the spikes and sell-off / buyback after it reaches a level on iView. There we are. So happy.
Well, I mean, this is the thing, you see, because when you get these big news events, then people are scrambling around. If you see a non-farm payroll like we've seen, you know, massively, you know, out of line, you know, what the market wasn't expected, the markets are trading because of that fundamental change, that fundamental bit of information. But remember my 80-20 rule. That fundamental spike, that volatility, that interest, that movement in the markets will still only be able to trade technically. So what will it hunt for? It'll hunt for previous daily highs, previous weekly highs, or what I like to call them, areas of interest where significant support and resistance has been found. So this is the great thing. The S&P, if we see a terrible non-farm payroll, if we ever saw a minus figure, could drop down 300 points in 15 minutes, in 5 minutes. But then it'll be hitting levels of key support. And when it hits one that you see and you think the market's moved enough, then that's it. You buy the market low and let it bounce back up, because people naturally will profit take. And any spike you see in any data, again, using our friend Fibonacci, 80% of the time, a strong spike, directional move will retrace to the 50%. That's 80%. Now, if you go through your charts and you look for a big series of red or green candles and do that 50% Fibonacci, if it doesn't work, then that's your 20%. But I guarantee that if you go through your charts enough times and you pick the right indication, and this is why Fibonacci kind of falls down for a lot of people. They don't pick the right scenario. But if you pick the right, I guess this is a question I've been asked a million times. I know, but I've stopped talking now. People ask it. How do you know what the right thing is? It comes with experience. To be honest, guys, it comes with experience. That's it. If it looks right, it is right. So in this one this morning, it just looked right. We extended the Bollinger Bands. You can see them wide apart. We broke 2 daily levels but didn't close below them. So that just seemed like a perfect opportunity to draw a Fibonacci. And again, going through all the things I've said about the daily, weekly, monthly charts, we've bought back the stocks low, we've dip bought because there's nowhere else to put your money. It just seemed like a no-brainer. So it looked right. So that's why we did it. Now, people don't like that, because me just saying it looked right isn't something they can write down in a notebook. It's not something they can put on the charts. Well, that just comes with 15 years of experience. I can only take you part of the way there. I can give you iView charts. I can give you my, setups. I can give you my screens. I can give you my everything. My experience. But what I can't give you is my trading. I can't. That's my trading. That's what I do. And I don't teach people how I trade. I teach people how they can trade, how they can make the most out of the markets. And this is the power. This is the power that we have. I've got guys that have gone 18 days in a row this month, making £1,000 a day plus by my mentoring. Because it's not very difficult for me to talk to a trader and pick out what's wrong, because every mistake that's ever been made in trading, I've done it. So don't waste your money doing it. Waste my money doing it. I've done it. And that's the whole point of my book, The Rough Guide to Trading. I'm not trying to tell you I'm going to make the best trader in the world, but I'll give you some pointers of things that you just shouldn't bother trying, because they ain't going to make you any money. Because I've not only been a trader for 15 years and a fund manager, I've managed some of the biggest trading floors in Europe. I've taught hundreds and hundreds of people to trade. I've done thousands of these webinars. I've been asked every question. And the reason why I keep doing these things, you might ask when I look over my house or my swimming pool on the beach, and why do you do this, Steve? You probably don't need the money. You probably don't need the hassle. I do it because it keeps me sharp. It keeps me sharp, and it keeps me grounded. That I keep realizing there are people in the markets that have ideas, but not the execution. So by going over these things, the basics, and doing the basics well time and time again, that's what keeps you in the game. If you're trying to buy some strategy, you're trying to buy some signals, you're trying to buy some guaranteed edge from somebody, it doesn't exist for me. What I like to do is, if you put some effort in, I'll put some effort in back to you. And then we'll learn together, we'll be helped, you'll be supported, and you'll be a better trader. And what's more powerful is it'll be your system. It'll be yours, and you'll take ownership, and that's when traders become great traders, by that process. And I know, because I've helped a lot of people do it, and I've also had to say to people, no, you don't get it. You're never going to get it. This isn't for you. Yeah, and that's, again, can be quite powerful, because some people need telling no, that trading's not for them. And I'm not afraid to do that, because it's not nice seeing people lose, more money than they can afford. And trading can be, and is, a very brutal, occupation. So it isn't for everybody.
Okay, still another few questions. We've just got 5 minutes to go. Douglas says, Steve, are your setups automatically set before market open, and how many trades are you in at a time? He says the DAX trade was brilliant. I was too tepid.
Well, everything is set up. Everything is automated. This is the power of MT4. I'm not a programmer, to be honest, but I know a lot of clever chaps who are. So I just gave them all my ideas, my observations, and we refined them into what you see. So iView charts is like living and breathing. So the Fibonacci's you see in the hourlies, there will be a certain set of circumstances over the next, few hours, few days, and the Fibonacci's will adjust for the market conditions. Because again, like I said to you, there's no point going back, to 2000. Before that, because the world was a different place. We didn't have quantitative easing, we didn't have, fake money, we didn't have all these different kind of fears in the market. So you only go so far back. So iView charts is living and breathing. When things happen in the markets, it readjusts and recalculates. So obviously the weekly levels, daily levels, monthly levels, they'll stay pretty static. But your Fibonacci's will move around with the market conditions. So they're always set. And when big things happen, the markets and then the system adjusts for that. So, I mean, it's not really rocket science, to be honest. I mean, if you actually went into the formulas and you went into the programming took a long time, but the ideas took 15 years. But for me to put them down, it took less than a few hours because there's only certain things that work. And it's not just they don't work for me, they work for the market. That's how the markets exist. And I heard somebody, the last presenter actually, he was poo-pooing the moving average. Well, I don't put it on my screens. Yeah, because I've got the Bollinger Bands, and they are 2 standard deviations around a moving average. So I have some sort of moving average on there, and I don't use it to trade from, but I do use it for confirmation. But that is something else that a lot of traders look at. So it has to be in your system because other people are right or wrong based upon it. So yes, the charts will always move with the market conditions. And I mean, for me, I'll generally only be in one trade at a time, unless it's a big news event. And if it's a big news event, like a non-farm payroll or interest rates, that kind of stuff, I'll be in a stock market, I'll be in a currency, and I'll be in gold. But generally, with the size I trade, when you're trading up to, £1,500 a point averaged in, I'll generally just be in one position because when you're swinging 10, 15, £20,000 a time, you don't want to have two positions to be managing, and that's a little bit too extreme. But yeah, generally just stick to one trade because as I said to you, going back to things that I've said so many times, it's burnt into my my retinas. It's the markets trade $4 to $5 trillion a day in the currency alone. So you don't need big percentages. I'm only ever looking for anywhere between 15, 20, and 30 pips of a winning trade. If I get that blip and I get 50 or 60, it's just a double bonus. Yeah, I'm not trying to take the entire move out of any trade. I'm just trying to get the money. So that again, I mean, it works differently for different people. Some people are tick whores. Some people are, kind of in it for set amounts of money. For me, the experience kind of kicks in. I know when enough's enough. I know when to take that money.
Okay. Very quickly, Wayne, how many trades on average would you trade a week or a day? Is there a number you can?
I would say anywhere between none. That's another key thing of being a trader, sitting on your hands when you don't see anything. So anywhere between none and 5 a day. If I'm trading any more than 10 trades a day, I'm probably over trading. So averaging around anywhere between 30 and 50 ticks a week, I would say, is probably a good place to be. But again, remember, when you trade the kind of size I do, I'm taking, big averages. So, if I'm not kind of scalping, I'm just taking, big average positions for the short term. Then it might just be, that one trade and I'm done.
Fantastic. Lax says, if you have done your analysis and everything is lining up at a particular point, why not enter aggressively at that point rather than waiting for a candle close? Would you not get a better entry?
Yeah, I mean, again, it's all how you trade, and it's what you want to get out of the trade. I trade for many different reasons, and I have things at my disposal that other people don't. So it's a benefit for me to put big volumes through the market. So it's not necessarily about getting the exact entry point. It's about getting enough size to warrant the position that I want. So this is why I don't teach my trading strategy, because unless you've got 6, 7 figures in your account, you can't get anywhere near my trading strategy. So it's not really about what. I think it's also a myth. When you're looking for the exact entry point, it's a myth. You're looking for a good enough trade that your entry point doesn't have to be exact. And that's again why I use the averaging position, because I can get in early if I want, because I know if I'm in early, I can then get in later as the confirmation is happening. But realistically, if I'm looking for 20, 30 ticks out of a move, that move to me has to be worth 90 ticks or 100 ticks. I'm only trying to get a third or a quarter of it, if you see what I mean. So my trade has to be, identification has to be good enough that I can take a big fat bite out of that total trade and not have to get the entirety of the trade. So the exact entry point isn't that important for me because I'm only trying to get a small proportion of that move that I've identified. I'm not a greedy trader. So if I know it's going to go 100 ticks, I'll try and take 50 or 60 ticks because I know that 50, 60 ticks is valuable to me in monetary terms, in every term. And that's, again, what I'm trying to do. I'm not trying to get the exact 100 ticks out of it and pat myself on the back. As I said right from the beginning, it's about being right at the right time and making money. It's not being about going down the pub and saying you bought the low and sold the high. Not interested in that. I want the money.
Great.
Okay.
What about hedging? Ian's been asked, waiting patiently. No. Do you hedge?
No, I personally never hedge, and I would say that hedging is a myth for people under £50,000 in their account. Really, hedging is just a license to be doubly wrong on trades. To be honest, the markets are heavily correlated in some respects, but the coefficients in the currencies are not providing me with enough confidence to hedge. So I would be very, very wary about the myth of hedging. If you're hugely invested in gold or the S&P, for instance, and there might be a possibility if the investment's big enough to hedge, against the dollar. But realistically, if you're trading anywhere less than a 50 grand account, I would say that hedging is probably something to stay away from. That's my personal opinion.
Steve, fantastic. Just what about hedging in the same market to lock profit? Just a follow-up question from Ian. If this will have to be the last question.
You can do. It's entirely up to you. Again, as I say, because I have large positions and I average, it isn't of much use to me. I'm taking all my position out when I get into profit. So the hedging kind of side of it or looking in profit doesn't interest me. I don't work orders. I generally trade at market. So if I'm in a big enough position, I've got on side where I want, everything gets liquidated and I move on to the next trade. Now, as I say, Sam, I don't ever sell things on this on these presentations, but for the first time in a long time, I'm offering this complete mentoring package where it's exclusive to me. InterTrader, if you want to move across to InterTrader, where I'm the chief market strategist, they only top out at 10% cash back. I will give you 15% cash back. So win or lose in a trade, you can get up to 15% back. But also with that, if you want to have these conversations in private with me, then you can get iView charts. I'll teach you how to use it. I'll teach you a trading strategy. Speak to me on Skype. I've got guys making £1,000 to £3,000 a day. It's probably for people with a decent size account, to be honest, because you just can't make money with anything less than, I would say, 10 grand in your account these days. But as I say, I don't normally sell things, but I happen to have some time and a very expensive wedding to pay for. So if people do want to kind of, jump on, they can get on that link that I've just put on. And, you'll be there, Simon. You'll see firsthand.
I'll be there. My kilt is all pressed and ready to go.
All pressed. Oh, I'm looking forward to that, mate.
I'm very much looking forward to it. Well, you don't sell it, but I have to say you have actually sold a couple of books since you've been on the webinar. Stephen and Keith, thank you very much for that. David Strachan, David, another recent convert to iView charts, been very useful so far. Wayne, he's excellent. Northern Lad and myself, talks quick. I feel like I've seen a 2-hour webinar in one.
You get value for money, yeah.
So there we are. So great. And with just 2 minutes to spare, that has been perfect timing. Steve, thank you so much indeed for joining us again. It's been a fantastic third session to Round the Clock Trader, and we're going to have to leave it there. There are more questions coming in, but I will direct them to Steve. Or
just send them by email, and I'll get back to people, sure.
.com. Fantastic. Okay, Steve, I'll take the presenter role as I do back from you, and I will see you again shortly. Looking forward to it.
Cheers, guys. Bye.
Fantastic. So that has taken us up to almost 12 o'clock exactly, where I'm delighted to be welcoming our fourth speaker for the day. So thank you to Steve Ruffley at intertrader.com, iviewcharts.com, and of course author of The Rough Guide to Trading. been a very good session. This is Simon Campbell speaking. This is London Investment Week's Around the Clock Trader monthly webinar show, where we have 12 expert traders going back to back with and systems and market commentary to help you increase your trading. One question has come in from Emmanuel, which I think was interesting. He said, the last speaker talked extensively on daily and weekly time frame, while the current speaker is talking of lower time frames. I'm confused which way to go. I think in short, Emmanuel, there is no one-size-fits-all for trading. The purpose of this event is to set out a buffet, if you like, of different trading styles and strategies, and hopefully from that you can pick up and tailor the different strategies that will suit your lifestyle. People have different objectives and of course different horizons and goals. So it's difficult. There isn't one correct way. I think that's something that everybody will agree on, is that there is no one way that will work all the time. So it's a question of fitting the trading to yourself and finding something that works and sticking out. So I hope that helps. With that in mind, I am very pleased to continue along and welcome a first-time speaker to Round the Clock Trader, Alejandro Zambrano from Londinium FX. No stranger to speaking, of course. Alejandro's been a regular speaker on CNBC, various investment and trade shows in London, having been the head analyst at FXCM markets for 6 years. And indeed, his presentation today is entitled What FXCM Taught Me About Trading Over 6 Years. So delighted to bring Alejandro in. I'm going to press a couple of buttons now and see if we can go over to bring him into the show.
Hey Simon, how you doing today?
Ah, good. You're online already. Very well, thank you, Alejandro. How are you?
Very good, thank you. I just finished watching the good presentation by the previous speaker.
Yeah, Steve Ruffley, very good. Lots of information there, and indeed, just to sort of qualify, that's what this day has been about, is laying different styles and strategies of trading, and we find that it's good to see what's going on and keep us up to date. But welcome for the first time to Round the Clock Trader yourself.
Thank you.
I think we have Zach Meir to thank for putting us in touch. Zach's spoken several times on the webinars before, of course, and also hosts his Tip TV broadcasts. But we're looking forward to this. Just briefly giving people a background there, I see you're sort of head analyst at FXCM previously, and now set up Londinium FX, which I'm looking at the website now, which looks fantastic.
Thank you.
Offering a very sort of comprehensive service from email alerts and newsletters to following the trades. So looking forward to it. I don't want to talk too much about it. I'll let you introduce it as we go through your presentation. Now, forgive me, we missed our test call, but I'm going to talk you through the process now, because what we're going to do is we're going to do a screen share. So as long as you're ready with your PC ready on a slide or a platform you want to show, because when you commit the button to share your screen, become the presenter, everybody will start to see your screen instead of mine.
Yeah, that's fine. I have some PowerPoints up and loading. I just need to make sure that we show the right screen. Let me see here if I can choose the screen. Yes, good. So here we go. I should be live now.
Fantastic. That's great. I am looking at the photograph of, I'm not sure if it's your head or someone else's head, but it's a trading
head.
What FXCM taught me about trading over 6 years. Londinium FX, Alejandro Zambrano. Thank you very much indeed. Okay, we will just switch to the recording on, and we have about 45 minutes with some questions. If you're okay for me to interrupt from time to time, if there's a question slide, that would be great. Otherwise, we'll do some questions at the end as well. So without further ado, over to you, Alejandro. I'll let you get started. Thank you.
Cheers, thank you. All right, good guys. Thanks so much for joining. I'm gonna introduce to you guys some of the things I picked up, working for FXEM. And obviously, what is interesting is that FXEM is, as you probably would know, one of the biggest, if not the world's biggest, retail forex broker. So being there for 6.5 years, you see a lot of things, and being a leader, you see pretty much all of it, right? So what I'm going to do today is I'm going to talk about one of the, I think, the sticking points that a lot of traders have, and try to show you how we can overcome that. Here's just some of the simple ideas, because what I noticed that when you're in the inside and then you are meeting people that are new to the markets, and I also remember myself when I was new to the market, there's a lot of myths, a lot of ideas, and a lot of truths online that are not correct. So this is just some of the few bullet points and things I picked up. Like, as you probably know, the 99.99% of the retail trader despises fundamental analysis. But if you, like me, have met people at BNP Paribas, hedge funds, if you've been at HSBC, met the different banks, Bank of America, Merrill Lynch, all these different people, if you come with them with a chart, they're not going to like that. So it's interesting to see, for example, as something that the retail traders doesn't like, and then you have the banks, which obviously run the market, that's the only thing they work with, and vice versa. So these are just some of the bullet points, and what we're going to focus on today is actually the second point, and that is scalping is extremely hard, or short-term trading. Then there's more stuff, but the primary thing is going to be the second bullet point. And I think this is a good reason or good way, if you can overcome this, that can help you with your trading. Now, I personally think, and there's obviously different sets. I mean, there are people that trade short term, as we heard the previous speaker, and then you have the long-term trader. Well, I can tell you right now, being on the inside with FXEM, is really hard to find anyone that makes money scalping. And I know this with 6.5 years of experience. So that's something we're going to talk about, and how we can actually beat that potentially. But just before we actually go into all the good stuff, as always, I just need to show you this risk disclaimer. So we're going to take about 15 seconds to read this. Okay, good. All right, good. So what makes me uniquely qualified to share some of this information then? And why would you actually listen to me? Well, first things first, I started to trade in 2006, so that's about 10 years now. So obviously tried out most of the techniques available online, long-term, short-term, high leverage, low leverage, pretty much everything under the sun, I tried that out. What else? Well, what makes me uniquely qualified is the fact that I was the head analyst at FXEM's London desk, and I was with FXEM, or maybe Daily FX, the big website. I was with them from 2009 to 2016. So obviously you meet a lot of people coming to the office, you have a bunch of colleagues, you have access to a lot of information that a lot of people don't have, and you see a lot of stuff. So that's 6.5 years of experience trading for the big broker. Developed some trading educational programs. We had about 300 traders coming through the offices to learn about forex trading. I was also in charge of working with the most valued clients of FXCM. We had what we call the top 50. Like all the big brokers have that. They have a special group of people that just manage the high net worth clients and people that trade a lot. And obviously, as Simon said before, Traders Expo, TV, City AM, things like that over the years. But before even doing this, I also worked for a short while at Swedbank, which is Sweden's biggest retail bank, and worked on the FX and fixed income desk. So that's purely institutional stuff as well. And I met traders that, been around. I mean, they've been working in the industry since they were very, very young, and now they're 50, 60. Before doing all this, of course, as well, I have a bachelor's degree in economics and a master's degree in economics as well. So this makes me uniquely qualified, specifically the stuff, of course, from FXCM, which is what we're going to talk about today. So now, one issue over the last few years that I noticed, at least since the last 10 years, that there is a consistent push towards short-term trading. Everywhere you look, there's articles, videos, webinars, seminars. They all promote short-term trading. Now, there are good reasons for that happening, and we're going to talk about that a little bit later on. But it's primarily to the benefit of the broker and not necessarily their clients. I personally think that the reason why there's a huge failure rate within trading is just because everyone is short-term. Nobody has patience to actually put a trade on, wait, because what we're doing, we're investing here. And I think people have forgot about that. Now, intraday trading, that's the way it was called when I started. And then you had a new hype, which was scalping, which is the prevailing word right now that people use to explain short-term trading. Now, there is an issue here within the industry itself. Because if you're a retail analyst and you're going to write an article, you can write a short-term article and you're going to get a lot of views and a lot of popularity within management because everyone likes the short-term trading stuff. So the clients demand it, and the analysts themselves, they want to do it because it's going to generate more business for the firm and the industry. So we have a bit of an issue here where this is turned into a bit of a monster where everyone wants to get involved in short-term trading. And because that's the case, the analyst, the client, the trader, everyone believes that the answer to successful trading is short-term trading. Everyone believes that, well, this guy makes a lot of money. No, this guy here as well makes a lot of money. Everyone believes that there's a lot of money being made, but you rarely see the money. So that's a bit of an issue, and I think I want to help to break, and I don't want to say that there's not people that don't make money trading short-term. It's just that I haven't seen that yet. So if you have been trading for a while, or even if you just started trading and you're just totally new to this, if you want to improve the likelihood of being successful and making money on trading, then start out with the bigger time frames. And then if you do that good, trade more short-term. Or you put 70% of your money in one type of account, the long-term or daily chart account, and then you put your 30 into a smaller account, then you trade that for 1 year, 2 years, and then see what works the best. And I'm going to explain to you why mathematically it is hard to just scalp and make money scalping and day trading in general. Okay, so as I said, first things first, after spending 6.5 years with FXCM, I haven't really met anyone. I have met people that make money in 2-3 months. There's people, clients that start with 2,000, they could make up to 50,000. We've seen that, but it's really, really hard to see these guys persistently make money. And that is the issue with short-term trading. And why is this interesting in general? Like, who cares about FXCM? Well, FXCM itself has about 150,000 clients, between 150,000 up to 185,000 clients. And these are official figures you can read at their website, the investor page relation. So you can see that they have a huge amount of clients on a worldwide basis. So it's a huge sample. And that's important. So out of these 150, 185,000, of course, there are people that make money trading short term, but it's seldom that, you know, you see a name through the books and then, you know, the same name is going to be there 1 year later. So again, I'm not saying, and I don't want to discourage you to trade short term, but again, if you are struggling, then try to trade slightly longer term. Just because I spent 6.5 years with a FXCM and I still haven't seen any scalper being profitable. Now, you can make money with the FXCM. FXCM, we used to call them the king of the mini. This is like in 2007, 2008, even before I started. You could open an account with FXCM, and you know the person that produced the highest percentage return over a month would get cash prizes. Now, because we have micro accounts, we call it the king of the micro. Now, to win that competition, you would see guys, you know, 350%, sometimes 500%. So again, it's not impossible. It's just the issue here is that you see the winner 1 month and then you never see that guy again. So you can make a lot of money in the short term, and that is obviously what all the advertising tells you. You know, come Forex, you know, start to trade from home and so on, make a bundle amount of money. But unfortunately, it's not really like that. What's my own experience then? Well, myself, when I started to trade, I was about 21 years old. And I, like everyone else, thought that short-term trading is really what you want to be doing. So I spent a lot of years trying that out. You know, you would have 30% returns over a period of a few months, but then you would slowly give that back. And it's obviously very, very frustrating because you think you have a true edge, but it could have just been random luck. So what do I tell people? Well, before, because obviously being in the industry, you meet a lot of people that are very, very happy to share their success. But if they don't have at least 1 year up to 2 years of consistent profitable trading, then it's not really worth that much. Now, who is making money trading Forex? Because remember, what someone loses, someone else is making. Of course, the brokers are taking parts of that because they make money in the commission. But it's not that the money disappears. Whatever you lose, someone wins and vice versa. All right? So, what did I notice? Because there are obviously profitable traders with a big broker like FXCM. Well, the people that did make money, they trade slightly longer term than the average person, and they trade less frequent. Again, if you go to the investor relation page of FXCM on a monthly basis, they will publish their metrics, like how many clients they have and how often they trade, or how many trades they trade per month. Now, the average FXCM clients trades 3 times a day. That's a lot, at least according to me. 3 times a day. That is the standard, and it's been like that for many, many, many years. Now, the people that did make money, they will hold as a minimum positions for days, and sometimes up to 32 days on average. How do I know this? Well, because with the FXCM, if you're a high net worth client, we provide people with software. They're a little bit like, well, it's a software that just analyzes your results. And obviously, when we're in touch with the clients, you know, we look at the results. So this is what we did with the high net worth clients. We would look into the results and provide them feedback to how to help them. And we could, well, I could see there that 32 days or so was actually for someone that was trading really, really well. It was a woman based in Malaysia, which started out with about $14,000 and turned out to about 120 about 1.5 years later. And what she did is that she was buying the dollar yen while it was trending higher. So you might remember it went from like 80 or 90 all the way up to almost 125, and she used to trade that, hold the position for about 32 days and add to her winning positions. And that is something that managed to generate these gains for her. So firstly, I could see the actual data of the clients Secondly, you meet a lot of people. Being a big broker, obviously offices here in London, you meet the hedge fund managers that come, they want to trade with FXEM, people that manage several millions of dollars. And they, too, traded long term. Now, again, this is just anecdotal and things I've seen, right? I've seen it in the books. I met people, spent 6.5 years researching what works, what doesn't work. So all of that is obviously great. Okay, this guy produced some returns. This guy too as well. All right, great. But obviously, you get convinced when yourself turn profitable, when yourself produce a return and don't give all of that back. And I started to do so when I started to trade the daily charts and when I started to pay attention to the macro fundamentals. So yes, people make money trading Forex, and the people I have met and shaken hands with, they trade long term. The people that don't make money, I haven't seen them yet. There's probably someone out there doing that very well, but I still haven't seen them. That is people that tend to trade short term. Now, why is everyone in love with short term trading? Well, this is a simple sample. I use the dollar yen. You can replicate this work using the euro or the pound. So I just used the simple indicator called the ATR, average true range. And I'm using a sample from August 2015 to August 2016. Now this is just the dollar yen, right? The average range for a single day in the dollar yen is 113 pips. This is the average range for 2 days, 131 days. 3 days, 172, 4 days, 204, 5 days, 229, and then 6 days, 255. Now here is the difference of holding a position for one additional day. So if you day trade, and just for the sake of it, let's say that you managed to buy at the very low of the day in the dollar yen, and the currency rose by 113 pips. Well, if you decide to hold this position for one additional day, you make 18 pips. So clearly, the risk-reward ratio here is terrible. You will potentially lose 113 to make 18. So as you can see here, it's not really worthwhile many times to hold the position for too long. Now, how can we use the same information to kind of show you again the discrepancy between day trading and trading long term and why people just love day trading? Well, imagine that I day trade, so I make 113 pips and I do that for 6 days in a row. The total is going to be 678 pips. So 113 multiplied by 6 is 678. So you do that for 6 days, and you're an excellent scalper. You made 678 pip. If you will, like me, trade slightly longer term, maybe hold a position, you could potentially make 255, because that is the average range of a 6-day period over the last year in this currency. So as you can understand why short-term trading is appealing. At the same way, you have people, they up 5, 60, 70%, and they want to do what I want to do. What I do is just hold slightly long term, and then it goes back and they get stopped out. And they do that 10 times, and then they realize, holding positions for more than 1 to 2 days is not really worthwhile. So then they just stick to these short term because that's what they think really works. But the proof I've seen online is that it's the actual opposite. You need to be slightly longer term. Now, why is it so difficult to scalp? Like, why are people not making money? So these are just some ideas. you got the news. The economic calendar just kind of wipes all the short-term traders out. You got the rumors, people saying that ECB is going to do this and that. You got the spikes due to low liquidity. Another issue is that the more you expose yourself to the market, the higher is the risk that you're going to make a silly mistake. Like if you trade 3 times per day, like the average FXEM trader does, say that you trade, say you have a terrible day, so you lose a little bit in the beginning of the day. You take a stop loss where you should. And then, you have a bit of lunch, you trade again in the afternoon, and you lose again, not feeling too happy. Now, it's the last trade of the day, your kids are coming home after school, and your wife, and you just want to make one last trade. But now you have a little bit of disruptions at home and so on, you're not really that happy, you put another trade on. Now that trade doesn't work either, but you decide to not stick to your stop loss this time. And then you wake up the day later and you're down with 113 pip or whatever. When you trade a lot, you expose yourself to the risks. And because you expose yourself more to the risk, it's more likely you're going to make an error. These are just some simple stuff that just, is problematic. The fact that the markets are many times random in the short term. But that's not really what I think is the #1 reason why people actually don't make too much money trading scalping. And it has to do with the risk-reward ratio. You heard it, the previous speaker, and you probably heard it before again. Everyone hails the risk-reward ratio and what that stands for. It's something professionals do and it's something that rookies do. Everyone loves the risk-reward ratio. Now, what does that mean? It means that if you're a scalper and you're scalping for, you have a stop of 20 pip, you look to make 30 to 40 pip. Now, the relationship between the gain and the loss is your ratio, right? And if you look online, everyone tells you, risk 100, make 500. Sounds really good, right? And the professionals are doing it, the rookies are doing it, everyone is doing it. Now, I randomly took, well, not randomly, a lot of people kind of stick to 20 pip. And for the sake of this presentation, I decided to go for 20 pip because 20 pip, 25 pip, for some reason, it seems to be the magic number. Like I met a lot of people in these different trade shows over the years, and I've been doing presentations in Sweden, Italy, and Greece. And then I've done countless of these here in London. Now, 25, 30 pip is like the magic number people are always looking for. Yeah, if I can make 25 pip a day, I trade a little bit in the morning, and then in the afternoon, I can do whatever I want. Now, again, if you are that person that is doing that and you're doing it successfully, keep on doing it. But if you tried that formula and it didn't work, then this is something for you. So, just to put things into perspective, if you risk 20 pip, that's your stop loss for one position. But the average range of something like the dollar-yen is 113. You can replace this with euro-dollar if you want to, or pound-dollar. But just for the sake of it, you risk 20 and the range is 113. Now the average range is 5.56 times bigger than your stop loss. Which means that you could trade up to 5.56 trades with 20 pip stop loss until you find the low of the day. What does this mean? Well, it means that it's going to be really, really, really hard for you to find the low of the day. So if you trade one currency, you have a 20 pip stop loss, and it happens to be the dollar yen, then the likelihood that you're going to have a successful trade is 17.7%, because 20 divided by 113 is 17.7. So there's a failure rate of 82.3%. I hope that makes sense. We can go back to it later. I can, when we finish with the slides, I can pull out the calculator, so if you want to. The key point is this: if you trade with a 20 pip stop loss, there's an 82.3% likelihood that you're going to be stopped out within 24 hours. This is simple mathematics, and I think it explains quite a lot. Now, the other thing here is the fact that if you're actually trading and you want to make 30 to 40 pip by risking 20, then your positions would just need to be open for longer. So it's more likely that your stop is going to be reached before your targets have been hit. And I think this is something that resonates with most people. So how can we improve? Now, this is one way which is very, very unpopular. It's unorthodox, that people hate it. And I think it has to do with the fact that the other view, which is the risk-reward ratio view, that is such a strong idea within people. It's so much ingrained with people that they refuse to do this. Now, I know one trader, and he's used to work for FXCM. He stopped working for FXCM a few years ago. He's been doing this for 15 years, and yeah, he would trade with a risk of 30 pip to make 10 pip. Now, is he long-term successful? I'm not really sure, to be honest. I haven't seen any signs of it, but he would do something like this. And this, if you look online as well, like because you have the crowd, the crowd trending, like the Zulu trades. You have the different websites where you can follow people. If you look at people that are scalping and trading, they tend to have this. They make 4 or 5 pips on a winning position, and then they lose 30, 40 on the losing positions. Now, this is interesting because it's more likely that your profit target is going to be hit. Now, the main problem with the strategy is that you need to have a lot of small winners just to overcome 1 or 2 bad trades. And usually what you see, unfortunately, if you go to Zulu Trade, which is obviously a platform that's been around for ages, and then there's the other one, my Forex book. Yeah, you can follow people, but the people that are doing really well today, if they're using a system like that, you're not going to find someone that has 2-3 years of data, because it doesn't exist. Many times you'll find a guy that trades very well for a year or so, but then he has 1 or 2 bad positions and they blow up. So it doesn't seem to be something that holds in the long run either. Now, a lot of negativity here, right? I'm just trying to highlight the situation the way it is, and I think it's better you hear about it now than later. Now, is there a formula to it? Yeah, of course. As I told you before, the longer-term traders, I met people that make money, shook hands with them. I see in the results, because when you work for a broker, when you speak with a client, you can see how much they deposited, how much they have on the account, how much they withdrawn, so you can just see, okay, what's the balance? And if you click on 2-3 buttons, you can see, the trades. And obviously, you do this when you speak with the clients. So you ask for permission, and you get a lot of this, and you can check things out. And obviously, so you have access to all of that. And it's nothing strange. It's pretty much like that with everyone, right? Because if you're a broker, you need to know your client. So this is one way of looking at it, is to widen the stop loss. Now, this is just a theoretical example to try to explain to you, but if the average range in the dollar-yen is 113 pips, and that's 113 pips over a period of 24 hours, well, if you randomly open a position during a day, and then in theory, the position should be open 24 hours later. Because if you open a position today, you put a stop loss 113 pips away, in theory, the position should be open 24 hours later. You could, however, be stopped out if you bought at the very, very high of the day, and then the currency moved down with 113 or 114 pips. So again, just by having a wider stop loss, you don't have to be able to pinpoint the low of the day. And this is actually very, very, very forgiving. So you don't have to be an expert. You don't have to narrow down the low of the day to 20 pip or so to be able to make money on it. And this is why I do suggest to people that if they just want to make money trading, then trading with a slightly longer term stop loss is something that does help. The issue with this, though, is that by expanding the stop loss, you're not longer scalping or day trading. Now, here's a bit of a proof on how things can play out with a wider stop loss. Now you look at a chart here, and this axis here is the percentage return of this trading strategy, and these are the number of trades. So if you look to the very, very far right, you can see that it says 211, but the actual number of trades is 214. And this is data from 2014. So something that's been working for 2014 and has been tested 214 times, it's quite likely that this is not a coincidence. Now, what's this? What are you looking at? This is a manual Forex system, and is produced by some people I know, and they like to fade strong moves. Now, just to let you know, these are based on their real trading recommendations, right? So it's based on them saying, buy here, put your stop loss on this level, book profits on these levels. It's based on all of that, and it is real calls for a real market. However, when they send me these results, they send me the results in pips. They don't tell me the percentage, because they don't tell people if you should risk 1 or 2%. So what I did, I took all these pips and I compared the stop loss in pips versus the gain in pips, or the loss in pips. And I assume that if you risk 1% per trade, then this would be the return, which is really, 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 really strong. Now, a word of caution, not everything was perfect, because when people send you stuff, you need to make some simplifications. But even if half of this is truth, or even smaller amounts, so if they only would have returned, say, 40% since 2014, or 60% since 2014, then that would be still good. So ignore the fact that it produced 180% if we would have traded this. The fact that it's pointing higher here, like this, is actually great. Okay, so again, this is based on real trade recommendations, but they send me the results in pips. So I assumed that I'm going to risk 1% on each of these trades. Now, what do I know about the system's average loss and winning, excluding the break-even trades? Well, if I get rid of all the break-even trades, the average loss would be about 102 pips, whereas the average win will be 235 pips. If I would look into the actual percentages, which is actually what is important, is obviously every loss is 1% and every gain is about 1.4%. So this is more or less what we should be aiming for. Make 235 pips, and when we lose, we should lose maybe 202, maybe a little bit more sometimes, but somewhere near 200 pip stop losses, and profit targets about 235 pips away. Now, what I'm going to do in a few minutes, I'm going to show you the breakdown per currency pairs, because obviously you don't necessarily need a 202 pip stop loss for certain currencies, whereas for other currencies like high volatile currencies like pound, yen, or Euro, Aussie, stuff like that, you would usually have a wider stop loss. So this is pretty much what is interesting. So forget about the 20 pip, make it 202. Now, what is interesting here as well is that with the break-even trades, now I included them in here to just make it simpler. But on average, 69% of these trades are profitable. And obviously it's less because the break-evens are here as well. But in about 147 trades are break-even or winners out of 214. Now, what is interesting is, again, that this system is profitable and they use the wider stop loss orders. Now, I'm not going to say just because you widen your stop losses that you're going to make money, but we know for a fact that they are profitable and they use wider stop loss orders. So it could be something actually linked to this. Now, here's the table showing you like the average loss across these different currencies. You got the Aussie dollar, 172 points. You got the euro pound, 150. You got the euro yen, 224. You got the euro dollar, 142. You got a pound yen, which tends to be very volatile. That's 271 pip. You got the pound dollar at 140. You got the New Zealand dollar at 95, and you got the dollar yen at 101. So what is interesting is, again, these guys here made about 180% if we normalize results. They made about 180%. Now these guys, they're clearly good. They know what they're doing, right? So they are what we call the experts here. Now the expert is not using 20 pip. The expert is using an average stop loss of about 202. You need to think about that, because the average trader that trades 2-3 months, he wants to have a 20 pip stop loss. So you need to be very, very savvy to know exactly where to enter and where to exit if you're going to have a 20 pip stop loss. But if you have a wider stop loss, like 202 points, you don't have to know exactly. And this is the stop losses that these people use. Again, it doesn't have to be that you have to trade with this, but if you haven't tried that out, then that's what I suggest. So what do we know? Well, these people, they like to trade, they like to fade strong moves. So they look a lot at the daily charts. They use, simple Fibonacci and a lot of trend lines. So a lot of the standard stuff you would see, but they like to buy at extreme moves, right? And I think the critical part here really is that pretty much most, if not all, of their stop loss orders are based just above major highs if they're short, or just below major lows if they're long. So they will use the daily highs and lows, like major levels, to put their stop loss orders, put them on the other side of it. So it's not a 5-minute, it's not a 4-hour, it's a daily chart. How can I relate to this? Well, I don't really like to trade strong or fade strong moves. I'm not like a mean reverting trader. I like to trade trends on the daily chart. And me, myself, I turned profitable when I started to expand my stop loss orders. So when I did that, I started to produce returns, because everyone in here, I mean, we're not stupid people, right? We read the news, so we know what's going on. And we can look at the charts and we can see the levels, and everyone can roughly say that, well, it's most likely that this currency is going to go down in the next few weeks, then going up, right? Everyone can do that if you just pick up the newspaper. But still, people still fail to make money. And that is just because we're too short-term in our trading. So we don't allow the market to do its thing, to develop in the obvious direction. So what can you do? Well, to improve your chances of being profitable, try to widen your stops. Now, what if you can't avoid, what if you can't do this? What if you can't afford it? Well, it's not fun, but trade with a smaller trade size. Do that for 6 months, a year, see how that works out. Or you just add more money to your account so you can withstand the wider stop losses. And if that's not possible, if you have a very small account, you can't afford big stop loss orders, and take the money and do something else with it. Focus your time on something else, because even though it's very simple to open an account with 50 pip or 50 pounds, the spreads are really, really, really narrow, then it is the same way as the previous speaker said. Unfortunately, you need to have money. Now, if you don't have money, you can still trade, you can produce a good result, and if you have a good track record after 2-3 years, then there are people that are going to probably be willing to invest with you. So even if you're not in a position to make huge investment, if you can show them that you're consistent in your trading, and here's 2-3 years of track record, then there's always going to be someone that would like to invest with you. So it's not a waste of time, even if you don't necessarily make money on the actual trading. So that's something as well to bear in mind. Okay, we are approaching the end of this presentation. I hope it made sense what I was talking about. Now, if you want to know more about me, then we do have the free live webinars. I do that at 9:15 a.m. London time, and this is something I do at, let me see here, at londiniumfx.com. Not sure what happened. I had a big URL here at the top, but I managed to get rid of it. But it's londiniumfx.com, and really, you can just check that out. I do webinars in the morning. Now that's just the free stuff. If you want to get to know me a little bit better and you want to have like a general overview of the market. Now, if you want to have access to premium content, as Simon said previously, I do share my trading journal so you can see what I'm buying and selling. But more importantly, I explain to you why I'm buying and selling. And there's a lot of macro economic analysis and a lot of technical analysis. I do videos, send that out to people. Now, we are running an exclusive promotion because we're doing this great thing here with London Investment Week. So you can have a discount. So the premium newsletter goes for £291 per quarter. But because you guys joined us here at the London Investment Week, we actually provide you guys with a 20% discount. So instead of £291, it's going to be £232 per quarter. And this is an offer that is valid until the 31st of August. So what you do when you go to Londinium FX and you decide to join to the premium newsletter, you just need to put in the discount code, which is 20 premium. So the first 20 people which sign up within the 31st of August has access to this. If you have any questions, Londinium, admin at londiniumfx.com. You can also reach me via Twitter, AlexFX00. And that's it really. Okay guys, want to open up the floor for questions. I think Simon, you have them. So
thank you, Alejandro. That's very good presentation. Thank you. Very thought-provoking and interesting stats that you have there. There are questions that have been coming in as you've been speaking. So we've got just about 10 minutes just to work through some of these questions.
Yep.
So we'll start off, perhaps. Andy was saying, who is the trader that you were talking about currently? I think you mentioned a trader.
Yeah, so it's a group. Yeah, so it's people that I know. It's a group of people that I know. They have this product where they provide these real-time calls. But I'm looking to get them to work with me. So I don't want to disclose that.
Okay, yeah. Now, Len says
they're good. You know, they're good. So I don't necessarily want to share their stuff. I mean, I want to share the stuff, but I want to share them via me. I'm sorry for being selfish.
We understand. Len asks, he says, you're making sense in a trending market. However, in a rangy market, this approach could kill your account.
No, not really. Actually, you see, let's see if I can load some charts, right? Can you, do you see a charts now on your screens?
Yes, we do.
Oh, you
no,
do? Okay.
It was there for a second, but now we're back to the slide.
There you go, right?
There we have it.
Okay, good. So, for example, let's see if I can load a new chart here. So these guys are right now, they're long the dollar yen. So they are long from about 101. And they have the stop loss at, I think it's 99. They have the stop loss at 99.30. So this is actually one of the positions they're holding right now. So they're long from pretty much these levels here with the stop loss down here. So they are actually very like kind of mean reverting, because they're pretty much saying that the market should move up higher here. And they were also short up here with stop losses above this high. They also trade other stuff. So they trade US oil. This is US oil. and these guys are short from pretty much up here. So that will be, say, 48. Let's make it a bad entry for them. So let's make it 47.50. Don't remember exactly. And then they have a stop loss up here at 50.50. So they're looking for a decline down to the levels. Now, what is interesting is every time, I read their analysis, they tell me, yeah, short here, so you risk, 300 points, and then they say it's going to come down. But what they do and what they say is different. So it wouldn't surprise me if it just comes back down to maybe 44 or something like that, and they make 400 or 300 pip, because they usually just look to make back what they're risking. So this is what they're doing. In my own case, I'm a trend trader, so I'm a little bit different. I'm actually short silver now with my clients at Londinium FX. So I didn't have an amazing entry here. I'm actually short from this low here. So I'm short from these levels yesterday. And the initial stop I had on this position, sorry for flipping back and forward like that, but the initial stop was up here. Very, 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 very wide, I know that. So we're talking about 100 points, and for this to come down to 18, maybe slightly lower. So then obviously when the trade goes good, I do like most of other people, I just reduce it, reduce it, and reduce it. But the key point is to start out with a wide stop loss. Does that make sense?
I think that makes sense. If there's anything else you want to add, Len, come back. In the meantime, George, he asks, how big is the comfortable account size for this large stop loss?
You know what? When I trade, I try to stick to 1%, 1.5%. Sometimes I go to 2%. What does that mean? That means that, if you have 100 pounds, I'll risk 1 or 2 pounds on this. So, and nowadays, I mean, if you really want to, if you trade the euro dollar, you have a micro account. So let's create a market order. This is with the FXCM platform. So if you buy the smallest amount, which is a 1K, and then you put a stop loss, I don't know if you can see everything here, but I'm going to add 100 pip stop loss. Let's add 200 pip, okay? So you can see here, if I buy the smallest account or smallest contract size with FXCM, and I put a 200 pip stop loss, then if I buy right now and I get stopped out, I'm going to lose 15 pounds and 37 cents. So that will be your loss. So if you are like me, you're trying to stick to 1.5% max loss per position, then 15 divided by 1.5% is 1,000. So to have a 200 pip stop loss and do this successfully, as a minimum, you need 1,000 pounds on this account to trade with FXCM with a 200 pip stop loss. I know it's a little bit mathematically complicated, but that's related to the risk. Now you can risk more. Like you have some people, they're going to make this 5%. So 15 pounds, turn that into 5%. So 15 divided by 0.05, that's 300. So you could theoretically start out with 300 and you risk 5%. But I wouldn't suggest anyone to risk 5% per trade if you're doing like 200 pip stop losses like this. Now you must ask yourself, okay, so like, I mean, I have 300 pounds, so I have 500 pounds on my account, and obviously, if you risk 200 pip, you're gonna lose 15, and if you make 200 pip, you're gonna make 15. Now with 15 pounds, you don't get far in life nowadays. Especially not in London where I'm based, but it's not that's not what is relevant for you now. When I was a student, I had a 2,000 euro account in 2006, and I traded with these 2,000 euros for many years. And then I was starting to work full time for FXCM, and I started to become more and more better in my trading. And then you get your yearly bonus, you add more money, and you work a bit, you add more money, and then eventually, before you know it, you're trading quite a nice account. And then the 1% is not going to be 15. 1% could be anything from 500 to 1,000 to more. So the key point here is that even if you trade with a small account, let's first just focus on actually doing this correctly, and then if you do it correctly, then you can start to add more money if you can afford it, of course.
Okay, we've only got a few minutes left. Jeff says, you said the average loss is some 200 pips, as you mentioned. I wonder what proportion of those trades were where an original stop loss was obeyed, and what proportion of those trades were where the original stop loss was moved?
Yeah, that's a good. No, that's a very good question. So the way they actually registered it, they registered their initial stop loss.
Okay, so it was the original stop loss that was used.
So the data you're seeing is the actual stop loss, and at one point, because the actual portfolio is about 200 and something trades, they would adjust. But when I saw that stop loss was a 0, then obviously the stop loss was not a 0. So I had to read into the analysis and pull out the original. So it's the original stop loss or average loss, really.
Yeah, well, thank you. A question from we have an anonymous viewer. Unfortunately, the name's not come through, but how many trades do you have at any one time in percentage terms, and do you trade the majors only in Forex and indices?
Okay, so I think the first question is how many positions I have open, is that correct?
How many positions in percentage terms, I guess, of your...
Okay. Okay, so I will usually maybe have 3 positions in one go. So that makes it 4.5%. And sometimes what I do, something we can do maybe some other day, is that I actually scale into positions. So, well, everyone tells you to scale out. I actually scale in, but to keep it very, very simple, say 4.5, and sometimes when you scale in, obviously it's slightly higher, maybe 7%. However, my intention is not to lose 7%. And when you add to the positions, you need to make sure that the ideas are not too correlated. Because if they're all correlated, all the positions, then it's quite likely that you're either going to make money on all positions or you're going to lose money on all positions. And you'll notice that very quickly. And when you see that, the best thing is just to kind of close out half of the position. Do I trade other stuff? Yeah, I do trade a little bit of indices, and I do trade silver, gold, and then crude oil. But I would say like 75-80% of the stuff that I trade is actually in Forex. And that's what I'm good at. That's what I'm comfortable with. I can open a position, and I mean, I'm not really that stressed about it. Because there's, for me at least, because I spent 10 years doing Forex, I have a lot of different tools and statistical research and analysis that helps me to verify an idea. So it's primarily a Forex, and the results I showed you are just a Forex trade that these people do.
Okay, maybe time just for one final question from Wayne. What would be your average risk reward?
So if we look at the system I showed you guys, the system would be a risk reward of 1.4. So in this situation here, they would win 1.4% when they would win, and they would lose 1% when they lost. In my case, my risk-reward ratio is slightly higher than that. And the reason for that is that when I trade, I add to the position. So in the case of silver, I'm short from the levels I showed you, and I'm risking 1.5%. Now, because I was in a position to reduce my stop loss over the last 24 hours, I have added another entry order to short silver on a pullback. And if that one is triggered and then eventually comes down and reaches my profit target, you know, I might make 3.5, 4, 5% on that single trade by risking 1.5% to begin with. So my risk reward ratio is slightly more than these guys, which is 1.4. However, the drawdown with my system is that you're not always going to have trending markets. As a matter of fact, in August, the only really thing that has been trending, at least in the beginning of the month, something that I noticed was the dollar South African rand, which declined a lot until the last few days. And now the only thing that is kind of trending is, for me, you know, silver and gold. You have silver and gold moving down lower. So what does that mean? Well, if you're a trend trader like I am, you can easily have a month or two where there's very, very little activity, and then when you trade, you make bigger trades. I mean, you make a big gain or so on a one move.
Okay, we are right out of time, I'm afraid, but Alejandro Zambrano from Londinium FX, thank you very much indeed for coming and joining us. It's been wonderful to have you on for the first time.
Yep.
Round the Clock Trader. We've posted the links to the website, obviously, there with the code 20 premium for those that want to get started with Alejandro's premium newsletter service. But it's been super to have you on, Alejandro. I really appreciate you making the time for us, and hopefully you can come back and join us again at one of our events in the future. We've got a timetable of events in the autumn, so I'll be in touch with you about that. But for the meantime, thank you on behalf of everybody here. Good job, says Len. Thank you, says Jeff. Great stuff, says so. Great feedback, so thank you very much on behalf of everybody. I'll take the presentation role back from you now, and we'll talk again. But thank you very much indeed. Bye-bye.
Cheers. Thanks so much for having me.
Okay, thank you to Alejandro from Londinium FX. Just into 1 o'clock, and we're shortly to go over straight to Rishi Patel at Master the Markets. Quick question, George says, can we get the recordings later on, Simon? Yes, you can. We are recording this. In fact, GoToWebinar, which is the platform we use for the webinars, has finally released a new service or a new gadget on its system, which allows us to record all this online and makes it far simpler to be able to get these recordings back out to you. So as a registered attendee, you will get the access to these recordings. They still take a little bit of time to process and crunch away. So it's like 12 hours of video, of course, but we will also edit these into the individual sessions and make them available on London School of Trading for you. So lots to get on with. That brings our morning sessions to the close, and we're starting the afternoon schedule here with Rishi Patel, 3 steps from inconsistent to consistent profits, followed by Nigel Hawkes at 2 p.m. from Hawkeye Traders. Forgive me, the website's slightly wrong there. It's hawkeyetraders.com. That's my mistake. And he'll be followed at 3 p.m. by Kim Watson from Easy Trader, talking about pivots, using pivots to catch the tops and bottoms in the Forex market. And then at 4 o'clock, Smart Investing with VectorVest by David Paul, MD of VectorVest UK. So without further ado, we'll go straight across and see if we can bring Rishi Patel into the show, and apologise for being a few minutes late. Rishi, good afternoon, it's Simon here.
Top of the afternoon to you, Agent Campbell. How are you, sir?
I'm very well, very well. I'm sorry to keep you waiting. I know you were there on time, but we have had an incredible amount of questions to the session so far today, which is really great news.
It's always nice to have the interactivity, sir, and they say good things come to those who wait, and I waited, and here you are.
Thank you very much. Well, flattery will get you nowhere, but we're so pleased to have you on board. I'm going to stop filling the time, and going to make you the presenter straight away so we can get on with the next sessions. Just as an aside, while we're doing that, I notice a lot of people have been joining within the last hour, so welcome to the show. We do have lots of new names coming on for this event today. Clearly, some of the new speakers that have been letting their own audiences know about the show have been coming on. So if this is the first time, welcome to it. My name's Simon Campbell. I'm the MD for London Investment Week, and this is the Round the Clock Trader 12-hour webinar show where I'm delighted to have 12 speakers, each providing lessons for us. So we'll carry straight on and welcome Rishi Patel. No stranger to Round the Clock Trader, but always welcome, and we always enjoy your presentation. So the 7 essential tools that every trader needs for success. Over to you, Rishi.
Well, a very good afternoon to you, Simon, and everyone here at the Round the Clock Trader this afternoon. It's fantastic to be here on such a beautiful day, and always grateful for this type of an opportunity to serve. So thank you to Simon for organizing that for us. Simon, if I can ask just before I get moving into the bulk of my presentation, if you could just upgrade my access on level of administrative access on GoToMeeting for so I can see the chat questions coming straight away.
I've just done that now for you.
To jeopardize that. Thank you. Right, so my name is Rishi Patel, co-founder, Master the Markets, the Elite Traders Conference, and the Traders Open Day, and a very warm welcome to my presentation on the 7 tools, the 7 essential tools that every trader needs for success. And I'd just like to start off by asking a quick question. Who here has seen me present before, or who hasn't seen me present before? Punch a Y or an N in. To answer that question. You might have seen me present either on the Round the Clock in the past, or maybe in-person presentation at one of the Forex shows or something like that. Punch something in to say if you have or haven't seen me present before, and then I'm going to got a couple more questions for you as well, and we're going to make our session nice and interactive. So it's going to be a good one. So let's have some responses coming through. Okay, yes. Some people haven't. Okay. Never heard of you before. Okay, that's good. I like that. We're reaching a new audience. Brilliant stuff. Okay, so it looks like around about 70% of people have seen me present before. It looks as though, okay, that's fair enough. Okay, good. So welcome to those of you who have never seen me present before. Very short background on myself. Very short, not to bore those of you that have already seen this before. My name is Rishi Patel. As I say, co-founder, Master of the Markets, the Elite Traders Conference and the Traders Open Day. I have a background in computer science. Can't say I enjoyed that too much. I then dropped partway through that degree and went on to found a video production business. Now that was good fun up until around about 2008, when you all know what happened. Fate would have it that I came into contact with now my business partner, Thiru Nagapan, who's been no stranger to the Round the Clock webinar series and a highly acclaimed speaker as well. For Master the Markets, various Forex shows. So we both started to trade the markets together in 2008 together. And now, obviously, we run Master the Markets from 2010 onwards. And you can check out our website, masterthemarkets.net. It has lots more information about us. We founded the Traders Open Day. I've had the privilege of speaking in China at the Easy Forex Partner Conference. Everything that we do as traders is transparent and is printed for our customers publicly. They can see all of our trades that are running in real time, all the historical results. We really don't hide anything whatsoever. And all the month-by-month breakdown, even trade-by-trade breakdown is totally transparent. We're also founders of the Elite Traders Conference, where we have the honor of working with Mark Brown, 40 years plus of experience in the financial markets space. So, and that's Traders Open Day, where you may recognize a couple of these speakers with Steve Ward on psychology. The fantastic David Paul as well came to give a presentation on equities trading as well. So what's my presentation about today? It's about 7 key tools that every single trader we feel here at Master the Markets needs to be successful in this space. So what are the most important tools you may be asking? I'm going to walk you through them step by step. I'm going to show you the key tools that you need that will give you a winning edge in this space. I'm also going to show you the most important statistics you need to analyze for confidence in your strategy. this is all about building confidence. What we're doing here as traders is we want to build our confidence. We want to build that conviction that we have in the market. And we've done lots of blog posts and articles on this. We've given numerous talks all over the world about this, about how to build a trading system, build trading strategy from scratch so that it gives you confidence. Because if you're confident, you can scale up your capital easily. No one wants to be trading 25 or 35,000 pounds for the rest of their lives. We want to be able to scale that up to 300,000, 400,000, 500,000, 800,000 plus, even beyond. So that's what this is all about. I want to give you some tools which can increase your confidence to allow you to scale up your accounts that you're trading. And the one thing as well that accounts for 80% of all your returns, you have to wait until the 7th tool to find out what that is. So that's my goal of my presentation today. Just before I carry on to talk about most traders' approach to the market, can you just tell me if you have your level of trading from 1 as a complete newbie to 10 as a professional making consistent money month on month? Where would you rank yourselves all in terms of your progress in the market so far? Between 1 and 10? Okay, good. Okay, huge variety coming. I think we're getting every single number between 1 and 10, which is interesting. Okay, that's fine. Perfect. I think the only number we've missed between 1 and 10 is a 9 and a 2. Other than that, we've got everything. Okay, good. So here's what most traders do in the market. Most traders generally tend to approach things this way. They take a set of trading rules, and this could include anything such as indicators, support resistance, swing highs and lows, all of these types of things, and they take them and they randomly put them together, and they start to look for opportunities or trade setups in the market. But what the problem is that not only do they use these parameters inconsistently, or these components, these strategy components inconsistently, they also execute inconsistently as well. So sometimes they will use those rules, sometimes they won't, sometimes they'll be emotional, sometimes they'll be super following their plan and super strict. And what that leads to is an invalid set of results. See, at the end, after you've taken 20 trades on a trading system, and sometimes you've used the MACD, sometimes you haven't, sometimes you've looked at the parabolic SAR and you've been like, you know, it's giving me a signal, maybe I should take that into account, I really want to get into this trade, and you know, I'm just looking for an excuse. I don't know if anyone ever resonates with that, but that is a very common thing that we've come across in 20,000 plus traders that we've mentored over this time. And that leads to invalid set of results. You get an invalid set of results, what happens is you then tend to repeat that and looking for an edge in the market, looking for some way in which you can resolve that. And most of the time, in fact, I'm saying most of the time, I'm lying. I'll tell you honestly, in 100% of cases of all of the traders that we've mentored, coached, worked with in the last 8 years, between myself and then another 8 years, Tiru, and then our mentors as well that we've backed with all the experience. In that 16 years of space of being in the markets, we've never come across a trader who's come back to us that's gone away with this type of an approach, to come back to say that they've actually been able to make consistent money. So then that got us to build something which was a set of components which you can execute regularly. And this is really where the 7 tools for essential trading come in from. So 7 tools that every trader needs for success. I'm going to walk you through them one by one. So the first is a very strong understanding of the fundamentals, a very strong understanding of what you need to get up and running in the market. Now, for those of you that have here put in your experience level as a 1 or a 2 or a 3, this is going to resonate most with you, because what this does is this gives you the opportunity to learn all the key basics of how the financial markets work and give you a strong foundation from the beginning. And this is actually our Trader Starter Pack DVD. This was actually released in the Empire Cinema in Leicester Square back in November 2014. And we actually made it into a documentary. It's around about an hour long, and it's shipped to you on a USB key and as a DVD as well. If you've got a DVD player, you can watch it on your TV. It's a really great documentary, very easy to watch, and entertaining and interactive as well. And it gives you all of the core tools that you need to now get up and running. So this we call our Trader Starter Pack. So that's the first tool that you need, because you need a good foundation. Even if you were going to build a house, and you wanted to build a great trading strategy, you wanted to transition from trading part-time to trading full-time, you wanted to take, if you're, let's say you're an IT consultant and you're trading the markets on a part-time basis, then you want to transition it over to full-time, you need a strong foundation. So that gives you the foundation. The next thing we talk about is understanding orders. The reason we talk about orders and put so much emphasis on them is because where you place orders correctly, they actually give you the opportunity to place trades and then walk away from the screen and make your trading passive, because everything is broker automated. So we're going to teach you how and when to use the pending orders. And these are not just your normal types of pending orders. We're talking about limit orders in here and all of the other types of orders you can actually place in the MT4 environment. That's walked through in detail. So that's there as well. We call that our placing orders module. That's the second tool that you need for successful trading. Now the third one is a set of trading strategies. Now this is really the magic, because lots of people think that the only tool that they need is a trading strategy. But where you look at our methodology in terms of our three-step methodology, the Master of the Markets three-step methodology, which is proven to bring successful trading, successful systems, which people have benefited from already and quit their jobs and started to live just from their trading. That methodology, that system, talks about the strategy component as just one out of three things that you need to get right. But even though it's one out of three things, it's still a very key component. And so what we've done in this set of Traders Essentials tools is we've actually put together two trading strategies which actually bring together a consistent set of components. It shows you a breakdown of a crib sheet and exactly how we lay out our rules for entry, our rules for stop, our rules for target. And remember, as I said earlier, this is what gives you absolute conviction and confidence in your system. Most people don't have a set of rules which is laid out, which is clear. And as a result of that, they end up trading. And I've met traders who have been trading the markets for 10 years, come to one of our two-day workshops, one of our two-day Traders Basecamp workshops, and say, I've been trading the market for 10 years, and I've been to every trading company, and I've not been able to make consistent money. And we're asking if they have a set of rules, and they've got nothing. And we're asking where their rules are. A lot of people mention that it's in their head, or it's just kind of rough. They're not keeping any kind of logs. This is not the right way of laying out this and working with this as a professional business. If you want to get this right, you need to have a professional set of tools, and a strategy is one component of them. But the second component is an actual crib sheet template, and that's what we actually go on to next. But there you've got the actual strategies. You get two strategies, the lift-off strategy, the pivot bounce-off. The lift-off strategy is actually a trading strategy that we ourselves use in our live trading room on a real-time basis. So we're actually using that all the time. But as you can see, the strategy component is one element of three, which you need for the three-step methodology to be able to return consistent results. So that's just one element. So this is all contained on the Traders Essentials kit just there. So there's first three components I've talked about. Now the fourth thing that we have are some live trading videos. What we've done is we've taken everything that we talk about and we've actually executed trades, many trades on the market on a live and real-time basis. And what we're doing is we're giving you the actual video tutorials. It's as though you get to the opportunity to look over our shoulder and actually see step by step what our thoughts were while we were in the trade, what we were waiting for, what we were thinking about, how tightly we were following our plan. You can see all of this actually happening in real time with some real live trades. So we've actually made videos of those, and you can see exactly how it pans out as well. Gives you opportunity to see professional traders actually in action. Now, the next couple of components I'm the most excited about, and they'll pertain to the more intermediate-based traders. You know, maybe those guys who are 5s or 6s out of 10 in terms of where they are in their trading career. Now, the crib sheet template is a mandatory structure, if you like, which gives you the opportunity to be able to lay out a set of rules and follow them on a consistent basis. It allows you to measure as well to make sure that you've got these rules in a way in which they eliminate doubt. So when you go into the market, you place the trade with confidence, and you can place that trade on a £25,000 account and you'd do exactly the same thing on a £250,000 account. It would be no different because you've laid it out on this crib sheet template in absolute concise detail. There's absolutely no room anymore for doubt for any of what you're actually doing. So that's the crib sheet template. So it gives you the structure that's required for consistency, and it's a very important set of documents that we've actually compiled here. And what I'm going to do is I'm going to actually show you in a moment an example of a crib sheet template and a trade journal as well, because you need to be able to log your trades. So that's really, really important as well. So a crib sheet, there's a snapshot of one just here, and you can see, so this is a 20 EMA bounce off trading strategy. It starts by laying out the rules for entry. Then there are several other categories. Under the rules for entry, you've got 4 types of what we call 4 degrees of freedom that you need to look out for. So on the crib sheet, there's 4 reasons you need to get into a trade. We call them degrees of freedom. That's just under the rules for entry. Then you've got your initial and trailing stop rules. Then you've got your target rules as well. And even the target rules are split into various sections. So to make this much easier, you need to lay out your crib sheet with exactly what I'm showing you here, with these types of actual categories and breakdown templates. So it's very important that we do that. So there's the entry rules that you need to actually put into place. You will need those 4 degrees of freedom, as I said, and that's the 4th component, just the 5th component just there. So that's the crib sheet template. Next thing you need, actually, and I haven't put it on the presentation, is a trade journal template. Actually, what I'm going to do now is I'm actually going to show you a trade journal template and a crib sheet template all at the same time, so you can just get a practical feel for what these tools actually look like. Before I carry on, I'm just going to very quickly ask, how many people here, and I'm just looking at the number of attendees we have, so how many people, I want to get a percentage idea, how many people here are keeping on a regular basis a log, a structured and detailed trade log? And here I'm not talking about an account statement. That's not what I'm talking about. I'm talking about a trade journal where you've actually logged your exact entry, stop, and exit from the market on an Excel spreadsheet. Who here does that? Punch a Y in or an N in. If you don't do that, let me know that you don't do that as well. I just want to get an idea because there is a certain percentage of people who do this on a regular basis, but then, yeah, so sometimes would be a no in that case, because remember, it needs to be consistent. It does need to be consistent. So a few people, okay, so I can see here lots of responses coming in, and again, the numbers always stand, so it's always around 5% of people that keep some kind of a trade record. But then when I show you the journal that we use, you're going to see the types of things that you need to keep. And the journal that we use is actually an advanced journal. It's got on it various columns which will help you to even optimize your strategy's performance. And it will help you to also track if you can allow strategies, your personal trading strategy to run for maybe a 2-to-1 reward risk, 3-to-1, 4-to-1, 5-to-1. It will show you, this journal that I'm about to show you will actually show you if it's more optimal for your trading strategy to run or if it's better to keep it as it is. And that's the actual columns and things that it does include. So for example, let's have a look at this just here. Right, so this is our dynamic breakout trading strategy, and this is a trade log that we have of that. And I'm just showing a snapshot of January, February, March 2015, and this is how we actually lay out a professional trade journal. So you can see, first of all, you've got the trade number, you've got the currency that we're trading, the entry and the exit date, whether we're going long or short. The time frame is really important. Now, this is a nice notes column that we use here. These are the reasons that we got into the trade in the first place. Because when you look back on your trading strategy, when you optimize something, you've got to ask yourself, what were the reasons that I actually got into the actual opportunity itself? You also need to log if it's in line with your trading strategy or not. So this is your actual fill just here. Actual fill, of course, is your entry price into the market. Then you've got your stop and your take profit. Now, the other things that we're also able to log here as well, which are absolutely pivotal actually to getting the best and most optimal results actually in the market, is these columns just here. So you can see what it does actually. It's a really clever, very, very clever bit of kit. What it does, it allows you to track how far did your trade run before it would come back and hit your initial or your trailed stop loss. And what that allows you to do is allows you to optimize your target. What do I mean by that? So let me show you here very quickly. Let's pull up a little drawing tool so I can actually demonstrate for you what I mean by that, because it's a really, really important thing to understand and to log as well. So a couple of questions coming in which I'm going to answer in just a moment. So let's say that you had a trading strategy that was running, and let's say you took your profit target just there. So in this case, actually for the dynamic breakout, we know that the reward risk we're looking for is a 2-to-1. That's why this is all printing 2 in these columns here. Now, the question that I've asked myself, the trade journal, what it does is it actually allows you to see, which opportunities will have run for what period of time. So here you can see my target was, let's say, 2% on this given opportunity. But what this journal will allow you to do is allow you to calculate very quickly if it's better for you to take your profit target at 3%, 4%, or 5%. It will track that for you automatically once you enter the information in this white column as well. It will also track for you what would happen to your target if you trailed and didn't have a stop. So all of these formulas are preset and in place. We've made this. This is our own IP, and we've actually put this all together. So all you do is you fill in the columns that are in white, and actually the things that are in blue already have pre-built formulas, and they will automatically populate themselves. So there's not really too much to fill in while we're trading, because what's happening is we're putting the information in, the limited amount of information we need, like the entry and the stop, and where we got out the market, and actually everything else is then calculated automatically for us. So it's a very, very easy trade journal to use, but it has absolutely superb information set on there as well. And what it does for you then at the end, it also tells you your trade statistics. And again, if you're not logging your trade statistics and on these types of numbers, then it's going to make it very difficult for you to actually go back and analyze your numbers, because you're not actually going to understand what your system is telling you if it's not profitable, or how to optimize the profits even if it is profitable. So you can see it's telling me the number of trades that I've taken. So this is the number of dynamic breakout trades that's set up for me in 2012. And this was, we started pretty late in the year. Yeah, we started in July. So from the 6th of July onwards, for those 5 months, we took 20 trades dynamic breakout. These are all daily chart trades, 13 winners and 6 losers. You can see it achieved just under a 70% reliability, and the total profitability was 14.58%. It then goes on to tell us the expectancy, the average profit to loss ratio. And all of these numbers, what they're doing, they're telling you a very key and specific story, which you can then use to tailor and increase your profitability as you go along, as you go down the line further into your trading careers. So this is a superb journal, trade journal template to have, and we would say that it's definitely one of the absolutely essential tools that you need in your arsenal. Now, the next tool that you need is psychology. And psychology is actually what I said at the beginning. It is actually 80% of everything you do in the market is around trade psychology. So you can see that it is important to have trade psychology, and you need to have a set of tools for that, which is why we've built a specific audio program. This is an interactive audio program which tells you to pause the video, do exercises, and actually follow along, which you can actually use to tailor your psychology and ask yourself very key and important questions that are going to help you to improve and refine your approach to the market. So that's basically one of the most key tools that we've put together. We think it's the most important, and some traders think it's the most boring type of tool that they can get, but I can vouch hand over heart, as a professional trader in this space, we absolutely need to lock down the trading psychology, and that's why we have so much emphasis on that. So that's really important. That psychology component is 1/3 of that whole 3-step methodology in the Master the Market system. If you've got that locked down, you're going to give yourself a lot of options, especially when you have a profitable trading strategy in your hands. You're going to be able to execute consistently. So the next step is that psychology component. As I said, 80% of everything is psychology. The next step is your trade journal, and I've shown you the trade journal template already. Now, the trade journal template, again, it's a superb vehicle. It's a superb tool that you can use to log all your trades. The one thing that I haven't shown you yet is a crib sheet template. So a crib sheet template. There are quite a few questions coming in. So what I'm going to do is I'm going to pull open a crib sheet template. I'm going to show you how that's actually broken down and what things we're actually looking out for from the perspective of a crib sheet template, what things you actually need to log inside that trade plan, what you need to put together. But I'm just going to put myself on mute for a couple of seconds to give you all an opportunity to ask any questions that you have, and I'll be happy to answer them as well before we carry on. But I'm really keen to show you what a crib sheet template actually looks like. Okay, really good question coming in at this stage about the time frames that we trade. So we trade actually 1-hour charts and daily charts. Those are our 2 time frames. So in the intraday trading space, we were trading the markets professionally, and most of our income actually comes from the intraday trades that we actually place. But the superb trades, and I would always recommend to everyone, unless it totally goes against your makeup as a trader, to always have some type of swing trades running as well, because these are so passive and they require such a minimal amount of time and attention. It's always just worth having them. Some of the most profitable strategies that we have that are totally passive actually come from daily charts, and they're actually superb mechanisms for creating a great income with just a minimal amount of work. Because the daily chart, the bar only forms once every 24 hours, it requires such a minimal amount of trade management. So I would strongly recommend that you absolutely do trade daily charts. I think that's really important to do. But we trade 1 hour and we also trade daily as well. Do you have to input the data manually, or can it be imported from MT4 trade logs? Some of the information can be imported from MT4 trade logs. You're absolutely right. It can be imported from trade logs from MT4, but there is some information that you need to populate yourself, and that's if you want to get the more advanced profitability. And that's the key thing just there. So you really need to know, again, should I let my trades run? Am I cutting them off too early? And a proper and a structured trade journal template will tell you that, actually. It will tell you that. So what I want to do very quickly is I want to show you here a crib sheet template and what an actual crib sheet template looks like, and the types of things that you need to log. I'll come back to the other questions in a short while. So the first thing you need to know is the objective of your strategy. What is it that your strategy wants to achieve? Now, most traders that I've come across, especially those that do a lot of programming work, they don't know. They just randomly put tools together to see if something will work and make money. The problem with that is, even if it does make money for a few months, at any time it can fall over because there's no clear, concise strategy. There's no clear, concise objective for that strategy just there. The other thing that you also need to know, apart from your objective, is the concept of your strategy. What's the concept? For example, does it trade a very short sharp move in the market? Does it trade manipulation spikes? Does it trade in line with market makers methodology? Does it trade, is your concept of your trade all around taking out stops from retail traders and then moving on to making money in line with the prime brokers and people like that are controlling large money? What's the concept? So you need to answer those two questions, objective and concept. Then you need to know the rules for entry. And then, of course, this is dependent on your time frame as well. Now, remember, within the rules for entry, you need to have at least 4 parameters which you will follow on a consistent basis, a minimal of 4 parameters which you'll follow on a consistent basis. That's the key just there. Now, the other thing that you need here as well are your rules for your stop loss. So your rules for your stop loss are then split into 2 categories. You need to look at what are your rules for your initial stop loss, and then what are your rules for a trailing stop loss. And even these can be further segregated down into different types of stop. You can look at a technical stop loss, you can look at a time-based stop loss, you can look at money-based stop. So all of these things need to be documented here. The reason that you do this beforehand is because then when you go into the market, you have a clear, concise plan. The issue is most traders don't do this. They don't actually know which items to even put onto a trading plan and which items to even host on a crib sheet, which means when they go into the market, they're actually able to make nothing or losses. Most traders that I've come across in the time that we've been doing this, and you pick up patterns. After coaching, mentoring between myself and Thierry, 20,000 plus people, you do start to see patterns of traders who are making the same mistakes over and over again. And generally, the type of thing that happens, actually is that you will generally always get traders who are unclear about what they're doing in the market, about whether they should be and shouldn't be in a trade. And what that lack of clarity leads to is a very significant lack in confidence, and they're never able to scale up their capital. So they can never make consistent money on a small account, and what happens as a result of that is that they lack confidence, they can't scale up their trading capital. So they're always stuck with maybe trading just 10 or 15,000 pounds, and they can never have the confidence or the courage to scale up what they're doing. So these are all of the things that you can put into a crib sheet. Someone's asking me for a pre-filled crib sheet template. Most of the pre-filled crib sheet templates that we have actually already are kind of IP, are pre-built strategies, which you can actually get samples of, and I'll show you how to in just a moment, actually. Someone is asking if we can indeed get the crib sheet template pre-filled. Another question, can we get all the tools in one place? Yes, I'm going to show you how to do that in just a moment. Trade journal template, tracking optimization profit. So I've shown you a crib sheet template, I've shown you a trade journal template. And yes, I'm going to show you how to get a copy of all the tools in one place in just a moment as well. So you'll have pre-filled crib sheets, you'll have the psychology program, everything sort of in one place. So that's not a problem. Because this is a common set of tools, we've basically made it into what we call our Traders Essentials Kit. And that's something that is obtainable actually by yourselves, which we've actually packaged and put into a superb little product just there. So it's very important in the market to know your trading stats, and that's the reason that we keep a concise and detailed trade journal. Most people do not keep a concise and detailed trade journal, and when they go back to look at why their strategy isn't working, and this is what happens with the bulk of traders that we speak to, why isn't my strategy working? They're never able to go back and analyze it in a level of detail which will give them answers to that. They'll always be lost and stuck in this loop of wondering, why is this not happening for me? So you really need to be aware of that, and that's why we have detailed trade journals as well. So one of the projects that I actually did a little while back was based around trading insider bars. And actually what I did is I custom built a spreadsheet which would help me to not only backtest insider bar trade strategy, but also be able to log my trades on a forward-tested template to make sure that the results I obtained in backtesting was syncing up with what I got in forward testing. And what I'm going to do here is I'm going to show you an adapted version of that trade journal that I've already shown you, but actually what it's going to do is it's going to give you a lot more detail in terms of the types of things that I've logged as a professional here. And so you can see, let's say, for example, what I've done in a nutshell is I've tested insider bars, I've tested, and I've asked the question on this particular spreadsheet, and actually this is one crib sheet that I can actually show you a sample of. So as someone asked the question, what I'll do is let me pull up that trade journal actually. Would that be good? Would you like to, would it all be useful to see an example of a pre-filled crib sheet? Would that be useful to you all? Okay, so this is a pre-filled spreadsheet. So pre-filled, not spreadsheet, I'm actually going to show you the spreadsheet as well, but this is a pre-filled crib sheet template. And you can see that everything that I spoke about just now, it actually concisely details and outlines quite nicely. So first of all, there are obviously some important notes for the spreadsheet. To use this strategy, these are the tools that you need. And then it goes on to talk about the concept. And then secondly, the objective. So the concept of this strategy, for example, is to capitalize on the market maker's methodology and either take the manipulation or the profit release phase of any particular given move on a daily chart here. The objective is to capture the expansion after a compression. So in a nutshell, what I'm looking for is I'm looking for an inside bar to form, and then I'm looking for a sharp expansion to take place. My goal is to capture part of this range just here. That's the purpose of this particular crib sheet and this particular trading system. We'll call it profit expansion. So here are the rules for entry. So you can see the sample rules for entry. Now this is not my final set of rules for entry. This is actually a version that I made which will still be profitable, which will still make a return, but it's not the final set of criteria that we use actually here at Master the Markets. It is a sample set, and it gives you a good methodology and idea of how to actually go ahead and fill out the actual crib sheet template, because that was the objective of what you all were actually asking. So here you can see, for example, this is a price action rule. You need 4 degrees of freedom. You need 4 rules like this. Price action here I've got a trend ID rule, I've got how to determine the entry figure, and a support and resistance rule as well. You need a minimum of 4. If you can have more than 4, it's actually better. You get stronger trades, and you'll start to whittle down the number of opportunities and just get involved more in the high profitability opportunities, which have low frequency but high profitability. And that's, for me personally, that's my preferred trading style. So this is a template of this particular crib sheet, the insider bar crib sheet just there. You can see rules for entry. Ensure we have an insider bar on the daily chart. And what does that mean? It means that the previous bar must be fully engulfed. The trend identification rule, place only trades in direction of current trend. So we won't take counter trend trades on this particular strategy. And we use the smart money indicator to identify that. Place the order around the bar in line with the market. Add 3 pips to the high of the bar to get involved on the entry. Add the spread where is relevant. Then it says to, there we go, add spread, take only in one direction. If that fails, do nothing. If the trade isn't triggered by this time. So you can see the level of detail that we go into here, because what it does is when we go into the market, it gives us no doubts about whether we should or shouldn't be in an opportunity. And the actual tools that we have on the Traders Essentials kit actually has pre-filled trade strategies inside there already for lift off, pivot, bounce off. You've got these crib sheets already, and also what you've got is a template for the crib sheet as well, which you can actually populate your own on as well. So in the stop loss, the initial stop loss here, you can see the stop is on the low of the outsider bar for a long, or the high of the outsider bar for a short. Again, you add spread where relevant, and the trailing stop loss is behind every buyer bar if you're trading the market long, every seller bar if you're trading a short, and there are 5 exit criteria as well that we can look at. So what I did is I took all of that together and I actually pre-built it onto a journal, and I custom made this journal specifically for this strategy. And this is a superb trading strategy. What I've got here, what we put together actually on this crib sheet, is a pretty awesome trading strategy. And what it does actually is, you can see here, these are the pound-dollar results in 2012 for what we would have seen historically and how it's set up. You can see I've got my high, low, close of the previous bar. I've also said where is the entry into the trade, where is my stop loss going, and then if I had exited in different places, what would the results have actually been? I took 5 exits and I tested them. And this is how you would lay out a professional journal. Now, unfortunately, if you were to do this yourself, it would take you years to even figure out what things to actually include inside there. Here is a pre-built template of a custom-made trade journal for this particular strategy. And you can see we're tracking 5 different mechanisms for entry and exit and stop. So here you can see all the way as we go along, the different exits would have given different sets of results. For example, the exit that we've used here, which is the third buy or seller bar, you can see this crib sheet, this trade journal also has my own notes on it as well. So you can see that I've got, if you've exited on the third buyer bar, in cable 2012, you would achieve 326 pips of net bottom line profit on that year. Now bear in mind, that is only one currency, and I've actually run this across 6 or 7 currencies. The third exit actually on the Euro Yen would have given you 1,006 pips for the year in 2012, and so we continue. So you can see that in a nutshell, of course, this is a fantastic journal. Now what's important about this journal is that not only does it tell you how much upside we've actually obtained, it collates the results all into one place, and I'll show you just here. So this is actually all of the results collated for all currencies. So if you look, this table, in a nutshell, it tells you what all of the results were across all the currencies, adds them up for you automatically. There are templates, there are spreadsheets, formulas inside here which take all the tabs together and they absolutely add everything up for you. So you can see, okay, total number of trades over that period of time, how many won, how many lost, what's our reliability, all of the most important numbers for you to see what we would do on an ongoing basis actually logged all here. So you can see, for example, I'll give you an example of this. I'll give you an example of this, which is that you have a, let's say, for example, on the exit number, let's take an example here, just a sample. The exit number 2, for example, over 241 trades. You can see how many winners, how many losers you have. This quickly allows you to see actually how much you have in terms of an opportunity for winners and losers. Is it an actual exit that will work for you in the long term or not? Some people don't know which exit they should be. Exit is always one of the biggest things that you need to get right. A lot of people can get into a profitable trade, they don't know where to get out. What this journal is telling you is where to get out on a consistent basis to get the optimal set of profits. But this is not the most important information to know. In fact, the amount of money your strategy will make for you actually is not the most important thing to know. Does anyone know actually on a strategy what the most important set of tools, most important actual statistic you need to know for a trading strategy? Does anyone know? Would anyone like to have a guess? What's the most important? Actual number, the most important figure that you need to have for your trading strategy? I haven't shown you it yet so far. That's a little clue there. Expectancy, no, it's not. The reward risk is not as well. No. Give me a couple more guesses. Let's see if anyone can get this right. The expectancy I've actually shown you so far. The reward risks I've shown you so far as well. Someone says losses, which is close, but it's not exactly losses. It's not losses. What is it? If it's not losses, what is it? Yeah, some people have got it right just here. Some people are punching the thing in, drawdown. Absolutely correct. You need to know what's your peak to valley drawdown. So what is the maximum amount you can lose over any given time before your trading equity curve makes a new higher high? You must know that. You must know that. Does anyone here have a journal that allows them to track their drawdown in real time and allows them to see over what period of time they've got? Yeah, this is the thing. So most people, so yeah, that's it. No one actually has this information. And so you see, this is critical. Now, if you look at this particular tab on the spreadsheet just here, what you actually do is you actually have a complete template. One person says that they do. Sorry, Chris, I didn't see that. Chris does have. He's the only person that says that he does. So out of, that's what, probably less than 1%, way less than 1% of the people that are here. So that gives you a little idea. Now, if you don't have a way of tracking your drawdown, my question to you becomes this: how do you know when to cut off your strategy? Can anyone answer that question? How do you know when to cut off your trading strategy? How do you know when your strategy isn't working anymore? How do you know when to cut it and run, that the market is no longer going to give you profitable opportunities on an ongoing basis? Totally, there's silence. There's actually, for the first time on the chat box, there's actually not too many people typing in. For the past couple of questions, I've got like 20, 30 answers coming per question. Yep, you will be if you're not tracking things like this. So you need the right set of tools. If you want to make consistent money in the market, you have to have the right set of tools. So yes, Carolyn says that when you exceed your drawdown expectations. So that is the correct answer. So someone says drawdown above 20%. So if you say drawdown above 20%, I would ask you why. What's the mathematical reason to cut it at 20%? Or is there a mathematical reason, or is that just an arbitrary figure? See, this is the thing. You need to know where to cut the strategy off. And on this template just here, you can see clearly and concisely that this is actually tracking for me the months where I had losses. Not only is it tracking the months where I had losses, it's also tracking for me what the maximum drawdown was over any given period of time. You can see here cumulatively, I took a loss of 5.92%, and that was the maximum drawdown that I had in any given time for any consecutive set of months. So that's what we lost. In order, this strategy actually, the final results in this strategy actually make around £70,000 over 3 years. Around 25. It's an end-of-day trading strategy. You only get around about 50 to 60 opportunities per year, but it actually grosses a return, pip-wise, it actually grosses a return of around £25,000. At £10 per pip, it actually gives you on an end-of-day basis. And we also know what the maximum drawdown is in order to achieve that is as well. So this, you can see, it's all tracked and it's tight, because you see that if you're able to understand what's the maximum drawdown, you're able to then also understand where is something not going right and where do you take a step back and review. So that's the whole idea behind this particular journal just here. Now, this journal, that's the idea behind that journal just there. So that's what you need to do. You must log your trading stats. That's really important to do. And that's the only way you can optimize. That's your optimization component in 3-step methodology just there. So you've got to basically be able to do that. And that's important. And that, obviously, we discuss a lot of this in depth in our actual 2-day courses, which we run on a bi-monthly basis now. There are only 2 left this year, I believe, of our 2-day courses. If you'd like to interact with us, that's a good environment in which to do that. We're actually primarily focusing most of our time now on only our trading business. So the trading business has become something we love to do, but we're just not putting as much focus on as at this time, because the bulk of the returns we're able to make is from the trading business. It only seems logical, but to spend most of our time there. But we want to reach out in this space. We want to serve. We want to build traders who want to be able to make consistent money and do what we've done, which is basically do this professionally. on a high-end basis. So this was the 7 essential tools that every trader needs for success. What I'm going to do is I'm going to take some questions. Before I take some questions, I will just quickly give you an overview of what we've gone over. We've gone over the key tools that you need to give yourself a winning edge, the most important statistics you need to analyze for confidence in your strategy, and the thing that accounts for 80% of all of your returns. Now, because someone has asked for the specifics of the actual tools that I've spoken about here, I will actually show you the end part. Well, actually, let me ask you, because if it's not relevant to everyone, we won't do it, but I mean, would it be good to see how you can obtain all of these tools in one place? Would that be useful to know? Because I don't want to give that presentation if it's not relevant. Would that be useful to know how you can obtain all of these and where to go to obtain all of these tools in one place? Okay, lots of yeses coming in. So I'll show you, let me show you in that case exactly what you need to do. If you want to get all of these tools in one place, we've actually compiled them onto a website. It's tradersessentials.co.uk. Simon has very kindly pointed us in the direction of the website. If you click onto that website, the price is currently discounted to £27 plus VAT for all of the tools that I've shown you. That includes actually the crib sheet template, the trade journal template, your Make It Happen Psychology audio program. Everything actually is there already. As a special bonus, you also get access to our 2-day trading workshop for free if you were to purchase one of those. It's a limited time offer. We're not going to keep it up for too long. It's just in order to sort of get the word out about this fantastic set of tools in the beginning. That's why it's there. It all comes on a really great gold USB key. You can just plug it into your computer. You don't need a DVD player, which is displayed actually here along these. It's £27 plus VAT. If you click onto tradersessentials.co.uk, you can actually purchase one, and that £27 plus VAT includes free shipping anywhere in the world. I'm very conscious that the round-the-clock audience is a global one, and so this will ship from our distribution warehouse. This will ship to anywhere in the world. Obviously, if you're in Australia, it's going to take a little bit longer to get to you. I think that the lead time is a week and a half. If you make a purchase day, around a week and a half as well. Just there. So you get access to all of that, and what we're going to do as well is just as a little incentive here for the round-the-clock audience, because we love you guys so much, for the first time ever, I'm going to give you that spreadsheet that I just showed you actually, the profit expansion spreadsheet, so the one that includes how we collated all our results year by year, currency by currency, trade by trade. I'm actually going to give you, and this has all of our custom formulas inside already, which you can then access and put onto any of your own trading strategies. So this actually has everything you need to be able to log all this information. It's already there. I'm going to give you that just there at actually no additional cost, but that's only for the first 10 purchases today. If you're catching this on a recording, by the way, that offer will have expired, so I'm sorry for that. If you're catching on a recording, that offer will be over by then. But if you're one of the first 10 purchases, I'm happy to include that spreadsheet for you. My team will go ahead and actually send you an email out that manually. That won't be sent automatically because it is only for the first 10 people. And just to summarize the offer, so you get the Trader Starter Pack DVD, the Placing Orders DVD, strategies, live trading videos, crib sheet template, trade journal template. We'll ship it to you anywhere in the world. Yes, the strategies, everything that you're seeing here is on the USB key. You'll get a USB key and one DVD in the post. In case you haven't got a DVD player, you will just have the same content on the USB key anyway. You can play it on your computer, but if you want to watch it full screen on TV, you've got that option as well. It's a really great documentary. That's all on there. Free shipping anywhere in the world. That's on us. And bonus one, you get a free ticket to the 2-day Traders Basecamp workshop in London. So someone asked if there's mentoring included, so you can get mentored by us in that 2-day space. And the second thing is, for the first 10 purchases, happy to give you that advanced trading journal. It's never ever been issued in the past before, and I'm pretty confident to say I'm not going to give that out. Actually, I'll just say right here, right now, I'm not going to give that out anymore. I don't want to have that too widely distributed. That is my premium IP, and I did spend some time initially developing that. So I will give that for the first 10 purchases. You can get that copy of that. If you're not within the first 10 purchases, my team will also inform you as well. And we'll be dead honest with that. I mean, we're very transparent with everything we do. and our top values around integrity. Happy to answer any questions at this time, either about the Trade Essentials kit or about any part of my presentation just now.
Rishi, I think unfortunately we're right out of time. We're about 2 minutes away from the hour, and we have another speaker waiting. But any other questions that could come in, we'll send them on to you. And of course, we've got the links that we've posted in the chat box already for Traders Essential for the USB stick, and free postage for a real gold USB stick. That's going to be quite expensive. I hope you realise that. But Rishi, I'm sorry we're just about on 2 o'clock now. But thank you very much indeed for joining us again. Great presentation, and thank you for sharing with us all the crib sheets. And
Mr. Campbell, many thanks for the opportunity, sir. I will let you get on with the afternoon. Thank you for the opportunity, and thank you to all the traders tuning in on Around the Clock presentation. Keep in touch with us and let us know how you get along and if there's anything we can do to serve. Until the next time, as we will say, stay disciplined, follow your plan, and trade like a master. Bye for now.
Indeed. Thank you very much, Rishi Patel from Master the Markets. There we go. So I will go right along to, without any hesitation or delay, welcome our next speaker, Nigel Hawkes, who's waiting patiently in the wings. Thank you for joining us today. If you've just been joining us in the last hour, this is Round the Clock Trader. My name's Simon Campbell, and we are halfway through our day of live webinar presentations from expert traders. So delighted to have you with us. If you've missed anything so far or can't stay with us till the end of the day, I quite understand. We are recording all these presentations, and as a registered attendee, you'll have access to all these recordings from tomorrow onwards. So don't worry if you have missed anything, but we do hope you can stay with us live as long as you can. Our next speaker, Nigel Hawkes from HawkeyeTraders.com. I'm very happy to be introducing Nigel to the event for the first time. Having met Nigel several times many years ago, we have recently reconnected to the Round the Clock Trader previous who have referenced Nigel's indicators in their own presentations. Raman Gill, among others, who regularly use the Hawkeye Traders system. So I contacted Nigel, and he very kindly agreed to come and join us today to tell us what it's all about and why everybody's been talking about it. I will bring Nigel in and unmute his microphone and say, good afternoon, Nigel, are you there and can you hear me?
Yes, I can, Simon. Thanks very much. You keep dipping in and out a little bit, as did the last speaker. So I hope I've got enough bandwidth here, but I'm sure I have. So let's see what happens.
Well, from your side, I can hear you very clearly without any pauses. So I think we're okay. Just saying to the people on the line there that how we've come back to connect with you again through customers and attendees and speakers who obviously you'll know of that use your system that you created, and we're delighted to have you to present that today. What I'll do, since we're just on 2 o'clock, or just past 2 o'clock, I'm going to make you the presenter now and give you the control for sharing your screen.
Show my screen. Let's find the right one. Do you see my desktop now, Simon?
We do. Thank you. Yes, we are looking.
Just hold on. Let me just try and move stuff across now. And now you can see a PowerPoint with a beautiful photograph of me, correct?
Well, actually not correct. We're looking at the TradeStation screens.
Ah, how did we get over there? That's clever. Okay, let me come back out again. And let me go back to share screens. I just want you to find I got it. Okay.
You must have 2 or more screens monitored.
I got hundreds of the buggers. There, now you can see it, and now you can see a PowerPoint. No, don't worry.
Sorry.
I'll sort this out. Don't worry. I'm not. Don't worry. We'll sort this out very quickly.
Not a problem. There's no hurry.
Now, if we do, can you see that? Can you see me now?
I'm afraid not. We're still looking at
Okay. Okay.
just a blue screen.
Let me sort this out. I use this software all the time, so it can make me look stupid. Now you should be able to see it. Got it?
Wonderful. Wonderful.
Hey, you got that handsome boy in front of you, Simon?
Well, you take the words right out of my mouth, Nigel. Handsome devil. How to predict market direction using volume and price. Nigel, it's so good to have you back. As I was saying, the last time we met was our rather glamorous location at the Fort Lauderdale Traders Expo many years ago, and of course we met in London at the shows that I used to organise.
Yeah.
But it's great to have you back. There seems to be more and more people using Hawkeye.
You're going in and out on me never mind. Let me kick off, Simon, yeah?
Let's just go straight to that. So let me see if I can just ask everybody at home, how is the sound for you? Are you hearing and seeing myself and Nigel okay? Okay. Okay, it sounds like it's my end, Nigel, but everything else is coming through okay. Okay. Thanks again. We'll hand straight over to you. Thank you, Nigel.
All right. Thanks very much, everybody, and thank you, Simon, and thanks for the invitation. Simon said that we met many years ago. I dread to think how long ago. And I started Hawkeye not as a business, but it was my own trading program that became a business. Main business is trading. Hawkeye, we've got about 4,000 users worldwide now over the years, who enjoy having the insight of understanding volume in the markets, and that is what Hawkeye is all about. So, whoops, that shouldn't have happened, and we've obviously got some problems here. Let me just sort it out here, and I can probably do it this way. Oh dear, dear, dear. Don't understand that. I'll have to share another screen, I'm afraid. Just hold on.
Okay, no problem.
Sorry. And
just not the slides just not turning forward, are they?
What can you see now, Simon? Can you see a disclaimer up there?
That's right. Yes, we can see that.
Screen. There's a bandwidth problem happening. I don't know what it is. Anyway, there's the standard disclaimer, everybody. If you're unhappy with that, please leave. I'm not licensed to give trading advice, nor do I wish to do so. So the agenda today is an introduction to volume, the application of volume, and closing thoughts. And the most important part of the whole presentation are your questions. So please keep those questions coming in. Simon, I might have to ask you, with these technical problems that I'm having, to read some questions out to me at the end. But let's understand, 70 to 80% of traders are failing. And why are they failing? Well, there's many reasons. One is their mental strength, one is their money management. The most important thing that I think traders fail from is choosing the wrong time frame. Most traders, when they start trading, trade far too fast to time frames, and they just become cannon fodder. But that is another presentation which I do and another talk that I do. But most traders are a failure because they are using traditional strategies. They're using MACDs, stochastics, Bollinger Bands, Elliott Waves. And I can tell you those strategies don't work because they're all lagged. They're all looking at what is happening and after the event as opposed to telling you what is coming into the market. And if you want, so important. It is so important. I'm sorry I have to do all this, as it is the only leading indicator out there. It signals price movement before it happens, and all other indicators are lagging. And I have to tell you, the aha moment for me was when I put volume on triple time frames. As soon as I saw, let's say that you are a fast trader and you had a 5-minute chart, a 5-minute and a 15 and a 30-minute, when I saw the volume in harmony on all those 3 time frames, or daily, weekly, monthly, or whatever time frames, as long as they are triple and in multiples of your fastest time frame, it really, really started to work with me. And that is how I really started my journey in understanding volume. I'm just going to tell you a little bit about how I became a trader. You know, I've just turned 68. I can't believe it. But in another life, I had a publishing company, which I sold out in the early 80s. And I sold that to a company called IPC, and I invested fortunate. Sailing is my passion. I was invited to join the America's Cup, the big sailing race, down in Australia, and I went off as a director of that down in Australia. And before I went, I invested some of my money, or I should have said speculated some of my money, with a broker that I'd met. And when I got back, he told me he'd lost it all, and I couldn't believe it. I thought the bugger had ripped me off, so I started to go through all his trades, and I thought, this is easy. I really thought it was easy to trade, because when you look at a chart in hindsight, you can say, yeah, I buy there, I sell there, any turkey can do this. And I started to trade, and I was horrible. I was attracted to it because my previous business, I had nearly 300 people working with me, and I thought, I don't need anybody. You know, putting one contract on or 100 contracts is exactly the same. So I thought, I was really attracted to a business where I didn't have to employ people. So I started to trade, and I was absolutely, absolutely awful. I have to tell you, I couldn't believe how stupid it made me. Because in trading, you have to be a loser first. You have to lose money. There's nobody that I know who has traded straight out of the box and made great money. And whilst you're going through that learning phase of learning to trade, you obviously have losses, and those losses hardwire your brain to fear. And one of the greatest problems traders have is that they come out of trends too early. It's very interesting. Became a broker. He was quite a good trader. He went off to become a broker, and I said to him, I said, why are you wanting to become a broker? He said, I want to see how the really successful traders trade. He said, I want to know what they do that I don't do. Well, it was very interesting. I met him about a year later, and we were having a lunch. I said, did you ever find out? He said, yeah, I found out. He said, they're exactly the same as you and me. He said, they all have their losses. They make 300, they lose 200, they make 500, they lose 100, they make 600, lose 1,000, they make 2,000, lose 3,000. He said, but, and here's the big but, the really successful trader suddenly makes 8,000, 15,000, 20,000 because they can hold a trend. And I do implore all of you to learn and have conviction in your own belief in your trades to hold trends instead of coming out. And very interestingly, about a year ago, I think it was, in the Sunday Times in the winter, I was reading an article that showed that the largest amount of apprentices that dropped out of their apprenticeship were electricals. And these electricians were trying to learn to become electricians, rather, in their apprenticeship. They got a belt from the electricity, and then they became too fearful to carry on wiring. And I thought, gosh, that's just like trading, you know. You get there and you start losing money, and then you start making a little bit, and to get off that launch pad of breaking even and making what I call not Tesco money, but real capital gain, you've got to learn to hold trends. And there's ways of doing that, whether you're using the Hawkeye system or your own systems that you have that show you when a trend is there. You've got to hold trends. So I was a loser, and I thought, how am I going to learn how to do this? So what I did, I went to the London Stock Exchange. I went there every day for 2 weeks. And in those days, it was before Bin Laden. I could just go in, and I got to know the floor traders. I went out with them. In those days, it still closed at lunchtime, so they used to go to the pub. I went out in the evening to find out what they were doing, and I really got to know what they were up to. And at that stage, I then found the missing link. And the missing link was their advantage. And they had three things that I didn't have, really. They had accountability. They worked for somebody. They had a job. They showed up at 7 o'clock or 7:30 in the morning, and they had to show their boss that they'd done X amount of trades and their profitability and what have you. Most of us have turned our spare bedroom into a trading room, and we sit there, and we're not accountable to anybody. We probably have a partner who we regularly lie to and say it's been a great day when you've sat there and done nothing and sat on your hands. But there's very little accountability when you're trading for yourself. They also had free money, which we can't do, which is the spread, the bid and the offer, and they could feel that and they could trade the free money. But most importantly, they could feel the market. They could feel the buying, the selling, the frenzy of buying or selling, the speed of the market. They had the DNA of the market in front of them, and that's volume. And that's when I knew that volume is the key. Whoops. Sorry about this. I don't know what's happened today. I did a presentation yesterday and it was quite all right. So I knew volume was the key. So I started researching volume goes to Richard Wyckoff. He was around in the 1930s. Very interestingly, you've got other great traders who were around in the 1930s, Elliott and Gann, great traders, and Wyckoff. And he was around and he was studying volume and price. And of course, in those days, they all had the ticker tape. And if any of you haven't read Reminiscences of a Stock Trader, you should do. It's a wonderful, wonderful yarn and story. So I started to study volume and price, and I jumped on a plane and went off to America. Found his family before I went, and they were based in Phoenix, and I ended up at a small little print shop in the corner of a shopping mall in America where his family had this small little print shop, and managed to get his photocopies of his original course notes. And I put them in a U-Haul trailer, got them shipped back to England, and devoured them. And that was really the start of my journey. And during that time, something really, really fundamental happened to me. Although I was doing it, and you've got to remember, this was really before computers, and I was doing it on chart paper. I had like a wallpaper table out in my office, and I was trading gold at the time, and I was just trading it. I used to get the Financial Times first thing in the morning, get the gold prices, and chart them by hand. And whilst I was doing that, suddenly there was a real aha moment, because standard volume spread analysis, VSA, doesn't consider the open. There are other people out there doing volume indicators. They don't do the open. They just do the high, low, close. Hawkeye, that's me, considers it paramount. Why? Because it's very similar to an auction. You know, you go along to an auction and an auctioneer starts off and he says 100. And there's no bid, so he goes 90, nothing, 80, nothing, 60, 40, 50. You know, it goes down to 30. Somebody puts their hand up, it'll probably run to 45, and the hammer will come down. However, if he starts at 100 and it goes to 80, it's probably run up to 140. immediately there, and off it went. So I started to do volume spread analysis by using the open. The Hawkeye algorithm, which I'm discounting hugely at the end of this little 40-minute section, will allow you to see volume in the market. It will show you no demand, buying and selling, and it really, really does give you the edge. So that opening principle really sets the bias for the session, particularly for the day. And for all you Forex people out there, if you look at a Forex daily chart and just turn it to a candlestick chart and say, is the day up or down, is the candle green or red, I can assure you that if it's red, just take short trades, and if it's green, just take long trades off a daily, even if it is a 5-minute. People make trading too complicated. Trading is a very straightforward business. It's very easy. It's very clean. You need to have consistency in money management and right time frame. That's all you need. And understanding exactly the structure of a market. You know, a market can only do one of 6 things. It can have a trend, it can have a trend pause, it can have congestion entrance, it can have congestion exit, and it has a trend reversal. That's all a market can do. And if you can understand and really drill into where you are in a market structure and then put your volume with it and know where you are, you will be successful. So the opening price principle, as I said, was really the aha moment for me, because volume price, it shows you how to perceive charts, how to place your trades, the profits you make, and it also tells you how to protect your positions. For example, let's say that you're in an uptrend and you see red selling volume coming in over triple time frames. You're slightly a dummy just to sit there and say, well, I'm going to wait for the trend to expire. You're going to pull your stops in tight because you know that there is selling volume going on, and that selling volume will turn the market. So you must do that. So let's go into Hawkeye volume. Now you can see that we've got our volume down here, and we have what's happened there? Regular volume down the bottom. My goodness, I hope this isn't screwing me up. So we have that on the bottom. Now you can see I have green volume here going up on the Dow. This is a slightly aged snapshot of the market, but it's showing you right down at the bottom here that there was no demand, white volume coming in, and then green volume pushing it up. As you saw right at the top of this market, red volume coming in, sending it down to here, and now you have green volume right at that bottom on that bar there. It's telling you, the Hawkeye algorithm's telling you, hey, this is buying. And then there's no demand volume, showing you that, like everything, nothing goes straight out of the traps. Accumulation has to go on. You know, you've got to understand the markets zigzag up for a reason, and they zigzag up because you need to have volume and price accumulation. So if something goes too quickly without the attendant volume with it, it'll fall back until there is enough volume that comes into that price move to push it back up further. And that is the principle of understanding the market structure. So understanding where we are, and just look across the top here, there we are. You could just see here, you've got double tops, the market's going nowhere. But the bias comes in with selling volume, no demand, 1 bar of buying volume, declining volume, where we're going over a Christmas period here, and then the selling volume comes in, etc. Very, very important to be able to understand that all the way through. Let's have a look at the 5-minute chart. I don't know what's happened here, but in the Hawkeye volume indicator, which I'm going to discount at the end of this project, there are 4 components to it. There is the Hawkeye. What's happening here? I don't know what's gone wrong with me today. Just bear with me. There we go. Let me just click that off. Oh my gosh. Okay, let's stay here. So we have here a wide bar, that magenta bar. That is the bar that is twice average true range over 20 bars. And normally when you see wide bars, 80% of the time the next bar will close with inside the range. When it doesn't, you know that you're into a dominant downtrend. We also now have the yellow dots both here and up here. These are called Hawkeye pivots. They're isolated highs and isolated lows. If you look at this one, for example, you can see that the low is lower than the previous bar and the next bar, and the high is lower than the previous bar and the next bar, so it paints a yellow dot. We expect 3, 5, 7 bar reactions off these isolated highs, isolated lows. And when they come in, you will see that they are very, very powerful, and the whole market just moves around them the whole time, and it's very important to understand that. We also have something called the volume radar, which are these dots that appear on the price of the volume, alerting us to certain events. One, the red is ultra high volume, the yellow is high volume, and the cyan is light volume. And that's just telling me all the time, what is the market condition? What am I expecting? So for example, here we come down on ultra high volume, but the next bar closes up with inside the range. Now, I can assure you that if this bar closed up, we would have got white or green volume showing us that that was a sales climax coming down here, and then it would move itself back on. So let's just see, I hate all this. And you can now see that here we have the 1, 2, 3. There is the ordinary volume that you would get in any program. This is the Hawkeye volume telling us that it's all being bought, and there is the trend run expansion going up. And that is the power of understanding the volume, and goes back to understanding the problem that I said a few moments ago, that most traders are not a success because they do not have the ability to hold a trend. If you have all your volumes in front of you showing you what is happening, what is the DNA of the market, you would be able to hold this all the way down. But if you were a rookie trader, you would have come to this point here where there is a candlestick hammer or whatever it's called coming down, boom, boom, you'd say, I'm getting out there, and you would have missed all of that move on there. And it's very, very, very important to understand the whole strengths of a market and the way that they move. So as I said, on the volume radar, we have the ultra high, the high volume, and the light volume, which is the cyan. I have to be terribly careful here. I don't know what's gone wrong. Let me just see if we do that, which I've just gone through. So these are all the volume radars telling me what's happening, and then we get here ultra light volume. Markets only go down on high volume, on turning points, and continue on down on average or above average volume. Markets go up and they can have light volume. Most markets want to go up, particularly stock markets. Stocks want to go up, so they will go up on light volume. And then we come here and you can see this cluster as I was showing you earlier. There is red selling volume, ultra high, and then 2 bars of no demand, and the market goes into its consolidated phase, and then here we get the buying volume coming in and taking it all the way up through there. Very important. And I have to tell you, without understanding volume, you really are like a boxer with a hand tied behind your back. So this is the wide bar. 83% of the next bars are inside. It fakes and it shows continuations. It's 2 ATRs of range back over 20 bars, and the bar is purple. This is all part of the volume package, which I will be showing you. I don't know what's happening here. Oh gosh. Does this do it? No. Okay, so here's the magenta wide bar, next bar closes inside. Here's a magenta wide bar, the next bar closes out. We know that we're going to get a trend run. Here's the magenta wide bar, next bar closes within. Magenta wide bar, next bar closes within. And if you are particularly a scalper and you take wide bars off a daily and you then drill down into your faster time frame, it becomes very, very potent indeed. So what I'm going to do for you today is I've got another 10 minutes, and I know these are boring, these PowerPoints. I would much rather get on to live charts. So this is the webinar special. It's $97. You get the Hawkeye volume indicator, access to the members area on our website where there's tons of videos helping you to trade. Weekly live members trading room. When you buy a Hawkeye indicator, we just don't say thank you and send you a good luck card. We run a weekly live room where we trade the markets in front of you and show you how to use all the setups, etc. And we also have a daily Skype room where at any time there's up to about 600 traders in there, all sharing ideas and talking to each other and swapping information. If you want to get hold of this indicator, www.hawkeyetraders.com/target. That will take you straight through. It's $97, which is less than dinner for two, I can tell you. And I'm now going to go off this because this isn't working particularly well. And I'm going to go into live chart examples. Simon, you're interjecting. Let me just...
Hello.
Yeah.
Just a few questions that are starting to pile up. I thought might be a good time to see if we can address some of these questions. If we wind back a little bit, Ray was asking, what are your entry signals and do you take every one? And how do you exit the trade? You may have covered these because this was 15 minutes ago.
Well, I'm going to show that on live examples because I'm going to show the live edge of the market. Let me just interject and say this indicator is only available in multi-charts, eSignal, MetaTrader 4, Ninja, and TradeStation. So they are the only platforms that this indicator works in. We haven't done TOS and we haven't done any other packages. So this is the only one. Let me drag across, if I may, Simon, see if this works. I don't know what has happened. I've even lost my mouse. Can you see that chart clearly? Can you see the live edge of the market?
Yes, we can see that coming across.
Great. Well, this really allows me to go through and show you the power of this. So if we come into GDX, and I trade a lot of gold, which I've always done. GDX is the gold mining index. It's the gold miners ETF. So it really tells me what is happening. And if I look last week, you can see that last week I had, and I'm just going to put a arrow up rather than that, and go, I don't know what's happened here, Simon, it's driving me bonkers. You can see that we've got a white volume bar which shows no demand. I also have, look, the yellow Hawkeye pivot behind me and another one behind me showing me that this market is coming up to a market top. If I then drill down in my time, I can see on my daily, I've got 1, 2, 3, 4, 5 bars, 2 bars of which are no demand, the other 3 bars of selling volume coming in. If I go to my 133 minute, which is a third of the trading day for when the stock market is open in America, you can see, and to answer your person who asked what are my entries, 3 time frames, right there is my entry. Why? Because remember, weekly. I have red selling after no demand on my daily, and I have red selling and my trend has gone red on my 133 minute. I have a low risk entry. That is what it's all about. Finding these low risk entries when everything is in your favor. And if I didn't have the volume, I wouldn't be able to follow that at all. Could I ask Simon for people to type in any stocks that they would like me to look at? I can only look at US stocks. I don't have data.
Sure.
Be very happy to show.
Let's see if anybody's holding a US stock, maybe we can get the code, and then we can look at that. Thanks, Chris. FISV. I won't pretend I know what that is, but
Nor do I.
Freddie,
Let me just put it in here, and I'll show you. I'm going to show you something that you can really make a lot of money on FX. Simon?
Yes.
FI, what was the code?
FIS for sugar, V for Victor.
FISV.
Correct.
Well, I didn't like that data, so.
Okay, we've got Facebook.
V. There we go. Okay. So straight away we can see that the monthly is an uptrend, nothing to hold us back. But at the end of this month there will be a yellow dot here if this current month of August doesn't take out the July high. If we come to our weekly, we can see that we have no demand volume here, and we have 2 bars of no demand after 1 bar of selling. And remember I told you the wide bar, if it closes under the wide bar, it's a sign of weakness. So we have that weakness in there. If we then come across to our daily, you can see that our daily, there was the wide bar. 80% of the time the market will close back in, which it's done here. And then over here, the Hawkeye algorithm comes in and takes us already in downtrend, and that would take us down there. Any others, Simon? No?
Yes, we have Facebook.
I've got that somewhere. Hold on. With, I'm just going to stat this off for a second. So we have our weekly showing us 1, 2, 3 weeks of no demand volume. There's our wide bar. There's the close within the range of the wide bar. So it's doing exactly what it's meant to be doing. And then if we come down to our daily chart, let me just take that off as well. You can see that we have got some red selling volume going on and no demand volume down here. And again on our 133 minute, it has gone short. But it's going short, showing us congestion. Why? Because this is going up, this is going sideways, that's going up. So at the moment it's going absolutely nowhere with a bias to the downside. Let me show you Apple, which is the most widely held stock in America. And let's have a look at that. And again, you can get a very good feel on this. Here we are, we're in monthly downtrend on Apple. There's a bit of a buy going in on the weekly, but again, declining volume. And then if we come over to our daily, you can see on the daily, you've got red, no demand, red, selling volume there, 3 weeks of selling volume, which is mirrored up here on the 133 minute, taking us short. Okay? So that's that. Now, I know that there's only 5 more minutes, and I know that there's a lot of traders in the room that are Forex. I want to show you something that I think will excite you. So let me just do that and see how we do.
Okay. Just
sorry, Simon.
A question on the indicator. the $97 offer that you want today, is it a plug-in? Is it a one-off payment? Asks Ian.
Yeah, it's a payment, and all upgrades are free. So remember, I've sat your side of the desk. I've bought tons of bloody programs, and in my day they were floppy disks and what have you. We try and be as fair as possible to everybody. Once you bought Hawkeye, you've got it for life, and you've got it all upgrades as well. This is, I just want to show you this very quickly. This is the volume on 5 minutes, and when we come to trading currencies, we color code each currency so we know exactly what it is. So for example, there's our buy indicator that's come in on the British pound here, taking us up here, and this is 5 minutes. We're just looking for 20 pips move all the time on this. But let me just show you, when you come over to the main markets, this is what I trade. So I'm going to share with you what I trade. These are weekly charts, and this is a 480-minute time frame here. So all I'm interested in is taking these trends as they come in off the 480. So if I put my cursor on here, you can see, whoops, that shouldn't have happened. I don't know what's happened with bandwidth today. You can see it went short there on the weekly, and I took that move out of it, and then it went brown, which shows that the pound is coming in, and that's my exit. And I just look at weekly and 480-minute charts, and I have to tell you, if you do that, you'll be down at Jack Barkley getting a Ferrari in Berkeley Square. It is such an easy system to look at with the Hawkeye volume. This is all the volume coming through. I know that you'll say there's no volume in Forex. Well, there is, because we take tick volume and run it in to the price, and that shows it all the way through. So you can clearly see these definitive trends here. So there was another one on the pound. So you can see, if you look at a weekly chart, it looks nothing. If you're doing it on the 480-minute, clicking into the weekly, it's very good. Here's the euro going up. So you would have bought the euro against the pound back here. You had that run all the way up, and as soon as it gets to here, you're out of it, waiting for the next setup to come in. Same with the Canadian dollar going down. There's your run down on the 480-minute. You've hooked back into the dominant weekly trend. As soon as it goes down here, goes into white congestion, bangs itself out. Looking at the volume, that all takes me out. And that's the same on the Aussie, etc., etc. I have to tell you, if you can do this, I call it the 10-2-6 system, because you have to look at your computer 10 o'clock at night, 6 o'clock in the morning, and 2 o'clock in the afternoon. That's how many 480 minutes there are in a day. 6, 2, 10, if you can do that, well done. Join the club, and you'll be very successful. Any questions whilst I'm just wrapping this up now, Simon?
Yeah, no, Paul's just said, if you buy the indicator for MT4 and use more than one broker, can you use this on all your brokers, or will the software be linked to one account only?
You know, I don't know the answer to that. I know that we do platform change. Once you've got it on MT4, no. Once you've got it, and I'll give you this as my guarantee, once you've got it on MT4, it'll work with any broker data feed that comes into that. What we don't allow is multiple MT4 programs. So for example, you can't have it on your computer and your pal in Glasgow or in the States have it on his. So we tie it into your computer, but not to your broker.
Okay, and Ian's asking, he says, can you recap on the room with 600 people in it? Can we access this room?
You have to be an owner of a Hawkeye indicator first. So if you, for $97, get the Hawkeye volume indicator, you'll get my newsletter, my weekly newsletter, and in that weekly newsletter is a link to the Skype room.
There we are. what 6 to 10 period, i.e. where in the world are you time-wise?
Well, all Forex resets itself at 10 o'clock at night. So 480, you put that on, and it goes to 6 o'clock, and it goes back to 2 o'clock. So wherever you are, Forex resets itself at that time at night, 10 o'clock.
Okay. Sanj is saying, does it?
So just to answer, I think 6 to 10 is UK time. So you've just got to adjust that for wherever you are in the world. But that's when the currency markets reset themselves every day.
Talking about the UK time. There we go. Sanj is saying, will it work on UK stocks? No, I think you mentioned it.
Sure.
Oh,
Sure.
will.
Sure, it works on anything. I've got a lot of people who use it on UK stocks, using eSignal or Ninja as their platform. Yeah.
Okay, sorry, I thought it was just US there for a minute.
No. I just don't have the data feed for UK stocks. I don't really trade stocks, so I just have a data feed to show people, the stock traders who do trade them. Most of my trading is all done on what you're seeing on the screen right now.
Fantastic. Is it possible to trade between yellow pivot points, asks George.
The answer to that is yes, but you've got to be careful, George, because you're trading risk. So if you're in an uptrend, I wouldn't be trying to phase the up move. I'd be looking to buy the low pivots to go back into the dominant uptrend rather than counter trend against the dominant move. The one thing I've learned over the years is A, don't have an opinion, and B, don't be smart. If it's an uptrend, go with it. If there's a pullback, wait for the pullback and then get back in.
Okay, is there any training available after the download? Asks Mohammed.
Yeah, well, yes, because what that will give you is access to the members area on our website, and on our website there are tons of videos to help you to really understand volume, the Hawkeye trend, the Hawkeye method, etc., etc. So there is tons going on that site to help you. On top of that, every Wednesday at the moment we run a free live trading room. You don't have to be a Hawkeye member for that. You can come to just go onto my website and download the free volume ebook, and that will automatically log you in to the Hawkeye newsletter. And on the newsletter, just click on the link and register for the trading room, which is held at English time 2:30 every Wednesday afternoon. So it's start of the market in America at 9:30, 2:30 our time.
Fantastic. Rob asks, does it work on shorter day trading Forex charts? Like
Yeah.
the 1 hour or 15-minute?
Yeah, it works on, I think I just showed you. Here's the 5-minute stuff showing you which we're looking at. And this is just telling me the whole time what market. These are all the pound pairs, and I wouldn't be trading the pound pairs because this indicator that we have is showing us the strength of the pound. So for me to trade the pound, I would like all these to be light brown like that. So the only one to trade at the moment would be the pound Canadian I'd have a look at. And then what I do, and let me just show you some really fancy stuff here. We just go across here, drop down on that, and put the yellow in, and now I can see what the pound is doing against the Canadian. So the Canadian's yellow, the pound is the brown line, and that's showing me what a 5-minute and a 15-minute is doing. So the 15-minute Canadian still coming down, the British pound is starting to rise. I would only be long of this, and that would also give me the confidence to ride through this period of congestion that we're in. And that bar there that comes up is my buy signal. That's telling me to get in, and then you would hold that on a 5-minute. Yep.
John's asking, just to confirm, are all the indicators we've seen today included in the $97 in the offer?
No. I'm showing you the whole Hawkeye suite here. What is in there is the Hawkeye. I just got this. Let me just drag you back. Which is the Hawkeye volume indicator, which is this indicator here, which is the volume. These yellow dots, which are the Hawkeye pivots, the wide bar that comes up, and the volume radar, which, let me just put that on here, indicator. I don't know what's gone wrong, Simon, with this. I do so many presentations, and I've never had this before.
I think it's called Murphy's Law, isn't it? Really?
Yeah. I had Murphy's Law at the weekend. I couldn't believe it. My partner, her Golf was absolutely on its last legs. I said, I'll get you another car. And we had a trade-in price off her Golf for another car. And as we're driving to the garage to swap them on Saturday, I looked out of the window. People were flashing me, and there was I was like a barbecue. The turbo had gone. So when I got there, obviously they didn't want to buy the car, so it was a bit embarrassing. So this indicator here is included as well, which is the volume radar, which is showing me when extra special events are happening on volume, i.e. the red showing ultra high, the yellow showing high volume, etc., etc. And that is included. So you get the volume radar, the Hawkeye pivots, these yellow dots, and the Hawkeye wide bar. That is what's included in the $97.
Thank you. Ian's asking about gold. Do you have a gold chart? Do you have any?
Yeah, what does he want to know about gold?
Gold chart. Interesting. Interesting.
I trade a lot of gold. So let me just show you. Here we go. So here is the weekly gold, just showing us that we're in a weekly uptrend. However, let's look at where we are at the top here. Can you see that yellow pivot dot there is lower than that yellow pivot dot? And can you see the volume profile that we have here? 1, 2, 3, 4 bars of no demand, 2 buys of volume, 1 no demand, and yesterday there was a little bit of buying came in, or last week. That is on the weekly. Not convincing that this is going up. And if I look at my trend dot, can you see this trend dot is starting to roll over? Now if I come into my daily, I can see over here quite clearly that I have, let me just expand this for you. On my daily, look at all these pivot tops, 1, 2, 3, just showing me that it's totally stuck there, and there's another lower one there, and now I've got 1, 2 bars of selling volume, 1 bar of no demand, yesterday a bar of selling volume, and gold is off today $5.60 as I talk. So this is coming down, and if I drill down even further, you can see that what's come in here is the 133 minute, which I really like. You can see that this is on a short all the way through here, and it's just drilling itself down. Now, Newmont Mining, which I again trade a lot of, let me just show you that. This is one of the largest North American miners. Look at my pivot yellow dot right at the top. Last week, no demand volume. White volume came through, no demand. If I look on my daily, you can see that I've got 1, 2, 3, 4 days of selling volume going in, followed before that there was no demand. And if I look up here on my 133 minute, bang, there it was there. Low risk entry to get in. Do you see that, everybody? Low risk entry. So That was the closeout of a long and a short also yesterday, as far as I was going, a few days ago, as far as I was concerned. If you want to go and have a look at the gold miners index, which is really the key, you'll see that that looks exactly the same. And if we come down to J, which is the junior gold miners, you'll see that being sold off. And if we come into any of the North Americans, Barrick Gold, etc., all the gold miners are being sold. So this gold is going off. I do a lot of work on gold. Cyclically, gold should be going down now till October. We should see a sell-off in gold down to October. And if you're a member of Hawkeye by owning an indicator, I highlight it in my newsletter when I see the buys and the sells coming in. There's another interesting one down here, BHP, world's largest miner. It's been in real trouble with what's been happening in South America with its mines and the downturn in China. This is going to be very, very interesting. It's the world's largest miner. If you want to see a chart, just look at that. It's just gone from hero to zero. If you look at it on a monthly, I won't bring it up. But you know that as soon as it breaks out of that high there, oh, damn this. As soon as it breaks out of this high here, we are off, and that high is at 32.99, 33. As soon as it gets above 33, load yourself up, because that's going to go. But right now, it's just going sideways. But put that on your radar for the rest of the year.
Fantastic, thank you. Now, the questions, Nigel, are just coming in thick and fast. I can't keep up with all the questions, which is great. But apologies if we haven't answered your question yet. Maybe just time for a quick one or two more. Whitney asked, what Hawkeye packages would you recommend to trade FX?
Our standard package is we do a standard Forex package. Again, go onto our website, look at the products. We do sell indicators individually as well, so you can build up your own package. It's a lot more expensive than if you buy a package outright, but you can choose what you like. But the volume and the trend would be the engine room. And let me just come back and show you. And then you need the money management tool. So let me just show it to you on. Let me show it to you on a trending market. So let's do it on gold. So when you get to here, I don't know what's happened with this. Oh dear.
Okay, not to worry. Can we
I
move on?
don't know. I don't know why this mouse isn't working.
Called the joy of the live event. Now,
Thank you. Thank you
worry,
very much.
I'm a past master at seeing the technology crumbling sometimes in front of my eyes. I've developed a leathery skin resolve now to it.
Yeah.
We'll move on. Just quickly, John's asking, the indicator which went into brown bars, what indicator is that? Doesn't even...
that is the... Right, I know what he's talking about. So let me just pull over another chart. This here, I think he's talking about these lines here. What I can cleverly do in all our packages is show setups when they're all in. So for example, the euro here will go green, telling me that it's a buy. And if I miss that, we come up with aggressive entries afterwards, saying the volume, for example, here has gone green, buy, sell, buy, and then we click in again. Now, it'll re-indicate itself to get in, because what is happening is that a lot of people miss the entries, and I'll tell you something which was very interesting. One of the rules that is built into this is that we don't take a buy unless the close is in the top 40% of the range of the bar, greater than the open, and this dot is higher than the dot 2 previous. So that dot there has to be greater than 2 dots back. The close has to be in the top 40% of the range. The volume has to be green, and then it'll go. And you can see that was the trend up there, and then it went. And because this trend will also show us where congestion is, because it paints white bars, it then re-enters itself here green and gives you another green re-entry. So I think that was the question he was asking.
Fantastic. Great. Everything has been recorded. Mr. Smith, who's asking, as he wants to go back and look at this again, so there will be a recording available. We'll have that ready for you by tomorrow. All the other questions, end of day data for shares, does the system have end of day data?
I don't provide data. I'm not a data provider, so this is a plugin that works, as I said, in MT4, eSignal, Multicharts, Ninja, and TradeStation.
Okay, fantastic. I think we're going to have to draw a close to it there, I'm afraid, but still the questions are coming in. I think, Nigel, if you're willing, I think I'm going to be having my arm twisted to ask you back again at some point in the near future, perhaps to run over that again, because you've certainly created such a stir, which is fantastic.
Well,
Nigel,
thank you, Simon. And let me just leave the listeners to this. Trading is not difficult. Do not make it complicated. Have the simplest system that you can have, the right money management. Do work on your mental strength. Read Trading in the Zone at least 20 times and become an expert of what you see and an expert of your own emotions.
Wise words indeed to finish on. Nigel,
and there is a great acid test. Great traders become great traders when they stop looking for the next indicator.
Okay. Very good. I like it. Nigel Hawkes, founder of a great trading indicator, Hawkeye Trading, hawkeyetraders.com. Thank you very much indeed for joining us. And,
Simon, thanks for catching up with me, and I hope to see you for a sherbet in London.
It's been my pleasure. Thank you very much. I'll take the presenter role back from you. Thanks again.
Okay. Bye, mate. Bye.
So there we are. Thank you to Nigel Hawkes, giving us a wonderful presentation there on the Hawkeye system, which we were curious to find out about in one or two of the previous round-the-clock trader events. We are at 3 o'clock here in the UK now, and I'm delighted to say that our next speaker, Kim Watson, is waiting patiently to get going. If you're just joining us, I can see 30 people or so that have joined in the last half an hour. Welcome to Round the Clock Trader. You've been listening to Nigel Hawkes from hawkeyetraders.com. It has been recorded, so you'll be able to view recordings, but you are just in time to catch our next speaker, Kim Watson from Easy Trader, which is going to be fantastic. So we'll go across to Kim now, catching the tops and bottoms in the Forex markets, and bring Kim in to go away. So good afternoon, Kim. Can you hear me okay?
Hi, I can, sorry. Hi, Simon. Can you hear me?
Wonderful. I can, loud and clear. Loud and clear. Great. Hope you're well.
I am.
Sorry for keeping you a few minutes later. We just had so many questions for all the speakers today. So a very active and engaged audience, which is great. But delighted you're here. We'll just go straight across, if that's okay, to your screen.
Sure.
So that we don't eat into your time too much. So if you do the usual accepting the presenter role.
Yeah, okay. I've not seen that part of it yet.
Great, yes, that's it done.
Done?
Almost without noticing it. Catching the tops and bottoms in the Forex market, Kim Watson. We're looking at your first slide at the moment. if people at home could just let us know that you can hear me and Kim. I know some people have been saying I've been a bit intermittent, so apologies for that. But as long as you can also hear Kim Watson and see the slide, that's great. Everybody seems to be confirming we're okay to continue. So, well, Kim, welcome back. We've heard from yourself, obviously from Charlie as well. But I've learned that this is a new presentation, catching the tops and bottoms in the Forex markets.
Sure.
And we might be looking at the use of pivots in particular.
We may touch on them, but not overly. Not overly.
Listen, I will let you get started, and then we can take questions as we go.
Okay.
Thanks.
Well, welcome to everyone. It's funny actually when Simon emailed me through, or Charlie actually passed on Simon's message asking for a title. I was in the south of France, and the heat was actually catching at the time. Catching tops and bottoms, and I thought it was quite funny bring up the name catching tops and bottoms because it's precisely what you're taught not to do. And the real name should have been really identifying overbought and oversold areas of the Forex market. So that's the real title. But the thing is, of catching tops and bottoms, it probably attracts more people to watch and listen than if I just sort of made it been more clear and said, well, I'm really looking at overbought, oversold areas in the Forex markets. Now, what we're going to be looking at this presentation, of course, is why not just trade with a trend, when to avoid trying to trade with the method I'm showing here, the best time to trade it, identifying the entries themselves, and talking about it's not just for Christmas. Oh, no, not just for entries. So this is what I'm going to cover through here. Now, I'm going to start off with the obvious, and is why not just trade with the trend, and why are we looking for overbought, oversold signals, or tops and bottoms, as they may be referred to. Now, you've got to really understand that the nature of the market that we're actually in. It isn't a market which literally only trades in a trend. The market moves in a trend-based series of oscillations. So if you actually study the market, you'll see that it's oscillating as it moves. If you look down at the smaller time frames, 2-minute, 5-minute time frames, you'll see the oscillations much clearer. When you start looking at the bigger time frames, it may just show a single bar quite often. Now, I'm taking this from pretty much an intraday trader's point of view, so I'm not looking at specifically at end of the day, although the principles apply up the bigger time frames because the way the markets are built and work, it'll work on bigger time frames. In fact, my main trading time frame really is the 60 minutes, although I use 5 minutes time frames to actually enter trades. It's really a 60-minute signal that I'm generally using. Not to say I won't use shorter time frames to even start the signal sometimes. Now, so having already proved that, I say proved, I can prove it if you like and bring up a chart and you'll see the way the markets move here, and this is a 5-minute chart and you can just see it. It's effectively, there was arguably an upward trend this morning in the euro running through to about midday-ish or leading into midday, but it was still oscillating in that. And with trend-based traders, all they're really trying to do is catch some of these oscillations. Effectively, they're trying to catch the oscillations down. There'll be other people that are trying to take the breaks of the highs on each occasion, and on occasions that will work well. Now, this particular chart I'm showing is the euro dollar, which is looking fantastic, and I wish it had what looks like a lot of movement in it this morning, but relatively, when you take it down to 10 pip moves, you'll realize that in fact, actually it's 5 pip moves, 10 pip into a 10 pip scale, you'll realize that the market was pretty flat this morning in real terms. But anyway, the main point now was to show you the oscillations. Now, when we look at the market on a bigger time frame, the oscillations may not be absolutely clear for this morning because it was just covered within these hourly bars. But that's what I'm looking at the oscillations, and certainly you can still be trading with the stronger and higher time frame trends when you're looking at tops and bottoms. What I'm looking at here is really entries and possible exits that to trade intraday. Now, retracements provide opportunities for both buying or selling at a discount, and that's really, as I said, as opposed to being a breakout trader where you're looking for highs and the breaks of highs. What I'm looking for is retracements and then continuation moves as opposed to anything else. So I really wanted to clarify that before you just thought, there's another chap trying to show us something that's just really doing exactly what I was told not to do when I very first started. Ironically, it's a lot of people start trading in the right way, as in following trends when they very first start, and then they become clever because they think they can actually identify overall bigger market swings, and at that point is when they generally lose their first account. Okay, so when to avoid trading something that looks like it's overbought or oversold. So you get to this point where you think, well, it's a double top or something like this, and there's many different ways of avoiding. And this is I'm actually looking at safety before I'm actually showing you what I'm doing, and ensuring that you understand that there is a safety measure. It doesn't matter what strategy you're using, what technique you're using. Some of these things I'm showing you here will work on the previous speakers combined with their signals. I mean, what I'm looking at is as free as it comes, so you can look at some of these things and use them with other methods. It may be that you're already looking at certain methods and you're thinking, well, actually, I'll take that trade or I'll leave that, and there may be times when actually you should be leaving it or taking it. So here we go. So the old saying is you should not be trying to catch a knife. Generally, this is where the Forex market, or a market, whether it be Forex or stocks, is falling. The idea is that you shouldn't just try and catch the knife. Well, there is some sense to that, of course, and it should be really, you're trying to, in such cases where it's moving particularly strong, you should be looking at how you're going to get in and push the knife down even further. Now, you can, of course, look at orders to see where price may continue in the short term. Most people in Forex, they're not even familiar that there are platforms and places where you can actually see orders. But I'm going to show you, I mean, I've been working on this quite a lot because I like to see where the market orders may be. Ironically, it's probably not much of a surprise when you see where the orders are relative to price so often, because we know where traders place their orders so often. But what you can't see is the volume of orders that are sometimes sitting there. Now, the source I use it's on our website, EasyTrader website, easytrader.com. Under resources, there's an order book, and you can go through it like that. But I've actually been taking it to a sort of a step further than that, and been applying the order book across, as Simon said, pivots. Let me just see if I can get rid of it. I don't think I can get rid of that horrible little box that comes up on here. But you can see this is a net position of the orders, and I can just refresh this up until it's time. In terms of this is the pound dollar, and I'm looking at it relative to pivots, because that's what I use a hell of a lot. I trade with pivots, as Simon suggested, but I'm not actually looking at the pivots in this particular case for trading. I'm looking at sort of overbought, oversold signals using a different signal. Now, when you're looking at this is an order book, and this is the net positions that I've managed to get on here, and we've developed it to it's not out there in the general public as it is here with pivots and etc. on. It's on another project that I've been working on for some time. But as I say, you can go onto the resources side of our website and get something slightly different, but it's the same data. And what you can see here, the blue are the buy orders. Sorry about this horrible box that follows my cursor around. I can't get rid of the cursor without clicking on something else, which it won't let me do. So the blue, though, is the buy orders, red are sell orders, effectively. So you could see, for example, at the moment that you've got these the red above where my cursor is, where looking right to the right here, there's been quite a lot of red sell orders above us on cable, net position. Obviously there's orders either way, and then there's occasional glimpses of blues. Now, where you find these blues, and this is a situation when a market starts getting a bit what we think is overbought, when it's pushing up and getting edgy, we're often thinking about, actually, well, we ain't going to go any further. You know, it's coming up to a double top. What you might notice is some of these orders, I mean, this is an R3 pivot that these orders are sitting above at the moment, and you'll see that there's a load of buy orders just sitting the other side of which suggests people have sold earlier on. I'll bring this to a daily view, actually. There's these, now you can see a daily view, I see a daily view, it's still a 5-minute chart, beg your pardon, but it's just showing a lot more data. You see why these blue orders, this order line is sitting up right up here, is because the price have been up there, traders have put their stops there, and the chances are there's more net buy orders than there are anything else. Price goes up towards that area. Generally, a lot of traders will be selling into the top because they think it's probably a bit overbought and there's a chance it will roll over. Now, of course, it could roll over from that point. But the chances are, if the retail traders would be just thinking of the double top, institutional traders may be thinking, I'm going to take those stops out. I'm going to have some fun here. We can push this market up a bit further, take those out, earn some on the kicker as that runs through 10 or 15 pips. I can make some money. They'll be potentially looking at that way, and in turn, by the time they've done that and started, they bought and it's pushed on through that sort of level, it's caused a big enough knock-on effect to get other short sellers rushing to close their positions, and you get a bit of a knock-on rollover. So, and then all of a sudden it all goes back the other way as we start running into a lot more sell orders. Now there's a couple of areas on this particular chart. There's another area just above this previous high that we had this since 9 o'clock this morning, where again people come in short around about so about 10:30 sort of time. They've gone short, but the stops above the high there. So there's some obvious places. And the thing is, if you look at what you can find out about the markets, there's a chance that we shouldn't be shorting effectively necessarily into a double top always if there's a bundle of orders sitting above it. Now sometimes it will go short, that you'll see the price never makes the double top. It's got overextended beforehand. It never makes, there's insufficient orders to push up for any further or demand, and the market will collapse earlier. Another thing to watch for is the money flow. Now, money flow index is available on, I mean, it's on MT4, it's on eSignal, it's on most charting packages has a money flow index. So there's no reason not to be using it and looking at it. There are times when the money flow index really signals a continuation of a move. I'm just going to bring a chart into play, and we'll just double click here, have a look at some money flow. He's got one on here. In fact, let's just bring this other chart across. There we go. And what I want to do for a moment is just take off the pivot so we don't get all confused about anything else that's on the chart at the moment. And let's just look at the money flow itself. And there are times when the money flow, you can see here, this is a 5-minute chart. Now the 5-minute chart isn't often, to me, I'm an intraday trader, and as I said, I'm often looking at a 60-minute signal, but then I'm looking down the shorter time frames. Now, for my signals, 5 minutes is not good enough in terms of showing the potential of something running through. I'll look at a 2-minute chart, and this then gives me the keep out signals more often. If I was seeing a signal that this market was overbought back here, and it starts getting a bit overbought, and I'm getting a signal to say, well, actually, that's in the again, big scheme of things, euro's coming down, so any movement back into the highs here, I could say, well, actually, I'm looking to short at this particular time. This is 10 o'clock this morning, so the bigger picture was certainly to the downside. I'm looking for the potential shorts. But look what's happened to the money flow. As soon as it starts running over the 75, 80 sort of area, money flow is getting high. There's a possible continuation move to see. And it did. It continued. It got high again. It pushed out on the highs. It was pushing up. Yeah, sure, it came down, but there was no divergence in this move, and it did actually push up until eventually running out of breath here. So yeah, sure, the market was overbought, and it was actually giving me a signal of overbought earlier on. But there's no point trying to do anything so long as this money flow is running high. The same thing works the other way when you see it. If I can just find a quick example, and I've seen examples of it actually where it runs and it doesn't just show up on a 2-minute, it shows up on a 5, 15, 60-minute even chart. We showed some great examples to traders the last couple of weeks ago. You see here, it's okay. It's got quite oversold. Eventually, it started diverging and moving up, but it was so oversold, and the money flow was so low here that it's just suggesting the market was still particularly weak. Now, bearing in mind, it's a 2-minute chart, so it's still a weak market. So it's another tool that we can use to keep us out of opportunities which aren't right. Okay, come back to my chart. So this is when to avoid trading it. So I'm always looking at the reasons why I shouldn't get into a trade when I see a signal. So the best times to trade it. this is important as well. The money, if you follow the forex markets and you look at the euro dollar, the pound dollar, for example, particularly, I only actually trade the five majors, and of those five majors, generally at the moment I'm trading the pound dollar, the euro dollar, and the Canadian dollar, or Canadian dollar Canadian. They're the most frequently traded pairs I'm trading at. I will look at the Aussie dollar, and I'll look at the dollar yen, but in the majority of my time is on three currency pairs, and that's why I'm really focusing, because I think focusing on a smaller selection gives me better feel for the market. I can actually see the characteristics of the market more regularly, and fully understand what I'm doing. We see the biggest moves, though, in terms of the trades. The biggest moves, the starting moves and the finishing moves, around the end of the start and the end of the London session. So this is where, when you look through markets, I'm going to bring a chart back up because there's nothing like looking at something that's actually real rather than me just running through. Now, I did have a chart. I haven't got it handy here, but I'm just going to put some lines on here through the day, and I'm going to pick the 8 o'clock bar here, and I'm going to look at around about 3 o'clock. And if I put these lines across 8 o'clock and 3 o'clock every day, 8 o'clock. Okay, that's a 4 o'clock, but I'll put the 3 o'clock one in anyway because I said 8 and 3, and it's really 8 and 4 often, but there's the 3. I've missed one here, of course, somewhere. 1 o'clock. Hang on, what's going on? Just popping a few. Okay, I'm not going to put any more on that, and I'll let you go and look at your own charts. But you'll notice something there just from, I mean, okay, these are not exact well, the lines are in exact places, but the market's not necessarily moved spot on of those all of the time. But this is a current trade. This is a 60-minute chart on the euro dollar. So I'm just showing you that. Nothing else. There's a 21 moving average on that chart. That's it. And what you can see quite clearly are some moves here. Then we've seen a whole move down to 3 o'clock on that particular day. It rallied, it moved up on the 8 o'clock all the way down. It actually went down to 4 o'clock there, and then they had a bit of a rally, but continued thereafter. The previous day here, 8 o'clock, well, leading into 8 o'clock, it had a low before then, but it started moving from 8 o'clock through to about 3 o'clock, then had a bit of a retracement. Yes, it continued afterwards, but there was this profit taking. Now, some people will argue the profit taking comes in the last hour that the London market, I say last hour, whenever the last hour is, but we generally take that as around about 4 o'clock. So between 4 and 5, you'll see in that hour often a bit of movement. So when we're looking, if we're looking to trade and get the best times to trade in the market, the best times really are at the beginning and towards the end there. Now, of course, there's news that comes out at 9:30 in the UK or Europe in around about that sort of time, sometimes a bit earlier in Europe actually. But then key UK news is 9:30 in the UK. In the US, it's 1:30, then 3 and 7, wherever. But generally, you'll in the main, we're looking at these. These are the sort of times which set part of the pace, and then if anything really changes, it's normally around the news time. So you may get something that changes, that comes out news-wise that changes the specific trend. But the trend, it'll either top there, it will continue, it will do something around about 8 o'clock. But you start getting some of the bigger moves, and then between these periods, you see the lesser moves, often consolidation, maybe some trend. But you see the consolidation through the Asian session so often, leading through the back end of the US session, consolidates, and so no great big surprises there as we run through consolidation through this session back here, and then 1 o'clock in the morning got a little blip for some reason, but then pushing through to 6 o'clock, and this morning it's pushed up for a good part of the morning there up until 11 o'clock candle when it rolled. Now, so there's the roll, that's the market, how it's moving. What I'm looking to do from this is look at where the market is physically, and I'm doing it using statistics. I'm just looking at where the market is getting a bit stretched. Now, this is, as I said, this is a 60-minute chart. Now, this is my preference of where I'm looking for my signals from. So let's go back now and carry on here. Now, news, in terms of trading, the other thing to consider is news can often give a temporary move to the currency, but it's often only a temporary move, unless it's what I call a game changer. Game changers I take as GDP figures that come out quite differently, but more so big employment numbers, and beyond that, of course, is interest rate changes, or any discussion or serious discussion of interest rate decision changes. So they're the game changers. Inflation to a degree, but inflation is so difficult at the moment. Before, I used to trade, and I would still trade news if it could, but since the Swissy situation, it's been almost impossible to trade it well. But you're really looking now at when most news comes out, it's before long, price gets back to the status quo. So it may have a spiky bit of bar for about bar or two. And I use regression channel trend lines on the bars sometimes just to show our guys in our trading room exactly where it's coming back to. And so often it comes back to where the trend where it was before. So it may be come back to a slightly higher point if it's moving up, or slightly lower. But news is just noise at the end of the day, often. So, identifying the entries. I'm always looking for the bigger times from guidance. So I'm trying to, in the main, trade with the main directions of the market. I then will be looking for entries. Now, these can come from different methods. Now, I'm looking at simplistic, and in fact, I'm doing this the other way around. In terms of my entries are actually coming from a signal, an overbought, oversold signal. So I've got a single signal that I use called the inflection point. And I'm using that, that's giving me the signal, and then I'm looking for the entries from the signal. So let me just bring the chart back just 1 second. So I've got this hourly chart on. I'm just going to, here's the inflection point signal on the bottom here, and it will give me different colors here as we run through the periods here. On the top here, there's a red at the top here, and suggesting overbought. It's stretched on this bar here. It's suggesting down here oversold. Now it's suggesting oversold here quite early, before I would normally in my preferred trading zone. So the best thing to do with that is watch and leave. Now there wasn't this. Bearing in mind that some of these ranges, okay, it's the euro and it's a 60-minute chart. Some of the moves generally in a normal market would be quite reasonable throughout that, but in the current market through the summer conditions, it's quite light. Obviously, it's sometimes only about 15-20 pips in an hour, so if as much as that. But what I'm looking for is a signal to be coming into play. Now this is a 1 o'clock signal. I'm not sitting there at 1 o'clock. But I'm waiting for a signal to come into play, ideally on the hourly time frame, unless I'm looking for something that's going with the trend, trend in the shorter time frame. Now this here, there's no signal. For example, 8 o'clock yesterday morning in this particular case, but there was a signal on the shorter time frame. So when I come down to the 5-minute time frame, I'm going to do it on a different chart and then drag it over so you can see them both at the same time. Just put the signal on. And this is where I can use the shorter time frames to trade with the bigger time frames to give me my signals. Now, as it happened, the great thing that pulled up here is I got the signal coming in, which if you watch my cursor on both screens actually made it a little bit more difficult by putting in those vertical lines. But at this point here, at the peak, as it was running into that 21 moving average, I was getting it was running into a 21 moving average. It could or it couldn't necessarily roll off that. I was getting a signal at that point as a sell signal. I was keen to be trading with the trend. It was easy to sell into the 21, and then, I mean, as it happened, it rolled down brilliantly. It's not necessarily always the case of rolling down as lovely as this, and often my trades are coming off a 60-minute time frame, by which I'm often using the 60-20 if it's going against trend. So, for example, if I say against 60-minute trend, that is. So, for example, I was looking at this particular day where it was coming in, the signal was coming in saying the market is oversold, watch out for the bottom. So as it's running into its sort of lows there at 3 o'clock, I'm waiting for a signal on the shorter time frame, waiting for something to come through. Now, I could get a 5-minute oversold signal coming into this point as well, which is my preference. When I'm taking it off this hourly time frame, I'm looking at the hourly 21 as the as the target for the price action. So it's quite a decent retrace sometimes. I mean, as I said, it's relative on this particular euro pair at the moment. I prefer trading it off the pound dollar, obviously, because it's got more liquidity, more volatility, and bigger moves in it. But that's all I'm actually looking for. In terms of when you're trading it off an hourly chart, you've got plenty of time to look down the time frames and see what else is available to give us some idea of the trade. For example, there was a signal coming in this morning, actually. I may as well just show this one. You see there's a bit of a pink signal, which is a slightly a weaker signal. Red's a stronger signal. Pink, it's just suggesting it's oversold. So I'm waiting and seeing what's happening. When I then, I'll just bring the 5-minute chart in. Now, just drag that across. So at this point here, there's a couple of things to bear in mind. I'm not showing you hardly anything on these charts, just very simple charts at the moment. So price had gone up there. The important thing was to look at the money flow, check that the money flow, as it's pushing up when that these highs were coming in, what was actually happening. And then I'm going to just throw in on this chart here some pivots here. In fact, I want the I'm not going to be able to do it on this chart. I'm going to have to do it on the other chart. Let's just put that 4-hour pivot in there. You can actually see what I was looking at earlier on. So as the market was moving up here, I was looking for the 4-hour pivot. So the 4-hour pivot was below us. It's got a high probability of being hit as they come in at around about midday. So I'm actually leading into that time frame if I've got an overbought signal coming through, which I had off the hourlies. And it's right the way through. It's daily, 4-hourly R3s, etc. It's pretty overbought. Statistically, it's overbought from a pivot point of view, and my signal is showing it's overbought in this sort of zone. Okay, the ranges are quite pinched at the moment, but it's certainly an overbought signal. And it's fair enough, it's come right the way back down. This wasn't a particularly great example in terms of the amount of movement, but it's a good example in terms of how you can see the signal coming in. You can see a target that you can be going for. And then you've got choices up here. You could be saying, well, actually, I can't just sell into that, so there's nothing else there. But then you've got to look at what else actually is, if there is anything around those areas, and there wasn't particularly a lot. But the secondary, you don't have to be right in at the top and the bottom. Whilst the range is pretty tight, as small on this particular occasion, the picture is as good as you get them. What we often have is a test of this is only a 21 exponential moving average. Price has come and tested that 21 and bounced off it. Now, it's already tested it a couple of times back here, so I'm quite happy of not trying to grab the absolute tops in this market. I'm just waiting for it to break and go back below those lows and that 21. As soon as it does that, then it gives me an entry. So I'm actually taking it on the breakdown. It's at that point, as it breaks down those lows, it's confirming a lower high end to me as well. So technically, in old-fashioned, bog standard technical analysis, I've got the signal that's come in earlier. I'm not wanting to take it when it first came in. The price of the money flow was starting to push up higher. Wasn't interested on the shorter time frames. Not interested in it, so I've just been waiting, and now I just wait for the signal. And I'm not, as I say, it's not a case of always getting these tops and bottoms here. It's what follows next, and that's what I'm trying to get. This particular case had a good probability of coming down to the pivot anyway. Now, this is a euro. The pound did a very similar move. Just be a cleaner chart with all those vertical lines sitting in there. And leading in, we had this is still an hourly chart here. We had an oversold signal coming through at just around about 12 o'clock there. It just pitched down a little bit further, but when you start looking at what actually happened, so it's telling me it's rather stretched at that point. When we liken that to this is down to a 5-minute chart for looking for the setup. Could have looked at something quite early on, but it hadn't really. I mean, it messed around with the 521 at this point. There's a chance it was going to come off that 521. So it's a case of being patient, and just pure trading point of view, there was a case of just waiting, because the range of buying on the break of the 21 here was, in this particular case, wasn't going to give me much of a target. back to the 12 o'clock pivot, or the hourly 21-ish, which it later did here. But waiting for it to give me a divergence, so just a straightforward RSI divergence that came into play as it pulled back here. Once it started, then it put the bar in at 1340 there, it gave a little hammer, and it just sort of suggested, well, that's it. Then I can think about, actually, well, now my reward, just even back to that pivot, is pretty decent back, relative to the risk that's sort of sitting there. It's around about 1.5, 2 to 1. I can take that trade, and that's it. So the signal came up on the hourlies. I'm waiting for the 5 minutes. Patience, wait for the market to do what it's doing. I like cable preferably to the upside, although it's been a bit iffy today. The range on the trend on this 60-minute was showing clearly to the upside at the time, so I still think there's possibility with the daily 50 being above cable at the moment. It may still yet push up there. So I'm really looking at this on a 4-hourly, but it's just a bull flag. So I'm quite happy to be trading an oversold signal into what I see as a bigger move. So that's pretty much that. So okay, bigger time frame gives me more scope waiting for secondary entries on a bigger day where we've got more volatility and the market's moved. I often have I can leave it for an hour or two before I actually even take the look at taking the trade, often longer, and just wait for the absolute best short-term signal. And then if the signal's coming in at 1 or 2 o'clock, even slightly earlier, I can wait a couple of hours and come back to the desk at 3 o'clock and look and see how things are developing. I know that the market's got pretty stretched at that point statistically, and there's a chance it will move back towards its hourly 21. The hourly 21 is very key to the way I'm trading off these bigger time frames. Is the price will come back pretty much to it a lot of the time. It's a close range in moving average. Price, I say price, it will work its way up to price quite sometimes as well, of course, when price is consolidating. But so often it's got quite a love affair with moving. So if you're intraday trading, you can get these moves back when they're overbought. Actually, it was overbought on this earlier stage here. I'm just showing you it's 3 o'clock in the morning. So you can trade it at 3 o'clock in the morning if you're really keen. But of course it depends on when you're trading. But there's plenty of opportunities where you get the buy orders coming through here back into the 21 each time. Okay, I've put here not only for entries. The important thing is when you're looking at signals and you're using signals, a good signal also can provide exits, and now I've ignored it a few times when I'm seeing I'm long on the market and I'm seeing overbought rather, and you see a lot of overbought signals on the shorter time frames, and then on the time frame I'm taking the trade, I'm seeing this and I'm totally ignoring it, thinking, well, no, it'll push up. And of course the market moves. The signal was pretty good. Now there's options I've got at that point, which is obviously to take partial profits, and that's what I've given up trying to fight my own signal effectively. So when I'm seeing it, I'm waiting, looking. If the money flows high, of course, or low if it's a short, I'm leaving it alone and staying with my position. But if it's the money flow is not particularly coming into play, if there's no orders sitting above where my price action is, and I'm seeing that signal coming in, I'm taking partial profits. I can always get back in at a better price if it goes with or against my original position. One thing I did say here is avoid the noise if you're trading into larger swings. So if you're trading on a daily basis and you're looking at swings, some of my movements of what I'm looking at here on a 60 minutes or 5 minutes are far too delicate, and I mean it's just literally noise. Whereas for the way I'm trading it in the shorter period time frames, I'm trading intraday with these. I use it as a guidance. I've still got a sort of a long focus on the weeklies. It's got an oversold signal on the weeklies that hasn't been fulfilled yet. It hasn't got back to the weekly 21, so I've got a picture of, and I'm still bullish in the bigger picture on cable back to that weekly 21. But I'm not trading that. I've got that in the back of my mind. I'm looking at what the market's showing me, and all of the time I'm just looking at what's actually happening from the daily position. I drill down. You can't see the whole of my charts here, but I basically run off I've got a daily chart here, a 4-hour chart, and then I'll run down to a 60-minute chart. So I'm looking at all these factors on the different time frames. and looking at where the trends are coming. So at the moment, cable arguably, well, some people will still argue it's in a downward trend, but when I'm looking from dailies here, it's starting to put higher lows in. The 4 hourly is definitely higher lows. So cable, for me, as an intraday trader, that's good enough to say that's actually changing. It's in an upward trend for intraday trades. Right. Okay. Want to find out some more? Well, the indicator that I'm referring to it's called the inflection point indicator. It's available off our website now. Simon's got all the details of which he'll put hopefully in the section for you guys, so you can actually see the website code there. Now, even for our current clients, I've not given anything more than 20% discount. In fact, a lot of them only got a 10% discount, because this is a really powerful, strong indicator. Along with it comes with education CDs. Well, it's not CDs any longer. We're using a pen these days to keep up on modern times. But it's got, I think it's for about 3 or 4 hours of content on there. Plus, there's follow-up webinars in terms of how to use it. It's very, very simple. It can go onto MT4. It can go onto eSignal. So if you're interested in that, you can find out some more from the link that Simon will put on the site here. The other thing is, if you want to come and trade with, one thing I didn't talk about in the beginning of the presentation is what I do. I'm a live trader. I do live trading with a community within our live trading room. I trade through the mornings from 7 o'clock until 1 o'clock, when Charlie Burton takes over and runs from the 1 o'clock to 4 o'clock session. So if you want to come and join us free for a couple of days, see what we're doing. You won't hear too much about the indicator massively in the room. I'll talk about being overbought, oversold. I'm not showing it too much, but I will make an effort at showing more of it so you can actually see it working in action. If you want to come and join us for a couple of days, if you go to www.easytrade.com round the clock, you can come and see how we're trading and follow our style. We both use very, very simple technical indicators in the main. In fact, this is the first indicator we've actually designed which meets what we're looking for, what I'm looking for, in terms of giving me something to. It's a combination of things I was using, and it's just made it very, very simple by building it all into as one into the market. So it's a very, very simple indicator, which and that's all I use, that and pivots. So in the main, so, and a few moving averages. So that's pretty much me. I can't see questions at the moment. I don't. Simon, are you there?
So I'm here, and if anybody's got questions, now is the time to type them in. We've still got some time on where we can look at some questions or charts or talk more about the indicators.
Sure.
But, thank you very much for that. I have posted the links into the chat box for both the indicator and for the 2 days in the.
Marvelous, thank you.
I know a lot of people have already been in and joined up with Easy Trader so far, which is great news. Bernard has. I don't think the question's come through. Bernard, if you can repost that question, we can get that. David's asking what you might have touched on this, but what is your predominantly Forex or stocks?
Okay, I focus purely on Forex, so that's where I've used it. I don't intraday trade stocks at all. I mean, I'd be jack of all trades and master of none if I did. I just literally focus on Forex, so I haven't tried it on stocks. It's something I might do, because we have clients that are interested in stocks, and I've got certain old scans which I said to them I'd give them at some point. So when I reload stocks on my charts, I'll have a look, but it is specifically around my own trading. And it was something I did for myself, effectively, just to make life easier, because I had lots of things on one chart and it was just too much. And some clients had used it, and basically the real test of this was to give it to some people that didn't really know how to use it too much, apart from some very basic information, which I did earlier this year or through this year, and to see how they got on with it. Now they range from people that have been trading for quite some time to a couple of newbies as well that we had come in our trading room. And you can read their actual comments on our website in terms of their views on how it's worked with them. So if you click on the link that Simon's given you, the inflection point one there, you can read what they've said. But it's pretty powerful, and it's simple. As simple is the basic clue about it. And it just with some then good technical trading knowledge, you apply that to the two together, and off you go.
Fantastic. Questions coming in on the indicator itself. Is it a one-off payment for the indicator, or
yes? Yeah. Yes.
Yeah. There's no ongoing subscription for that.
Yeah, it's a straightforward single payment. It's 297 less the discount, obviously, is the price of it. Sorry, I haven't put it on here. But it's a one-off payment. There's unlikely. Well, there's a couple of things we're looking at doing with it actually, because I'm just trying to get it to send me alerts to my phone. So there's a couple of things I'm trying to do, because trading it on the owl is one of the things I know. I looked through the list of speakers today, and there's people about trading less to make more profit and things like this. And I thought, well, yes, bang on, because what I'm looking at here is basically trading the hourly time frame quite a lot with this. So I'm actually trading fewer trades now by doing this intraday. I can scalp off. I mean, if I show you, the best thing is to show you where they set up, and you can see. Let me just bring intraday chart in here with some pivots, and you can see the cable for this morning. I mean, I did take a long this morning off of this signal because I'm still, as I said, bigger picture bullish. The signal came in. I know there's a good probability. I'm not going to talk massively about pivots, but there's a good probability of the pivot being hit, the 8 o'clock pivot being hit. And I also know price moves a certain amount after 8 o'clock. It's just a weird old thing. Wherever it opens, it will move a certain. Some other analysis I've done anyway, so I'm quite happy taking when the signal comes here. But this is, as I say, 5-minute chart. So it went from overbought here. It spiked down there. Oversold rather. It got oversold again at the low on this yellow here, but it was a bit of a spiky, funny old price action. A bit of knowledge there. If you'd been in on that, that'd been fine. But probably most people realistically have missed it. But there it was giving me oversold signals coming in. Overbought signals. Get it right way around. And then again, overbought signals here, and so you could be sort of scalping with it. It's not, and just trading it back. And when I originally did this, the market really had a lot of volatility in it, and you can do that. You can trade it off the 5-minute time frame, but you find yourself in and out of a number of trades. What I'm looking for at the moment is like yesterday's trade late in the afternoon there. I had overbought signals on the bigger picture. I had a couple of overbought signals coming in here. Now I looked at. Actually, I missed this one at 14.35 because I wasn't at my desk, but I did come back in, fortunately, and seeing it got overbought again a little bit higher. Now, yes, it's into the daily R2. There's other bits and pieces. It was late on the day. It's 3 o'clock, and I'm looking at this thinking, well, okay, we're sitting here. That hammer, shooting star had already happened. I'm quite happy of looking for this. And I actually didn't wait for the 521 to break. I actually took on the break of the 5.8. It must have been about 3.25, but then just left it. I went out. The gutting thing, what actually happened here, I'd left my order at literally half a pip below that low to take the profit. So needless to say, when I got back, it was I don't know, it was fiddling around, and I was looking later on, and it was down here somewhere. Now, I generally would close out at this point, and I did yesterday, so I didn't get the absolute low there, but I'm not expecting to get the absolute low. I'm just wanting a chunk of a market. You don't need to be in right up the top here and out right at the bottom. I mean, the disappointing thing there was I was literally 1 pip away from my order was sitting on the low. As it happened, it got down to there, but that was a sufficient, easy one trade walk away situation, which I quite like. So, and as I say, this one it didn't get as far as I wanted it to get down to. overall. And by the time it was later in the evening, I will close them because you can get all sorts of drift, and you also get this sort of thing happens at 1 o'clock. We've seen this a lot lately. I'm almost tempted to get out of bed at 1 o'clock because we get the overbought signal coming in at 1 o'clock in the morning a few times lately. And well, look at what happens next. It's you know, boom. But anyway, you still got to wait for the entry. But that would have given a great entry. But yeah, sort of getting back to the main point here is I'm really looking at trading it purely towards the 60-minute time frames. Take fewer trades and make more profit, basically, because on the 5-minute you can be in and out, and you sort of risking 10 or 15 pips, maybe to make 20 or 30 if you're lucky. If you get on the right side of the market early on, that's brilliant, but a lot of the time you're sort of getting possibly chopped up in these current markets. I'd rather just sell and wait. And now sometimes they work out a lot better than others. Okay, sorry, Simon.
You're right, Tim. It's great. You're mentioning the other speakers and the themes of some of the presentations today about trading less and fitting in trading with life, etc.
Yep.
What do you think is, and this is me just asking, there's a trend for social trading now, of course, which is becoming more and more popular. When you're in the trading room,
yes,
that's a form of social trading, isn't it? Really, just to.
Do you know, to me, it's the only form of social trading. I'm completely biased here, but I think if you're just following someone's signal, I mean, there's this sort of let someone else do it for you, where you can get these EFSs and all sorts of things, can't you? These days, say EFSs, whatever they are, IMT4. You can follow other people's trades, and you're not really learning anything. What our social discussion, it's about learning, and it's constant learning about what you're doing. And also, we spend as much time talking people out of trades as trading. Someone might have an idea, and you actually end up spending about 15 minutes talking to them why it wasn't such a good idea. Then eventually, of course, the market proves it to them that it wasn't such a good idea in terms of what they're looking for. But there's no better place than actually being there with other traders. The other thing is, what we find is a lot of our other traders are becoming, I mean, Jackie in our room, our trading room, she joins us on the mic quite a lot in the mornings, etc. But she's only one of our traders who's just done it for so many years, and in the end I like to talk to someone in the morning rather than just sit there and hope some's going to be listening. At least I know she's
social trading, yeah.
she talks back to me. She answers me back. Would you believe it, Simon? But realistically, it is that social contact when you're trading, because that's what often people really need. We have some good traders come in and join us. I say surprisingly, it surprises me sometimes because some of them are pretty good. You know, they'll start looking at this and you think, well, yeah, that's fair, that's good. And all they're really looking for is a nod and also someone to chew the crab with, because if you're sitting there looking and intraday trading Forex for a long period, surely you've got to talk to someone or read it or do something, because sometimes in the morning, realistically, my trading window is somewhere between 7 and 10, and if I haven't got a trade by 10, I'll leave it unless something's really looking keen to set. And personally, at that point of the day, I'd probably just walk away. And in fact, it's really 8 to 10 because I don't place that many trades. Perhaps a few, an odd. This morning was a rarity, actually, just trading before 8 o'clock. But between 8 and 10 is my window of opportunity, as I see it. You've already seen in terms of the moves, and I want to get in on one of those moves. So that's what I'm really looking at for there. So I would only be trading those 2 hours, and then I'd come back and look at it about 3 o'clock-ish, most possible, unless there was news. I'd come back for the news events, but I wouldn't really be sitting there. And Charlie and myself, we found it so boring when there was just, we would get through. In the old days when we first started trading, we were piling on £1,000 a month on our phone bills, just chatting to each other, just being on the phone, because we live about 60 miles, 70 miles away from each other, and it was that other voice, other person to bounce ideas off of sometimes, and particularly in the very early days of day trading. As I said, it kept us out of trades, it puts in trades we planned, but the room's like that. It's that very social network, which I think to a degree in the right sort is, if you're just following other people's ideas, you're not really learning anything. I always think if you could when someone comes to us eventually and say, well, actually, I'm only coming in for the company now, that's when we know we've got it, because people are capable of trading on their own, and they're literally just coming in for the chat, and sometimes they'll come in for 2 or 3 hours in the morning, a couple of hours in the afternoon themselves, for the banter as much as anything else.
That's fantastic. So you're yes, I mean, I strongly believe this is the key behind the success of even the round the clock days. I think everybody enjoys just sharing different ideas and always learning something new. So that's the key to it. Just had someone saying, not sure the link is working for the 2-day free trading room. We'll check that link. easytrader.com/around the clock. It should be. That's the same link it's been for a while. We'll check that out right now.
Yep.
Now, it is worth saying it doesn't give you instant access into the room. Just in case that's maybe what you're expecting. I had this conversation with Charlie just last week. What Sam does is arrange these sort of special 2 days, because having a lot of new people in the room at once can sometimes sort of upset the rhythms and so forth. So you actually do prepare these 2 days so they are tailored towards the guests.
Yeah. What we do is, Simon, is we call our friends up in the city and say, look, we need some real good volatility for 2 days on Wednesday and Thursday of next week. Can you sort it? Seriously, it's more so our clients, because we're giving 2 days away free. It's more so our existing clients. I mean, if we did it randomly, you've got a person coming in randomly, and it's sort of, oh, such and such a visitor, and you find yourself and us answering the same questions it would be every day. So by doing it in the 2 days, we can answer the same questions for 2 days. And to be fair to our existing clients, they find it really useful. A couple of them moaned once, and I say once, and until we covered a couple of subjects that they hadn't. I mean, money flow, for example. I mean, I got onto my old thing about money flow, and all of a sudden I didn't realise that. No wonder I keep getting stopped out when I'm doing such and such, or or there's opportunities that you learn just by repetition so often, and the idea of the room is the repetition of some of the same things. We're not always right. I mean, call trades that don't always work, I can assure you that. It's a real balance.
Fantastic. Just going back to the attendee, Uwe, just saying that there's no confirmation email. I'm sure it will come through. Sometimes they don't come through instantly, but as long as you filled out that form, it should.
I was going to say, sometimes they may go into spam. Of course, that's the other thing to bear in mind with those. Is they run through into people's spam folders. I can normally see when they come through at my end as well, so, on our system. But yep, they do come through quite quickly.
Yeah. If there are any problems or you don't hear anything, just drop me an email, and I'll forward it on to Kevin, Charlie, or Sam.
Or Sam.
Sam at
easytrader.com.
Sam at easytrader.com.
Yeah.
Lax is asking, just in our last couple of minutes, what is the cost of just coming in to join the webinar every day? So I guess this is the membership, the subscription.
Yeah, membership of the room is. I mean, it's. I mean, there's a fee of £75 a month basically in terms of the membership of the room, but what we've avoided to make things even is we have a training package which goes with that, because we want people to have a basic understanding of where they are and what we're doing, so that the package there is, I think it's reduced actually for your guys to about £800. It's £997 normally. I'm sure there's a discount, which if you speak to Sam, there will be a discount now. I've said it, of about £200, which is £800, but which, when you bearing in mind 6 months, that includes 6 months membership of the room as well. It basically 6 to 9 months you paid for. It's covered the cost of the course, but the course content is extremely important, because otherwise it will be all the fine details all of the time. We would be answering as opposed to an occasional question in the room about what we're doing and understanding the strategies.
Sure, fantastic. Well, Kim, I think we'll have to leave it there. We're just a couple of minutes until 4 o'clock. Thank you very much indeed for coming and joining us and showing us the new indicator. I'm sure it will be very well received, and we have posted it into the chat box, and of course we'll copy these links. Anybody that's missed these links, don't worry, we'll copy them all onto the follow-up emails that you'll receive tomorrow and over the weekend with a copy of the recordings. So thank you, Kim Watson from Easy Trader. Thank you very much indeed.
Pleasure.
It's a good new name. Maybe you should stop that. Thank you very much.
Yeah. I think I'll leave that one, Simon. It's not your best idea.
Okay. Bye for now. Thanks again.
Take care. Bye for now.
There we go. You can tell that it's getting late in the day as I'm starting to get all my words jumbled up. But from Easy Trader, thank you very much again there for joining us on today's Round the Clock Trader. My name's Simon Campbell. This is Round the Clock Trader, and we are just about to start our 4 o'clock presentation with David Paul from VectorVest. For those of you that are just joining us now, we are more than halfway through our schedule of today. We've already heard from George Halme at 9 o'clock, Rob Colville at 10 o'clock, Steve Ruffley at 12, Alejandro Zambrano at 12, and then this afternoon we've heard from Rishi Patel, Nigel Hawkes at HawkeyeTraders.com, and just now we have finished listening to Kim Watson at Easy Trader. So it's been a great day. It's all been recorded, so if you are just joining us and missed anything, you'll be able to catch up over the weekend with the recordings that we'll send you. Still lots of great stuff to come. David Paul from VectorVest starting in just a minute's time, followed by Alex Ong at Traders Corner at 5:20. Actually, not 5 o'clock. He will just be delayed by 20 minutes. So that gives David slightly longer than the normal hour that we have set aside. 6 o'clock, Alex Spiroglu, Trader Training and Development, very much a look at the steps of trader psychology that we all need to overcome. He's followed by Philip Conchar at TraderCast.com at 7 o'clock. And at 8 o'clock, we cross over to David Warner in the US. He's one of the instructors at the Online Trading Academy, and he's telling us about how to trade Forex like a fund manager. So lots of great stuff. Thanks for joining us, and hope you can stay with us as we start our next presentation with David Paul from VectorVest. I'll go over to David now and unmute the mic and say good afternoon. David, are you there? Are you receiving me okay?
Yes, Simon, all clear, all clear.
Oh,
I hope you can hear me.
I can. It's good to hear your voice. I hope you've had a pleasant summer, and I know you've been busy with interviews on Tip TV, so I don't know if you might have any time off, but it's good to have you back.
Not yet. Not yet. Maybe in September a little bit.
Keeping you busy. That's great.
Yes, but it's been good. It's been great. So I have no problems. No problems.
Well, the markets are looking fairly buoyant, and I keep seeing the emails coming out from VectorVest. Are we in a confirmed up at the moment?
Yes, we've been in a confirmed up. For those of you that are new to VectorVest Speak, I'll define that in a few minutes' time. But yes, we've been in a confirmed up, in fact, since the last week of February. And even the Brexit sell-off, in fact, didn't change the long-term trend. Came close to it, but it didn't. So VectorVest has been positive about this market since the third week of February. So it's 22nd of February, in fact. So we've had a really good run. I've published all of the calls in my blog, and most of them have been made public
on TIP TV. So we've had a really good run over the last 3 or 4 months, I must admit, in both blue chip shares and in small shares. I'm going to show some of them this afternoon. Okay, most of the trades I've taken myself. So
great. Well, shall we get into it? And I'll make you the presenter now.
Okay. Show my screen.
So, those of you that haven't had the pleasure of hearing David speak, David is the Managing Director for VectorVest UK. VectorVest is probably one of the world's largest leading portfolio management research software programs for investors and traders in all markets, US, UK, South Africa, Australia, you name it. It's an algorithmic system which has a fantastic track record. I think it's 28 years in the making, I think, since it was properly founded by Dr. Mark Delido. So
that's correct, Simon, yes.
It's been a fantastic thing. And I also know VectorVest very closely, of course, having spent some time working with the company myself in the past few years. So I'll hand over to you and allow you to explain the detail of the program and show it in the context of the markets today. So David Paul from VectorVest.
Yes, good afternoon, everyone. I'm David Paul. I've got a checkered background. I'm a mechanical engineer to start with. I've got a MSc in metallurgy and a PhD in mathematics along the way. I've no formal financial education apart from what I picked up along the way, and I had to do some ghastly exams for our FCA authorization some years back, and I picked up everything along the way. I started to trade purely by accident because a very long time ago I emigrated out to South Africa, and that was in 1981, and I shared an office with an old fellow who originally hailed from Cornwall. And he was hand charting the South African stock market every single day, following about 50 shares. And I watched him and I watched him. He was making decisions based on classical technical analysis, the head and shoulders, reversals, double bottoms, etc. And he was doing very well. And I watched him. I saved up some money, and that was, I put on my first trade in October 1982, and it was a winner. And I got hooked, and I've been trading pretty much on my own ever since. Between 81 and October 82 and April 1988, I in fact worked and traded. I worked for De Beers at the time, and in April 1988, I'd had enough of working from 8 till 5, so I cut the corporate umbilical cord, and I've been trading on my own ever since. Along the way, one evening, I in fact went to an investment meeting, and the speaker got laryngitis, and they asked me to take the meeting, and it went quite well. There were some stockbrokers in the meeting, and those guys in fact asked me to come into their office and coach their young traders in how to become consistent in the market, and that led to another career in training of traders, and I did that for quite a long time, mostly at the institutional level, and some of the stuff that I'll talk about today I can talk about with a great deal of authority because I know exactly how the city traders think, because I have taught enough of them along the way. We'll get into that a little bit later. While I was training at the institutional level, I developed a friendship with a London trader called Tom Hogarth that many of you will know, and Tom and I had a little business together for quite a long time called Which Way Today, which none of us has any, neither Tom or I have any part in anymore. And while I was in London working with Tom in Which Way Today, I in fact went to a VectorVest meeting. This was in 2010. I went to a VectorVest meeting. I took a 5-week trial of VectorVest UK. I was so impressed with it that I managed to get the agency for South Africa, and I built up VectorVest South Africa into a reasonable size of an organization. Simon, our host today, was running VectorVest UK, and Simon decided that he wanted to focus on this media business rather than VectorVest, and when he in fact decided to step aside, VectorVest asked me would I like to run VectorVest UK as well. So at the moment I run VectorVest South Africa and I run VectorVest UK. I'll be meeting quite a few of my South African friends tonight because just as we conclude, I'm off to watch Saracens play London Scottish at the Honourable Artillery Company, and the Saracens would seem to have a side that could beat most international sides, so it's going to be a great evening. Looking forward to that immensely. So what is VectorVest? Well, what we're going to try and talk about this afternoon, before we talk about anything, I have to put up this disclaimer because I'm not allowed to give one-on-one financial advice, folks. I can talk about what I've been doing myself, but I'm not allowed to give one-on-one financial advice because I haven't sat down with you and completed a long and a detailed fact find. VectorVest UK is pretty much the only organization that markets investment software and investment education that in fact is authorized by the FCA, and we take that very seriously. So with the disclaimer up front, I can move on. So what we're going to try and talk about this afternoon, I've got a little bit more time than normal, is the VectorVest system itself, how to know when it's a good time to be in the market, and how to know when it's a bloody awful time to be in the market. There are times when the market is rising that everything is rising and it's easy to make money, and there are times where it doesn't matter what you do, you can't make money. We're going to look at our tool called UniSearch, which will in fact help us to pick stocks that suit us. So if you're in the market for capital growth, you can find shares that have a high probability of growing their share price. If you're in the market for income, we can try and locate easily shares that will pay you a good dividend and have the ability to grow that dividend safely. And of course, there's people like me who want both. Okay, so I'm primarily looking for shares that can have a mixture of both capital growth, pay a small dividend, and have got the ability to grow that dividend. And then towards the end, I'm going to be talking about a very simple but robust trading strategy for reliable profits that you can keep under control once a week without any great effort. I'm going to look at two different entry techniques. One is a fairly mechanical technique which gets you in after the turn, and the other entry technique is a little bit more subjective in that we will use support and resistance and Fibonacci strategies to try and pinpoint the turn. And then I'll talk about how to actually work out where you should be getting out. And remember, ladies and gentlemen, you should always have it written down as to where you're getting out at the same time as you get in. Okay, so that's what we're going to try and talk about in the next little while. Simon will, in fact, well, at least he normally interrupts me when there is a question coming through. Okay, because I actually can't see those from here. So
I'll do that too.
That's very kind of you, Simon. Thank you. And I'm afraid I think that your countrymen are going to get a hiding by Saracens tonight, I'm afraid.
Oh, well, don't take it different. Let's see. Okay.
The VectorVest Edge, folks, and we all need an edge in markets, and the VectorVest Edge is comprehensive. We put together the fundamental position of a company with the technical position of a company, with the technical position of the overall market. And when all three things are saying yes, then the future can be determined with certainty that's unusual in this line of work. So VectorVest, as far as I can ascertain, is the only software package in the world that integrates both technicals and fundamentals. Now, there's lots and lots of software packages that have got the fundamentals there, but you still need to be a CFA and have lots and lots of time and skills to actually ascertain what the fundamentals are. And I was in that position when I started. I really did my best to try and ascertain the fundamental position of shares when I started to trade. And I failed abysmally because the data came at me far too quick, and all of a sudden the corner of the office would fill up with annual reports and interim reports. The second thing, of course, that I didn't have the tools because I was a mechanical engineer and I just didn't have the expertise to sift through those reports and pull out the salient pieces. So every time I got my mind around accounting rules, they would change them. The fundamental position of a share, as far as I'm concerned, is the search for the true value of a share. And that's how I define fundamental analysis, the search for the true value of a share. And in terms of a definition of the technical position of a share and the technical position of the overall market, I use Martin Pring's definition, and he defines technical analysis as the study of trends and turning points. So I define fundamental analysis as a search for the true value of a share, and I define technical analysis as a study of trends and turning points. So in a nutshell, I want to try and find shares that are undervalued, that are growing their earnings aggressively, that are rising, and I want to buy the darn things into a general market that's rising. And that's in fact been the case over the last few weeks, where we've had a really good run. So what every investor should know is that what's a share really worth? How safe is the earning stream? And when to buy, sell, or hold. Some idea about the trend. And that's what we're going to try and put together over the next few minutes. And I'll try and do it as quickly as I can, and then we can move into the sexier stuff, which is looking at some shares themselves. So first, and a cornerstone of VectorVest, ladies and gentlemen, is all about value. Every evening, VectorVest puts a value to every share in the market. It uses an algorithm that's been around for the last 28 years now, that's grown over the last 28 years, which looks at the balance sheet of the company, looks at the income statement, looks at the cash flow statement, and we suck in all those numbers for all 2,200 companies that we follow on the London stock market and on AIM. And from those numbers, we calculate a value. And our values are robust, they're conservative, and some years back when I, in fact, took over VectorVest UK, some of my friends in the asset management business, I compared our valuations with their valuations, and in the FTSE 100 there was only one company where our valuation was more than 10% away from the institutional consensus. So a very robust valuation where you can see at a glance whether your share is overvalued or undervalued. Now the next proprietary number on VectorVest is called relative value. I believe that it's the most important number on VectorVest. It drives the share price. And as you can see from the slide, it's an indicator of the long-term price appreciation potential. And for long-term, ladies and gentlemen, read 3 years. We look at a window into the future of 3 years. And we project the growth of that share in relation to the risk-free rate, and we use a AAA rated corporate bond for the risk-free rate. Everything on VectorVest runs between 0 and 2. If your share has got a relative value of 1.3, then we believe that that share will outperform a AAA rated corporate bond by 30% over a window of 3 years. It actually doesn't tell you within that window when it's going to happen, and as you all know, shares rarely do things linearly. They normally do nothing and then go poof. It's the only timing that there is in relative value is a window of 3 years. So exceptionally important number. The next proprietary number is relative safety. And relative safety, as the slide says, quantifies the consistency and the predictability of the financial performance. So we look at, again, the balance sheet, the income statement, the cash flow statement. We look at 17 measures of the numbers, and we make a judgment based on those. Are these numbers getting better or are these numbers getting worse? Again, it's mathematically massaged between 0 and 2. Above 1 is okay. Above 1.3 is excellent. Above 1.3, there's a company that's making lots of money, and all those financial ratios that I struggle to get my head around are getting better. So what we've done so far, and what the program does at a glance, is that it puts a value on the share today. It puts the earnings upside over the next 3 years into a number, and it puts the earnings safety into a single number. The next number is a measure of the trend. Done a little exercise, folks. And I hope you can see this. And we'll do this maybe a little bit when we get into the program in a second. All I've done is that I've looked for shares that are trading below the vector best valuation, that have got a relative safety of greater than 1. And I did this test at the start of 2015. So 18 months later, 19 months later, 20 months later maybe, we've got the top 10 shares from that search are up 29% over the last 18 months, which is 17% annualized, and the market is up 7.91% annualized. So just looking for shares that are trading below the vector best valuation with a reasonable safety has got quite an edge without doing anything further, without any market timing whatsoever. The third proprietary number in VectorVest is relative timing. Now, this is a measure of the trend itself. It's a short-term measure of the trend, and we, in fact, mathematically massage it again between 0 and 2. Above 1, the share is rising. The further above 1, the faster it's rising. And then what Bartolito did next was that he put all three numbers together. He combined relative value and relative safety, which are fundamental measures of the share, with relative timing, which is a technical measure of the share. And thus, for the very first time in my career at this, I'd seen a number which comprised both the fundamental and technicals of that one company. And I'd never seen that before. And as a default, ladies and gentlemen, all of the shares on the London market and on AIM are in fact sorted by descending VST. You can sort them by whatever you like, but as a default, they're sorted by descending VST, and very simply, that's where the winners are. Now, if relative timing is a short-term measure of the trend, the comfort index is in fact a long-term measure of the trend. And the comfort index is a proprietary vector-based measurement. I haven't seen it anywhere else. Again, it does its best to tie together the fundamental position and the technical position. And here's what it does. It looks at the strength of the trend over 3 years. It looks at the volatility of the trend, and it looks at the fundamentals as measured by relative safety. If the trend is strong and strengthening, and the volatility is low, and the fundamentals are getting better, that scores well with the comfort index. And I think you would agree that a share that's trending strongly with little volatility, where the fundamentals are getting better, should in fact give you some comfort, and that's why it's called the comfort index. It's a really strong and proprietary tool that is totally unique to VectorVest. And as I say, all threading right through the presentation is this putting together of the fundamental position with the technical position, which is unique to our product. We calculate a stop loss for every share in the market. The stop loss is in fact around a 65-day moving average. The 65-day moving average is adjusted for two things. It's adjusted for the volatility of the share using a concept that technicians use called average true range. And it's also adjusted for the fundamentals. If the fundamentals are good, we widen the stop loss, we give the share more room to move. And the stop loss is doing its best to find that fine line between not getting stopped out in the noise and secondly, making sure that you don't give too much profit back or make too much of a loss. It's a very fine line. It does its best to do that as best it can. Every day we put a buy, sell, or a hold rating on every share in the marketplace. Now, the buy rating is largely a trend following tool, and the only fundamental input is that the VST must be greater than 1. And you can use this to time the market, and certainly we can scan for shares that go from a hold to a buy, and that makes very good entry points. But its biggest use is to ascertain the breadth of the market. And every day we calculate the number of shares that are rising divided by the number of shares that are falling to work out the breadth of the advance. And the breadth of the advance is a big part of our market timing model that I'll be getting onto in a few minutes. So let's have a look at the program itself. And if I go into the program and I go into, first of all, there's an enormous commitment to education at VectorVest. And the first thing we do is that when you get VectorVest, we have an interactive tutorial. That's Bart DeLita, the gentleman who put this all together. We have an interactive tutorial that talks you through the process. First of all, you can put the stocks that you've got at the moment into the program, and one of our guys will in fact talk you through the whole thing of how to analyze those and how to analyze, get to what really matters very quickly indeed. We then show you how to get rid of the bad ones, and then we talk about market timing, and that will take you maybe an hour, and when you go through that you will really know how to get your money's worth out of the program. Similarly, under training, we have a 5-week course. You could do it in 5 days if you wished. That actually goes into an awful lot more detail. Okay, how to analyze your stock in 30 seconds. That's what we're going to try and do now. How to get rid of the bad ones, how to incorporate market timing, and how to actually build a plan of attack. So let's look at some shares. To find some shares, we go to viewers. Puts all the shares into the spreadsheet. Now, when you go into this for the first time, guys, you're going to find that this is empty because you've got a choice of stock viewer, industry viewer, sector viewer. So just click on stock viewer, and that will populate the spreadsheet. And we're following 2,156 shares on the London market and on AIM. And although I'm at our office here in St. Paul's and the internet is really good, but I've just loaded the top 50 so that it actually doesn't put too much strain on the internet. Sometimes if the computer is manipulating all 2,156 and the internet is not good, the sound quality goes down the hill. But I think the sound quality here is good today. Am I okay with that, Simon? I'm very happy to report that quite a few of these shares I'm a shareholder in, right at the top here. To make some money, folks, you really do not have to look at much more than the top 20 shares as listed by VST. These are sorted by VST. So I'm going to look at a share that I've got at the moment called Hill & Smith, and I'll put up the chart of Hill & Smith when we get into the timing section in a second. So there's Hill & Smith Holdings. There's the code. It's listed on the London stock market. That's a little L. As you can see, Fever Tree above it is in fact listed on AIM. That's why it's got an A there. Ladbrokes down below has got a little X beside the L, and that means that it's optionable. There are options written on that particular share, as in the case of CAS. Okay. First, it's trading at £11.97. That was the close yesterday. The first proprietary number, ladies and gentlemen, is the valuation, and we believe that it's worth £14.93. So immediately we can see that Hill & Smith, we believe, is undervalued by the market, and that's good. we favor undervalued shares. It was down 11p yesterday, which is hardly proprietary. I know you can get that from the Evening Standard, and that was 0.91%. Now, the next proprietary number is relative value. And relative value, as I said earlier, is a measure of the share price upside in relation to what you would get from a AAA rated corporate bond over a window of 3 years. We believe that Hill & Smith will outperform the risk-free rate by 42% over the next 3 years. And on a scale between 0 and 2, that's good. That's excellent, in fact. So that's good. So immediately on Hill & Smith, we've got a share that's undervalued, that is growing its earnings aggressively, and RS is the next proprietary number. The relative safety is in fact 1.34 on a scale between 0 and 2. That's excellent as well. So this is a company making money, making lots of money, and all their accounting ratios, etc., are getting better. So in Hill & Smith, I've got a share that's undervalued, that's growing its earnings both aggressively and safely. That's rising, and the RT is 1.68. And it's on a buy recommendation, and the VST is the second highest in the pack. Now, we're going to have a look at the technical position of the share in a few minutes, and towards the end of the presentation, I'm going to show you how to actually get into the share and all shares at a very good price. So VectorVest is not a black box. It's on a buy recommendation, and there are dozens of shares in buy recommendation. We're not saying that you go out and buy them tomorrow. You still have got to bring a little bit of COP to the party, and COP is South African for head. We calculate the stop loss. The stop loss is £10.28. These numbers to the right-hand side, ladies and gentlemen, are our best shot at the future. That's the growth rate next year, the earnings per share, the earnings yield, the PE. Now, if you go to the Financial Times, you're going to find that the Financial Times has, in fact, got different numbers there. That's because they're looking back, and this is our best shot into the future. And as Mark Twain said, the future is a very slippery commodity. This is our best shot at it. If I go across in the spreadsheet, we now can look at dividends. And the dividend yield, we believe next year of Hill Smith is 1.56%. But the really, really important number is dividend safety. And dividend safety measures the, as it says, the safety and the predictability of that dividend over the last few years. It's rated, strangely enough, on a scale between 0 and 100. And it's the only anomaly on the program. Everything else is between 0 and 2. At 87, this is saying that this share has maintained this dividend and grown this dividend. And we expect the dividend growth to be 12%. Now, if you are in the market, ladies and gentlemen, for capital growth, the master indicator is VST, value, safety, and trend. If you are in the market solely for dividend growth, the master indicator is YSG, the yield, the safety of the yield, and the growth of the yield. And we could easily, just by clicking on YSG, we can sort the whole London market by YSG. Now, as we'll see when I get into Unisearch in a little bit, I find that some of the best shares are sorted by a mixture of VST, which gives me capital growth, and YSG, which in fact gives me dividend growth. And I'll show you some searches that we have in a second that will do that for you automatically. Dividend information is all here, and we can build dividends into our searches if you require a dividend. Now, many people say that they're in the market for capital gain only, but if you are a conservative investor, ladies and gentlemen, the quants have shown over and over and over again that even if the 1% dividend is not going to make any difference to you. A company that pays a small dividend, that's got a history of growing that dividend, is a much safer financial instrument. So those numbers on dividend and dividend safety are very important for you to quantify the financial position of that company. And conservative investors will want to have a share that's got a high dividend safety. Okay. If I go right to the right-hand side, we have the comfort index. Now, if I was designing this program, I'd put it in a different place, and I suggest that you click on CI and pull it right across beside VST. It's such an important number. CI measures the long-term trend, and as we can see on Hill & Smith, the CI is 1.66. Very strong, and it's the company's got a market cap of 940, so it's not a tiddler. Okay, so, and what we've done is we've analyzed that company very quickly. Now, to get to the data quickly, if I right-click, I can pull up a full stock analysis report for every share in the market. Now, there's some very good charting in VectorVest. This is just summary charting, and it was down 11 pence yesterday. That's why the red was there. Buy recommendation is green. Value, relative safety, relative timing, and the report CI is excellent. It talks you through every facet of the company, and that is a report for every share in the market. I have stockbrokers who cut and paste this and send it to their clients. It saves them hours and hours and hours of work. Okay, for every single share in the market, a very, very comprehensive report. And again, if I right-click and I go to View Stock News, I wish I could work out why this Windows 10, which I've just newly installed, puts up this new browser. I really don't know that. This takes us into the Financial Times, and pretty much everything that's ever been written on this company is here. So, for example, we've got charts, directors' dealings, all of financials, the investment analyst forecasts for the company, and we go down a little bit, key statistics, all the annual reports, all the press releases, the financial calendar. Now, this is a paid-for subscription at the Financial Times, and in fact, this is a part of the VectorVest monthly subscription, and it is a part of the 5-week trial that I'm more than happy to offer everybody so that you can make sure that VectorVest is for you. The 5-week trial is £5.95, and then you can ascertain for yourself as to whether the program is for you. Okay, I don't think I can be fairer than that. So Hill & Smith, now on VectorVest there are, if I can get rid of this now, I think. Yeah, on VectorVest we have 3 sources of news, and if I go to Tools and Application Settings, I've set my preferred news source as the Financial Times, but we can also default to Yahoo, which I think is average, and Reuters, which is excellent. So you can actually get background news from both the Financial Times and Reuters. I've set mine at the moment to the Financial Times. Okay. I prefer a white background, although my son, for example, always uses a black background, and there is no doubt that the black background is much easier in your eyes. So when you actually get your 5-week trial, ladies and gentlemen, it's going to have a black background, and if you want to change that to white, the classic background, then you do that in application settings. Now, a lot of information I know, and that's why we have a call center, and that call center is open 12 hours a day. Any questions whatsoever, you pick up the phone, it's a free call, gets you straight through to our call center in North Carolina, and if you've got any problems with your subscription, any problems in what button to press, how to actually change this, that, and the other, then there's a young man or a young lady on the phone who will sort that out for you instantaneously. Okay, so tremendous level of support, 12 hours a day from 12 o'clock midday to 12 o'clock at night. Okay. The last thing I can do by right-clicking, although there's lots and lots of ways of doing it, is to pull up a chart. And there's some charts. I'm going to be talking us through this now in a little bit. I default always to a weekly chart. So I have my chart set to default initially to weekly because I like to get a long-term view. And I'm going to talk in a great deal of detail in a little bit about how to actually trade this. Okay, and so let's look at another company. Let's look at Victoria. Now, Victoria I like. And Victoria has come enough a long way in the last week or two. If we look at Victoria, now Victoria is the largest manufacturer of carpets in the UK and in Australia. I had a great run in it about 18 months ago. It went from £2 till £12. Now that's a nice run, and you find a few like that, you can turn small amounts of money into large amounts of money, which is just wonderful. It's trading at £15.77. We believe it's worth £27, so it's significantly undervalued. The RV is 1.58. On the scale between 0 and 2, that's better than excellent. That's bloody marvellous, and that drives the share price. But the relative safety is 0.82. Now, that's saying that over the last 5 years, there have been ups and downs in these numbers. Okay, so one has to be careful if the relative safety is less than 1. There's a higher probability of a surprise. My son loves these companies. He loves companies that are undervalued, that have got a high relative value. He doesn't worry about relative safety because he's a portfolio manager, he's sitting in front of 6 screens all day and he's watching stop losses from 8 o'clock in the morning to 6 o'clock at night, keeps them out of harm's way. I'm too old to do that. I'm 61. I'm too old to sit in front. I've been sitting in front of screens all day for the last quarter of a century. I'm too old to do that. So if you've got the ability and the focus and the emotional detachment to manage risk proactively with stop losses, then just be careful of low RS shares. But at the same time, you're not going to get a share that moves from £15 to £27 quickly that has got a high RS, unfortunately. So that's the difference between Hillsmith and Victoria. So Ladbrokes looking fairly fully valued here. Trading at 160. Its valuation is 162, so pretty much fully valued. Relative value 1.21. Okay, that means that if the share price stays at 160 and the earnings come in as we anticipate, that at some time in the next 3 years, at 160, it's going to be undervalued. I think the greatest example of that, of course, is Fevertree. Fevertree is trading at £10. We believe it's worth £6.66. So it's significantly overvalued. I've had a tremendous run in Fevertree. A little naughty because the rules say, the conservative rules say, that we should only buy into undervalued stocks. But the thing that changed it for me was the relative value. The relative value at 1.47. So the question I get more than anything else is that if the share is nearly trading at twice our valuation, how can the relative value be 1.47? Well, here's the nub, folks. If the share price stays at £10 and the earnings come in as we anticipate, we expect it to grow earnings at 37%. If they come in as anticipated, then at £10, at some time over the next 3 years, it's going to be significantly undervalued at £10. Relative safety is not bad. And as I say, I've had personally a very, very good run on that over the last month or two. So that is the VectorVest system. We're looking for shares that are undervalued. Cranswick is a very good example. Undervalued slightly, okay. Relative value 1.25, relative safety a whopping 1.47. Clearly safety in those sausages. And relative timing at 1.29, and as a result the VST a very healthy 1.34. It's on a buy recommendation. Now, we don't have to eyeball this stuff, but I assure you, to find trades, you don't have to do much more than look at the top 20 or 30 by VST. And VST is the default sort because it's the most robust. So what we can do is that we can now go to Unisearch to try and find the best combination of shares that suit us. So if I go to Unisearch, click on Unisearch, that's today's date. So I always put time of search in there because it always defaults to here. First of all, the first thing that we see is that there's literally hundreds of searches grouped into categories, or you can see them one by one by clicking A to Z. Aggressive, bottom fishing, candlestick searches, conservative searches. But we can write our own. So first of all, I'm going to write a search, and let's say that we are too lazy to work out stocks price. Stock price is less than equal to value. And immediately we can find all of the shares that are undervalued and sort them by VST. And so there they are: Hill Smith, Victoria, Ladbrokes, JD Sports. Okay, it's taken out all it's done is taken out all the shares that are trading above their valuation. As you can see, Fever Tree is gone. Right? So I can now put in, and I'm just making this up, those shares must pay a dividend. Dividend yield greater than or equal to 1. I'm going to get rid of all the shares that don't pay a dividend. There we go. And clearly, I think the dividend safety is really important. Stocks, dividend analysis, dividend safety greater than or equal to 80. Okay, now what that's done is that from the whole of the London stock market, we've now got ourselves to a couple of dozen, say 3 and 3, 6, and 3 is 9, 12, 13 shares in the whole of the London market that are undervalued, that are paying at least a 1% dividend fairly safely. Okay. Now, I'm sorting these shares by VST, but I can change that sort very easily. And if you're looking for a dividend, the best sort tends to be VST plus YSG. I run that search again, and that's bringing the shares with the best combination of VST and YSG to the top, and there we've got them. Hillsmith, Bellway, Gleeson, Cranswick, WPP, Next, Reed Elsevier, TriFast. I'm a shareholder in TriFast. Diploma Group, Rentokil, Smith Nephew, Schroders, Joe Menzies. That's pulled those to the top. So very quickly, you can in fact find shares that suit you. Now, for example, to live, if you want, that needs to be 3. Let's see, how does that change the thing? 1 company in the whole of the market, folks. That's how it changes. That's undervalued. They can pay a dividend of 3. That says a lot. Now, we've got some really, really cool searches in conservative. And the one that I always default and ask new people to go to, and this search has been robust in both South Africa and in the UK, is a search called Pale Blue Chips. And this search looks for shares, it's a conservative search, so it looks for shares with a high relative safety. It looks for shares that are going to grow their earnings by more than 10% with a dividend safety of greater than 50. The dividend growth should be greater than 10, and the dividend yield should be greater than 1. And we're sorting by VST plus YSG. It's finding those shares with the best combination of value, safety, and trend, which encourages the share price, and yield, the safety of the yield, and the growth of the yield, which helps dividend. And if I run that search, There we go. Again, Hill and Smith comes out of it well, and we take the whole stock market, folks, and we go to 1, 2, 3, 4, 5, 6, 7. We can now chart those easily. So in this tool called Unisearch, you can either use our pre-programmed searches, or you can write your own to get you exactly to where you want to be, to find shares that suit you. Okay. Any questions, Simon, at all there? No. Okay. So let me move on and back into my PowerPoint presentation. Where I want to go to now, guys, is timing the London stock market, because there are times where it's easy to make money, and there are times where it doesn't matter who you are, you cannot make money on the long side of the market, i.e. buying the market and hoping and praying that the darn thing's going to go up. So our mantra is buying rising shares in rising markets, and if you've got the stomach to sell something you haven't got, to sell falling shares in falling markets. And we've been timing the market for a long time, and we've perfected several systems that identify market trends with accuracy and precision. Remember, what we're trying to do here is to, in fact, ascertain the technical position of the overall market. And the technical position of the overall market I define as the study of trends and turning points. And we've got systems for investors, and we've got systems for short-term traders. Our systems are totally rule-based, and no subjective input is required, and we in fact do our best to make it color-coded, so that there's very little thinking and subjective input needed. The three things that we measure is that we measure the price of the VectorVest composite. Now, the VectorVest composite is a composite indicator of all of the shares that we follow on the London stock market and on AIM. It's the broadest measure of the London market that I know, and the index and the composite index is in fact calculated on an equally weighted basis, not a market cap weighted basis such as the FTSE 100. So we look at the price of the VectorVest composite, we look at the breadth of the VectorVest composite by using our measure of breadth, which is the buy-sell ratio. And we look at the momentum, or the RT, of the VectorVest composite. So we have longer-term systems and shorter-term systems, I say. So the short-term system is based around a 5-day rate of change of the price, momentum, and breadth. And the longer-term systems are based around a 21-day rate of change of the price, momentum, and breadth of the market. And we do our best to try and simplify and color code all of this for busy people. So, and the slide, in fact, is a little out of date. That should be down up. I forgot to change that. Nearly spell. We quantify the trend into 2 words, and as I write on the LSE is in a down-up situation. This means that the primary wave is down. Very unprofessional, guys. Amazing, you can go through this a dozen times and you only see the mistake when you're in front of people. This means that the primary wave is down, the short-term trend is down, and the underlying trend is still up. And that's reported on the front page of VectorVest every single day. The underlying trend is used by position traders, and the short-term trend used by short-term swing traders. And the primary wave, or the short-term trend, has been down since after trading last Thursday evening. So that's the guts of a week now. Okay. The front page of VectorVest, for example, this little traffic light summarizes the short-term trend. And as you can see, the pointer is into the red, and if you can read that, it says VectorVest does not advocate buying any stocks at this time. Okay, so the longer term trend, this is the VectorVest composite, and the longer term trend has been up since the end of February. The short-term trend has gone up and down, and for the last few days the short-term trend has been down, and you know that I've noted this rising wedge, which is also quite a bearish pattern. The rate of change of the price, the breadth of the market, and the RT are in fact all put together into a long-term trading system which are called confirm calls. And at the end of February, we got a confirm call up the page. At the start of the year, we got a confirm call down. And this, in fact, preceded that big sell-off into February. And since the third week of February, the longer-term trend of the London market has been up. Nearly came off here in Brexit, but in fact the market in fact closed well up, and it didn't in fact kick in a sell signal during the Brexit debacle whatsoever. So the longer term trend of the market still up. Now the blue chart below the composite is the market timing indicator. Now this is the 21-day rate of change of the price of the composite and the 21-day rate of change of the breadth of the market, all rolled into the one indicator. Like everything else in VectorVest, mathematical massage between 0 and 2. Now we found over the years that when the MTI gets up to about 1.5, 1.6, that's a good time to be running away. And when the MTI gets down to about 0.6, that's a great time to be getting in. And ladies and gentlemen, that has called every turn of the market over the last 2 years. This called the April 2015 high, it called the August low, and it called the February lows. Called this high, which was the sell-off into Brexit, and it's saying that this market has gone too far at the moment. So an exceptionally strong measure of the sentiment of the market based on these overbought, oversold levels. So I've been, in fact, advising everybody to be very, very careful in this market over the last couple of days. So we've got, since last Thursday, the short-term trend of the London market has been down. The longer-term trend is still up. But we're in this very, very overbought situation here. And historically, that's always been a place to be very, very, very clever. The options players, any options players out there, you'll find that this MTI, absolutely invaluable for your option strategies. Up around there, very, very safe place to write calls, okay? So as I've said, for those of you who want the presentation, Simon will send it through. At an MTI of less than 0.65, there's a strong possibility of a bounce or a trend change. At an MTI of greater than 1.5, the market invariably pulls back. And you can build a trading system around that if you've got the strength to step in when the MTI is down around 0.6. That's difficult to do because that's normally when everybody's running away and doing the wrong thing. So if I go back now to the front page of VectorVest, I'll try and show you how this is all put together. And here we got the front page. Maybe you can see this a little bit better now. This confirmed call, the C up in green, that has been there every single day since the end of February. So the longer term trend has been up since the end of February. The short term trend down up since August the 18th. 1, 2, 3, 4, 5 days now. The short term trend has been down, longer term trend has been up. Our guidance here is easy, and if you stick to the guidance and do nothing else, you're going to find that you get very lucky. VectorVest does not advocate buying any stocks at this time. Now, the time to buy stocks and you can use Unisearch to find them, will be when the short-term trend turns back up, and the little pointer will in fact go into the green, and VectorVest advocates buying safe undervalued stocks at this time. So if you're busy, you don't have to look at the VectorVest composite at all. You want to be buying your stocks where the longer term trend is up and when the short term trend joins the longer term trend in an upward direction. It's that simple. Okay, and when that's the case, you're going to see an awful lot of green on the color guard, as was the case here. Okay, this is green on the color guard is telling us that the price, the momentum of the price, and the buy-sell ratio are all rising. At the moment, we've got a red light in price, which has pushed the pointer right down here. The short-term trend has been down for the last 5 days. We've got a very, very overbought situation. Okay, the MTI is coming down a little bit, but nevertheless, it's been right up at 1.6, and a time to be very, very careful, as the color guard says. Now, if the short-term trend changes to up, then the game is back on again. So what we've tried to do is to simplify for those people that are on the run, and all of this can be done, VectorVest can be downloaded onto your smartphone, and if you're on the run, you can have pretty much 95% of the analytical capabilities of VectorVest on your phone. Okay, so you can take it with you everywhere. It's the first thing I do when I wake up in the morning is to have a look at, I don't look at it in the evening, have a look at it first thing in the morning. So that's market timing. Very simple indeed. When you see a confirmed down here, then that's time to be very careful. Watch your stop losses very carefully. Said don't buy any more. And maybe get rid of those shares that in fact haven't done anything for you. So that's market timing. Very, very simple, very easy, and it's not a time to be buying shares today. So assuming that we understand when it's a good time to be in the market and when it's not a good time to be in the market, how do we actually get aboard? Well, I've put together a model which is based on a weekly chart. It's a model that I've used for guts of 20 years, and it's worked for me for all of that time. It's a simple study. It uses a 20-week moving average and a 40-week moving average. And this is a chart from 1999. This is the NASDAQ. Okay. And it just illustrates that the NASDAQ flew up and it gave it all back again. So the investor, in fact, was a loser. If he'd bought there, he was a loser. Whereas the trader on this weekly chart could have, in fact, made a lot of money there and could have made, if he felt like it, some money on the short side. Now, I call the area between the 20 and the 40-week moving average the zone. And simple-mindedly, I like to accumulate shares when the market pulls back into the zone. If the 20 is above the 40, then I want to be a buyer. If the 20 is below the 40, I want to be a seller, or I want to be in cash in that particular share. And my charts always default to a weekly view before I even look at the daily view. Now, this is a share called Barrett, and this is the last year. And I think most of us will know Barrett developments. There's the 20, that's the 40, and as you can see, in this area, the 20 is above the 40, and that's a place to be buying shares. And then all of a sudden, at the start of the year in January, well before Brexit, this thing keels over. And in fact, that was a place to be in selling the share as it rallied up into that area between the 10 and the 20. It's doing the same thing again. It'll come off this, may not make a new low, but it'll make a low here. And simple-mindedly, and I haven't got a great deal of time to talk about this today, but when the market pulls back into the zone, I'm looking for one reversal candle before it goes again. And this is a 3 weekly candles which technicians call a morning star. Down, doji, and up. And if you'd bought there with a stop loss under there, you were well rewarded. This is a outside week, very useful formation, and away it goes again. That was an outside week, and it falls through the floor. So a couple of, I think that you need 3 candle patterns. One is a morning star, comes up over and over again. The other one is an outside week. And the third one, of course, is a hammer. I think if you understand those 3 weekly patterns, you can trade my weekly zone trade. So let's have a look. There's nothing much to it. Japanese candles chart and a 20 and a 40 period moving average. You can short it as well, because that was a buy down here. Market runs up, comes back into the zone, and we saw a morning star, and then it moves up the page. If you see the market running wildly away from the moving averages, then, and you see a big topping tail, then you could have a quick and sneaky little short if you wished. And as you can see here, it comes back. This is Amazon, I think, and then all of a sudden we get a hammer, and the job is back on again. Now, all of this just needs to be looked at the weekend. So, this Hill and Smith. All right, so here's Hill and Smith. There is the 20, that's the 40-week moving average. Okay, and the fundamentals, both in terms of capital growth, in terms of dividend and dividend safety, just couldn't be better. And it pulls back into the zone between the 20 and the 40-week moving average. And then, ladies and gentlemen, it charts a hammer, a beautiful textbook hammer. Down, opens, right down, reverses, and the close is above the open. Now, you can go back and check on TipTV if you want, but I called that as a buy just there, and it's flown up the page very nicely indeed. And that's the basis of the technique. Now, in a second, there are 2 ways to enter this. The first is to wait for the reversal candle. The second is to try and do your best to try and work out where the institutional traders are going to be hitting this. And I assure you that these tails and candles are rarely done by retail traders. They're mostly institutional traders who are sitting waiting for it down here. They've got the ability and the guile to actually try and find these bottoms. So, but you can make good money by waiting for a 1-week reversal candle. And in that case, if I can get my pen right, you would have been a buyer there with a stop loss down there. Now remember, we're only looking at Hill and Smith because it's got outstanding fundamentals. Its technical trend is up the page as defined by the weekly chart on the 20 and the 40. And ladies and gentlemen, at around this time, towards the end of June, in this area, the longer term trend of the London market was still up, and the short term trend had turned up. In here, all 3 things were coming together at once. 1, fundamentals were good. 2, the technicals of the share were good, and 3, the technicals of the overall market were good. When they all come together, you can predict the future, as I said earlier, with a degree of confidence that's unusual in this line of work. So that's the first way of getting in. Now, the institutional guys don't particularly believe in candle patterns, and they will always be trying to actually work out a level. If you walk through an institutional trading office, there's only 2 sentences. They walk and you hear people talking and talking and talking. What's the level? What's the level? What's the level? What's the level? And of course, the other sentence is, that was the level. That's when you've missed it. So what's the level? What's the level? Well, here was the level, folks. The market came back, and those of you that understand fibs would take a fib from the low to the high, and the institutional traders, and I will be always looking for confluences. When I see a confluence of an old high like this, that area of support, and a 62% retracement, that is why the market stopped there. X marks the spot. And that would have been a good place to have your order. Now, that's difficult to do, because sometimes you'll buy it down there and the thing will just keep going. But and the other way, of course, is to have a charting system that's got a bell on it and sends you an alarm when the market does get down there, and then you can have a look at the situation, maybe on an hourly chart or something, and that's certainly what the institutional people will be doing. But nevertheless, it was hit hard down here, so you got a choice. As it pulls into the zone, are you a support and resistance trader? When I'm at my best, I'm not saying I'm always at my best, but when I'm in my best, that's what I am, trying to work out these levels. And I'm paranoid about levels. Those of you that know me will know that I'm paranoid about levels. I want to try and get in at the best level. Many's the time I actually miss trades because the market doesn't get to my level and reverses before I get there. But on Hill & Smith, this market pulled into the zone. The easiest thing to do was to wait for the reversal candle and just simply buy it there with a stop loss down there. And it's flown up the page. But the real pros would have been wanting to, in fact, have bought it right down here. And their stop loss needs to be tiny, and that amplifies the risk to reward ratio if you can spot and are good at support and resistance. Very simple, a confluence between fib and this old highs. It's not difficult, but what have I done? They're always easy in hindsight. Okay, always easy in hindsight. So that's an entry technique, and that in fact was the level between the confluence between the 62% and that old high. And I know that institutional trade, I know how they think. Now, the target, we turn the whole thing on its head and we take a fib from the high to the low and we expand that pullback. And the first target is 1.618 of that, and that was the first target just here. The second target is up there at £14, and we'll see if we can get there. If you're a swing trader and you get in here and you get out there, then that's a really good trade. However, many people look on this entry as a really great place to get into a sound share, and they're more than happy to let it run up the page towards the vector based valuation. And we can see up here that the Hill & Smith and the vector based valuation pretty much around this common area up here, and I think that with a decent market we can get up to there. We'll see what Ms. Yellen says a little bit later today. Read that. So that's the basic methodology. I'm looking for shares with outstanding fundamentals. I want the share to pull back into the zone between the 10 and the 20. When I'm at my best, I'm looking for support and resistance to be able to get aboard with virtually no risk. When I'm not at my best or I'm sleeping, then I get in with a reversal candle. And there's only pretty much 3 reversal candles. One is a hammer, which is this one, a morning star, which I'll show you in a second, and a outside week. And then, if I'm trading, I take a pullback, extend this pullback, and my target is 1.618 times the pullback added to the low. That's it. And folks, you got to get very good at doing one thing. And that could be the one thing. Fever tree. Fever tree. There's the 20, there's the 40. It traded inside this little triangle, and then it broke the triangle, and then it came back and kissed it. That would have been a great place to have got in. But I didn't see that, and I, in fact, waited for this outside week just here. So we got a down candle, a doji, and then an outside week, and I bought it there with a stop loss down there, and it's moved very nicely. Okay, so that again, in this period, Fever Tree's got great fundamentals. The technical trend on the share is up, and where I got in, the longer term trend of the London stock market was up, and the short term trend was up as well. So all 3 things were coming together, and that's when you get these outstanding moves. So Fever Tree was great, and as you can see, folks, that the market in fact pulled back to a confluence of this trend line and the fibs. It actually stopped at a 786 retracement, which is my favorite retracement down around there, but I don't want to confuse you with fibs. And it's now at a 2.618 of this, and I'm watching this very closely around the £10 level up here, and I haven't taken any profits yet, and it's been quite solid in the sell-off that we've seen over the last 5 days, but I'm nervous of giving those back. JD Sports, folks, again, impeccable fundamentals. Trading below the VectorVest valuation, the green line is the VectorVest valuation. That's earnings per share rising strongly. There's the 20-week and the 40-week, pulls back into the zone. And if we look at it a little bit more clearly, we get this hammer candle. And I bought in just as it broke the high of the hammer candle, and I'm still in. I nearly had a heart attack last week when it came back, but when this was over, it's now looking strong. I did this a couple of days ago, and it's stronger still. So I think it's just a matter of time, and this is a very healthy looking hammer candle here. Looks to me as if that was a little bit of argy-bargy and hitting stop losses here. So I think that this just a matter of time before that breaks up the page again. Everything looking good. And there's the targets. First target is here. Now a second target is a 2.618 extension of the pullback, and with a fair wind behind us, I think we can get there. This is 4 imprint, and it pulls back into the zone. We get a lovely big hammer candle in here, and then it flies up the page. Again, there was a fib and a confluence of the support level all came in at the same level, and that's exactly where the low of the hammer came in. So that was quite easy to work out where the institutional orders are going to come in, just there. Okay, so if you want to be a support and resistance trader, you can push your risk to reward ratio through the roof. You can get in with virtually no stop, small stops with big targets, and to have 10-to-1 risk to reward ratio trades with this type of methodology is relatively easy. Okay, always easy after the fact, much easier emotionally to wait for the confirmation. Cranswick, again, Cranswick. The lows here were that 786. I've ignored the spike, and I didn't get in there at all. I wait. There was the doji, and then there was a lovely hammer candle here, and I bought in just there with a stop loss down here, and I'm still in. And I did this the day before yesterday. It's now pushing at this level. I think Cranswick's got plenty of upside. It's had 1, 2, 3 goes at the £24 level. Normally breaks on the 4th. Okay, so I'm positive on Cranswick. Great little company. Royal Dutch Shell. That's an area to be short of the market. This is a weekly chart. This is a couple of years. There were some great shorts here. That was a lovely evening star just there. That was a great short into that low. But then it goes up, the moving averages cross, and then it pulls back. And we get 2 dojis here. We get an up candle, and away you go. Now, I'm waiting, and I think the level's going to be here, folks. So I'm going to be tempted at a confluence between somewhere down around here. I'm going to be tempted to buy into Royal Dutch Shell. Okay. I'm waiting. It's a weekly methodology, so you wait. Randgold Resources is one of my best trades this year. Comes up, comes back into the zone. We get an outside week. Where she goes. I'm waiting. Where's it going to come to? Without a doubt here. I'm bullish of gold. I'm actually short of the gold market at the moment. I'm short of bullion, but I think that it'll pull back to that level, and I would be tempted to buy a little bit there and add to that. You can wait for the reversal candle if you wish, but now I'm in waiting mode. We have a lovely lady who runs our London user group called Susan Thornborough, and she says, what do you do when you're waiting? There's no doubt that because this is a weekly methodology you can get a little bit bored at it, but it's incredibly profitable and relatively easy to run. There was the 2 targets. That was the first target. That was the second target for Randgold Resources and selling into that. Admiral. I called Admiral on Tip TV with Zach. Some of you will know Zach Mayer, a very fine man. And it pulled back into the zone. Fundamentals in Admiral, great. Again, the London stock market the underlying trend was up, and the short-term trend turned up. We got this big outside week, massive outside week, and it takes 1, 2, 3, 4, 5, all of this trading, and that was in fact a no-brainer to buy in just after the outside week, and it goes up the page quite nicely and makes its target quite nicely. Polymetal. Okay, this was difficult because it didn't quite get into the zone, and we got this nice big breakout candle here, and I took a chance on that, and it went well. There's another one, you can't miss this. This is a big outside week. Those weekly outside weeks rarely let you down, and then we got another one here as well. Okay, so a little bit more interpretation required there, but that moved. So here's my rules, folks. The good trade is a hard trade. The market's pulling back. It's pulling back into the zone. I fade the short-term trend in the direction of the long-term trend. Okay. So the long-term trend is defined by the 20 and the 40-week moving averages up, and I'm buying a pullback into that zone. I fade the short-term trend in the direction of the long-term trend in shares that are undervalued and growing their earnings strongly and safely. And when I'm at my best, I define the entry by fairly simple confluences between support and resistance and Fibonacci levels. And I place my entries where the masses place their stops, because that's where everybody else will be running away. Now, the secret. You've all waited a long time for the secret. Here's the secret. The secret to trading is not what you would think. When you're in a winning trade, become optimistic, and when you're in a losing trade, become fearful. I reckon the top 5% that make money think like this, but unfortunately the 95% that lose money think just the opposite. When they are winning, they become fearful of losing the gain and thus get out far too early. And in a loser, they become optimistic and give the trade more rope. Just think about that for a second. So the secret of success is to observe your thoughts, and when you're in a winning trade, become optimistic. Add to winners. When you're in a losing trade, run for cover. And the 95% of people who lose money get that completely arse about face. Please excuse the language, Simon. Guys, the VectorVest product is the only product in the world that puts together the fundamental position of a share with the technical position of a share with the technical position of the overall market. What I've tried to do in a very short time today is to try and show you how to integrate that all together. We're more than happy to offer you a 30-day trial of VectorVest UK and VectorVest USA, which includes full telephonic support 12 hours a day and full access to the VectorVest online university, which includes the Successful Investing Quick Start course. All of that is £5.95, and after that, if you wish to go ahead, VectorVest for both countries is invoiced at £39 per month. If you're interested, I can assure you that if you're in competitive markets and you're not making the type of money that you would like, then by taking a step back and integrating to making sure that you're trading only in the very, very, very best shares at the right time, you're going to find that your hit rate goes up significantly and the whole process becomes emotionally much more satisfying. So if you're interested in the 5-week trial, Simon has got the link that he'll post for you, vectorvest.co.uk/RTC. Am I correct there, Simon?
That's correct, David. Yes, I've posted it a few times in the chat box.
All right.
People always miss it, so they should get it. We'll follow it up with emails afterwards. I love that last slide that you've got about being optimistic when you're winning. I think it just sums everything up.
That's what it's all about. The losers, and the 95% of people who are losers think the wrong way. Okay, when they're in a winning trade, they are absolutely poop scared that, in fact, the 10 ticks or the 20 ticks that they've got are going to run away. And when they're, you've done it. We've all done it a million times. You've had a loser, and you say, give it another tick, give it another tick. We'll see what happens tomorrow. And so we become optimistic with losers, and we become fearful with winners. But it'll be. I do webcasts twice a month, and I do my best to try and keep everybody on the straight and narrow. We've got user groups all over the country, and we're building those user groups. But I think now it's time to go and see how Skulk Burger plays his first game for Scotsman.
Well, I wish you luck, but there's nothing scarier than a Scotsman with nothing to lose. So,
so I used to play with his father, Skulk Burger's father. Can you believe it? So I played competitive rugby. Well, I played rugby until I was 45. I played my last game when I was 45, and I've now got to the point where I can watch it again. For many years after stopping playing, watching it upset me because I was upset I wasn't on the field.
Right.
All right,
well,
Simon.
I'm looking forward to my February. I've got my tickets for Murrayfield for Scotland, Ireland.
Okay.
So I'm looking forward to that. David, thank you so much for joining us. And I know you've gone on a little bit longer, which was great because Alex Ong was delayed, so you filled in that time. But thank you. You've given us a lot more than we normally get. The links are all posted. We'll follow these up. And doesn't leave me nothing else just to say enjoy your evening. I hope the game's good.
Cheers, Simon. God bless. I'll see you around, mate. Bye-bye now.
Bye-bye for now.
Bye.
Thank you very much. David Paul there from VectorVest, and we are going to move right along to Alex Ong, who is in the room already, a little bit later than previously scheduled, but delighted he's here now, so we will go straight over to Alex and say good evening, Alex. Can you hear me okay?
I can indeed. How are you, Simon?
Very well, thank you, very well indeed. It's been a super day today. We've had a very lively audience and lots of great. So it surprised me actually because I wondered that August may have been a tricky month, but it's been a fantastic event. Lots of new faces, some new products to look at, and of course this is why we're pleased that you're here tonight, because I know when we met in London a few months ago, you told me about a new product that you were launching with Nikki, so it's great to have you join us, and maybe you can tell us a little bit about that.
Yes, I'd love to. Could I share my screen? Is that okay?
Doing that as we speak. You should have now.
Hold on, let's see. Let's make sure it gets the correct screen. Can you see a presentation in front of you?
There we are. Yep, the money file, leveling the playing field for the retail trader.
Yes, indeed. So shall I just...
Wonderful.
You've got somebody that's due to come on in about 35 minutes' time, so I won't sort of waste too much time. First of all, everybody, thank you very much for waiting. The problem was that I didn't think about the air show that's going on in Clacton at the moment, and at the time we were due to be on, we had the red arrows flying over the top, so you probably wouldn't have been able to hear anything, which wouldn't have been the best. But anyway, so we're here to, it's a little bit different one today. We're not going to teach you anything as such. We're here to talk to you about a service that we've had a lot of people ask us for, over the years of us delivering education. That's for some sort of like a signal service where they can follow along with our trades and they can, sort of trade what we're trading. And we spent a lot of time going back and forth on whether it was the right thing to do, whether we could do it from a regulation perspective. And eventually we've come up with a format which we want to present to you today and basically just sort of get your feedback, see what you think, see how you think it could be improved, as it's something that's not released yet, but it's something that we will be releasing in sort of September, October time. So it'll be good to get your feedback anyway. So the money file, leveling the playing field for the retail trader. So if I ask a very quick question, well, let me, first of all, before we go there, to get the most out of today, I'm sure Simon's mentioned this to you already, but if you kind of make sure that you're not typing any emails or listening to your phone or anything like that, and just focus for the next 35 minutes, that'd be much appreciated. And if you have any questions, please save them to the end. This presentation will take like 10-15 minutes. Then we can answer any questions that you'll have about the service. So, first question for you, though, from myself. If you were given, a constant stream of well-thought-out, actionable trade ideas with a solid fundamental and technical drivers, do you think that you could be more successful than you are now? And I know that there's going to be a few people that they'll probably say, no, I can't be successful no matter what. I give up on this trading game. But I hope a few of you would turn around and say yes there. Well, did you know that the major institutions have teams of analysts, both internal and external, whose only focus is actually to present these ideas to their traders? My brother and I are lucky enough that we went to school with a bunch of people who are now working for hedge funds, banks, and all of that kind of good stuff. So we know firsthand that this is what goes on. So you have the analysts, you have the traders, and the analysts present the traders. They also not sell their ideas, they present their ideas to other institutions. So the big players always have a constant stream of trading ideas coming to them, and they can basically pick and choose what it is that they feel sort of fulfills their portfolio the best and what sort of fits in with their strategy the best. Okay? So with this in mind, it's perhaps not so surprising that the retail traders generally fare quite badly when going up against the professionals, right? Because the professionals, they not only have the traders who have got a hell of a lot more training than you guys will, but they've also got teams of analysts presenting them with ideas, like, as I said, well thought out ideas, things that they've been sort of looking into for a great deal of time and researching. They'll be presenting the traders with them. And then the traders, they basically just need to take them and pick and choose which ones, as I said, fits best with their strategy, best with their portfolio, and they kind of plug them in. Well, Traders Corner, we're hoping with this service to change that dynamic. And we're going to do that with something called the Money File. The Money File is a weekly report, all right, with actionable trade ideas and market analysis. What we will do is we'll analyze the data, we'll break it down, and present potential opportunities for you. All right, and when I say we're going to be analyzing the data, for those of you that know us, you'll know that my brother and I are quite different. So what you're going to get from us is the best of both worlds. My brother, from a fundamental perspective, is an absolute genius. He can put together some fantastic trade ideas. And what I enjoy the most is looking at the technical setups and the triggers for the trades. So with this service here, what we will be doing is Nicky will be looking at the fundamental drivers. He'll be looking at, from a top-down perspective, what makes the most sense in terms of where do you put your money, all right? Rather than saying, I'm only just going to trade Forex, for example, or I only trade gold or whatever it is, he'll be looking across all markets and figuring out where is the best place to put your money, where are you going to get the biggest bang for your buck in the shortest amount of time. And then what I'll do is I'll take those ideas and I'll look at the technical setup, I'll look at the chart picture and say, okay, so if we want to be long gold, for example, this is where it's most likely to go. This is where you're most likely to get into a position without the market going against you for too long. Because as retail traders, no one wants that, right? You want to get straight into a trade and you want it to be, making you money almost from the off. So ultimately, we want the Money File to take on the role of the analyst that the hedge fund traders benefit from, and we want to give that to you guys. See, the professional traders at the banks and hedge funds, as I said, they have teams of analysts going through the data and offering their ideas to the traders. The retail traders, they don't have this benefit. But hopefully through the Money File, and us taking on the role of the analyst for you, the retail traders, we'll be able to change that dynamic. Okay, as I said, we will analyze all of the data, more accurately. I'll analyze some of it. My brother will analyze all of the data. He'll go through every different marketplace and figure out where is the best place for you to be able to put your money. The objective of the Money File is to draw your attention to potential trade ideas. Now, like the traders and the large institutions, when they get presented with ideas, they can choose to take these ideas or they can choose to ignore them. If you fundamentally disagree with it, that's absolutely fine. What we're doing is that we're just presenting you with ideas and opportunities. Okay, that's ultimately what this is all about. It's not saying you must take this trade, it's just saying this is what we're looking to trade, this is why we're looking to trade it. And that's where it differs to, you know, the general signal services out there. The signal services will kind of just be buy here, sell here, good luck, all the best. And you don't really learn anything. You know, if you're lucky enough to find a signal service that makes money, great. But when they decide to sort of like close down shop, you're kind of left with nowhere else to go. Whereas with this service here, we're giving you the reasoning behind every single opportunity that we present you with. Okay, then you go into it, you look at it, and you think whether or not it's right for you, and you start to understand it, and you kind of start to learn through osmosis as well. You see, fundamental analysis is often overlooked by the retail traders. Okay, and it's not surprising. You know, the sheer volume of data makes fundamental analysis a very, very daunting prospect for most retail traders. You know, most don't know what's important to look at, so you'll probably be looking at the lagging indicators as opposed to the leading indicators. And those that do know what's important don't really understand why and necessarily understand how to use that information to develop trade ideas. And that's what we're going to give you with the money file. So I'll go through a few very quick examples. And these are things that we've sent out to our Less to Our Mentor program over the past few months. But this will give you an idea of the kind of ideas that we'll be presenting you with. The format will change slightly to make it obviously more educational so that you can really learn from it. But understand that these ideas went out to our mentor students who understand the way we trade already. All right? So the first example is one with the CAD yen. So back on the 3rd of June, we sent out an email saying we've got a bearish bias on the Canadian dollar, Japanese yen. Our base case scenario is for the deterioration in the CAD data to be, so that says counter, to be supported by a dovish statement from the Bank of Canada. Okay, which we do not believe, the market has priced in yet. And basically what was going on back then, okay, and I'll take you to the charts in a minute, is there was a lot of negative data coming out of Canada, right? But the Bank of Canada was kind of neutral in their stance. They weren't particularly negative about anything, right? So we kind of thought that when eventually they do get to that point, because the market isn't pricing this in yet, that there'll be quite a lot of downside potential for us. Okay, obviously the risk to the trade is there were rising oil prices at the time, and obviously the Bank of Japan stimulus, which they weren't really holding up to their side of the bargain at the time anyway. So this is the data that we were looking at that kind of brought us to this idea. Okay, as you can see there, March, April, May, June, all of the data out of Canada was really turning quite negative. All right, the chart where we highlighted it, you can see that there's a trend line in there, good old technical analysis. We kind of saw that if we broke the trend line there, broke that structure level as well, we would see further downside in the CAD yen. And sure enough, that's where the market went. Now, I say sure enough, that I shouldn't really have used that word, because there are going to be ideas that we present that will not make money. Absolutely, that's going to be the case. Okay, but over the long run, all right, our ideas over the past, how old am I now, 12 years-ish, okay, they've proved to be profitable, they've proved to be successful. So if you manage your account properly, okay, and you don't take obscene risks, and you don't completely go against everything that we're saying, then you should come out ahead of the game, and you should also learn something whilst you're following these trade ideas as well. Another trade example in a completely different area, so just to show you that there is a lot of breadth here, was one in an ETF. Now we noticed that the gold miners, which GDX ETF trades with a correlation to gold prices, the GLD, all right, ETF, And what was happening is at the time was that GDX was looking to test a recent high. And what we were saying is if we get a successful break of that particular high, we would be looking for GLD to follow suit. Okay? From a technical perspective, GLD was in a period of consolidation after a rally in the early year risk-off environment. Okay? Now, considering our view that the rebound in commodities and the risk appetite would not be sustained, we kind of saw that the flight to safety was a bit of an obvious trade and would support our idea. So if you take a look at this chart here, the orange one is GDX, the blue one is GLD. You can see that this here is when we sent out the email to our members. That box there, that highlighted box in sort of reddy pink, if you like, is that same moment in time, and that's where the market's gone since then. Okay, now I'm not doing this to brag or anything like that. What I'm trying to do is give you an indication of the type of analysis and the type of markets that you can expect, okay, to be trading if you sort of look into our service and if you're interested in our service. So coming back to Forex, another opportunity that we talked about was long euro pound. Now I guess this one there wasn't any genius behind this one at all, because everybody's probably erring on the side of caution with this as well at the time. But basically, back in April, we said that we favour buying pullbacks in the euro pound because the uncertainty around the UK Brexit situation will likely weigh on the pound heading into the EU referendum. The economic and political risks that comes with a potential Brexit, okay, will bring added volatility and investment fragility. For this reason, we expect the pound to remain under pressure. Okay, the euro has stabilized after Mario Draghi failed to jawbone the euro lower, preferring to wait and see what the impact of the stimulus efforts were before rocking the boat. Okay, so basically what we were saying there is that Mario Draghi failed to kind of, when we say jawbone, was saying come out with statements that would make traders feel that they were going to do something to intervene in the markets, thereby pushing the markets lower without them actually having to do anything. All right, the technical picture was also supportive. Right, and we'll go over to the technical picture now. So the technical picture, you can see that you've got a sort of like a reversal pattern. You could almost, if you squint, call that a head and shoulders at the bottom there. And the market just broke out above structure, which is what we like to see. Going on, we all know what happened from there. The market then shot up and has continued to go up ever since. Finally, and this is a trade idea that we're looking at currently. So the other ones were ones in the past, have already gone. This one is one that is sort of on the table right now. Now, before I go into this is not investment advice, okay? We're literally just showing you a service that we're looking to release in September, October. We're not telling you to go and take this trade in any way whatsoever. So the example is the transportation industry. What we do when we're doing some of our analysis is that we look at various different reports, one of them being the ISM, and the transportation industry has turned up as being a very, very negative industry over the past over the past year really, and it's been a leader in terms of it being negative over the past 6-7 months, all right? And in this particular month's report, so in August reports, there was also a supportive statement saying demand and industry production are both slowing down, all right? And we'd like to see that. So even though the report is telling us that it's a negative industry to start with, we like to see supportive statements as well, which is what we got there. And then what we do for you, so going beyond the reports themselves. So a lot of people, as we said, even if they understand a little bit about fundamentals, they don't really understand how to put them into a trade idea. So then what we do is we go a little bit further. And we looked at, in this case here, we look at some of the other indexes. So we looked at the Total Transportation Services Index. All right, now as it says, this index represents a combination of both freight and passenger services, okay, across a whole wide range of different industries. So railways, passenger rail, air transportation, okay, so it's pretty wide reaching. And again, year on year, you can see the percentage change is flirting with negative territory. All right, so if you look at that from a charting perspective, that kind of supports what the ISM is saying. Now, this trade currently is not making money. So this ratio right now, the transportation ETF is actually outperforming the S&P 500. So at the moment, it's not working, but we've got confidence in this particular trade idea, and we think that there is going to be further moves to the downside. Then we looked at, so when we're looking to take our trades, right, we look at hedging out our risk. So we don't just want to get into one trade and be naked and basically be at the will of the markets, if you like. We would like to make sure that whatever trade we take, we are always protected. So looking to take this trade here, we want to look for some sort of a hedge. And what we've done here is that we've looked at the ratio between the freight services and the passenger services and saw that the freight services have been outperforming the passenger services throughout the current business cycle. Okay, however, that's bottomed in January 2015 and looks to be showing signs of breaking out to the upside. So one idea that we could go with would be to look for a stock, okay, within the freight services, all right, and short that and go long within the passenger services with the theory that if the freight services has actually been outperforming the passenger services, it's probably got further to fall. All right, and obviously looking at this ratio, we can see that the dynamic is changing there as well. So, to wrap it all up, the money file is going to focus on finding opportunities that have the highest chance of success, okay, which means that the focus will not just be on one specific asset class. The approach will be a top-down approach with a short to medium-term view, allowing us to cover more markets and better opportunities than if we were going from bottom up. And for those of you that don't know what that means when I'm saying top-down, bottom-up, a top-down approach starts with the big picture. We use the big picture to try and guide us to the place where we believe the market is going to move, or to guide us to a market that we believe is going to move. Okay? And then once we find the market, we isolate some markets, then we go and we look into some of the more fundamentals of that market. Then if we think that that works out, then we look at the technical picture. So we can cover a whole heap more different markets and industries than if we were doing it from a bottom-up perspective. So if you were from a bottom-up, if you were to just go and pick a stock, for example, there are like billions of stocks out there. You know, so it will take you forever and a day to be able to find the right one. And that's why our approach is a sensible approach if you have a small team doing things. Now, there will be losing trades. Of course, there will be losing trades. But over the long run, these ideas will put you in positive territory. You don't need to take every trade. Okay. In fact, you should actually use the service as a utility to complement the rest of your trading and investment strategies. So you don't follow what we're talking about blindly. That's not the point of this. We're providing you the trade ideas and the analysis. You then need to go away and take a look, all right, at what you believe fits into your particular portfolio the best and what sort of marries up with your strategy the best. And then you take the trades accordingly. So Traders Corner are going to change this dynamic and level the playing field for the retail trader. And we're going to do this in September, late September, early October. If you're interested, I've posted a link here, and I wonder if Simon could probably post it in the chat box as well, where you can put your name down on the, just sort of declare your interest. So we will then let you know as soon as this service is ready to be launched. Okay? So, whew, almost as fast as the red arrows that were going by earlier. Are there any questions at all?
Hi, Alex. Fantastic. It looks very, very good indeed. I know you gave me a sneak peek in the Starbucks in June, but it's great to see it taking shape. It's September. Is it the sort of the live date?
Yeah, so it's September/October. There are still a few things that we need to clear up. We're working through some suggestions with some of our current members because we want to make sure that, you know, it's not too sort of like there's not too much industry speak that that nobody understands. It needs to be something that every retail trader on the planet can pick up, understand, and go and do something with. If we kind of too technical in the approach and too technical in the way that we present it, then we feel like there won't be enough value there. And the point of this is that this will be a utility that anybody can use.
So for the moment, this is a free opportunity to sort of register for the beta version of the service and run it free for a few weeks or a month and provide some feedback.
Yes, indeed.
Excellent, fantastic. Well, hopefully, plenty of people will be doing that and signing up. No questions on it, I'm afraid. I think you've obviously explained it completely well and very clearly. It hasn't sparked any.
No, they've all been like, someone pushing a service.
Don't take that as a signal, but it sounds very, very, very good indeed.
No, that's fine.
There we are. Just as we say that, of course, Gordon, thank you for asking a question. This will replace. Gordon says, will this replace your weekly Forex focus?
No, it will be more in depth than the Forex focus. So the Forex focus is obviously just 2 or 3 currency pairs every week, and we'll continue to do that. But this is a much more sort of like in-depth analysis report that will come out every single week. So there's a whole heap more information contained within this than there is the Forex focus, and there's a lot more explanation as well behind the trading ideas than we have in the Forex focus.
Okay. We've got questions from, thanks, Scott. Questions from Lyle Chan, I think, I'm not sure I'm pronouncing that correctly. Please share some trades which we can currently trade. Is the GLD trade still valid? When do we take profits?
No, unfortunately, I can't. We shared the little one on the transportation sector at the end there. The one thing that I should possibly say actually is that we can't tell you exactly. We can't just say trade this, take this one trade. Okay, so that's one of the things from a regulatory perspective that we had to contend with. If we present people with just one trade, we're giving them investment advice. We're saying you must take this trade. This is the only one there is. Whereas if you present people with an array of different opportunities, then you're providing them a person with information as opposed to providing them with specific investment advice. Does that make sense?
Well, it does to me, yes, of course, because we had all this with VertiVest going through. That's why they're regulated now. So similar circumstances.
Indeed.
Yeah. Fantastic. So, Lao Chan, we can't answer that specifically for you. Well, it's fantastic. Well, perhaps the best thing to do is for us to, we will promote that link to everybody that's here, everybody that's been here. That's a good question. David is asking, what will the likely cost be when it does launch?
So, from a costing perspective, we have looked into that, and we're looking at other sort of providers, and we kind of figure there are going to be different levels. So, you know, if you're somebody that just wants to come and do it on like a month-by-month basis, like you might get it one month and not the next, then it will probably be it will be a higher price, somewhere around maybe the £100 mark, if you just want it as a one-off. Whereas if you're committing to us and us committing to you over a longer period of time, then obviously there'll be substantial discounts upon that.
Excellent. Well, stay tuned. Watch this space, because I'm sure as soon as all these things are firmed up, we'll be able to let you know the details of where to go to subscribe. But certainly, it's a good opportunity to get in at the start and take advantage of a few sort of complimentary weeks during the beta testing. So use that link that we posted. It's the bit.ly link has been posted in the chat box there.
Absolutely.
Any other events? Big webinars?
No, we're very much looking forward to your live event, which I think everybody's down to.
Thank you. Yeah, that's great.
Give away the secret there.
No, not at all. I want to shout it from the skies. We're doing a live event. For anybody that missed that, talked about this earlier on. We are doing Round the Clock Trader Live, which is a live version of Round the Clock Trader, if that makes sense. We've booked out. It's a very deep. We've booked the Grand Connaught Rooms in central London for Saturday, the 5th of November, and we have 5 seminar areas, a little exhibition area. It's not a big exhibition. This is a training event, and we're hoping to invite and have almost as many as we can, realistically, who have spoken on the Round the Clock Trader webinars, attend in person. I think if you're in the British Isles, I hope you can be there. And I think, Alex, you've already earmarked it in your diary for the 5th of November, so that's fantastic news. And we'll work out your particular speaking times and things in due course. But
yeah, no, at all. It's going to be really cool, guys. So try and get down there.
It will be. It'll be fantastic. Well, I think if there's nothing else, no other questions that come in just now, we could probably wrap up and let you go, and we'll look forward to hearing from you again, perhaps when you do get the service launched.
Yes, indeed.
We'll keep in touch and get you back to show some of it in action.
Thank you very much. Thank you, everybody, for having me this afternoon. Sorry about the red arrows. It was hazy here, so there wasn't much of a display anyway.
Did you see anything?
Yeah. A little bit, but not too much. But thank you very much for bearing with me anyway. It's much appreciated.
It's been our pleasure, Alex. Thank you again for coming on. We really appreciate it.
Take care, guys. Bye-bye.
Bye-bye for now.
Bye.
Okay, well, thank you, Alex Ong from Traders Corner. Very interesting to see the service they're launching. I'm sure it's going to be a big success. The money file, go ahead and register for that beta testing period over the next couple of months, and let us know how you get on with that. So we're just about 5 minutes away from our 10th speaker. I think it must be Alex Spiroglu from Traders Training and Development. Slightly later than previously scheduled time slot, but we're pleased Alex is still able to join us here. So he'll be starting in just another few minutes' time. Just to confirm, this is Round the Clock Trader, and this is Simon Campbell from London Investment Week, your hosts for the day. It's good to have you here, and if you've missed anything throughout the day, don't fear, because we have been recording all these sessions, fabulous live sessions we've had today, highlighting a number of different trading systems and indicators and trading styles, so you can review them over the weekend as we send out the link to the recordings to you tomorrow, as we will send a reminder of all these special links for the various special offers and that. And they'll all come in an email tomorrow from me. So just keep a check on the inbox from there. So I hope it's still good. We're still live now. As I say, another Alex is just about to start in a few minutes' time. Thereafter, Alex, we go over to Philip Conchar from TraderCast at 7 p.m. and our final speaker, David Warner, one of the instructors from Online Trading Academy in the US, will round us off with a presentation on how to trade Forex like a fund manager. So all good stuff. I hope you've been enjoying the presentation today. Gordon, no problem at all. You kind of understand the time difference. Enjoy the rest of your holiday. For joining us during your holiday. Gordon's on the other side of the world at the moment, so really appreciate it. Incidentally, one or two of you have been suggesting speakers to me that we haven't had yet on the show. We've been doing Round the Clock Trader now for over 2 years, and we have featured many speakers. I think 70 plus traders have taken part in these presentations. Of course, we do have regulars that I call up come and join us and update us, but we try to feature as many new traders and educators as we can. So if you do know someone that's not, you haven't seen them on the schedule and you think they would be a good fit for this event, please do try and put me in touch with them. I know a lot of people, but of course it's such a huge industry. Even the amount of people I reach to is only a tiny proportion. So any help, any recommendations, it's always the best recommendation of someone that you've enjoyed listening to or learned something from in the past. Please just put them in touch with me. You can reply to any one of these emails that you receive from London Investment Week or from me personally. I'll get them all. They'll all come into the same inbox, as it were. So that would help to keep it fun. And if there's any particular subjects equally that you feel we haven't touched on, something that you feel we should be focusing on, highlighting, looking for some guidance on, please do just drop me a line, get in touch, or we can go to the Round the Clock Trader Facebook page. We will be able to share some of these ideas as well. So just a couple of minutes away from our next speaker, Alex Spiriglou. I will go across to Alex now and see if we can bring him in and do the screen share. So Alex, good afternoon. It's Simon. How are you?
Hello?
Okay. Hello, Alex. It's Simon here.
Yeah,
can you hear me okay?
Yes, I would assume you can hear me.
I can hear you loud and clear, which is
fantastic.
fantastic.
That's
great.
All right, thank you. First of all, I would like to thank you for your invitation to your great event. It really is a privilege to be here, and I know how much work it takes to organize the whole event, and that's why it gets such a good response from the trading community.
Fabulous.
Also, I would like to thank you for rescheduling my presentation, because I was supposed to do it in the morning, but I made a mistake. I was traveling in the day, and I had to ask you to reschedule. I don't know if I've caused any kind of trouble. In any case, I'm taking a 2-month holiday, so I've been traveling quite a bit this past few weeks.
Fantastic. Well, we're pleased to have you, Alex. Even later than scheduled, doesn't matter. You always present a fascinating presentation on trading psychology, and you're alone actually in today's schedule, today's agenda for the trading psychology topic. You are the only speaker to be really touching on this today. So we're looking forward to that. Let me do the screen share, and we can go over and have a look. If you're ready for your presentation, you should have the command prompt.
Yep, show my screen. Perfect. Can you see my screen now?
Yes, I can see Legends and Lessons. Fabulous.
Perfect. All right.
Before we get going, can I ask everybody else that's in the webinar to use the chat box again to put a little Y in to let me know that you are hearing both myself and Alex, and that you can see the first slide. Wonderful, great. Okay, all systems go just as we turn 6 o'clock exactly. So, Alex Spiriglou from Trader Development Systems, I will hand over to you for your presentation. Thank you.
All right, great. Okay, let's begin. I'm sure a lot of people today have presented on trading techniques and trading methodologies and tips and tricks of the trade, which is all good and useful. But to my presentation, I think it's going to be different in the sense that I'm not going to be going into techniques yet. I'll be holding another event for that. But what I'll be going into is learning how to learn, and what are the the things you have to learn in order to become profitable without going into trading in systems. Now, before I go on with the rest of the presentation, I'd like to say one thing. At the end of the, for those that stay up, don't get bored and stay at the end of the presentation or don't fall asleep, I have a few gifts for you, quite a few actually. I have 4 free webinars, which recorded ones on entries, exits, psychology of trading, and which I will be giving in for free. I think the total running time of these is about 3 to 4 hours, and I'll be giving this away for free for as a thank you for people's attendance. And also, I've started a new product called the Cross Asset Strategy. Basically, it's a weekly research letter where I write my views on the market, on global asset classes like equities, forex, bonds, and commodities. And I do this on video. And so if anyone stays, they'll be getting that as well. They'll have to basically email me and I'll send them the material. So it's 4 webinars, 2 issues of the Cross Asset Strategy letter, the video actually, and also an invitation to a live 4-hour workshop in London. I'm in the process of setting this date, but all I know is that it's in the middle of September. I haven't got an exact date because I'm waiting to hear back from the venue. But you'll be getting all these gifts for a small thank you for staying awake up until the end of the presentation. So without further ado, let's proceed with the presentation. The title, Legends and Lessons, Things I Have Learned from 18 years of trading and from the greatest technicians in the world. A common, actually the most common question I get from people I hear is, what do I have to learn so I can trade? Some people come with already preconceived notions of what people should learn. For example, I should learn technical analysis, or I should learn fundamental analysis, or I should learn about Fibonacci or Gann or this and that. They already have some kind of an idea of, they heard from a friend, from a broker, read it on the newspaper or a magazine. But so what is it my suggestion people learn in order to they study in order to learn how to trade? Well, I ask people to start from this. No technical analysis book, no fundamental analysis book, but an academic paper called The Cross-Section of Speculator Skill. That's the first thing I want people to learn. And what is this academic paper about? It's actually written by Dr. Barber and Dr. Terence O'D from Berkeley School of Business in the United States. And have people heard of the adage that 90% of traders lose? Or, well, this is exactly the point of the study. What they did is they did research of 360,000 traders over a 15-year period, and they studied their performance. So this is what they found. 87% lose money, net of fees. Only 0.28, 1 in 36, 360 are able to make money year after year. So the figure, the common statistic that 90% of traders lose, it's actually true. 80% actually lose money, net of fees. This was, like I mentioned, so a 15-year period over 360,000 day traders. But in my opinion, in my experience, I think the things are much worse than this. Because what I found was what I call the rule of 90. The rule of 90 says that 90% of traders lose 90% of their portfolio in 90 days, especially the ones involved in leveraged investments such as Forex or CFDs or spread betting. So not just that they will lose, but they will lose a huge amount, 90% of the portfolio, and also in 90 days, in a very short period of time. But I think it gets even worse than that, because 10% of them will even go bankrupt. 10% of these out of that 90%, because they will lose a lot more than their capital. And unfortunately, it's even worse than that, because I have a lawyer friend of mine who tells me that the trading community has one of the highest divorce rates in the country. And I think it's totally explainable, because if a lot of people go wandering into the jungle of trading unprepared and they lose money, that causes financial trouble, and that translates into family trouble as well. So although there is a lot of benefits to trading, and the risks, if you try to do it without knowing the full risks, are huge. So why bother? The next question is why bother learning about the rule of 90? I mean, why not go straight into the market wizards and the really successful traders and the super hedge fund managers, and do this and that, and why study losers? And the main reason is that foolish people don't learn from their mistakes, and I think no one can succeed unless they fail first, and but foolish people don't learn from their mistakes. Another reason is that clever people learn from their own mistakes. Learning it's an integral process, and we can only learn if we make mistakes and we learn from them, but we keep them up to a certain point. But I think it's wise if we learn from other people's mistakes. It's a sign of wisdom, not just learning from our own mistakes, but from other people's mistakes. So it's quite important to learn what people do. But there is another reason. The reason is because trading strategies, for example, are individual to each one's character. Some may like to do trend following, some may like to do trade pullbacks, some may do high frequency, others may like to do fundamental trading. And these all are circulated around our own character. But there's a big difference in trying to learn what's good for you, but also learning what is bad for you in terms of your mistakes. Because what I found is that although there are many trading styles, the type of mistakes that traders do are much fewer, so easier to learn. So it's a more finite universe to learn from, the mistakes we can learn to do. All right. Here's a photo of I don't know if people have seen me before present, for the past few years I've been chairing the Market Technicians Association. The Market Technicians Association is the largest technical analysis society globally. We have a chapter in the UK, which we do presentations every month. These presentations come from members of the institutional investor community. We have hedge fund managers, bank managers, analysts that come and present their own trading views and trading techniques. And I've been chairing the UK chapter for the past 6-7 years now. And through that experience, I was lucky enough to meet probably the greatest traders in the world. For example, people like on the left here, Mr. John Bollinger, or on the right, Tom DeMark, who's technician to probably one of the greatest traders in the world, Steve Cohen, and Linda Raschke, who is the renowned author of Street Smarts and also was a part of the Market Wizards book, or Martin Prink, and many others, hugely, probably the best and the brightest in the technical analysis community. And the thing is, but what does have to do? What does this have to do with our own situation of learning how to trade? Well, I think it has to do a lot, because having, like I mentioned, met truly the greatest technicians on the face of this planet, I've noticed quite a few things, and I've been knowing them for some years now. First of all, what struck me as quite something that made them quite a bit of an impression on me was that each one had their own techniques. Each one had their own trading style that fit their own character. For example, Linda was quite short-term technical. Martin Prink was long-term fundamental terms, like in the sense that he was using intermarket analysis quite a bit. So each person has their own techniques, their own strategies, and their own approach and philosophy to markets, but all of them managed to be successful. So I thought, this is quite interesting, because they're not doing the same thing, but they share the same amount of success. I also noticed that they all shared some other common characteristics. For example, they had working ethics. They were very passionate about what they were doing. And but also another thing that I noticed that was common among them was that they had discipline and confidence. Each one was very disciplined in their approach, and they're also very, very confident, although it was a completely different technique to someone else's. So I wondered, is this thing, are these two features, discipline and confidence, these two virtues, shall I call them, transferable? Are they teachable? Can you take someone and, if they're willing to do the work, learn how to be confident and disciplined? Because I think these are the two main problems with traders right now. I mean, I'm sure probably I would safe to say that probably at least half of the people on this presentation have a confidence problem in terms of like pulling the trigger, because after you've taken a few losing trades, I mean, you start doubting yourself. And so is this teachable? And in my view it is. And I think it's quite it can be done. And I created a model around it. It's called the Trader Development System. And basically, I systematized the way how people can learn how to trade in order to achieve these goals, confidence and discipline. And my initial idea of how to develop the system, the systematic process of becoming a trader and learning how to trade, was on a gentleman who was in the 1970s called Noel Bursch. What Mr. Bursch developed was the, I don't know if people have heard of it, it's called the levels of competence. Basically, Mr. Bursch said that, whatever you try to learn, it can be maths, music, sports, it doesn't really matter. We all go through the same 4 different levels of competence. The first level is the level of unconscious incompetence. Basically, we don't know that we don't know. And through trying and failing, then we go to the next level, which is the level of conscious incompetence. We still don't know, but we are aware of our ignorance. Now, through repeated practice, then we go to the next level, which is conscious competence, which means that we are not competent, but we're very deliberate about, we still have to think what the next move. And again, through repeated practice, we go through the fourth level, which is the level of unconscious competence. That's basically that, you're so good at what you're doing, it's become second nature. An example I usually give is like Michael Jordan. For example, when he was the famous basketball player, he was taking a last-second shot. He was trusted to take the buzzer beater, as it was called, and he was making that shot. But obviously, since it was like just a few seconds to take that shot, and he didn't have enough time to think, position himself properly. I mean, a lot of people from the other team knew that he would be taking that shot anyway, so everybody was like on him, and there was so much pressure. The whole stadium, like 40, 50, or 60,000 people were watching, so there was so much on him right now, and obviously there was no lack of time to think. But he actually, most of the times he was making that shot, but it wasn't. He was doing it because he had done it so many times. It's become second nature. So that's the level of unconscious competence. And I found that structure of learning how to trade was to learning how to learn. That by Noel Bursch quite intriguing, but there were quite a few pieces of the puzzle missing. First of all, I thought, okay, I'll adapt this for trading. Fair enough. But I thought there were a lot of pieces of the puzzle missing. First of all, you have the stages, right? Okay, fair enough. The second is, what are the necessary skills someone has to acquire to go from stage 1 to stage 2, from 2 to 3, and 3 to 4? That wasn't obviously mentioned. It was, of course, it was. Mr. Bursch didn't create this for trading, but I thought, if I truly want to apply this to trading, this framework, I must also take it to the next level and also include the skills. So, what are the skills that people have to learn? So, and this is my this pyramid is the 4 levels, the 4 stages, and each letter denotes the skills that someone has to learn in each stage. These form the acronym SMART, and these are actually 5 skills that people have to learn, because in each level we learn 1 skill, with the exception of the second stage when you learn 2 skills. So, 4 stages and 5 skills. But still, I wasn't satisfied with that as well. I also wanted to take it to the next level and say, okay, these are the skills, But what drives people to go from stage 1 to 2, from 2 to 3, and 3 to 4? What is the motivation? Okay, so what drives people? What's the inner psychology of this from at each stage? So I thought that was also an important integral part to add into the trader development system. And the next idea, or point of focus I had was, what are the results you get at stage 1, 2, 3, and 4? Because I'm sure people might want to reach stage 4, or might want to reach stage 3, but they may not. So what are the results will they get if they stayed at each particular one? And what are the problems that they will face in each stage? So without further ado, let's try to see the result of this work, and begin at stage 1. So what is the usual? So what I'll do is I'll present the usual mistakes that people do in each stage, and then also what they should be doing. So we've got both the rule of 90 group do, and then I'll be also having the market wizards that we saw before, the John Bollingers, the Tom DeMarks, and the other people, what they really do. I mean, how they work. So what is the motivation? On the left here, we've got the motivation. What's the motivation of people when they start to trade? The first motivation is to gamble. I think that's the main motivation when people want to learn, is to gamble, to make a quick rich, to become rich quickly. They're not interested in trading. Some people may say, "Oh, I have a passion for it," or I'm really interested in trading, and I want to be interested. And I think that's not quite true, not true to themselves, because it's like someone who walks into the gym and say, "Oh, I have a for the first time," and say, "Oh, I have a real passion. I'm really passionate about getting fit." And I don't think so. I mean, once you get on the treadmill and start sweating, and you see how hard it is, only then that sort of excitement will wear off. After having it done for a few years, then you can say that I'm really passionate about it. You're just excited at the idea, at the notion of having a beautiful body, of being fit, having the six-pack and everything. And this is exactly the same thing with trading. Initially, you're not interested in trading. You're just interested in the results of trading, which is money, freedom, or whatever trading means to each person. But so the primary interest for people at this stage is to gamble. So what happens? Well, they usually start sometimes, by and large, they think, oh, trading is exciting. They start with a notion that trading is like sex. I mean, you don't have to be good at it to enjoy it. So they usually, put a small deposit around, £500 or £1,000 or $2,000 or something like that, and they think, oh, I'll put that money in, and then I'll turn it into like $1 million. But that expectation is like over harvesting. Is like having a small plot of land, like one by one, expecting to live off it forever. But it's just basically over harvesting. You can't. Your capital is too small. So they go into the market, they open the account, they start trading that small amount of money, and they obviously they start losing, and they're losing again and again and again. That type of trading isn't really trading. It's just charity, because you're giving away your money, taking it from your pocket into your bank account, and then giving it to other people, the counterparties, and also the middlemen, the brokers, and the exchanges. Then they take it to the next level. They say, okay, I'll just put some more money in. I think this is what I call the too smart to trade phase, because people at this stage, their ego starts working. And they say, oh, I've been, especially for people that have enjoyed success in their life, like a doctor or a lawyer, or someone who's self-employed person, or someone who's like a successful businessman or an executive, and they think, oh, success is transferable, and I've done well in my profession, I'll do well in trading. Their ego, the pride comes in. But no, success is not transferable. Some skills are, but success is not. Just being successful in one profession does not mean that you will automatically be successful in trading. So they continue trading, and they continue throwing money into the market, and again continue with the charity. Then it might go into an addiction thing, because doing again and put some money in, and then continue with the charity trading and losing some more and then losing some more, and eventually it comes to the point where people have to deal with the fact that they've lost a lot of money. And there are two ways that people lose. So what they do here, the first way is to go into conspiracy theories, because they have to justify the result. I mean, the reality is right there. It's beaten them, and now they have to justify it. So they've got two things. As they say, traders, there are two types of traders: people who make excuses and people who make money. So the first type is people who make excuses. They go into conspiracy theories. Oh, the broker is after my money, the exchange is after my money, it's high frequency trading, it's because of this and that. There is some kind of excuse. And I'm saying excuse because you always hear people making excuses for when they losing trades, not for the winning trades. You will never ever hear someone say, oh, I thought the euro would go up, and but it was a silly trade because it was it wasn't trading with discipline. But I was lucky, and the market went my way, and God willing, I made some money. And you won't hear anyone say something like that. They won't make excuses and say, I made money by mistake, or I made money by someone else's. It wasn't due to me. It was luck. So it was good luck, but you always have the factor of luck, bad luck coming when it comes to losing. When it comes to winning, it's always their own skill. And so people go into the conspiracy theory thing, and from the rule of 90, the 90% of people who lose money, 50% end up here. They end up giving up. Now, you've got what people can do here is develop the first skill, which is self-awareness. Admit that people don't know and try to learn about self-awareness. So the first thing, you need self-awareness. So what does self-awareness mean? I've created a model called the GROW model. I teach a workshop which we go step by step one of these. Obviously, I don't, for lack of time, I won't be going into these, and it will be the point of the workshop we will be doing in September. Again, for the people that will invite me, we'll be going into details with this one. So what is the GROW model more? First of all is the goals. Then we look at the realities, the options, and the will. Goals is for what kind of a trader you want to be, what type of trading do you want to do. Realities, what are the four obstacles that people will be facing. We'll be going into each one of these one by one. Then we'll be looking into the options of how to bypass these obstacles. And then the will. Then we'll take a test and see how much of a will you have to go into trading, whether professionally or on a part-time basis. And this is the first step that people have to do to self-awareness. So what happens next? So if supposing some people drop and some people continue, they do go to the self-awareness phase. What's the next step? So what is the result? Sorry, the result is anger. People start feeling angry, and they feel angry because also they've made the self-awareness test. They feel angry because they've seen how silly they have acted in the first place. So what's the next step? They go into the stage 2. Stage 2 has 2 skills, so we'll be going into these with some detail. The level of motivation here is interested. Now people are getting interested in trading, and I say interested because they've been through some hardships and they know that it's hard, but they're getting interested. They want to learn more about it. So how does the interest translate to? Of course, let's first of all look what the losing traders do, and then what the winning traders should do. First of all, they switch time frames. They say, okay, I'm trading the 5-minute chart. Maybe this is too much for me, because I'm losing money, hand over fist, and I'm not quite sure I want to be going down that way. And so they usually take a time frame back, or they do a multiple time frame analysis and so forth. So they switch time frames. Obviously, that doesn't work, and because they're still not using correct techniques and things, and so they switch markets and they say, okay, I'll start trading from the Urals to the Canadian dollar, or I'll go to the cable, or to the DAX, or the FTSE, maybe, or crude oil. Maybe that will be more merciful to me. And then they continue trading, and the charity trading, and then they lose some more money. And what happens is they usually try to say switch products. Switch products, for example, I'll say, oh, I'll be trading Forex, and then they say, oh, Forex maybe is not for me, I'll trading shares, and they start, continue charity trading there and losing some more, and they say, oh, stocks is not for me, I'll do CFDs and binary options and so forth. They go from product to product and product up until they continue losing some more. And at this point, they get an aha moment, and they say, oh, maybe I can need some advice. So what they do, after having switched progress and markets and timeframes and things, and they go into a forum or a chat room, and they open up an account there, and they use a name like, I don't know, Galactic Trader 888 or 555 or something like that, and they start chatting with other people who have equally silly names, and they start exchanging views. The problem with that, of course, is that the other person you're asking to is equally as ignorant as the people making the questions themselves. It's like literally the blind leading the blind. It's just people who don't know. They're talking with themselves, and sometimes you'll find that the discussions get quite heated because they get personal on their position. Oh, I think the market will do this and that market will do that, and so it's like almost feels like it's discussions for politics or religion. But it just gets silly. It's literally the blind leading the blind, and people lose a lot of money, and they give up. Now, for the people that don't give up, what is the skill that they need? And the second skill that people need is market knowledge, and that M. That's the M out of the SMART acronym. The second is M, market knowledge. But what does market knowledge exactly mean? Again, this is the point of the things we'll be going into the details of the workshop. But this is what the four W's. The core 4 W's. First is the what, the technicals. What is the market doing? This is the first thing you have to learn. What is the market is factually doing? When I say 4 technicals, and this is subdivided into another 4, what I call the core 4 of technical analysis, which is trends, momentum, volatility, and relative strength. This is what no Ouija board techniques like Fibos and stuff and candlesticks, but the core fundamentals, the physics of finance. The second thing that people have to learn in terms of market knowledge is the who. Who is the commitment of traders report? First is what is the market doing, but then is who is the market, who is participating. The commitment of traders report, to just give you a brief synopsis, is a depiction of who holds the open interest in futures contracts and who's got, for example, the large positions in, for example, I don't know, crude oil. Is it commercials, or is it large speculators? Is it like hedge funds or the smart traders? Who has the biggest positions? And you can see that their data to show you what are the insiders buying and selling. The fourth W is the why. Why is that they doing what they're doing? Because markets move for reasons, and these are the fundamentals. Of course, you can get a shortcut into intermarket analysis. How the asset classes relate to each other, how interest rates affect the stock market, and how commodities affect interest rates and bonds and so forth. So, and then you've got the when. When is the sentiment? When is it too much? When people have an idea, they get into a trade, and they think the market should be going there, but everyone's piling up, and when is it too much? When sentiment is too much. I think these are the core 4 of market knowledge. What people should be focusing instead of Ouija board techniques and try to predict the future. These are as close to the realities of the market. So the first, so in this stage, the first skill people have to pick up is market knowledge. So what happens next? So if you've got market knowledge, does that mean it will make you a more profitable trader? Well, let's see what usually happens. Well, people, after having gone to forums and things, they say, okay, I'll need to pick up to learn some things, and what they usually do is they pick up an ebook. They say, okay, I want to learn some things, and they they usually go buy an ebook because it's cheap. They're sold for $10 or $15 or $30 or something like that, and they come with some ridiculously impressive titles. For example, learn the secret of the super hedge fund managers for $5.99, and obviously people learn, they buy it, and there's not information. Then they continue with their charity trading. And so what's the next trick? Well, they decide people to open up their budget a bit, and they go buy books, usually technical analysis books, and they open up their chart books and they learn about the RSIs, the MACDs, the stochastics, and this and that, and they start plotting things, and they end up having what are called Christmas tree charts, and because everything is there, and they usually end up having paralysis of analysis, and again they continue with the motive of charity trading. So what usually happens then? They say, okay, we'll open up our budget a bit more, and we'll go into seminars, and we'll we usually go to a weekend workshop on the magic method mystics, and you can learn about things like where the magic numbers stop markets 168, or how this market will stop at this level because the magic number stopped it, and so forth. Obviously they go and apply it, and they start trading again and again, and they lose again and again, up until the point where they said, okay, we had enough, we won't be trading on our own, and what we will be doing is maybe subscribe to an expert advisor, a signal service. Someone else can show us the way to riches, and they start following signals, a signal provider. They're actually trading themselves, so they've given up on that, but they continue losing. So what people should be doing at this instead, because obviously this is the way how traders lose, but how do traders win? What they need here is a trading process, a trading plan, because at the first stage, market knowledge, you're learning what the flour, the butter, and the milk is. Now, what you need is a trading process, you need a trading plan. And the difference between these two is at the trading knowledge, you're learning the ingredients. At the second, you're learning a recipe. You're learning how to collect everything together, because yes, you have learned the ingredients, but that doesn't mean you have a recipe. And so what does a recipe constitute of? Well, first of all, you have to learn things at a strategic level. Then you have to learn at strategic level of a trading plan is figuring out the markets you will be trading, the type of inputs you will be using, whether you'll be systematic or discretionary. Again, we'll be going into all these and much more in the September workshop. Then you go into the tactical part. Tactical means whether you will be, what kind of strategies, what type of strategies you will be using, because each one has its own risk-reward characteristics and types of drawdowns and things. And these will be picked based on your own character, because a trend following strategy is a much different beast than someone who's trading pullbacks. And then you go into the operational part. The operational part basically is the part where you are trading what's popular called as a trading setup. A setup is called, a trading strategy. A strategy is comprised of 4 parts. It's the setup, the selection of the market that you'll be trading. First of all, then the signal, then it's the size, the position sizing, and then it's your stop. So these are the 4 parts. So when people say, oh, show me a strategy, this actually means out of the trading process, it's just the operational part. So there's a whole lot more they're missing before that, and that's why just getting a strategy, doesn't make you profitable. And the 4th step is to do some backtesting, because yeah, you may have an idea and you think, if I do this and then do that, but will it work? It may sound good in your mind or my mind as well. So we have to do some verification, the backtesting. And these are the 4 stages of how to create a trading process. Let me make a small parenthesis here. A lot of people have the notion that if I get a trading setup or give me a trading strategy, and it will make me profitable. And if there is 1 or 2 things you may pick up out of this presentation, please note this down. Having a trading strategy will not make you profitable. Please let me repeat this. Having a trading strategy will not make you profitable. And it will not make you profitable for the same reason that buying a treadmill will not make you fit. There is no magic pill solution to trading and making money from the markets. You need something more. And this is where almost 90% of the traders finish up. Even if you have done the self-awareness, if you've got the market knowledge, and if you've got the trading process, you'll still be losing money. Even if you have a good trading setup, a good trading strategy, you will be still losing money. And this is the result people get at this stage: disappointment. They start asking why? Because I have a good strategy, or I have bought this one from XYZ, or I've learned this from this gentleman, or this and that. But why am I still losing money? Because you need to take it to the next level, the third level, and this, at the third and fourth level are the levels where people are getting profitable. First and second level of people are losing money. So what is the motivation of someone who becomes profitable and comes to the third stage? Well, commitment. And there is a big difference between being interested and being committed. In stage 2, people are interested. Let me give you a definition of what interested is. Interested is, I like trading. Oh, I'll pick up a technical analysis book, or I go to a seminar. This is what interested is all about. Committed is having the discipline and having the effort, the work ethic to take what you have learned and start practicing it. Putting it into practice, and then looking yourself in the mirror when you make the mistakes and trying to overcome disappointment, trying to overcome failure up until you get proficient. And that's commitment. That's the difference between committed and interested. And without trying to offend anyone on a personal basis, from the most people I've met, most of them are interested. They're not committed. They think that trading is the easy way to make money. It's a shortcut to laziness and getting rich quick, but they're not committed. And so what is commitment? What is the skill that people have to pick up to go to stage 3? The R skill. Well, R, let's first of all, R stands for repeat and review. First of all, you have to have to practice, and that is open a demo account. A demo account is, some people frown upon demo accounts because they see that, it's not the real thing, and it's not, like losing real money. And I would say, there is some truth to this argument, but the reply to that is, first of all, you've got 80% of the experience with 0% of the risk. And you need a safe environment to learn. For example, you've got flight simulator school for pilots. I mean, how would you feel if you went into an airplane and while you're going in, you had saw the pilot, holding up a book saying, learn how to fly a plane, weekend course, crash course. I mean, you wouldn't feel very safe in that airplane, would you? The same thing with a lawyer. They do mock exams, the mock trials, and with doctors, they operate on cadavers. So they've got their own sort of called demo accounts. So we've got the privilege of using a demo account to learn, again, in a safe environment. Again, it's 80% of the experience with 0% of the risk. Unfortunately, people are not, they get anxious, they get impatient, they just think you can't make money with the demo account, so won't be using it. And B, also, they've got a bit of a bad reputation because, unfortunately, they have been shoved down our throats by brokers as a marketing tool, because in order to lure people to make a deposit and say, okay, first open a demo account, and then after a while they call you up and they say, grow a pair, put some money in, and then start making some real trades. Unless you trade, you won't make money, and so forth. So demo accounts have been usually associated with like a broker marketing trick. But it's a genuine, if you know how to use it, and there are techniques to learn how to use demo accounts. Obviously, I know we don't have the time to go into that, but there are ways to learn how to do demo accounts. The thing is to monitor what you're doing, monitor your trades, and monitor with the what you've done on the demo account. That's a journal. Journal is the most important technical analysis book you will ever read. Believe me, there is so much information if you learn how to read it properly on what you were planning to do and what you are doing, and recording that. And it's like it's a perfect way to psychoanalyze yourself. Everything will show up there. And the third step is psychology. Now, trading psychology, if I was to define it mathematically, is psychology equals the difference between your trading journal and your demo and your trading plan. What you plan to do and what you actually did, the difference between these two is psychology. And let me, please allow me to make a small clarification here. A lot of people, when they are in stage 1, they say, oh, I'm losing because of my psychology. And I would beg to differ with that view. And the reason is because at stage 1 and stage 2, you don't know what you're doing. So you're losing because of ignorance, and that, of course, affects your psychology. But the primary source of losses is ignorance, is not psychology. At this stage, now it's a different ballgame, because now you know what you're doing, but you're not doing it correctly. So the difference between your knowledge and your lack of execution skills is psychology. Now it becomes a psychological game, but it comes at a later stage. You know, you're reading about the famous technical trading psychology books comes only after having learned about the trading techniques. It's something that I stress a lot in my training program, which I have for people that want to learn. First, I tell them first learn the strategies and then go into the psychology. It's not the other way around. So what's the fourth thing people have to learn is assistance. You know, they have to get a mentor. When I say a mentor, I mean someone to hold their hands, because you can't be both a patient and a doctor. You can't, see what you're doing yourself. Also because page 58 of the book will not tell you what you're doing wrong, and you need someone to help you there. It's like athletes do. So you do need a mentor, and make sure you find one that fits your own psychology, fits your own profile. It's a legitimate person, and not just a legitimate person, but also someone that you can feel that can relate to you in terms of your philosophy in life and markets as well. So this is the fourth skill people have to pick up. It's called repeat and review. So S for self-awareness, M for market knowledge, A for a trading process, and R for repeat and review. So that's the final. So that's the fourth stage and third stage and fourth skill. So what's the result of people having reached this stage? Discipline. And now is that you get discipline. Why is that you get discipline now? Because you get what is called repetition-based discipline. You do something. You have your knowledge, you have your trading plan, and you put it to practice. Supervised practice, because you go through the whole process, trading on a demo, recording it, analyzing it, and repeating. Repeat and review, over and over and over again, up until you get so comfortable with it. Now it's become part of, you're very familiar with it, and you start applying it correctly. Now you get discipline, because discipline stands on knowledge that has been repeated. You've done the mistakes, and you know what's coming to you, and now it's become, you have no fear, you have no doubts. Once fear and doubts are out of the way, because you've done the whole thing again and again, you know how to close your stops, you know how to close your positions, use stops, and you say, okay, if I do this wrong, I'll lose some money. If I make this right, I'll make more. So you've gone through the whole process, so you've got nothing to fear, you've got no more doubts. That creates discipline, because hesitation creates lack of discipline. So how do you get to the fourth stage? Well, how do you get to the fourth stage? I mean, you need the right type of commitment. And the right type of commitment is passionate. Now, people get passionate about trading, and they get passionate because they feel that it's no longer something that they want to be doing. For example, people in the third stage, where they're committed, they usually trade on a part-time basis. But here, people are passionate about it. When I say passionate, I mean they want to doing it for a full time. This is what they want to be doing. This is what would be their chosen vocation. Be doing it, on I wouldn't say a 24-hour basis, but they want to be spending the whole day, doing this on a full-time basis. People on the third stage want to be using it to create some extra income, but now they want to be trading for growth. People want to be doing it professionally. So what you have to do? What are the professional edges? What do people do at this stage? Well, this is what I call the elite edges. First of all, it's fusion analysis. Fusion analysis means creating trading systems that amalgamate technicals and fundamentals. I'll be going this very briefly, so I can open the room for some questions. The second thing is position sizing, because yes, you can only push your trading systems that much in terms of how much you can improve them by incorporating various aspects like technical analysis, like fundamental analysis, like behavioral finance, and so forth, you can really take it to the next level only through position sizing. Then the elite edge is diversification, because nothing lasts forever. I mean, you can have a very good trading system, a trading methodology, but eventually it may start losing, because the edge you're looking at is no longer there, and this is one of the reasons why people at this stage sometimes lose, because they become one-trick ponies. They have, we have a good strategy, and then it fails, and that's why you need the diversification. And diversification comes in three forms: either in time frames, I mean, trading the same methodology in the various time frames. You can diversify across markets. I mean, trading the same thing with crude and FTSE or the S&P. If it's a technical nature, or the best type of diversification is trading technique. So if you give different techniques, completely uncorrelated trading systems that blend their equity curves, that's the best form of diversification you can have. I mean, there's people who take it to the next level. I'm not doing on the super system myth, and that's another fallacy of people say, oh, these super traders, they trade the super system, they're super smart. No, they're not. I mean, they have good strategy, but that's it. The secret, if you will, and I'm giving you this for free, it's diversification. They use different good strategies who uncorrelated each other, and when one fails, the other one stands on its shoulders, on its two feet, and that's it. And the fourth elite edge is what I call a knowledge base, and having a thirst for knowledge and learning more and growing as a professional, and because that will only take it to the continue making you grow, having a knowledge base. So the T stands for transformation. It's transformation because you're transforming your mentality, transforming from, oh, I'll be using this trading setup, oh, I'll be using the XYZ oscillator, I'll be using this. No, you're transforming it. Now looking into the stuff that really matters, like fusion analysis, position sizing, and diversification. So what's the result here? The result you get is confidence, and that's how you get confident, because you've increased your repertoire, your knowledge has gone to the next level so much, you get confident. When I say confident, in an arrogant sort of way, and like, oh, I'm indestructible. No, you respect risks more because you've been there, you've lost money, you've done the whole thing, so you know what's going to go wrong. But you do confident because you feel that you're doing the work. You're not taking shortcuts, and you've got good methodologies. You know how to blend this together, so you feel confident. And that's how you reach the level of discipline and confidence. Before I finish off the presentation, let me say that people in stage 1 and stage 2 lose money, and that's the rule of 90 people. And the 10% club is the R and the T, the third and fourth stage. And let me make my my gifts, and I'll open up the floor for questions for the remaining 10 minutes. And if for anyone that emails me, contacts me, that's the email at the top of the page, alex@tradertd.com. If anyone contacts me at this email, I'll give them the following, the gifts. Again, these are for free. There's no, I'm not looking to sell anything on this webinar. First of all, it's the cross-asset strategy. I'm doing a video analysis of global asset classes and global markets. Equity indices, bonds, and commodities and forex, and you can see some of my techniques. And I don't go into too much depth, but you can see my what I'm trying to do and how I get trades. I post these on a weekly basis, so I'll send you 2 of these, and also send you 4 webinars for free. I think this is last 3 or 4 hours, and also I'll be doing a live workshop. I mentioned this. I'll be doing this on in September. So if anyone emails me, I'll get you on the list. I don't have an exact date. I think it's safe to say I'll be back in the UK on the 17th of September. So it's going to be shortly after that. I don't have an exact date because I'm still in Greece right now. I'm taking a 2-month holiday, and once I'm back, then I'll be doing the workshop. So I'll be opening up the floor for questions. And Simon, if you've got any questions, I'll be happy to take them now.
Hi, Alan. Thanks for that. Very good presentation. Okay, first of all, Ripple has a question that's been waiting for a while. He says, Alex, what is your advice when you are committed and have done all the steps to become successful, as you mentioned, but you still find that your trading is not consistent?
Well, the good thing is that, you know, if you're really committed and you're not doing it, then first of all, you have to retrace on your steps and see what's going on. First of all, I mean, have you done your self-awareness? And again, that's one of the things we'll be doing at the workshop. Because you're not just saying, oh, yes, I'm doing something wrong, but you have to, you know, really try to understand what you're doing wrong. The second step is see your market knowledge. Don't have the gentleman's information about, you know, what techniques they're using, and so what kind of market knowledge they're using, and then you go into the how you put this together. So even if he does have a strategy, we should, you know, try to back test it. First of all, see the what kind of what's the premise, you know, what are you trying to trade? Is it something viable? Because yes, you may have the commitment, I have no doubt about that, but maybe your strategy is at fault. The theory maybe should be tweaked, maybe we should be, you know, let's verify it basically. And once we've done that and we see that, you know, it does fly, I mean, theoretically it does fly, then we go into see not the strategy itself, but the execution of that, and then the psychology. So there's a whole lot of steps in between to go from step 1 and 2 and 3 and see what's wrong. The good thing is commitment, and there is the way out. But my suggestion is to go through the steps with a mentor, find someone you trust, and they can help you with it. Because like we mentioned, you can't be both patient and doctor. I mean, it's very difficult because if you have a strategy in your hand, obviously it looks good to you, but you know, you have to have some outside third party looking at it.
Okay, there we are. You mentioned a workshop. Ian's asked about the particulars of the workshop. You've mentioned a 2-day workshop or a day workshop that you're holding in September.
Yes, I'll be doing in, it's a 1-day workshop. I'll be doing in One Canada Square. I know all I know is the venue. I don't have the date. It's safe to say it's in the between 17th or 25th of September. All I know is the venue is the One Canada Square in Canary Wharf. But if you send me the email, I'll get people on the list and they can be divided. There is no cost for it, so there's no sales pitch. You can just join, and I'll be sharing a lot of my my knowledge with you. I mean, feel free to ask questions. I mean, if you go to my LinkedIn profile, I'm actually in the process of setting up my website as we speak. We should be should be ready in a few weeks. And but if you visit my LinkedIn profile, you'll find quite a few testimonials there about the workshop itself. It's, like I mentioned, it's free to attend.
Free to attend. It'll be probably 3rd week in September. And
yep. Yeah, correct. I don't have the exact date because, like I mentioned, I'm waiting for the dates. But all I know is the venue is the One Canada Square. But other than that, I mean, I'll be send me an email. I'll get you the details.
And equally, Alex, just let me know when you get the date confirmed.
Perfect. Okay. Any other questions? Simon? Hello, Simon? Hello? Hello?
Hello?
Hello, yes, I can hear you now.
Sorry, that's my fault. I had a very brief sort of computer crash there. Momentarily blacked out. I'm back now, so thank goodness. I won't touch anything else. I was about to say that, yes, if you let me know the details, I'll include these details on the Monday newsletter that we send out.
Perfect.
As well.
Yeah,
so
most definitely, and I'll be I'll be very happy if you of the people that can attend. And in the meantime, I'll share the webinars and the 2 video analysis letters. It's with my views on markets, because I think we are quite a bit of an inflection point on equities and bonds as well. And we've already got the top in bonds, and we have quite a few interesting developments coming up in equities and a few commodities as well.
Wonderful. Just to confirm, yeah, this webinar that you've just presented now here for us has been recorded.
Perfect.
Jack, so we'll get a copy of that recording out to you as soon as we can. Normally it'll be about 24 hours, so I do expect it tomorrow afternoon maybe. We'll have that to you. Ripple, the workshop is being held only in London, as far as we know. Yes, I think that's the case. I don't think.
Yes. Yeah, for now it's just held in London, but I'll be because I had a lot of requests for that workshop from people outside of London, so I'll be recording it, putting it online at a later stage. So do contact me if you want to be getting the video of the workshop as well.
Fantastic. Well, there we are. No questions. Awesome presentation, says Stephen. There we are. So I think that sums it up. And I'll add my thanks to that as well and say, Alex, thank you very much again for joining us. It's always
thank you very much.
Thought-provoking presentation, holding a mirror up to ourselves and letting us examine the issues that we all face as traders. So I can see that our next speaker, Philip Konchar, is checked in and ready to go in a few minutes' time. So we'll say thank you very much to Alex Spiriglou from Traders Training and Development. And thank you. I'll take the presentation.
Thank you all very much. A big thank you to Simon, and also Stick for Philip's presentation, because he's a really nice guy, and I'm sure he has got a lot of interesting things to share as well.
He is indeed, and he certainly does. Thank you, Alex. Enjoy the in Greece. So I hope you enjoy the rest of your holiday. And
thank you very much.
Bye bye for now. There we are. Apologies for the slight blackout. I hope it didn't interrupt you. I think it maybe only interrupted me. But the joy of long live events, I think, is my computer gets a little bit tired after 10 or 12 hours of being on the go all the time. Gets a bit tetchy. So here we are. We are now almost at our completion of today's event. Our penultimate speaker, Philip Konchar, is from TraderCast.com, a signals and alert service, a community of traders. I'll let Philip explain in more detail what's been going on over there. So let's bring David into the event and say hello.
Test, test, test.
Test, test, test. Good evening, Philip. How are you doing?
Hi, good evening, Simon. You must be tired after such a long day. And before Alex disappears, just a huge thanks for his comments. He's a great guy. I had the chance to listen to his presentations and share the stage with him in the past, and a huge amount of respect for what Alex does, and quite a few of your other previous speakers as well. So a good lineup, and well done, Simon.
It has been. It's been a super day today. Really, some new faces. Of course, Philip, we haven't had you on for some time now, so it's great to have you back. Interested to learn what's going on over at TraderCast. I still see the alerts everywhere, so it'll be good to see. We didn't get as far as confirming exactly what you wanted to talk about tonight. So perhaps when we screen share, you can introduce and tell people what it is you're going to focus on this evening.
Well, before we do that, why don't we ask them what they want to hear, and they'll talk about that. Because I have a few slides, but after such a long day, ask them what they want to know, and I'll talk about it. If I can help in some way, we can go into a live markets, check out some levels. I'll use my platform and show you how it works. But we can talk about absolutely anything that they want to talk about. including sex, drugs, and rock and roll.
and further down the list, we might talk about some trading. Well, there we are. There's an invitation. I know you have a standard presentation, which you have delivered before successfully, and it is always interesting to find out how the service works, because it's a nice service, TraderCast, in that you have the signals coming out, and you have a community which shares. In fact, I think we should go over and let people have a look at it.
Absolutely.
To begin with. So I'll make you the presenter, and as we go, because I'll be here, of course, throughout, feel free, everybody at home, to suggest something that might have been troubling you, or a currency pair that you maybe want Philip to analyze. Here we go.
Maybe something like this. Let's see. So I'm just trying to make a few changes here. And do that. So, is that okay?
See, we're looking at the website.
You're looking at a website. Okay, so that's the screen that we'll use. I have about 5 screens here, so hopefully I'll get one to work. And I don't know if you can hear the song. Can you hear the music?
No, I can hear something that might be in the background, but it's very faint.
No? Okay.
We don't have any music.
No music. Okay.
Well, not to worry. Well, we'll move over. We've already had one suggestion from Ripple. So can you share some knowledge on fundamentals in the Forex market?
Okay. We can talk about that as well. So that's a good topic, good stuff to talk about as well.
So first of all, before you just get stuck in, perhaps I could ask people just to know that they are seeing your screen okay, and they can hear you speaking. If we can just do the confirmation with a little Y. Yeah. Great. Thanks, Peter. Thanks, David, Ripple, Elizabeth. Thank you very much. Okay. Philip,
okay.
TraderCast. I'll hand over to you, but I'll be here.
Thanks, Simon. Okay, guys, what you're seeing here is basically a landing page for TraderCast portal. So TraderCast is not really a website. TraderCast is not a broker, although our piece of software looks like a trading platform. It's basically a community of traders who work together. We share our market analysis, we communicate, and we also research and analyze. So it's a good piece of software, but overall it's only as good as the people who are using it, so the community is the important bit. So what I'll talk to you about is, I don't want to make this a kind of a death by PowerPoint. I think you're probably very tired. You probably have heard so many different speakers and watched so many slides. I thought maybe we can keep this very informal, look at a few things, and then I'll show you what TraderCast is, and if it makes sense to you, then I'll provide you with some information on how to join us. There is a promotional code as well, which you might benefit from if you choose to do so. So let me just log in. If you're not a member, you can't log in. You need to register, and this is me getting in onto the home page. So while I'm waiting for that to load very quickly, so this is my charts, I'll just show you a couple of things which could be of interest to you very, very briefly. My name is Filip Končar. Website or the service is called tradercast.com. What TraderCast is, basically it's a community of traders, but you get all sorts of wonderful stuff in it. You can watch financial media, you get your watch list, news feeds, heat maps, you can create your alerts and signals which are feeding off your watch list and giving you a trigger. We have daily broadcasts from 9:30 until 11, and then from 1:30 until 3:30 every single day. This Mr. Potato Head is me, and this is our office in Dublin. We are a Dublin-based company, although I'm in London quite often as well. Our site has inbuilt charting, which provides you with a fairly decent functionality. So if you're a frequently traded kind of intraday trader or end-of-day trader, you'll find something that you can use on our charts as a functionality that's quite unique. All of the trading ideas are then saved and posted in the community with the levels for other members to see, and they can basically click on them and engage with that analysis and choose to do something with that information, or maybe communicate with the person who actually shared that information. Also, person who shared that information will receive instant notification that somebody commented on their trading idea, therefore they can start talking to you in real time. In addition to all of that, we have educational segment, which is in a video form, and basically if you click on any of these videos, which are 2 to 3 minutes long, you can watch anything that we talk about during our broadcasts, and if it doesn't make sense to you, you can very quickly find the explanation in the educational section, or you can speak to the in-house analyst who is broadcasting at the moment in real time, or you can speak to other members in a group chat and ask, what did he mean by when he said a triangular breakout and a market symmetry potential profit taking level or upside resistance at X. Before we go any further, this is membership-based service. The cost is, get ready, £40 a month, £95 a quarter, £320 a year. Absolutely nothing. Okay, so it's a very, very small amount of money to join us. We have a promo code for today. I'm going to get this out of the way right now, and I'll bring this up at the end. It's RTC Promo 16. RTC Promo 16. Go to tradercast.com, subscribe, create your user ID and a password. Instead of monthly, quarterly, or annual, if you enter this promo code in a promo code section, you receive an additional month off in addition to the usual 2 weeks free. So anybody who creates a user ID and registers for the trial, he gets 2 weeks free of charge anyway, before any money is taken from their account. You can use PayPal or Stripe or anything like that. But with this promo code, you're getting an additional 40 quid off, or an additional month off. So if you choose to subscribe on monthly basis, you would pay £40 after the initial 2 weeks free, and then you would receive 2 months worth of access. If you choose a quarterly subscription, which is normally £95, after 2 weeks of free access, you would be charged £55 for additional 3 months, so 3.5 months for 55 quid. If you choose to pay annually, it's only 280 instead of 320. Now, I don't mean to sound this as a salesy bit, but these prices are changing very soon, and they'll be going in the multiples. So people who subscribe with us prior to that change will have a lifetime guarantee that their price will stay the same for as long as they keep on subscribing with us. This is the salesy bit over and done with, and I'm going to remove this now and go into the platform and then show you what it is, and then maybe we can look at some levels, because today markets are actually moving quite nicely, and we have quite a few bits and pieces coming up on the economic calendar. This is the home page. On the home page, you can watch video reports. You can also watch a Bloomberg TV by clicking here. So nothing unusual so far there. You can also get a social media integration, what people are posting, and you can also access a Reuters news feed, and you can click on this stuff and read what's happening or what's of interest to you. We have also economic calendar, and today, for example, we also had a couple of good events which moved the markets. In the afternoon at 1:30, we had durable goods orders for US, and we had initial jobless claims. Those two events actually moved the markets, in particular in US. Going forward tomorrow, all eyes are going to be on Janet Yellen's speech at Jackson Hole. Apart from Janet Yellen, a couple of other keynote speakers or central bank decision makers and influencers will have presence at Jackson Hole, including Constancio from ECB, Bullard, we'll have Bank of Japan Kuruda, and these people can potentially say or do something which will set the expectation for currency movement, exchange rate movement, or even a base rate normalization process going forward. That's the expectation. Expectations are that Janet Yellen would appear hawkish, potentially indicating to us as market participants that they might be considering to do something with interest rates in US, maybe not in September, maybe in December, but she will leave us kind of wondering, will they do anything? They'll kind of find the excuse not to do anything as they did in the past because they're keeping the consensus or they're keeping the kind of everything in balance as well. So that's the economic calendar. I very often go on daily basis into the heat maps and I find out the prevailing trends and the sentiments based on the time frame that I'm looking at. So daily, weekly, or even lower. So our heat maps are interactive, and if I'm interested, let's say a viewer was interested in Forex, I could click on major FX for a daily rate, and I can immediately see by the color what's going up, what's going down. So is the prevailing trend stronger dollar or weaker dollar? But I can also change the time frame and drill down to the actual time frame and get statistical information on anything that I'm looking at. I can also click on the individual financial instrument that I'm following, in this case euro dollar, and get a correlated statistical pieces of information for anything else that's working in addition to US dollar, so dollar crosses or euro crosses or anything like that. And this piece of information for me as an intraday trader or active trader is really, really important because this provides a graphical representation of the market sentiment. I can see it straight away. And I'll show you a few other things that we have, especially in charting, based on a kind of a visual representation of where the sentiment is, where the prevailing trend, and different timeframes as well. This is all live feed. You could create your own user watch list. You can put in there what you want, your commodities, indices, or whatever else. And then whatever it's in your watch list, it's feeding the ticker. So if you click on any of these names or anywhere on the ticker, that will take you to the live chart and open the live chart as well. The interesting bit is this. Anything that's in your watch list is constantly scanned by these signals, and some people might refer to this as algos. And these algos are basically preset, hard-coded set of parameters that we feel could be of interest to you as a trader. You can pop this out and put it on a separate screen, and you can have this really running all day long. And if you are a particular type of trader, you can say, I am not interested in 5-minute or 15-minute noise. I am interested in only a 4-hourly type signals, or only in 1-hourly type signals. And the more signals that you get in that particular time frame would indicate to you the price, the reason for whoops, sorry, let me just move this. The reason for something that's happening at the moment, and also a statistical piece of information which says what happened over the past 8 times when the same signal was triggered. So we were looking at sterling Swissy at this price in 15 minutes. Over the past 8 times, the price went down 8 times, it went up only once, and these are the dates and the price when it happened, and it was based on a price action in relation to exponential moving average in 34. We have a different setups which are constantly working and scanning the market. So there was a good one today for Euro Swissy. There was a good one today on Dow. There was plenty of these signals and alerts which are constantly scanning the market based on your preferred time frame. So these signals are not instructions for you to trade. They are basically statistical pieces of information which are saying that something is happening with this financial instrument in this particular time frame based on this set of parameters, i.e. the price, indicators, and anything else that we've set up. And they're giving you the information of what's happening there with the price or what happened in the price in the past. So basically this does not mean go and short dollar Swissy. Well, actually it's coming to a resistance. I'll show you the chart. But if in your time frame you are already long dollar Swissy and you know that this particular level caused a bit of a consolidation in the past, and this is when it happened, maybe you should be looking to at least move your stop loss above your entry or take some partial profits, therefore protect your position. So it's giving you plenty of information that you can use, yet again, in addition to your normal fundamental or technical analysis as well. Okay, this is what's happening with the platform as well. On daily basis, we have this live broadcasts, and they appear like this. So this is our trading floor in Dublin, and these are live. The camera is on. This is me talking. I'm just going to sweep through this, and then we go into the charts and levels and anything that's been discussed apart from the economic calendar and macro view. It's actually discussed in real time. I believe somebody was asking about gold earlier on. I would love to show you some levels in gold. This was a couple of days ago. We were looking at this 1321 level as a logical level of support based on the market symmetry, and we are at that level right now. I would love to go into that. But basically what's happening with this broadcast is anything that's been discussed is saved and then posted in the community for other members to see. So in addition to this live broadcast, people can chat in real time as well with the presenter and other members. If I'm going too fast, or if this is too much detail, just ask me please, and then I can show you what I mean by that. Now, this is a charting package that we use, and the charting package is something that we would use to analyze the markets, and then we would save that in the community. This is the good bit. Before I do any of the analysis, with one touch of the button you get 4 different time frames for the same financial instrument, and then I can pop this out and put it on my separate screen, so I can have my 4 euro dollars, 4 cable, 4 yen, all ticking along and providing me with a prevailing trend. You can change these time frames to suit your trading style. You can also see this in one chart, or you can see it in 4. This is euro dollar. Daily is going sideways. There is no trend. The price action is above 20, 50 and 200 period moving average. This appears to be oversold bounce back, but it's still bearish. 4 hourly, immediately we can see that trend is up. So price action is very close to 20 and 50 period moving average, above 200. We have a rising trend line. Important level of support is at 112.40, which is this current low, which will correspond to this sequence of lows and this high here. So there is your horizontal support. Bullish above that level from the intraday point of view, potentially targeting 113, 113.25, 113.50, which will be this falling resistance trend line, which will be visible even more in 1 hourly time frame. So we have 4 hourly uptrending, 1 hourly uptrending, but currently consolidating, and a 15-minute is looking like this. So we know immediately, if we are a 15-minute time frame trader, is this bearish continuation pattern? Are we going to sell? If we are 1 hourly trader, if this is uptrending and this is uptrending, I must wait for a pullback to buy. If this is downtrending and this is downtrending, I must look for a rally to short. It's very visual what's happening here, in addition to your heat maps and everything else that you can put this together, and it's already preset for you. Is this all okay so far, or am I going too much into details and confusing anybody? Now, let's talk about a couple of things that could be of interest to you guys. Let's talk about cable. Let's talk about cable. Cable is looking quite nice at the moment. So this is cable in daily time frame. We all know this is the Brexit low, and then we're having this sideways consolidation pricing range. If I am trading in end of day time frame, I'm probably working full time. I would do my analysis of the weekend and I would look to place the trades or initiate the trades at the end of the trading day. Therefore, at 9 o'clock tonight, I would go and look at this candle and check out what this candle is telling me, and then base my decision and readjust my stops. So this is end of day trader. My prevailing trend is based in monthly and also weekly time frame. So from the end of day point of view, we know that we have 50 period moving average here. We know we have this falling resistance trend line, and we know that this 3275 area is actually really important resistance. Above 3275 we have 133. So these two levels, actually 3340 on the top of that as well. 3340 would be on the top of that. So I would color these red, and I would say these are my resistances. Therefore, these are the levels that I would be closely watching from the intraday point of view, because they represent end of day significant resistance zones. And resistance zones would be there to prevent the price from going any further based on macroeconomic, fundamental reasons, technical reasons. And the reason for this to potentially go into resistance and consolidate for a while is that on one side we have Bank of England, which is cutting the base rates and potentially increasing the easing because of the concerns that Brexit might have an impact on the UK economy. On the other hand, we have Federal Reserve, which is almost getting ready to hike rates, and if Janet Yellen comes in tomorrow and appears hawkish, indicating to us as traders that they are seriously considering it because the unemployment data is good. Today we got durable goods orders. Today got weekly jobless claims, which came in at 261,000 versus 265. So 4,000 people less than expected claimed uninsurance. But this is all good news for states. Okay, so they might say, okay, well, maybe it's time for us to hike rates. And if they do so, this is sterling dollar. That means dollar is a stronger currency, and this can only go one way. Now, where can it go and what can we do with that information? So basically, I would draw this trend line here. We know this is a 20 and 50 period moving average in 4 hourly. I would also pay a close attention to 132 from the intraday point of view, and I actually, to be honest with you, went short below 132 today. I felt that that was a good level to go short. Levels to watch from the underneath point of view as a resistance where the profit taking might take place is 130, 160 followed by 130, 120. This area here. So these two zones would offer some level of support. And what I mean by that is, from the intraday point of view, I'll show you the reasons why I went short, but my trade was in 5-minute time frame, not in 4 hourly. In 4 hourly time frame, if we see tomorrow a red candle closing below this rising support trend line, and let's not confuse anybody and do this. It would put, and Janet Yellen comes in and says something that causes dollar to rally, then potentially we could see a little bit more downside play. Technical traders who are trading price action are looking at the existence of this, and this is known as a rising wedge pattern. Rising wedge pattern in a clearly defined downtrending market is a continuation pattern, and they tend to break in the direction of the prevailing trend, which is in this case down. If you're not sure about what I'm talking about, you can simply click on education and find out continuation patterns, pennants, flags, triangles, and if you click on this, this will start a quick 3-minute video you can watch and see what I'm talking about. Now, this is what's happening now. The logic behind this is that as long as this current high at 3270 holds in end of day, this is still bearish below that level. Most of the people are seriously looking at this level and verifying that level as a considerable end of day resistance area. If we see a loss of that support tomorrow, and the price does something like that, quite often we see a bit of a sell-off and then a bounce back. And I'll show you that today twice. And then the price goes down. Where it goes, it would depend on a number of circumstances, and it would depend on a number of trading styles that you might choose to engage with. So if you are a price action trader, those guys are looking for a measured move below. So they would take the widest point of this rising wedge and they would take it down at the loss of support, and they would say this would be a measured symmetrical move in a market, and therefore this is where I'm looking to take my profit. So we have to be aware of that level, because that's what they would do it. This is a 4 hour, it's a really, really longer term time frame. Now, before we do any of that, let me show you where the fib traders might look to trade profits. Fib traders are taking swing low and swing high, and they're saying retracement from this low to this high of 38.2% is at 131. So fib traders would be looking to take profit either here or here. Loss of that level would open up the way for the retest of 130.54. If you are a shorter term intraday trader, if you're, oh, I didn't mean to do that. Sorry. If we are looking to, sorry, let me just go back. If you are intraday trader, your profit taking is based on a different time frame. Therefore, your entry levels and exit levels and position size, as Alex was talking about, and the risk to reward ratio is based in a different ratio. So let's go and look at this in an hourly time frame. So hourly time frame appears to be like this. So hourly time frame is uptrending, but we are seeing these pullbacks, and in hourly time frame, all of this appears to be a nice corrective pullback testing this support. So that's why that 131.60 is now hugely important going forward, and especially tomorrow. Janet Yellen is scheduled to speak at 4 o'clock. So that's the level that everybody else would be watching. From the intraday point of view, in a 15 minutes and lower, that 132 area was important level of resistance because of this. This here was a nice consolidation in overall prevailing downtrending market, and we saw a loss of that support and the flush lower. When this actually happened, that indicated that this 132 zone is a fairly significant resistance, and most of the intraday traders were looking to short below with a view to take profit down here. With a view to take profit down here around 131.60, and that 131.60, if you remember, if you go to end of day or 4 hourly, is that fairly significant support that we are looking at here. So intraday traders are looking to take profits where a longer term position holders, swing type traders, end of day traders are looking to enter as well. And that's why it's important to keep an eye on these levels from a different perspective, and you must have a perception of different time frames. That helps. So the same financial instrument exists in a different time frames, and it could appear in a different trend. So anything that we do here would then be saved in this way. So saved, and then that's posted in the community for other members to see. So we would say, so there is my euro dollar, and so I would write some sort of analysis here, and I would say 132 is either entry level or point of control level. Point of control means it's a level that we are looking at, but I'm finding analysis rather than trade, and I'm looking at 131.60 as a logical. Sorry, this is a support. 132.75. Above that we have one spot 33 as a fairly decent resistance area. Below us we have 131.60, 131.20. So 4 hourly levels. Okay. And as such, I can click on share, and then other people can see it in the community. And anybody who follows other members who are posting will get instant notification here that something was posted by that person that they are following. They can simply click on that chart, read what's been posted. If that makes sense, they can comment, and if they comment, the person who posted will receive a notification that they received the comment. They can then choose to connect with that person by clicking on the chat. Only when the invitation is accepted by both parties, you can see each other as friends on the list. So if they're green, they're online, and therefore they can talk in real time. So if I wanted to talk to somebody, I would click on this and say, "Hi buddy, are you looking at Eurodollar?" and so on. And if I click on send, James would be able to receive that and talk to me in one-to-one. So this is a private chat between you and your friends who are on the platform. You can also do this. You can go into a general chat room, and if you go into a chat room, then you can talk to multiple people at the same time, people who are currently in a chat room and who are talking about all sorts of stuff throughout the whole day, and especially during the broadcast, and this becomes quite lively. So it's very much live community of traders, and we kind of want to share our excitement about the market. We don't want to feel isolated, and especially if you're new to trading, this could be quite educational for you, because you would be able to engage with other people who trade, but you can learn by watching what's happening very quickly. You can ask questions, you can click on education and so on. So it's very, very easily kind of usable and so on. If you're an active trader, or if you've been trading for a while, but you're finding that you are isolated and lonely, you're trading from your home office, or you're trading from a remote location and you have nobody to talk to, this could be a good solution for you as well. We would love to welcome you in our community and share our excitement with you. Tell us what you trade. We'll tell you what we trade, and it might be beneficial for all of us. Just to clarify anything, we are not giving an advice. What we are doing is we are looking at a technical analysis in real time. This is all supported by economic calendar, what's coming up as a data point, good fundamentals, research, and we are identifying the levels which could be of interest to all of us, rather than advising anybody on where to trade. If you're looking for a trading signals which will tell you buy now, put your stop loss here and take profit there, this is not for you. This is definitely not that type of service. We want to know you as a person. We want to know if you fit in our community, and if we can help you in some way, if you're new, or if you are already trading, maybe you can benefit to all of us, and we can all benefit to each other. So that's the trading idea. That's the kind of a general idea behind TraderCast. I did want to talk to you about something else. I know some other guys were asking about gold, and this is what's happening with gold at the moment, guys. Let's start with the daily, and then maybe we can open up the floor for some questions. Guys, this is a bit puzzling at the moment. Now, gold is in end of day time frame. It's in uptrending market, so there's no two ways about it. We have basing, cup and handle, breakout, consolidation, breakout, consolidation, breakout, and this becomes a new consolidation. We have a sequence of higher lows and sequence of higher highs. Price action is trading above 200 period moving average and above this rising support trend line. Now, all of this becomes quite prolonged consolidation pattern. Normally, if you see a pullback in equity markets, you would see a rally in gold. Normally, when equity markets are rallying, gold should be selling off. So what's happening at the moment is we are seeing a pullback in gold, but also pullback in S&P and Dow Jones, and FTSE is quite toppy, DAX is quite toppy as well. They're not selling off just yet. I'll show you that maybe later if you have time for that, but they're pulling back. It's a time for some profit taking there, although the markets are moving higher. Markets are in the uptrend. S&P and Dow Jones and FTSE and DAX, they're all uptrending at the moment. So the levels to watch from the gold point of view is, it was today at 1326. 1326 was a big level to watch today. And that's from the intraday point of view. But I wanted to show you this end of day purely to give you a perspective of where these longer term trend lines are and the meaning of them and the importance of them. Below 1326, intraday gold appears to be pulling back. From the end of day point of view, this 1321 is hugely important zone. Below that we have 1315 and then 1310 and then 1305 and then 1300. So 1321, a massively important support zone for gold, and then below that we have 1310. Below 1310, 1305, 1300. So these several levels would offer some level of support to the downside, but this zone here is actually hugely important because of this rising support trend line. So let me just be a little bit more specific. Closing level rather than wicks is pointing. This is the wick, this is the daily time frame trend line, this is the 4-hourly time trend line. It's coming to that level now, and that level is hugely important to hold as a support. If Janet Yellen comes in tomorrow and says something that leads us to believe that dollar will strengthen straight away, this could be bearish for gold. If end of day time frame daily candle close below this 1321 and we see a sell-off, quite likely oversold bounce back rally, and then creation of that another lower high, bearish traders will quite likely engage and potentially try and push the price lower towards 1320, 1315, 1310, maybe even 1300. So that would be a bearish outcome. That would be a bearish outcome. Longer term bearish outlook will take in consideration all of this and add it down as a potential support level. Fib traders would be looking to take Fib from here to here and identify 61.8, which will correspond to that 1300 level, which is a nice and round number as well. Fib traders from a longer term perspective would be looking at 1287 level, and then over here we have a 1305, 1307. So a number of reasons why they would be looking at these few levels, as well as moving average traders, as well as trend line traders, as well as price action traders. Upside is clearly capped by this 1326. So a longer term bullish traders are looking to feel this level and wait for a daily candle to close before they can read it. There's a little bit of a buying pressure now here. So we saw a flush lower, and now the price action is moving higher. So this here is a hanging man candle, the flush lower, but it did not sustain itself lower. There is a wick with a body closed up. If this is followed by another green candle, potentially this could indicate that the price could maybe, just maybe, move towards this 1326 again to test it. Then sell off from there, or a breakout and a move higher. If it moves higher, then a couple of levels to watch from gold perspective is at 1335. A number of reasons for that level to be significant to any trader is because it's 200 period moving average in 4-hourly, and it's also a falling resistance trend line. And people who are trading trend lines, people who are trading trend, would be referencing that level very quickly, and they'll be looking to either engage there to short, or if they're long, they'll be looking to take profits there. And what I mean by that is this. So we have sequence of these lower highs, and that comes to this level. 13. So breakout above that would target that level as a point of interest and a point of resistance. From the intraday point of view, if you look at this as an hourly type trader, these levels are still holding the same. This was the consolidation at 1326. The price is dipping lower, but it's not flushing lower below this 1321. It's barely above it. We're coming to the end of today's trading day. This is stopping at 9 o'clock tonight, and then Asian session will kick in at about 11 o'clock, and that'll get busy towards the tail end before the European session opens tomorrow. But bullish version of this event would be something like this, and then a move higher, and then a breakout into this zone here. This is that falling resistance trend line and 200 period moving average in 4 hourly. So these are the two scenarios that we are talking about. This line here is also referencing the sequence of this lows previous consolidation as well. So a number of reasons why that 1335, 1340 area would be of interest to the bulls as well. Now, all of this is then saved and posted in the community for other people to see. So if I click on the community and go to today's posts, there is the gold post, and we were saying important level for gold is at 1326. Price action appears to be bearish below, pointing to further downside supports at 1321. 1321 is lost, then 1315, 1310 comes in play, and this is all here. So you can click on this, engage with it, get these levels, and decide what to do. Okay, I've decided to go long, and the reason why I went long was here. And yet again, my trades are very much shorter term trades. I was looking for the formation of the morning star, and that looked like this. So let me just see if I can show you that bit in a 15-minute. So I am currently long from this 1320 zone from down here. All of this can morph into another bearish consolidation pattern. Price can dip down very quickly. The stop losses that I have are just below 1320. I would be looking to take profit at 1326, 1330, if I'm lucky, 1335. So partial profit taking. That's what I'm looking to do. I'm not saying that's what everybody else should do, but the reasoning for that is that that daily support level held, and potentially we are seeing a pullback in S&P, we are seeing a pullback in Dow Jones, we're seeing a bit of a selling pressure there. So therefore, all of that can add to the credibility that that 1321 support in gold might hold. This is S&P, which appears to be creating this almost ugly looking topping head and shoulder pattern with the neckline here. Levels to watch for S&P today was at, this is S&P futures, we were looking at 2174 and also 2177. These two levels were hugely important for me from the intraday point of view. Bearish price action below these two levels for today, not for tomorrow. This is for intraday. Breakout above 2177 would open up the way for 2185, 95, even 2200 over the coming days, maybe a week. Alternatively, if Janet Yellen comes in and says something tomorrow that causes market to flush lower, I'm looking at this 65 zone, 2165. That would be a first logical point of support. Loss of that 2165 would open up the way for the retest of 2158, 200 period moving average in 4 hourly. Below that, we have 2148, which is this zone here. I don't know if this is too fast for you or not, but I am going to open up the floor for questions. But what's happening here is the price was below where it closed yesterday. When the European markets opened, we saw a little bit of the rally. This was the rally that I'm talking about. So let me go to a 15-minute time frame. I'll show you what I mean. When the European markets opened, we saw a bit of a rally. and then a sell-off. And then when US markets opened, because we got durable goods and weekly jobless claims, the markets rallied. Numbers were good, but they were not able to break through and sustain themselves above this 77 and 74 area. These are futures. If you're trading cash, if you're spread betting, then check with your broker. The daily rolling price or a cash price is probably a couple of handles higher than where we are now, because this is front-running futures month. So my premise is that the price action is bearish intraday below these two levels. If the price broke above this high, especially above 21.77, then it would potentially grind its way higher over the next coming day to 21.85. But because the price is below, this is now fairly significant resistance, and I would be watching where this price closes today. A loss of this sequence of current lows would be seriously concerning to the bulls, and then potentially we could see some profit taking and a flush lower towards 65, maybe even 58. Might not happen tonight. We still have about an hour and 10 minutes of the trading day, but that's where the trading range was for today. So yet again, this is all saved and posted in a community. So this was clicked and saved, analysis were done, and then we clicked and save and share. This was posted in a community for other members to see, and we discussed all of this during the broadcast today, where we have, here we go, S&P futures posted at 12.25 ahead of the open. We were looking S&P futures ahead of durable goods and services PMI. They're coming at this time. This is the expectation. These are the market consensus. And if we get a slightly different level, this is the price action. So important level for today, 21.74. Price action below yesterday's closing level appears bearish intraday. Further downside, 67.58, 48. Alternatively, breakout above, blah, blah, blah. Exactly what I told you right now. So if what I'm telling you right now makes sense to you, or you feel that you can get some sort of edge or might benefit you in some way, please try our service. And the way to try it is in this way. Go to tradercast.com. When you create your subscription page, so let me just go to, actually I'll go and show you what I mean by that. So you would go to Tradercast, and then you would click on sign up rather than login. When you sign up, you would get the boxes here telling you create your user ID and password, put your email address, and blah, 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 how you're going to be known internally, and there is a promo code box in there. So once you go to that and complete all of that, you should enter a promo code RTC Promo 16, RTC Promo 16. That will give you an additional month off. Monthly is 40, quarterly 95, annual 320. With this promo code, you're getting an additional month off. So you have 2 weeks free of charge anyway. No money will be taken from your account, absolutely none. Only after these 2 weeks, money will be taken, and instead of £40 for a month, you would get an extra month. So you get 2 weeks free plus 2 months for 40 quid. If you choose quarterly subscription instead of £95, you, after 2 weeks of your trial, if you're completely happy with the service, you would be charged £55 for 3 months. If you go for annual, it's 280. And that's basically it. So once you subscribe and create your pass kind of user ID and so on, that will take you to the payment stage. And then you can say, I'm choosing monthly, quarterly, or annual. But because you have a promo code, it will tell you that in addition to 2 weeks free, you are getting an extra 40 quid off or a month. And that's all it is, basically. That's all it is. Now, let me just close all of this. Guys, do you have any questions? Do you want me to cover anything?
Yes. We've got just under 10 minutes left with us.
Sure.
So, Wayne wonders how many members you have. I don't know if you want to disclose that.
No, absolutely. Absolutely. From the retail side, well, this is our service works as an enterprise type service, a business type service, but it's also a retail type service. We have a couple of other fintech solutions for the financial sector services. But for TraderCast itself, from the retail side, we have about 2,000 members with full access, currently active. What I mean by that, they would log in on daily basis, watch a bit of broadcast, post something, chat in a community. It ranges. On a good day, we have about 50 to 60 people in a chat rooms during the broadcast. So let's say if we have non-farm payroll or something big, you know, like the FOMC or rate decision, then it gets busier. But on a good day, about 50 people in a chat rooms, because loads of people are just watching, they're not engaging in a chat rooms, and I figured out that because they're working, so they can watch on their phone or a tablet, and while their boss is walking around, they pretend they're typing something on a keyboard, where in reality they're watching the broadcast. So they cannot really actively engage in that sense, and they choose to kind of do it passively. But on a good day, we have about 180 to 250 people watching the broadcasts and visiting the website on daily basis. The site gets busier during the broadcast hours, 9:30 until 11, and then between 1:30 and 3:30 in the afternoon. This is UK time, London time. But we are noticing that loads of people are getting in at 8:30 in the morning and kind of 8 at night. We have a morning briefing service as well that's done by James Hughes. He's a well-known market analyst, and he's a dear friend of ours, and he does a service called Morning Briefing at 8:30 for about half an hour, and he's looking at a macro picture, and he goes through the economic calendar and checks few levels, but he's on holiday this week, so there is no service for this week. At 9:30 we have either FX review or DAX kind of European review for about an hour and a half, so sites gets busier at that time. Then there is a bit of a gap. There's no broadcast, but we are still in the chat rooms and on the website. And then site gets really busy between 1:30 in the afternoon until about 3:30 pre-US opening, so US futures opening, which is what I trade, until about 3:30, 4 o'clock, just before the European session closes. So it's still a fairly small community and fairly manageable. We don't have tens of thousands of members.
Okay, thank you. Ripple's asking, can the signals for Forex be set up to show what is happening in relation to indices?
Absolutely, yes. Whatever you have in your watch list will trigger the signals. So these signals are basically what other people are calling algos, and there's something to do with the price and indicator or moving average or something like that. So they are statistical pieces of information that are constantly scanning whatever it's in your watch list. So you choose, you create your watch list. So basically you would go in here and you say, in the manager, I'm going to create my watch list and I'm going to put these products in. I'm going to add I'm going to add an extra watch list. I'm going to call this one my test, and I'm going to go and look for GBP JPY, and when I do that, that'll add that product to my list. And then when I save it, when I go into my watch lists here and go into my test, I will see that GBP JPY is in there. And these signals will constantly be looking for what's in there, and it will tell you how many signals were generated. And if I click on those, that will take me to the community posts which are specific for sterling Japanese yen. So whatever it's in your watch list, it's your watch list, and that feeds your ticker, and it's also triggering the signals. These signals are not instructions to buy and sell. They're providing you with a statistical piece of information to create your informed decision. Now, you're talking about indices. There was a very good signal today in, was it a 4-hourly or hourly on Dow Jones? Let me just, I think it was a 4-hourly, and I took it actually because it corresponded to the level that I was looking at, and let me just see if I can get it right now. Oh, here we go. There's S&P. So S&P is currently triggering in 4-hourly. The signal price is at 21.72. Previous time when the same thing happened, happened on these dates, and the price went down 7 times out of 8. And it gives you the signal price and the date. So you have price doing something with moving average, price doing something with Bollinger Bands, price doing something in relation to MACD, stochastics, RSI, moving average. Oh, you sexy thing, you. S&P is pulling back quite nicely. I'm really happy with that now. So this is actually, it's coming down to these levels that we were looking at. Cash is at 2170, and we're at 2169. So this is the live price. It's coming down a little bit, guys, and it's very close to this area here. I don't know if we're going to get a flush towards the end of the closing day to test this 2165. If you're trading cash, that will be 2166 or 2167, depending on your provider, as well. So let me just show you what I mean by that. If you're familiar with MT4, this is what's happening right now in S&P. But anyway, what was another question? Sorry, Simon. Before I start.
No problem. We've just got maybe another 2 minutes. There we are. Can we look at the Aussie dollar, the Swiss franc? I think we've run out of time for that, Ripple.
The dollar Swissy, I can give you the levels very quickly because I was looking at them, but very, very quickly. This is dollar Swissy, guys, and that signal that I was telling you about was actually pointing to the existence of this zone here at 96.85. We have end of day falling resistance trend line here. It's a fairly substantial coiling pattern. Dollar Swissy is into resistance at the moment, bearish below that level from the intraday point of view. If we see a breakout tomorrow, Janet Yellen is speaking, and she leads us to believe the dollar will strengthen, that this will spike higher to 97.10, 97.50 very quickly, because that will be a fib from this high to this low. Alternatively, if we see some consolidation here and the price starts pulling back lower, then 96.45, 96.20 would be of interest, possibly even 95.90 zone. Guys, you have 2 weeks to try this. Join us tomorrow in TraderCast, and then I can talk to you about this all day long. I have no problem at all. That's dollar Swissy, and that trigger was actually here. It was dollar Swissy in 1 hourly, I believe. So let me just try and change that. Any more questions, Simon?
Great.
Dollar Swissy. Dollar Swissy was red, 96.85, and that was based on a Bollinger Band cross price testing upper Bollinger Band, and the same thing. When the same thing happened over the past 8 times, the price went down 6 times, went up twice. And if you hover over them, it tells you when it happened. So that's what it was. Sorry, Simon. Go on.
No problem. Wayne says he wants to pop in for a cuppa. He has a house in Dublin. Wayne is going to sign up. So he has a house in Dublin, and he's here when he's over.
Absolutely. Our office in Dublin, I'm actually at home today, but our office in Dublin is in the Keys. And if he knows Dublin, our office is opposite of IFSC, Irish Financial Services Centre, or old kind of a trading floor there by the Custom House. And we are on the 4th floor. We are overlooking the IFSC, and come in. We have a lovely, a fresh coffee grinding machine. We make me and coffee. We have a huge terrace. Sometimes we do barbecues as well, but that's only for the good members. Come and say hi. Come and say hi.
Fantastic, Philip. Thank you very much. We're going to have to wrap it up there. We're just in the last minute. We've got another speaker still to go. Thankfully, one more, David Warner from Online Trading Academy. So we will say thank you very much, Philip. We will follow up with the links for the TraderCast offer. Is that offer going to be open until the end of the month, or?
It is valid for a couple of weeks because something else will come up soon. I'm really looking forward to your event in September. Lisa and you are well known in the industry, and your events are really well worth a visit. And I'm really looking forward to meeting some of the guys in person and going for a beer with them, I suppose.
It'd be great to have you over for both of them. Yes, Lisa's one in October, and I'm doing the Round the Clock Trader Live in early November. So it should be good. Philip Conchar, TraderCast, thank you very much indeed. We'll leave it there. It's been lovely to have you joining us, and add my thanks to everybody else on the chat box, adding their thanks to you. So I'll take the presenter role back from you.
Absolutely. Thank you, Simon.
Thanks, Philip. Speak to you soon.
Stay safe, guys, and happy trading. Stay safe.
Okay, well, believe it or not, that brings us up to 8 o'clock, and we are still getting people checking into the room, which is great. Really appreciate it. For those of you that are just joining us, my name's Simon Campbell. This is Round the Clock Trader. This is our 12-hour monthly webinar show where we feature 12 expert speakers. And if you're just joining us, you've missed 11 of them, but we have recorded everything, so do not fear. We will be able to issue you with a link to the recordings so that you can catch up on all these presentations over the weekend. Fantastic presentations we've had so far today. Of course, lots of different ideas and strategies and indicators, all set against the context of the markets, where they are now, giving us a great insight into how we might be trading our way into the autumn. So it's been a really enjoyable day, and I'm delighted to see that we still have one speaker left to go, and he is someone that hasn't spoken before at Round the Clock Trader, and his name is David Warner, and he is a head instructor at Online Trading Academy in the US. John O'Donnell, obviously Chief Knowledge Officer at Online Trading Academy, old friend of mine going back many, many years, has spoken many times before Round the Clock Trader as well. We're delighted to welcome David to the show, trading Forex like a fund manager. So I must preface this with saying my apologies for not being able to make the test call with David. So if there's any few minutes that we need to do the handover, all blame falls on my shoulders. David hasn't used this particular platform before, so I will be guiding you through. So stick with us, and we'll soon have you going. So I'll take the microphone off and unmute David and say good afternoon.
Hey, yeah, it's good evening, I guess, to you.
Good afternoon, good evening. It's super to have you. We can hear you loud and clear, which is great.
That's great. Yeah, I'm in Southern California, in Orange County, California. John O'Donnell actually he has the office next door to me. I'm in the headquarters of Online Trading Academy, and we're next door neighbors. And I think you know Merlin Rothfeld as well. He's the office next door to us. So
I know Merlin. I've known many of the guys from OTA when we first launched the first workshops way back in 2003, believe it or not, in London.
Yeah, nice. Yeah.
So yeah,
we sit and talk markets all day together, these guys. So it's awesome.
It's been a fantastic story, Online Trading Academy, to watch it grow, and you really do sort of span the globe now. With all the training, it's a fantastic, and you have so many students that go on to actually put it into practice. This is the beauty of it.
Yeah, that's right. Biggest online, biggest trading academy in the world. We have 40 plus now actual academies where you can come sit and learn in a live classroom how to trade from a professional trader.
Wonderful. Wonderful. Well, David, thank you for coming on and joining us. I think John's probably told you what Round the Clock Trader is. We've been doing this for 2 years, but my background is in the sector, working with retail trader expos and spent a few years working with a company called VectorVest, which you'll know of, a big US software.
Yeah, I do.
So this has been a fun business to start a couple of years ago, trying to utilize the technology to spread the education further than you might, booking hotels and so forth. We've really enjoyed it. It's been great, but we do need a constant flow of talent and enthusiastic speakers and experienced traders to share their knowledge with us. So that's why we're pleased to have you.
Thank you very much. Yeah, happy to join you. So, just show me how to share a screen here, and we'll take a look at some things.
Sit back, and you should have a box turn up right now asking you to just accept the invite to share your screen or become a presenter. I'm not sure the exact wording.
Okay, I got it.
If you hit that, then we should all see your screen, which we do.
What do you see?
We are looking now at the Forex Factory.
Okay, good.
All right. On your browser. Is that the one?
Yeah, no, that's all right. I just want to make sure. I want to see which monitor you have. I got multiple monitor. Okay, good. All right, so I'm gonna move some stuff over here. So, what I'm gonna just I don't really have a slide deck prepared for you. What I kind of do is just kind of show you what we really do over here at Online Trading Academy. Get a little bit of a sneak peek here, this is what you're looking at. I actually I teach in classrooms, and I actually teach online. I did what we call it an XLT, which is just an extended learning track every single day. We have different asset classes. I'm going to talk about Forex today, but Forex, futures, options, stocks. You can basically join us, join a professional trader, and we just I try to identify just some major market turning points. So every day kind of starts with just kind of looking at the economic reports that are coming out, the big kind of trends that we need to watch out for, and then everything we do is just based off of really trying to find institutional supply and demand, major turning points. We're not in an academy that really goes into using a ton of indicators. Really just look more for imbalances of where we see imbalances in supply and demand, and look for major turning points. So I just wanted to kind of pull up some charts actually with you guys, and just kind of look at some of the markets, and just for Forex, kind of just ways that you can possibly kind of fine-tune and really find the best zones to engage a trade. What I think a lot of novice Forex traders, the mistakes that a lot of novice Forex traders make, is they forget that this market is here to facilitate international trade and investment. So when you think about where the really the smart kind of turning points for the markets are, really typically they're going to hover around the way that we break up really the U.S. dollar. U.S. dollar, basically 85%, I think it's even higher than that right now, of all international trade is being done in the United States dollar. It doesn't matter if you live in Europe or Australia, New Zealand, wherever. As these countries do trade with each other, they're doing all that trade in the United States dollar. So a lot of the focus that I have is usually always dollar crosses, because those are really the most liquid pairs, or the cheapest to trade, etc. So when you kind of coming up with a theme or a title to speak with you guys today, kind of trading like a fund manager, and how would I kind of really set up my charts to do that. First thing, just to kind of, we got to look at the market in kind of a big picture format first. And this platform, I am on FXCM. Obviously this platform is designed for a professional trader in mind. So a lot of just where these numbers, you got these scales, right? And so just how we kind of can adjust our scales can really just kind of set us up for better success. So my argument is going to be is that the market is really just from a kind of big picture standpoint, always just really kind of moving down through kind of 10-cent, 10-cent increments. So within that kind of 10-cent increments, so it's always like, I always try to look at the market and, what kind of 2 10-cent, increments, am I in between? Overall, pretty bearish on the euro. We always had this fall. You guys have that whole Brexit fallout. Just fundamentally, there isn't a lot, going for this pair to really make any significant gains to the upside. Tomorrow's going to be really interesting because we have that big Jackson Hole get together, all the who's who of central banking. So it's going to be interesting to kind of see what comes out of there. But we can probably see, kind of this next leg and maybe hopefully break out of this sideways pattern. But looking at the market in kind of these 1,000 pip increments, the next thing that we would typically look to do, I'm going to remove all these lines. I take that 1,000 pips, and now I've taken that 1,000 pips and I've really just divided it into 250 pip increments. If you like, it goes back into kind of breaking up that dollar. We use pennies, nickels, dimes, quarters, etc. So there's like this every 250 pip focus. I can see kind of a lot of tops and bottoms that are going to be created just naturally around those 250 pip increments. They're just magnets for major turning points. If we looked, just as far as finding quality areas to be a seller and then quality areas to be a buyer, you can just really kind of really find this 1250 is quite an interesting kind of area, but you can kind of see what I'm talking about as, you just kind of see buyers kind of come in just naturally kind of off that number. I want to see it kind of fall through there. Actually had a short on this one already. I just want you to notice how a lot of these areas and levels that just kind of line up around these major turning points. And here we are kind of around that big 1250 right now. It's not really that surprising to me that we're just kind of hovering around there. Here we bounced off of it, but this is really, this area right here is really kind of key. And it's all, we probably won't, if that comes out of tomorrow, if they come out of there tomorrow dollar strong, I would imagine that we're going to break right through this 1250 and we can make a serious run, down here probably to that big 110 figure. And that's just really trying to move it really from one big institutional level to another. I can do this with really any of these pairs. And, we talk about trading like a fund manager. I'm going to show you guys something here. Here's dollar yen. Dollar yen is a bit of a nemesis right now. It's interesting to see how far it's fallen, but I just want to kind of see, how we're setting up here. So just kind of going back, kind of adjusting those scales like I was talking about. Argument's going to be market's moving every, here every kind of 1,000 pips, not breaking it up the same way, but break up the market every 1,000 pips. Now we're sitting at these big kind of 100 figure. If I watch this and adjust these scales, actually, I'll show you guys here first. I'm sorry, I don't know if hopefully there's no lag and you guys are seeing me.
Yeah, David, it's coming through fine. We're seeing it on real time. It's looking good, thanks.
That's good to hear. So the whole thing is trying to find supply and demand imbalances. Here we have trying to just play off of that big whole number. In Forex, everyone just needs to think, if it's to facilitate international trade and investment, where are the levels that just make sense, numbers that make sense? Too many traders try to get cute and they start trying to trade with numbers or trying to trade with zones that end in 1s, 2s, 3s, 4s. 7, 8s, and 9s. And I want you to think of like, is BMW, Coca-Cola, or GE, looking at a price chart and saying, oh well, if it just gets one more 1/100th of a penny, they're not dealing in zones like that. To the commercial money that's going to come in and really create real demand or supply balances or whatever. Look at all. I mean, they're going to come in around these big whole numbers. I can't make this stuff up. You kind of see. Let's see here. Like, I know that this area right here, if I'm going to be long, that's an area that I'm going to have to really, really be nervous about getting through. You kind of see how price just really kind of fell from here twice. We fell from it, drop, base, drop, came right back into this area to drop again. This level's not necessarily fresh anymore, but as far as like where I need to start getting nervous, if I can get through 102.50, I don't have anything really stopping it until we get up into this 105 area up here. This one's going to be a little bit further away. The higher we go up, a curve, the bigger our zones are going to start becoming. Nice thing about Forex is we have so much flexibility as far as how we can manage our risk. But you can just see, I can go up, I can even just continue up into this scale. See that? And it's just using, just being smart, when you're really trying to find the levels. I know I'm really kind of showing you more of kind of a little bit of a swing trade setup right now. Just kind of looking at the market, breaking it into every kind of 250 pips. If I'm on like a 4-hour chart, that's typically, my focus, trying to move the market every 250 pips. You're on a 4-hour chart. You are going to be dealing with, bigger kind of risks, bigger, more risks, higher reward, type targets. Bigger risk meaning wider zones. But just, always coming into it and just, being smart, with the levels. If I was going to be something on a little bit shorter term, let me show you guys something. And it's just as far as like, I'll show you Euro Pound. You guys see, I got a lot of UK guys in here, so I bet that might be a pair that you guys are trading. And I saw this, and we actually caught this trade. We do this all. I mean, I actually did this in a live XLT. Our online class, and that's something if anybody's interested in. I mean, we trade live in there every day, with our students, and this is kind of what I'm talking about. Here is a daily, and we had this big kind of around 87.50-ish area here. You can see that we've fallen off from here is 2012, 2013. And then we had these falls. Now we have a process that we go through. I can't really. I'm not gonna. It's gonna be too deep to really kind of go into and into here. I can't give away our secret sauce here, but able to really kind of identify a zone really right before this 87.50 using a series of auto enhancers that we have at Online Trading Academy, and you kind of see it just really kind of came into that zone, and really just fell off from there and fell down to. Can't make it up. What's the next logical target? Almost like to the pip. You know what I mean? 85. Like where do I get out? There you go. Be smart. Check this out. Get this little area, buy area comes in. Just happen to be right there, right around that 85 figure anyways. bam. And then a move. And actually, we just engaged this. I just engaged this in a short again, like right before I started with you guys. Is it going to work? I don't know. But I mean, I had a setup there. Kind of came off of that 85. I love looking for kind of supply and demand areas that end in like a 7.5 and 2.5. They're just magnets for reversals and targets. You see I had a drop off from there, came into it again. Now I'm trying to short out of it. It's right around a big kind of 7.5 figure, which I do love to try to find, but came up into it, see if it's going to come out of it. On a 30-minute chart, should remove my lines here.
David?
Yeah.
Just a question from Wayne. He says, don't you use any indicators or moving averages at all?
None. Zero. No, we don't use, here at our academy, everything has to do with, we do everything with price action. You know, I'm not knocking anybody that uses any indicators or any type of moving averages, but just from my own experience, and I used to work actually on a trading desk in the Forex market, and I worked with commercial, you know, traders and fund managers. We even actually had a platform at one time that didn't even have freaking charts on it, you know. And so you can just really, you know, everything just kind of boils down to a price. If I showed you, I don't want you. Like if you looked at like for a picture of like a floor exchange in the United States, and you got all these professional traders, you know, on the floor. No one's, you know, plotting charts on an iPad, you know, looking at moving averages and stochastics and RSIs and Bollinger Bands. You know, we at the Academy we call it like trying to find unfilled orders, and you know, that whole process that we go through has nothing to do with any type of technical indicators. You know, technical indicators, you know, just the lagging nature of them. Plus, you have news announcements that come out that give these huge spikes in price one way or the other. Well, that totally skews all those technical indicators and puts you into trades that, you know, you may not necessarily, you know, want to be in. And it's not, you know, it's just because of the that whole you know, lagging process and just that of it. Not to knock them, we don't use any of them. So I don't know if maybe I'm talking to everyone. I may have just lost the whole room when I said that, but
not at all.
No.
So we're just confirming. It's just confirming saying so. So it's just price targets of previous structure and support and resistance.
Yeah, yeah. It's not even support and resistance. We call it really kind of supply and demand. You know, this isn't necessarily. Let's see. I don't know how to reword it here. Shoot. Yeah, not necessarily support and resistance. I don't want to go too deep into it, but we call it really supply and demand. Just looking for unfilled orders, like we said, and we have a process that we go through. It's almost like a checklist, you know, type system, and we have a system of odd enhancers that we go through to kind of score a trade. But a lot of just what we do has to do with how price enters into an area and leaves an area. But you know, just as far as having that Forex focus, you know, if you just think of the logical way in which a dollar is broken up, let's show you guys something here. Let's see. I'll just do it this way. You see how this kind of area to sell, I think this one I already was trying to map out, has this kind of 7.5 figure wrapped around in it. something like that. We look at the big round 86 number, at a little zone that just forms in there, and then look at the 25 right above it. You notice how the price just kind of stair steps through there? Just logically, commercial fund managers, fund traders, they're not looking at, a price and they're like, oh, well, if there's just one more pip in between here, then I'm really screwed. They're really, they're going to go, if it's not here, it's up here. If it's not here, we're just every way you break up. There's nothing really in between. And that's how we're going to do it. If we look at just where these zones on the other side, check it out. Look at where the little sideways action comes in. Look at this 25 right down in here. 50. 85. Bottom. You see that? Didn't try to trade anything in between. Has nothing to do with really any type of technical indicators. A lot of what I try to do in the market as well is we try to find, and this is something that I do with our students, is I always try to find divergence in monetary policy at the same time, and that's why I do a lot of, central banks over the last couple of years have been very, very difficult to try to trade off of them. They've lost a bit of control. But it used to be just gravy train, finding those imbalances. Right now, I know I kind of have two. Yeah, I try to keep bringing it back to this dollar yen. I think we're going to have some exciting moves. I don't know how much lower it's going to go, but I don't imagine much lower than this. And, just kind of get rides, back to this 105, back to 110, back to 115, back to 120. This is one of those pairs that eventually I think we're going to be like, oh, it's at an all-time high, Here we just have that big round number. You can see we have some serious difficulty going below it. If 100 does not hold, I'm telling you, I'm going to be real interested in possibly coming in and being a buyer right around in this 97.50-ish area. Nothing really in between from I call these institutional numbers from one to the next. This is where, some areas are going to come in. 97.50. Check this out over here. This is the whole thing is I don't know what indicators are going to be telling me when price is down here. If it's falling like a falling knife, I'm going to get over this. Let's see, 97. Let's see what this looks like. Oops. Just somewhere in there, And then you're like, well, where's my target? Well, your target is you're going to try to pull it up to the next big institutional number here at least, and then look. Notice. So just a smart way to kind of approach finding the right zones here. As far as one of the processes that we go through, I kind of showed you guys this here a little bit. We talk about just the numbers that are coming out, and then really a trade plan based off of whatever news or anything that's happening. So I think the first thing I had kind of come up with you guys is this Forex Factory. I'm sure if you guys trade Forex, you guys are all very familiar with the Forex Factory. One of the things that we'll look at the calendar, we're like, okay, well, the news out of the United States today, we had this big positive print. Here, I'd be interested in possibly being a buyer of dollar today. I come up here, you can kind of see that I have this. I adjusted the Forex Factory scanner. You guys might want to take a screenshot of this. But what it allows me to do is just really quickly get an idea of what my favorite pairs or what the market's doing in real time. I know a lot of people use like a FinViz or some type of heat map, but I like this whole percentage way. We're looking at it over the last 24 hours, 60 minutes, 15 minutes, 5 minutes, and then just really see, I can really get an idea of the trend, right? If I see all green, that means, I probably have, I'd be interested in trying to engage buys. If it's all reds, I'm interested in engaging sells. Just trying to go with that momentum, that theme of the trading day. If it starts getting red and green, then I know I'm probably getting into a little bit of a sideways choppy market, and then I'm going to look to kind of do some set and forget orders and see if I can engage a trend one way or the other. Today, we assumed, even kind of coming into today, that it was going to be a kind of a boring trading day, probably very low volume, very tight, more of a tight range trading day, because no one's really going to take any big moves. You're not going to, if you're a fund manager, you're going to be a commercial trader, and you're like, okay, yeah, the day before, this whole big central bank summit, and they're going to come out and they're going to start talking and saying things that are going to move the market. So the day before, I'm going to come in and I'm going to put a ton of money in and establish a new position. That really doesn't make any sense. So here is just a sideways, moving, very, very boring market. Really just waiting for the next big trade move. There's a lot of these pairs I feel are just really, really prime for reversals. New Zealand is probably one that's really on my radar. I'm going to show you guys something here real quick. I actually read central bank statements. Let's torture myself here. So you guys see in my Google right now?
We're looking at the New Zealand.
Okay, good.
Bank.
I just want to show you guys something here. Check this out. So here is their newest policy statement. This was just a couple weeks ago. But I just want to show you just how we can, the central bank's job is they're not necessarily supposed to be super cryptic. They're there to facilitate international trade and international business and trade. And so what the whole thing is that they can't really be cryptic on what they want policy to do, because they need businesses to be able to forecast growth. So for example, they can be pretty vocal about what they want their currency to do. So here's the very first page of New Zealand's central bank statement that just came out a couple weeks back, but I just wanted to read kind of one paragraph with you guys. Weak global conditions and low interest rates relative to New Zealand are placing upward pressure on the New Zealand dollar exchange rate. The trade-weighted exchange rate is significantly higher than assumed in June's statement. The higher exchange rate is adding further pressure to the export and import competing sectors, and together with low global inflation, is causing negative inflation in the tradable sector. This makes it difficult for the bank to meet its inflation objective. A decline in exchange rate is needed. Monetary policy will be accommodative. Our further projections and assumptions indicate that further policy easing will be required to ensure that future inflation settles near the middle target range. So basically what they're saying is our exchange rate is too high. We're going to probably, introduce more policy easing. All of that would be just, that would weigh on, this New Zealand dollar. We're kind of coming into areas here, we're breaking it up into kind of that 250 pip type shot. I was really surprised to really kind of start seeing, here's a daily, let's look at daily. We got a higher close here, but all of this area here, this is that big 7250-ish area. I'm not interested in really kind of taking this higher, and I'm not going to really kind of chase this with buys. I know that's kind of the momentum that I have going here, but I feel like pretty soon the wind's going to be taken out of this thing's sail. So really just kind of looking for big areas to sell it. We engaged this in a short earlier today. and it's not showing up on this account. It's on one of my other accounts here, but we actually shorted it right around these highs, and we just hit our high right above this 133.50. Just to show you guys real quick, it was a trade idea we had. Here's where it was. So right now it's in the money. Our stop was just right above the 55. But that's just really trying to catch that whole central bank and see if we can push this thing back down. If that area doesn't really hold, I have to be interested in the only real logical place, that sellers are really going to come in. I'm not going to try to mess around with really anything in between the middle. I'm going to really just kind of come up to the next just logical place where commercial interests and businesses are going to have to come in and be like, oh crap, well now it's at 75 cents. What do we do? That's just the next kind of logical place. Somewhere in there if I was going to have an area that I would just kind of have a set and forget, that would be something like that, have a stop, just a logical, I don't know if you use these highs there, but 75 to really try to take this thing, not just, I'm not talking about just a couple hundred pips down. I mean, we're talking about a move back through, 70, possibly, 265. Look at all of the stair steps here. 62.50 bottom, 65 this is where origination comes down. Where did it stop? 70, came down 67.50. You just see it, right? Just the smart logical approach, like someone who would manage money or commercially, something like that. What do you guys think? Any other questions or anything, Simon? I feel like I'm going so fast, and usually I have all sorts of feedback, and I got people chatting in questions, and I don't know if am I making sense to you guys or what? What do you guys think?
I think we're making sense. Wayne says it's refreshing to see a blank screen. We have had a whole day of very cluttered screens with all sorts of fib levels and trend lines and support and resistance. So looks very sparse.
Yeah, that's the way it is. I mean, this is trading. We approach trading in a very different, kind of a different way. I don't know if you guys look us up at all. Maybe Online Trading Academy. A lot of you guys don't know who we are, but we are the founder of our strategy. He's by the name of Sam Seiden, and Sam Seiden used to be on the Chicago floor of exchange, and his job was to take all these institutional orders in over the phone, and so he would kind of create these almost like you can just think of almost like stacks of paper of all these institutions or commercial interests want to buy or sell or whatever the heck they want to buy or sell. Well, if you think about it, then if I know where all the buyers and sellers are coming in with a very high degree of certainty, I can tell you where this market is going to turn. Well, we basically took that, and then and all that really is. All charts are just fingerprints of where all these financial institutions are coming in, buying and selling. That's what charts are. That's what candlesticks are. And so we have a way of trying to identify where those zones will be, and they have nothing to do with technical. It does nothing really to do with technical indicators at all.
Okay. Yeah. Peter says he guess this is not for novices, but I think you train people from.
Oh, this is for novices. Yeah, our instructor pool. We all came out of the not all of us, but the vast majority of us. We have students that have become instructors with us, but the vast majority of our instructors came from the business. Now, our students come from all walks of life. We have people in here that have no background whatsoever in any financial markets, and actually those are typically our easiest students to work with because they come in with no bad habits. You know who our hardest students to kind of work with are those guys that come in. I've used 100 different technical indicators for the last 20 years. I have all these terrible habits. Now we got to go and try to unwind those and break those. And it's it's not anything where I know I'm probably going a bit fast just because I have a very limited time with you guys, but we take people from the ground floor, like this is a candlestick. Green means this, red means this. Guys that just don't know anything about the financial markets, to just some very kind of advanced lessons. And so it's a progression. All our students are our students for life. You know, they don't. It's not anything you're just a student for a little bit and you go away. So you take our classes over and over again.
Yeah, I think Elizabeth says she is an OTA student. She was on the webinar this morning. She said it was great.
Oh, really? Cool.
There we are. Yeah, well, yeah, 8 a.m. this morning. So this is a second chance. Do you read all the central bank statements? Asks Wayne.
Yeah. Well, the thing is I came from a desk that was very in tune with what was going on with the central bank statements, and so it just became a and they had control, you know, at one time. I'm going to show you guys something here real quick. Like, check this out. Bank of Japan easing September 2012. So look at that. So just to show you guys. So this is like, I do this because they give us a real clue of where those next big moves are. So here's September 19th, 2012. Bank of Japan announces new monetary easing. This stuff is like, this is like Christmas for us over here at the Academy. Brexit, I feel for the UK and all the money that they, I don't even know like how people feel, kind of about Brexit. But for us, that was like a Christmas holiday. We had that whole setup. We had the setup if it's a stay vote. We had the setup if it's a leave vote. Just to capitalize on those. Just to it's a net sum zero game, right? For every dollar that someone loses, someone's picking it up, on the other side. And so the central bank policy, just to kind of go into it, here's September 2012. So I just showed you a headline, September 2012, right? Here's where yen was. They announced new easing. Look what happened. All right, so that's 4,000 pips. Now the whole thing is that's the whole thing we're waiting on right now. What's going to come out of Bank of Japan? What's going to come out of the United States? If we do start raising interest rates, they start easing, who knows what's going to happen. That could create the next big, not 250 pips, 500 pips. We're talking 1,000 pip type moves. And so that's where just to kind of get a direction, give me a direction, I'll stay with it and I'll be adding on, all the way up or all the way down. And that's just one of the things that we do here at the Academy too, is we have some very strict guidelines and rules just as far as managing risk and adding on to positions and this and that. And a lot of the times with Forex, when we've had a kind of a sideways market, when we can get a trend, those trends just last, and you can just really capitalize on the, way up and down. So this one, this is all I would have liked to just sold it in, January and just never looked at it again. You did pretty well,
Tell me,
yeah.
Given the big fundamental emphasis, the elections that are coming up in America, is that causing the funds or traders to think about what fallout there might be from either candidate going into the White House?
Oh my gosh, yeah. Oh my God, big time. We're really watching that, and that's very interesting. That's nice you brought it up. This whole election, with the United States raising interest rates, it's probably going to be very difficult for them to do anything before the election. There's all this chatter that, oh yeah, maybe the Federal Reserve will do something in September. The Federal Reserve doesn't want to shock the market. It shocks the market, and then all of a sudden, the election could be, kind of about something else. The thing about, at least it is here in the United States, and you guys follow, this U.S. election, we don't even bring up the economy or, central bank policy or anything. It's, what do you think about this moral issue? What do you think about this? What do you think, just this very kind of black and white. And the economy is just, so I think that, obviously, I think for, just Fed policy to just kind of stay status quo, and for kind of for, just traditional traders. I don't want to. Maybe I'm throwing myself underneath the bus. No one threw me under a bus, but I think they would prefer Hillary Clinton in the office. Trump, I think, is a little bit more of the wild card there. So I think that it's going to be interesting to see after the election. We have our U.S. equities like at kind of these all-time highs. I'll tell you, here in the United States, it doesn't feel like the economy is the best it's ever been. So I imagine we could see some serious reversals after the election, and that's where I think it's just kind of set up. For our next kind of really big leg one way or the other. I have a bias to this dollar yen to the upside. I see a lot of, there's a lot of people piling into this yen short. It's becoming a very, very crowded boat. Just if you look at CFTC positioning, we have, yen longs at highs. We also have Great British Pound, like the most net short since of all time, was last month. So we got bullish on the Great British Pound because it was just gotten beat up for so long. That 130 was the lowest level it's been since 1985. We hit that 130, and actually we got this one just perfectly. We had a buy at 130, target at 130. As it went through 130, we had a buy at 130, target 132.50, made it right up to there. I'm still kind of bullish the Great British Pound. I think we can probably make it up into this 135-ish area, which that's why we're looking at that Euro Pound short and everything too. I don't like to see so many people in the same side of trade, because that's typically where you start getting the reversals. By the time Joe the barber gets into that short pound, he's already missed that boat. You know what I mean? So I don't know if that answers. Hopefully, that answers your question.
Yeah. That brilliant. Well, I mean, as far as the election is concerned, we're watching in stunned silence from across the water.
We're not proud over here, I'll tell you that. I don't know.
It's a fascinating thing. The the U.S. elections are a spectacle that we haven't seen before. But I think our UK elections they're leaning the same way.
It's a wild times we live in. I'll tell you that. I've never seen the sentiment here in the election. It's just there's no excitement for either any real candidate. I'm not going to be surprised if they're going to say this is like the record turnout for the lowest turnout on record for people voting. I have a feeling that's coming. We'll see though.
I think we're in for interesting times. Yeah, Farage and Trump on the same stage was something to see his win. Yes, indeed. Well, we'll just wait and see what transpires. Apparently, there's a secret poll that suggests there's a lot of secret pollers, voters in the U.S. who are not confessing to perhaps being a Trump supporter.
Oh, I know that's going on. That's happening. I see that right now. Everyone is
really?
It's all it's closet support. It's just they're looking for the same shakeout that you guys had with your Brexit. I feel like that Trump vote is a Brexit vote, almost in a sense. Like that status quo. We want to shake up the system. I feel like, and I feel like that's kind of our
Yeah. Well, it's
he's extreme. That's for sure, though.
It's certainly done that over here with Brexit. We're still sort of grappling with exactly what it means, if it's actually going to happen, and what will the results be. So makes it interesting times.
Yeah, definitely.
Well, we're at risk of getting too political. Going back to the thing. This is fantastic. You've spoken for about 45-50 minutes now. What should we do if we want to find out more about Online Trading Academy? Because I know you have
definitely
resource of content and webinars and the radio station. It's a lot. Where's the best place for someone to start if they're in
the UK we have one of our schools actually in London. And I did an online class last night at midnight. Our time was about 8 a.m. your time, And I always have it full of students in London. So I know we have a really nice academy there. You can just go to onlinetradingacademy.com or .co.uk. I'm sure it's going to redirect you to the same place. But if you're in any of our areas, you can register and come take a free class with us. I'll go to our website actually. We also are online, so if you're like, man, I'm not anywhere near one of these centers, but I'm very interested, we have online classes as well. And so there's self-paced ones. We also have live, which is like kind of what we're doing right now, which would be kind of that webinar type setting. But the thing about the Academy, and I love being a part of the Academy. If anybody asks me, well, what do you do? I'm a trader first, and I also work here, on the side, type thing. I just love the community. John O'Donnell, Merlin. It's just everyone here is just so passionate about just trading and making money in the markets, and so our students can take our classes as many times as they want. So it isn't like, oh, I didn't get it the first time, I didn't get it the second time. You can just take it over and over again. I teach Forex, and there's probably 8 or 9 other kind of Forex instructors that we have. And so, obviously we're all going to have our own little, we all have kind of that same main strategy. We're all going to have little different approaches and nuances that, people just pick up. So maybe you take the class, with a different instructor, multiple, and so it's just, it's cool. We have, not only do we have online classes, but we also have, as far as resources are concerned, we have all sorts of, here's like Hour with the Pros. We have all sorts of webinars, Power Trading Radio. Every single day we host a 30-minute show on what, the market, what's going on in the markets. I actually on this show quite a bit. I don't know if it's any of these my shows. No. Yeah, so you can kind of. This is Merlin. Anybody know? I keep saying this Merlin. This guy, right here is the host of this show. He's in office a couple doors down. This guy right here, who's holding the head. That's John O'Donnell. Very, very smart traders. You can read all about us. Here's our instructor pool. You can read about all our instructors. You can read our reviews. Just so you guys know. Here I am, so you can put a face to this voice. Yeah.
Yeah,
I know.
Did I read in your bio that you're ex-military, David?
Yeah, actually, I spent I don't really bring it up that much. I just did it for very I did it for selfish reasons to pay for a college education when I had a young daughter. So I was in and out. I did my time, got my college degree, then I went right into the financial industry.
No, I just going to sort of draw a connection because several of our speakers, and it's quite common. The military influence on trading, the discipline, the military seems to instill. So I just wondered if that was the case with you.
I loved every day that I had in the military. I think that as far as just the discipline and all of that, without a doubt, I think that it definitely teaches some life skills that definitely are good for trading, no doubt.
Fantastic.
Yeah.
Well,
I was just going to say, you can just come to our resources, learn a little bit more about us, Online Trading Academy, and you can register for a free class. Maybe you just do it online, and then you can learn a little bit more about us that way too.
Fantastic. Well, we'll follow up in our we tend to send a few emails following these events to all the attendees, and we put all these links that the speakers have discussed in there as well. But John's one of the regular contributors to our newsletter as well. I think we linked to that weekly show that he does with Merlin on the Monday newsletter now. So no fear people not being able to find you, which is great. Well,
great.
David, thank you very much indeed for joining us. You brings us right up to almost 9 o'clock here in the UK. So unless there's any final questions or you have anything else to add, we'll probably draw it to a close.
That sounds great. No, I appreciate you. It was nice, speaking with you guys. Hopefully, you guys learned something about our time together.
We have indeed. Nice comments that are just coming through the chat box now. Thank you again. Another great presentation. Thank you. Fantastic. So great. I'll just add my thanks to them. David, it's been a privilege to have you on. Many thanks indeed. Perhaps we'll speak again if you're available. That would be good. But,
okay.
In the meantime, we'll let you carry on.
All right. You take care. Have a great evening.
Andy, bye-bye.
Thank you. Bye.
And there we are. That was David Warner from Online Trading Academy, all the way over there in sunny California. So that concludes our Round the Clock Trader today, 25th of August. And thank you to all of you who have stayed on to the bitter end. A lot of familiar names, and it's been great to have you. As I say, August is a funny month. We weren't very sure whether we should have done one or not, but I'm very glad we did. Because it's been a very active day and always good to keep the activity going. So thank you all for your support, and we will get busy processing these recordings and have them with you by tomorrow. And if there's anything else that you need in the meantime, please don't hesitate just to drop me an email. And thank you for the tips to some new speakers. I will get in touch with them just as soon as I can. Next event, which will be the 22nd of September, which is the Thursday again, 22nd of September. Then, of course, we've got our Round the Clock Trader Live for those of you that are in the London, southeast of England. You can get to London physically Saturday, the 5th of November, and the Grand Connaught Rooms will be our get-together. So, thank you to everybody, and I think we'll close it down there. So thank you and good night.